the companies, owns nearly 54.93% in Nuvama, putting its stake, the value of its stake at almost 10,580 crores. The timing of the deal is not yet known. It depends on how the market conditions pan out. But sources further add that rival PE firms focused on financial services and who have the ability to cut big checks could be contenders for acquiring this stake. So, given that development, going with the green for this counter.
Okay, all right, Vamakshi, thank you very much for that. In fact, let's take the story forward with Ashwin Mohan of Money Control, who's actually broken that that piece of news around Nuvama. Ashwin, morning. Good to get you on the phone early in the morning. Deal action with Nuvama. What's happening and how much is the stake? Because, I mean, after buying it out from the erstwhile promoters, Mr. Rashesh Shah, PAG was pretty much, owning the largest chunk of equity in the company. So what's the game plan?
Right. So this is definitely a big deal that is brewing in the wealth management space. PAG had made this investment about 4 years back, and that's when it had picked up a majority stake. And now what sources are telling us is that it's in exit mode and is looking to unlock value. So what our sources are telling us is that two top banks, JP Morgan and Morgan Stanley, they have been roped in. Work on the deal has begun. But the timing of the deal launch, of course, will depend on market conditions, considering the current volatility. Now, if you look at the value of the stake that is held by PAG, it holds about a 54.93% stake. And based on the market cap at the end of day's trade on April 7th, that stake was worth around 10,579 crore rupees. So clearly a big deal brewing over there. Also keep in mind that Nuvama Wealth Management was listed on the bourses back in September 2023, and that was following a demerger and restructuring process. The firm's share price has doubled since its market debut. Sources are telling us that a slew of private equity firms are likely to, express interest in this proposed transaction. Many of them who are focused on the financial services space and those who have an ability to cut big checks, and especially those who do not have a presence in wealth management, they are likely to express interest in this big deal. About 3 years back, we saw two big transactions in the wealth management space. Blackstone acquiring a majority stake in ASK, and Bain Capital picking up a stake in IIFL Wealth Management. Let's see how this one pans out in the days to come. Volatile times, but definitely deal action is continuing.
Absolutely. And Ashwin, now we are talking about the entire 54%. I mean, they want a complete exit. It's a matter of whether it's in tranches or in one go. Is that what you're picking up?
Yeah, what I'm picking up is that they're in exit mode. So there are two options. One option, of course, is to exit and sell the entire controlling stake to one single buyer. Or, of course, in the past, we have seen that when these big controlling stake transactions don't work out, then they always fall back on the second option, which is, of course, you can sell it through a series of block deals.
Got it. Got it. So they want to exit fully. It's a question of whether it's going to be in a single shot or multiple deals. Thanks, Ashwin, very much for that interesting story. With that, let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them are Titan, BEL, Global Health, Nuvama Wealth, Godrej Properties. Now let's talk about the ones that have some negative news flow around them. IOC, BPCL, HPCL, of course, on the oil and gas developments. Sobha and PN Guardgale on slightly weak Q4 updates. And with that, let's now head to the commodities universe, find out what's the latest. Manisha Gupta is joining in as always. Manisha, some calm and some green, at least on the equity side. What about commodities?
Oh, that's exactly what we are seeing in the commodity markets as well. So some respite and some technical buying possibly in the overnight markets here as well. If you look at the crude oil price as well, we gained 1% overnight. And with that, we are back above 65 for Brent and above 60 or even 61 for the U.S. crude oil prices. Well, there is technical recovery, especially after the prices did decline 15% in last 4 trading sessions and hit a 4-year low when it comes to crude oil prices. While the tariff concerns still are on, but the markets also are taking a cognizance of the fact that the U.S. shale production break-even cost is at $60 a barrel. Anything below that wouldn't really work well for the drill, baby, drill slogan that the U.S. has been working on. Also, take a look at the kind of volumes that we are looking at in the Brent prices. Record high numbers on Friday and on Monday as well. Remember, Brent crude is 75% of the international traded crude oil, and we are looking at very strong, very heavy volumes onto this one. A quick word on metals, and we've seen some bit of a buying coming in here. Off lows for copper, aluminum, zinc, there is a bit of a buying here. Even silver prices gained up by 0.5%. What hasn't done well in last 12 hours in the New York session has been the gold prices. We saw not just 3,000 break, but it went down to 2,955 as well. So nearly 4-week lows in case of gold, but the other commodities seem to be doing slightly better. So clearly some risk on.
All right, Manisha, thank you very much for that. We take a break. We are back. Amnish is with us. On the other side, we talk stocks. Stay with us.
Welcome back. Hope you're having a good morning. Well, for starters, at least it's going to be far more green than you were expected when you went to bed last night, because the GIFT Nifty is suggesting that maybe we see a 350-point pop-up. And keep in mind, in yesterday's trading session, we pulled back close to 300 points from the low point of the day. Amnish Agarwal, the Director Institutional Research at Prabhudas Lilladher Capital, joins us on the show. Hi, Amnish. Thanks a lot for joining in, and good to see you in as always. We've got a couple of quarterly updates that have come in. Titan, it looked a little bit positive. What's your view on the stock in the backdrop that we had Kalyan as well that reported pretty okay numbers?
The Titan sales were really positive. You look across whether it is jewelry, whether it is watches. I think the growth rates of 20-25% they are really positive. The only concern seems to be the mix, because last year they had studied activation, and this year, consequently, the ratio of studied has gone down. That is one, and even coin sales are up by 65%. So while I think on the sales growth front, they have done well, but I think the same might not translate into margins. So overall, I would say a pretty healthy set of numbers, given that the gold prices, they were actually continuously moving up during the quarter, but they have got the benefit of, I would say, a very strong marriage season. So I think in the current context, I would say reasonably good set of numbers, but definitely the profit growth will be significantly lower than the top line growth which we have seen in this quarter.
Okay. Amnish, hi, morning. Oil marketing companies, it's all over the place. This math get really confusing, but now we know. Government is boosting its collections with excise. How much they give back to the OMCs in the form of making good those LPG losses, we need to see. And then separately for this year, for running LPG losses, now there's a 50 rupee relief because it's been passed on as a hike. What would your call be on oil marketing companies?
You see, this typically happens when the crude oil prices actually they go down. Then the government collections of the revenues, they also take a hit. And we have seen in the past also that the government actually takes a part of the gains in the low crude prices by way of the increase in the excise duty. And so to that extent, it is no different. But definitely, if you are looking at that the entire decline in the prices of crude will translate into the gains for oil marketing companies, so that has never helped. But having said that, I think the way the crude prices have softened from close to $75, where they were quite stable, to the current levels, I think it does leave some room for the OMCs to make incremental money. But having said that, I think that the situation currently is too volatile, because markets or the crude or commodities, one day they are going up and the other day they are going down. So I think to that extent, it is very difficult to take a call, in my view, at this point of time. It will be day-to-day movements depending upon how the crude prices and commodities behave.
Okay, all right. Amnish, given that the global backdrop is a little bit volatile, all eyes are going to be on domestic plays. Any top bet that as a house you are looking at, which will be reasonably protected from all this global volatility, and that would be the top pick that you all are advising your clients?
Nigel, we have to look at it in two contexts. The bigger thing is that if it's a situation like we had faced during the Lehman crisis in 2008-9, although I believe that if it actually plays out, it could be much more severe in terms of impacting the markets or the economies globally. Then I think it is not long before it will start impacting the domestic sector also. May not be immediately, maybe say after some time. On that backdrop, I think the way we are currently poised, I think there are some domestic-oriented sectors. For example, if you look at, say, hospitals is one segment which we are very confident about. The second is some of these defense companies, like, for example, in hospitals, particularly, you can look at, say, Max Healthcare is there. Apollo is also, I think, reasonably good, and so is your Aster DM. In case of defense, I think particularly Bharat Electronics, which we have been, I think, very positive about, where the news flows are positive. And the stock also is showing strength relative to some of the other stocks in the sector. In addition to, I think, select consumer names also one can look at, but with moderate return expectation and more from the defensive side. So I think these are the three. I think as of now, these three look to be better in the current context.
Okay. All right. Amnish, stay on with us. We'll just quickly move over to look at some analysis now. Speculation of some sort of tariff pause circulated on social media yesterday, and this is what caused a massive whipsaw in stock prices before finally the White House had to come clean on it, and they called it fake news. But it's a swing of almost 2,600 points on the Dow. Prashant has more.
Well, thanks very much for that. You know, what does it take to move trillions in global markets, right? As last night we saw, all it needs is just one headline, and that too unverified, and as markets found out later, a fake one. Now, this is a story of how sentiment whipped in minutes based on pure speculation and nothing else. Let me tell you how this played out. Even as equity indices were starting to recover from the lows, rumors broke out on Wall Street that Trump may announce a 90-day tariff pause for all countries except China. The headline was picked up and flashed across news networks, and Wall Street went vertical. The S&P 500 added over $3 trillion in market capitalization from the intraday lows. I mean, in terms of percentage gains, the Dow was up 7%. I've taken lows to the high. Remember, some part of it, of course, already happened, and market, as I said, was already recovering when these headlines hit. S&P went up 8.5%, the nasdaq rallied 10%, all in a matter of minutes. Well, but you know, in a matter of minutes again, but minutes later, came the first crack. Reports said that the White House was unaware of any such move. The White House officially denied the story to CNBC, calling it fake news. And almost immediately, the market went south, giving up all the gains it had accumulated a few minutes prior. In all, trillions of dollars, you know, by some estimates, $5 to $6 trillion swung on the back of this headline, this fake headline, in less than 30 minutes, driven purely by hope, greed, herd behavior, and just general sort of anxiety. What are the lessons here? And I think the lessons are very true for our markets as well on a daily basis, but I think in markets like this. You know, this is a market where there is extreme emotion. Markets are in a fragile state. Number one, you can't take headlines at face value. Please investigate sources first. I think that is paramount. It has to come from credible news sources, not an unverified Twitter account without any backing. Also, it kind of helps to say a bit cynical, especially in markets like this, unless proven otherwise, even if a short-term bounce cannot be ruled out. I mean, I think it just generally helps. Bring me proof. You have to have proof before you decide to act because there is real money at stake. And of course, as always, remember, short squeezes in bear markets, or I'd call it this bearish markets, can be vicious. I mean, they can be absolute rippers like what we saw yesterday. To wrap it up, I was wondering, right, and I think many are as well, markets were down sharply 4, they went up 4, so 8%, but they did not go down 4. We ended flat. Why is that? Why is that? And the reason perhaps is a little tongue-in-cheek, but, you know, maybe the thinking, at least among some market participants, is this: imagine if a fake headline can do this to markets, what could a hypothetical real headline of some sort of relief do? So maybe better to be a little light. The simpler explanation, of course, I think is also in the mix that markets are much cleaner. We've had 2-day historic falls and people just want to stay a little light. So I think that is what we are looking at this point in time. So that's the story. These are markets which are moving much faster than facts. So be careful out there, because this is a story which is not wrapping up quickly. And headlines, well, as they are important, they need to be real, verified before you jump in, take positions one way or the other. Back to you.
All right. Prashant, thanks very much for that indeed. I mean, it was absolutely haywire going there on what eventually the White House called out as fake news. That's equities. Of course, commodities have also been reeling under pressure, whipsawed left, right and center, up and down because of all the tariff headlines. So let's focus on this recovery that we're seeing this morning. We have with us Peter Maguire, CEO at trading.com, for some thoughts. Peter, I wonder how your last couple of days have been. How are you feeling? And, for the oil markets this morning, again, we're seeing some recovery. We're seeing about 64, 65 back on Brent. But China's retaliating. I mean, and that war of words is only escalating. So if you're looking at a real trade war between China and the US, then is oil already at the base now with this decline? Or do you see more downsides?
Well, good morning, Surabhi. I mean, what we've seen since Sunday night Sydney time, it was electric, because the markets come on and you saw the futures and it just went absolutely cratered. And then, as Prashant said, that big swing that we saw yesterday on that news, which wasn't actually news, then that really demonstrated, I think, the sheer volatility. Now, the energy markets, you've had them, when we think about what we've lived through, we've got President Trump threatening, and he's really looking at, additional, as it says there on the screen, 50% to China. China's coming out and it's not backing down either. So this is going to be a very, I think, incredible geopolitical situation, how it plays out. I don't think energy's down 15% off in a week. I feel as though it's had a bounce, and it's no doubting that. But I think it's absolute. I think the velocity of what we saw, and it is in a downward trend. I expect energy prices to actually go lower than what they are at the moment.
Oh, gosh. So you're saying even after 15% decline, it's not all in the price, if indeed this is a full-blown trade war. So how much lower?
Well, I think I've got to be considerate as far as what OPEC mentioned last week. There's the first part. I still think it's got a mid-50 handle. I'm seeing, the guys that I talk to and the teams that I talk to across Middle East and so on that are independent oil analysts, many are calling 45 could be the handle. I'm not prepared to go that low, but I still believe that NYMEX, WTI, it's got to have a 50, 57, 56. If it gets through there, then I think you're going to see a push lower. But we've just got to get to that sort of number. But I feel as though that downdraft is going to continue. But again, there are many ways to get there. The volatility that we've seen, it could be up another 3 or 4% today, and it could be off 6% tomorrow. Who knows?
Mm-hmm. Hi, Peter. Morning. Always good to have you on the show. What about gold? It was glittering all along, and then, this sort of a meltdown and some strength is what we have seen on the dollar index. Gold has pulled back as well. Where is that one headed?
Yeah, you betcha. 102.90. Lovely to see you, Nigel. What you've seen, 102.90 for the US dollar index. Gold sitting, 3,010, 3,015. It certainly was sold off, and there was no doubting that. Silver as well, down to $28 from, this time last week, I think it was near 35. So it was really cratered, and silver's bounced as well. It's back up at $30.10. So I feel as though you would have had, don't forget, as Prashant mentioned, you have to take on board, there would have been algorithmic trading and a lot of margin calls yesterday, and that would have really impacted with big swings, people having to liquidate positions. So gold was probably, I would say, liquidated. You've had a big push down, and I think that, it will resume its upward trend, but they're in these times of much volatility, and that's what we've lived through in the last matter of days. It's not unusual to see every asset class get tanked. Have a look what happened to the 10-year. It was down at 389. Now it's up back at, that 415, 420 sort of handle.
Okay. All right, Peter. Thank you very much for that quick analysis. Let's see what the next couple of hours and days bring. Thank you for joining in today. Let's take a break, come back on the other side, and it's all technical. Sudarshan Sakhani and Mitesh Thakur will join in with the trading views of the day.
esteemed guests and friends, above all today, we express our deepest gratitude to our visionary Prime Minister, Shri Narendra Bhai Modi ji. Pandit Deen Dayal Energy University owes its very birth to his
Welcome back. As we have been mentioning, for starters, we're going to start off gap up. What do you do from there? We have our technical experts who join in, Sudarshan Sukhani as well as Mitesh Thakkar. Good morning, gentlemen. Always good to see you all in. Sudarshan, you go first. What do you do today? If you get a 350, 400-point gap up, what do you do? Take money off the table if you had a long position?
Yeah, good morning. See, today is a much better day. Yesterday, the Nifty, not the US markets, but the Nifty printed something that we call a one-day reversal or an exhaustion day. They both come to the same point that the markets went down, rallied from the lows, essentially finding strong support and closed near the highs. That's at least giving us a sign that a short-term low is in place for the Nifty. If that is so, then I would be a buyer. Now, if somebody was lucky enough or wise enough to buy yesterday, then the gap up gives you an opportunity to take profits and re-enter. The trend is now likely to be up at least for the next few days. So for those who don't have a trade on the long or short side, as I don't have, the trade is to wait patiently for minor corrections in intraday corrections and go long. But essentially go long in the Nifty and in the Fin Nifty, the financial Nifty. Both are giving attractive opportunities.
Okay. All right. Go long in both the Fin Nifty as well as the Nifty. Got that, Sudarshan. Mitesh, what about you?
Rajan, I think, yesterday, the breakdown which happened with the gap, didn't see follow through post the first 1.5 hours. Yet, I think the structure will not improve immediately. We yesterday suggested taking some bear spreads on the index and, basically buy the 22,000 put and sell 21,500, 400 puts in some ratio. So you recover most part of your premium. Therefore, you have a situation when, in case the market keeps going up, your loss is very minimal. And in case it declines, I think, then you'll make some money unless the decline is very big. So we'll continue with that position. But on the stock side, yesterday towards the late afternoon, we saw good reversal. So I think what I'll do going forward is that on the index, we'll maintain some bear spreads and we'll look for long opportunities on the stock specific basis. On the Nifty, I think 22,600, 22,800 are my targets. Only if we start trading above 22,800 and the gap is filled, then we'll turn positive. But otherwise, we'll maintain that put spread which we are carrying.
Oh, okay, all right. Positive on individual stocks, but you believe that the Nifty has firm resistance at 22,800. Did I get that correct, Mitesh? Mitesh?
Yeah, that's right.
All right. All right. We're coming back to you for your calls. For the time being, we slip into a short break. We come back, we'll get pre-open rates. Our technical experts will give them their calls as well. And also, we'll have Praveen Sahai of PL Institutional. He'll be giving his view as reports suggest the government is set to tighten refrigerant regulations. Stay with us.
Vision. All of you are benefiting from what Narendra Bhai thought in the early 2000s. And when he called me and said, in 2005 that we have to build one of the finest institutions in Gujarat, right? And that is what we have achieved from 2007 onwards. So we will always be grateful to our Prime Minister. Long before he became Prime Minister, he foresaw that India needed Atmanirbharta in energy. Over 20 years ago, he told me he wanted Gujarat to lead the nation in energy and energy products. He also told me that Gujarat should take the lead in cultivating world-class human resources needed to achieve India's clean energy ambition. That is how he helped establish this pioneering university. Friends, there are
Okay, welcome back. Let's just quickly run you through the picks which Mitesh and Sudarshan have. Gentlemen, morning. Prashant here. Mitesh, you go first. What are your trading ideas?
So, Prashant, I've given calls on stocks on the long side, adjusting for some kind of a gap up opening, which the GIFT Nifty is indicating. So, Colgate is something, which I like. It's showing signs of bottoming out. So, if it starts getting past 2400, buy with a 20-odd point kind of a stop at 2378. Look for targets of 2470. Similarly, so in a weak market, delivery did very well yesterday. That's the buy above yesterday's high. So 271.5 is the trigger to buy. Then take a stop at 264. Look at targets of 285. Indus Tower is a very similar kind of a call. Buy about 361 with a stop at 355 for a target of around 375. And Bajaj Finance is the final buy call. Keep a stop at 8,500. Look for targets of 8,850.
Got it. Okay, all right. Thanks a lot for that, Mitesh. Well, let's hop across to Sudarshan. Sudarshan, what are the picks you have for us?
Well, it's almost the same pattern as Mitesh had, all buys. I'm not giving stop loss levels because, it's very difficult to say where the markets will open. So the theme is that these are 4 stocks where buying is suggested for today and for a positional view also. Chambal Fertilizers, then Maruti, and I have very small long positions in Maruti, option spreads, Hind Liver and Dixon. So there is a spread all across different sectors. I would feel that every dip now represents an opportunity to go long.
Okay, all right. Thanks a lot for that, Mitesh, as well as Sudarshan. Well, as promised, there's lots to talk about, in the consumer and the durable spaces. Well, we have Praveen Sahai, the research analyst at PL Institutional Equities, who joins us. Hi, Praveen. Good to see you, Ben. Well, we want to talk about the government looking to tighten refrigerant norms as well and match global standards. But I need to ask you about this. Various reports indicate that Apple is looking to send more iPhones to the US from India in comparison to China. Any listed entity that you believe could benefit from this if this is to happen?
Especially for an Apple thing, definitely, there is not any specific listed entity which I believe is going to benefit much of that. But on the refrigerant gas, also want to highlight that this refrigerant gas accounts for around 5-6% of a cost of a RSE, room air conditioner. So that is not too much. And if there is a price increase of refrigerant gas, it will not much impact the cost for the RSE. So I'm not so worried about the refrigerant gas prices increase, which will directly impact any demand.
Okay, got that, Praveen. Talk to us about your coverage universe and how you're feeling about, that pack. What is risk reward looking like? What's the environment? Go on.
Yeah, right. So in the coverage for a consumer durable space, we are liking the wire and cable companies, and there is a significant correction because of increased competitive intensity, which is expected to come in, as well as the market correction. So one name which has corrected quite significantly is a KEI. Now it's trading at around 23 times, corrected from some around 45 times. So that is looking very good, and their earnings CAGR is also nearly around 23-25% from 25 to 27. So it's looking better off at this valuation and return risk reward scenario.
Okay, all right. Praveen, just to revisit that point, if with Apple trying to change their sourcing more to India in comparison to China, any EMS companies, they would have the potential to benefit in the time to come?
Yeah, that's a volume is very large, and if they will shift from the China to India, definitely we have a direction which already there in the that's a mobile assembly manufacturing. So definitely they are the one of the potential beneficiary of that. As well as some of the names like who are doing the PCB assembly, especially in this segment. So there are some listed, unlisted players as well. They also can benefit from the component side.
And absolutely. Nigel, we've spoken to Dixon and we've asked them many times what will happen if, because they are only in the Android ecosystem. They are the market leader in phones. But Apple, of course, they don't cater to Apple. I mean, actually, there is no, as Praveen said, nobody caters to Apple.
Yeah.
But if they're able to crack through Apple, I mean, of course. But I don't know, is there a confirmed news that Apple is looking to do this?
It's a report today. You know, when I woke up this morning, we saw in that report. So
news report.
News report, sir.
Yeah, so news report, then we'll have to be a little careful because, you know, it makes sense, but, you know, it's always made sense for Apple. And they've said, right, 25% of output from India over the next few years. But, of course, that's a huge ecosystem. And as Praveen said, Dixon perhaps and many others would benefit if that shift were to happen in that sense. Okay, all right. Let's talk about a few other names. You know, the consumer durable names, Praveen. You mentioned KEI. Any picks here on the durable side?
So on the consumer side, the two segments, electrical consumer space and the durable space. And in the durable, we are still seeing that the RAC demand is at a peak. And also the like of a name Voltas or even the Lloyd or Blue Star are getting a benefit of that. And I'm continuously repeating that whoever going to maintain their market share and the margin profile both are that name is a clear winner. So here I can see that the Blue Star is a better placed as compared to the peer set. That's they are maintaining their market share as well as the margin profile. And so that's the only concern what I look at for Blue Star is little stretched valuation. So otherwise, on the fundamental side, number side, Blue Star is expected to do well. On the electrical space, in our channel check, we also get to know that fan channel inventory has been a very good, and that's indicate the primary sales of the fan has been good for a fourth quarter, as well as we had heard that and get to know that the 2 to 5% of a price hike. So that is also going to benefit the ECD players, especially the Havels and the Crompton. Who are the leader in the different segments of the fan category. So I believe that even their base is quite high for last year fourth quarter, especially for the ECD growth. On that, the high single digit, double digit of a growth looks very good for them. And also, you know, if I look at the Havels currently trading at around 41, 42 times FY27 earning, that is also looking better up post the corrections. But as I said, in the entire pack of a consumer durable, wire and cable looks better off in terms of the growth in the earning as valuation current.
All right. Thanks very much, Praveen. Appreciate it. Good to get that perspective. Well, the flash at the bottom of the screen, oil companies to mop up 9,000 crores in FY26 by LPG price hike of $50. That's coming through, and they're going to seek a cabinet note in due course to seek the 32,000 crores in compensation to OMCs as far as LPG losses in due course. That's essentially, the point which is coming through. Stocks are starting. OMCs are
all higher, yeah.
Not feeling the heat. The title. OMCs are feeling some relief, I guess. 2% up, slight lifts higher, 1%, 2%. At this point in time. Let's, I think, look at the market, the pre-open as well. I think we've come to the close of the pre-open. Makes sense to look at the Nifty and how we've settled down. And we should be able to get some 9-10 calls out of the way as well in a bit. I think, I think we have Mitesh and Sudarshan with us for that. Mitesh, you want to start with your call and then a quick view on these IOC, HP, BP, any clear trades here?
So I think, the 9-10 call for me would be a buy on Colgate for about 2,400 for targets of 2,470. And so I think, the way crude prices cooled off, I think even I was considering Indigo as a bet, apart from the obvious, the oil refinery stocks. And Indigo did cover up most of the ground yesterday. And the last swing high was around 51.26 and the stock is about 5,000 yesterday. So in case we start getting past 5,100, I think Indigo could be very good. That apart, I do like IOC. I think 132, 134, once that level is being cleared, I think there's clearly a long trade.
Okay, all right, got that, Mitesh. Let's come to Sudarshan as well. Sudarshan, what would your 9-10 call be?
Well, it will be Chambal Fertilizers, and I can now give a stop loss. Keep a stop somewhere around 590. It's a day trade as well as a positional trade.
Okay. All right, Sudarshan, got that. Thank you very much, gentlemen. So the pre-open has finally settled down with a gain of about 285 points on the Nifty. That's about 1.3% higher. And mid-caps could do even better, looking at the rates on the screen right now. Let's actually play out sound bites from that conversation that we were having with Prashant Jain yesterday, a market veteran who's seen several cycles and many of these, global sort of issues play out as well. He's saying India's share of manufacturing goods to the US is just 2%, and hence the impact of tariffs should be quite small on India. He's, of course, the founder and chief investment officer at 3P Investment Managers. Listen to what he says. Where does India stand in this global Trump tariff storm?
India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly.
All right, so that's Prashant Jain on the India impact, which he says should be fairly limited from here on. A couple of pharma stocks are in the news. We've got Vinny quickly rounding them up before we hit opening bell. Vinny?
Good morning. So yes, a couple of pharma names, specifically the CDMO players, where Goldman Sachs is initiating coverage on both these stocks. One is Suven Pharma and the other one is Piramal Pharma. Talking about Piramal Pharma first, buy rating, target price of 275 rupees per share. They believe Piramal Pharma is quite well placed overall in their coverage, and especially CDMO players. And they believe this company could see a good growth in terms of operating profits as well as financial side as well. They're expecting good performance coming in. The PBT margins, they expect that to see a jump coming in as well from 3% in FY24 to around 16% is what they're expecting, more than 16% in FY28. And what will be the driver? CDMO, overall, this business, three segments are there for the company. So CDMO business, that is expected to see a good sustainable growth FY26 and onwards. Complex hospital generic business, that is expected to see capacity ramp-ups that will support the growth for the company. And India consumer healthcare business also is expected to see a turnaround. They're expecting that Piramal, will see a very good growth in terms of EBITDA margin as well, because the company is aspiring around a 30% EBITDA, 25% EBITDA margin by FY30. So note coming in on Piramal Pharma. Suven Pharma initiated coverage on this one, buy rating, target price of 1,350 rupees per share from Goldman Sachs. They're expecting a strong rebound and a structural growth starting from FY26 and onwards. And they're saying that there could be a turnaround in agriculture chemical macros as well, and expecting combined entity EBITDA to compound at 20% plus CAGR growth in the medium term. So positive signs there as well.
All right, it's a 300-point higher start. Vinny, thanks for that. 22,481, 1.5% higher. The Nifty Bank is up on 1.3%, 50,550. The small cap index is starting about 3% in the green. So it's all between 1.5 and 3. The mid cap index will also come up on your screen. It's almost again about 3% higher at this point in time. And the Nifty heat map will give you a quick sense of how we are starting. So it's getting up to about 400 points now on the Nifty. So 22,541. The 20 hourly average comes in at about 22,710, 700 roughly. So we'll see if we are able to get to that. The heat map is all green. It's exactly the polar opposite of what we saw yesterday. Yesterday it was all red. It was all green except one sun, which is slightly lower. Surabhi.
Okay, let's talk about stocks. So in this 400-point up move, the leaders would be BEL. BEL also announced a pretty big order win from the Air Force yesterday, over 2,000 crores, 5% up on that stock. Some of the names like Tata Steel, JSW Steel, Hindalco, the metal guys are recovering after yesterday's brutal sell-off. Titan's update is flying well with the street, 4.5% up on that stock. There is some relief on IT names like Infosys as well this morning, 3% up on Infosys. Other large stocks worth mentioning, Axis Bank, L&T, 2 to 3% on these names as well. Trent, which was down under big time yesterday, 15-16% drop, finally recovering about 3% of it. Actually, I don't think there's any Nifty stock on the negative side. No, there isn't. The least performing one actually is HDFC Bank, which is up only 0.5%. ITC, Lever, all the stocks, all Nifty 50 constituents positives. It's a positive start as we expected. Let's see what happens from here, Nigel?
Well, that's right. A few stocks, though, that are coming on your radar. Godrej Properties, the quarterly bookings crossed 10,000 crores for the first time ever. So that stock is up and about. And remember, real estate will not get impacted from the global headwinds, at least as of now, because it's more domestic facing in nature. So real estate index is up. Godrej Properties is up 5.3%. Shobha, the sales value is up close to around 32% on a sequential basis. It's up close to 22% on a year-on-year basis. For FY25, the sales value is down by close to around 5.5%, coming at around 6,300 crores, which is a little bit lower than the previous year. For the time being, though, the street has seen through that. That's up close to around 3.5%. As I mentioned earlier today, if the markets are going to bounce, the indices that get hit the hardest, well, they are going to do well. So the metal index is up and about, the tech index is up and about, and from the tech space, the mid-cap companies, they are seeing a bigger bounce. Cyan, there was a fair bit of action that we saw in yesterday's trading session in terms of large trades. So that stock is up. Persistent as well is up close to around 3.5% or thereabouts. So both those two stocks flying away. MCX, we pointed this out earlier today, that because of the volatility we are seeing in commodities, the volumes yesterday were the highest we have seen in very, very long. And it's much higher than the average turnover that we've seen in the last few trading sessions. So yesterday, MCX recovered close to around 10% from the low point of the day. And today, it gaps up with a gain of close to around 4% or thereabouts. Stock market related plays like Angel One, that one as well is up close to around 4.5%. And BSE, the last few expiry days, their market share actually has been increasing on Tuesday. And if I got that number correct, the last Tuesday, the market share for the options data, that was at more than 30% or thereabouts. So that's why the street likes that as well. Today as well, there'll be a weekly expiry. So BSE and MCX, both of them flying away in trade.
All right. Well, it's all up. 2,000 stocks are higher and about 150 stocks are lower. That's the advanced decline as far as the NSE is concerned on an overall basis. And 22,500 plus is where we now stand at. So let's, yeah, I mean, actually volumes are still yet to pick up. I mean, I can spot only about 4-5 names with large volumes, really large volumes. And then it really drops off very quickly. And I think yesterday also it was the same. A tariff headline a day keeps volumes away. It's like, it's uncertain. It's very difficult to kind of call it one way or the other. So what do you do? I think that is also, of course, at play. We have our market master today, Gautam Dugar, Head of Research, Institutional Equities at Motilal Oswal Financial Services. Gautam, great to have you with us here on the program. Prashant here. So I saw your report and I liked the front page, the picture. All Trump and his top officials sitting on a tree branch, cutting the branch while they're on the branch. So it's like self-inflicted, right? Drives home the message pretty clearly. But what is, that's a fourth quarter earnings preview. I think as we start to talk to companies, it's backward looking, right? Q4 in that sense, that everything is happening forward looking now, especially with tariffs and what can happen. How are you thinking about this, Gautam? Because you write that massive uncertainty, if there's a full-blown war, not many sectors will escape, but there are also some opportunities in some sectors that can play out. Go on.
Hi, Prashant. Good morning. Thanks for having me. Yes, earnings will be slightly less relevant this quarter because people will be looking more at cues for numbers ahead and how the corporates in different sectors are dealing with the situation which is unfolding right before us in the last 4-5 days. It's very hazardous to make any guess as to how these things will evolve. Suffice to say that even the corporates right now, whomsoever we've been able to speak with in the last 4-5 days, they're also grappling with this situation, trying to assess the damage and what kind of changes they need to make in their supply chain, in their pricing. One thing which is very certain right now is that the uncertainty is going to remain for quite a period of time. And therefore, it will have a serious bearing on multiple things, which is the growth, second, the visibility of the corporate earnings itself, and third, as a consequence, therefore, the impact it can have on the equity risk premiums. Typically, you would have seen in episodes of such global uncertainties, which is basically not natural, but man-made, then the equity risk premium takes a knock. And that is where I think we've not been used to in the last 4-5 years. The post-COVID world has been very benign in the sense that liquidity was ample, The governments across the world were pumping in money, lifting the growth rates. India itself has seen a massive corporate earnings cycle post 2020, and that also lifted the valuation multiple across the indices. So everything was coming together. And of course, all of this was contextualized by a very benign macro and a very robust balance sheet across the corporate world. Now, one by one, a lot of these things have started unraveling. FY25 give us a hint of some bit of a corporate earnings slowdown. The reasons can be anything, because the government spending slowed down, and then you had a big urban consumption slowdown. Capex started coming off. And now to add to that, you are seeing a new global headwind, which is just about, by the way, started. So very difficult to take a view at this stage. The approach, in our view, should be to limit the damage to the portfolio as much as you can and hope that the situation solves itself over the next couple of weeks or months. That's how we are placed right now. Amidst all of this, one silver lining is that a lot of the macros have started shifting in India's favor. So dollar index, which was 111 in Jan, is now 103. Crude prices, obviously, everyone is aware. They've gone off. Your 10-year yields are quite benign right now. And large cap valuations have corrected a whole lot. So the backdrop for long-term returns, the foundation is being laid with the caveat that it's very difficult to predict what is going to happen in the next 3-6 months.
Yeah, no, absolutely, Gautam, take that point entirely. But I want to sort of narrow this down to what we can, tabulate and discuss in terms of numbers, and that is the earnings trajectory, right? We don't know what's happening with Trump, and we don't know eventually where the tariff levels are. Let's leave that aside. Let's park it aside because it's anyway a very small proportion of India's GDP. Let's look at corporate earnings. FY25 was a washout here. I think most estimates, I believe even yours, are around just 5-6% growth for the Nifty. I was going through a Nuvama note as well, and they're saying that FY26 full-year expectations are at risk. I believe even you've slightly trimmed your estimates for FY26. Where are we on the earnings recovery trajectory?
So, Surbhi, look, FY25 is ending absolutely flattish on EPS terms. While on absolute basis, the earnings are up 5%. In EPS terms, the earnings are up just 1% for Nifty. So we ended FY24 at 1,006 rupees. We are about to end FY25, if this quarter's estimates are met, at 1,017 rupees, which is just about a 1% growth. Now, if you look at April 24, when we were first projecting April 25, March 25 numbers, we had projected an EPS of 1142. And all the way down, we are now at 1,017. So there has been about 11 to 12% earnings cut. Similarly, for FY26, right now, we are at 1157 rupees. Now, this number was close to 1,300 rupees a year back. So concurrently for FY26 also, the estimates were cut. I agree that FY26 earnings estimates are also at risk because there are several sectors like IT, commodities, pharmaceuticals, where numbers can change multiple times as we move forward. If you look at the clean earnings excluding commodities, last year Nifty earnings have grown 9%, that is FY25, and we are projecting 12% earnings growth for FY26. One thing that looks quite okay right now is that 26 can be much better than 25. Sure, the base effect can play out there, right? But yeah, there are going to be a lot of intersectoral changes which will unfold depending on first order, second order impact of the global trade war, which is underway right now. So therefore, the natural tendency for any portfolio manager or a strategist would be to try and see, spaces where the damage is limited and focus more and more on domestic plays.
As of now, so just reiterating the number, as of now, your base case is 12% earnings growth for FY26. Potential downside risks could come from sectors like IT, chemicals, and pharma, right?
Yeah, even auto for that matter. See, it's very difficult to pinpoint which sector will not see earnings cut. So 12 to 14% is the earnings growth, 12% ex commodities, 14% on a reported basis. That's what our estimates are for FY26. And I would say virtually every sector is vulnerable to earnings downgrade till you see some clarity emerging on the horizon. And therefore, that's why I mentioned the point right at the beginning that the only comforting thing right now is that the valuations are in your favor in large caps.
Okay, all right. Hi, Gautam. Good morning. Good to see you in. Valuations preferable in large cap. That seems to be the consensus as well. But Gautam, I wanted to ask you about the consumption/FMCG index. After a while, when the market's seen a correction, they have actually underperformed. As you'll have mentioned in your note, normally we see an outperformance coming in from there. Do you think this time around as well, the time has come now where you see the FMCG pack/consumption stocks do relatively better and they could be a place where you could hide?
So, Nigel, top down, that argument can be valid that in periods of extreme volatility, defensive sectors should try and outperform. And that has usually been the case in the past 20 years. The note that you're referring to, we've highlighted various episodes there. And this is the first time that Nifty FMCG index has underperformed Nifty in an episode of a double-digit correction in Nifty. This is happening first time. Second, the age-old argument that consumers should always outperform in falling markets is getting a bit of a reality check because the FMCG companies in India, and more so consumer staples within that, have severely underperformed on growth. If you look at the last 10 years, there are hardly one or two companies in India in consumer staple space where the compounding on top line growth has been 10% plus. So most of the companies have grown their top line in the 5 to 7% band and earnings also in that 7-8% band. They obviously witnessed a huge re-rating between 2010 to 2020 because other sectors were not growing earnings. Post 2020, when other sectors started performing, consumer obviously took a backseat because the growth was not forthcoming. So our view is that within consumption, one has to stay in consumer discretionary and not consumer staples. Because in consumer discretionary, you have visibility of growth. There is a room for penetration and per capita consumption opportunity there. Whereas in consumer staple, now this will be the fourth year where companies will come and give you the same commentary that either urban is slow or rural is slow. So market beyond a point will not accept those excuses till the time they do not see growth. Because the valuations, while they are moderated in the last 2 years, they're still quite expensive for consumer staples.
Yeah. Gautam, you have such a wide coverage universe, you and your team. Give us some specific instances of, sectorally, because, there is an annexure as well, which is being updated continuously because there are a lot of exemptions being provided and it's changing, it's dynamic. So, for example, after this, we are talking to 2 chemical companies, to understand what is the impact there. But in your coverage universe, maybe do it sectorally. Where is the impact coming from? Direct, I'm talking about direct impact, products which are sold in the US. Indirect, of course, everything will get hit. Go on.
Yeah, so no, direct impact, Prashant, as you would have guessed, can come in auto, chemicals, pharmaceuticals. These are the 3 most important stock market relevant sectors. Textile obviously is a beneficiary, but textile has a very little market cap and it's not there in a lot of portfolios either. And even if you look at the discussion around textile companies, they're very episodic, right? So from an investable universe point of view, the direct impact I can foresee at the moment is in auto angs, a bit of pharmaceuticals, chemicals. And on the positive side, you might see beneficiaries emerging in EMS spaces, right? Indirect, as you rightly said, it can manifest in multiple sectors as we move forward, because IT obviously is not a direct impact, but an indirect impact as the corporates, sort of start penny pinching in their tech spend. So clearly, you've seen huge impact on IT companies in the last 1.5 months. If you recall, between September to January, IT companies didn't correct at all. In fact, they were the ones which were providing resilience to Nifty. But in the last 45 days, you would have seen IT companies have also taken a big knock, and more so after this whole announcement of tariffs started rolling in. So very few sectors limited, Prashant, where you can say the impact is not there. Obviously, financials will remain insulated, and which is why you would see every guest on your channel talking and belaboring on financials. We've also done that. We've also increased the weight on financials in our model portfolio since last 6-9 months now. We've done that this quarter also when we did the revision.
Gautam, you're making us feel very glum this morning. I mean, there's Mr. Donald Trump, who's anyway making the whole world feel very glum. But, I'm hearing your commentary. It's sobering. It's a reality check. We have to take it as it comes. I mean, you're saying this year was washed out. We didn't have any earnings growth, practically none. Next year, best case is 12%. No, I'm just let me complete my question, what I'm coming to. So 12% best case if we don't get more downgrades. Credit growth estimates are also at 10%. We're talking financials, right? Which brings me to the question that I asked Prashant Jain yesterday. 10% earnings growth, 10%, probably credit offtake. Are we talking about this market becoming a 10% return market then? X of all the tariff headlines, because that's a very new sobering reality for a lot of the post-COVID investors.
But that's not surprising, Surbi, because between 2020 to 2024, you had 20% earnings compounding. The market gave you 20% returns. 25 was a washout year, as you said, in terms of earnings. And if 26 is also a 10-12% kind of year, then market will be quite fair in giving you 10-12% returns. Ultimately, market will respect the corporate earnings. In the short term, it will obviously fluctuate a lot depending on news flows and noise. But over a period of time, if you look at 2-3 years, you will always find that the line of earnings growth usually converge with the line of index returns. So it's not surprising. In fact, what was surprising was when you got 5-6% growth in first of FY25, the market kind of ignored it and kept on rallying for whatever reasons. There was liquidity gush, there was huge positive sentiment and all. So now it's quite fair that Nifty is now trading at a 10-year average. It's reflecting the underlying economic uncertainty and also the corporate earnings.
So you know what? I think next time we have to get Ramdevji back. And I want to see his take, because Ramdevji, he's an eternal bull on the Indian market, right? And I know his math. His math is if earnings are compounding at 15% every year, the market will compound at 15%. And every 5 years, the market should double. But maybe, is that thesis at risk? Because you're talking about very hard reality when it comes to corporate earnings and overall growth.
So 5 years, if you stretch, and if you see 12 to 15% earnings growth, market will still double at 15% compounding. What we are discussing right now is FY26, and even those estimates are at a risk. So the reality is very different today. Hopefully, when we speak in July after the next preview, a lot of these things should have settled, and our confidence in that 12-14% earnings growth would have gone up, because then the market can read it a little bit if the assurance of that 14-15% earnings growth is there for FY26, FY27.
Fantastic. I'm so glad.
Different fronts.
I'm so glad we're ending at least on an optimistic note that thesis of the market doubling every 5 years, that is still intact. We just have to get through maybe a slightly difficult FY26. All right. Always a pleasure, Gautam, having you on the shows. Thanks so much for joining in today.
Thanks.
We'll take, I think, a very, very quick break on that note. Come back on the other side and we'll get you more market opinion. Welcome back. We're keeping the market conversations going, and now we're seeing some green on the screen, which is a huge sigh of relief for the bulls. Our next guest weighs in on what lies ahead. We have with us Kenneth Andrade, who's joining in, CIO of Old Bridge AMC. Kenneth, great to have you with us, and personally, in the studio, so that's always fantastic.
It's nice being here.
Is the worst of this tariff storm over? Some people are, calling it something similar to the oil shock of the 70s. There are parallels with the Great Depression because of the tectonic nature of changes. Is the worst over or not yet?
So I guess we got to reconcile with the fact that this is a new way of doing things and just identify as to how this thing moves forward. So in simplistic terms, the countries with a high trade deficit, okay, have nothing to worry about, and countries with a high trade surplus across the world have everything to worry about. And if that's going to be the norm, you position yourself where you want to be, and I think that's the way things will get implemented. But over a period of time, I don't think this is going to be par for course. It will get reconciled. It should logically get reconciled. Otherwise, globally, you'll have to put a lot of manpower in monitoring tariffs. Okay, so if you've lived in the 80s and 90s in India, okay, you know what it's like to have a tariffed economy. So those things may not come back in the proportion that has been talked about, in the sizing that it's been talked about. So let's see how it evolves.
Kenneth, you spend a lot of time in Canada as well.
Kind of.
The 51st state, as President Trump has said. But the basic question which goes to the heart of everything is he and what he's trying to do for real? Or is this, after everything said and done, it'll come down to a negotiating tactic? And because if it is the latter, then it is okay. It's a 10-12 day problem, which will get solved. What is your sense?
Prashant, it's not for me to comment if this is for real or this is not.
But what is your sense as an investor? I'm sure you've thought about this. You have a take.
I mean, it's not the most logical way to reformat an economy. It's not the most logical way to reformat an economy, and not an economy.
No, that we know. But
that's
what is your sense? Is he going to persist?
He will persist for a time, and then after it, I think it'll normalize itself.
But the price damage, that definitely was for real, what we've seen across 3 days. In the financial market impact sense, that was my question as well, that is the worst of that at least over, the worst of the shakeouts?
I mean, I speak for India as a country. I think we're almost done there. Okay, we've normalized in terms of valuations. And I've been saying this, and it's been there in the public domain, that the financials in India are probably the best that there is. In no way is our competitiveness actually diminished globally. Okay, and we just have to recalibrate our stance in the global environment and just move forward.
All right. Hi, Kenneth. Good to have you in the studio. Well, a couple of questions here. From an Indian investor perspective, has the time come to increase your equity allocation in comparison to what you were doing, given the fall, given the uncertainty? Point number one. Point number two is, since you briefly spoke about financials, what do you like out there? And as you said, that's reasonably insulated from what's going on the globe. Both those two. Allocation to equities as well as what you like from financials.
So if you look at equities on a one-year basis, you're at low single-digit kind of returns. If you look at it on a 2-year basis, it's higher at about 20% return, and if you look at it on a 3-year basis, it's about 12% return.
Yeah.
So you're already there. So to look at the template from here into the next 3 or 4 years around that 3-year return matrix, I think if that's your expectation level, the numbers are there. Anything lower, obviously, your return expectation should be higher, or your returns will be higher over a period of time. So from an equity investor point of view, I think the valuation risk that was there and the hype was there in some of those businesses, a lot of that has been corrected and it's been normalized.
Okay.
So today it's an okay time to invest, not the best time. I can't say there is deep value in the marketplace. I don't think it will come, given where corporate balance sheets and the solvency is. I don't think that's going to be...
so it's a good time to allocate more equities.
Yeah. What you've been doing so far, I think it's an ongoing process.
And the return expectation that you said should be around 12%. That's realistic to keep.
So the last 3 years, today with all the correction, your returns are 12%. So going forward into the next 3 years or 5 years, if you can just extrapolate the numbers, you will know what to see.
12% is not bad.
Not too bad.
Long periods of time. Yeah, absolutely.
Yeah.
Well, give me 12, 15, that's happy.
And the point on financials, you wanted to finish that point as well?
Well, it's an industry where the valuations are great at this point in time. Okay, they're struggling with some operational issues that are there. I won't say operational issues. Some part of the entire economy is struggling, and growth is not at its peak. So you got valuation comfort. You just have to wait for the cyclicality to play out, and this business will also reverse itself.
You want to give us a sneak peek with what PSUs, NBFCs, large private banks?
So they're all different categories out there. NBFC is probably one segment of the market, which is microfinance, and some part of private banks have extreme amount of valuation comfort, but obviously there are risks that are there on the business model. Private sector banks have normalized. They're waiting for growth to come back. I think 27 and 28 should be good years for some of these businesses. And public sector banks, I think they will give you market returns or near about where market returns are. There's actually not much to choose between the lot.
So, Kenneth, sectorally, what do you like? I mean, banking, financials, you already said. You used to like agri as a space. What else? I mean, segments, sub-segments. I mean, just give us a flavor of what.
So, from a valuation standpoint, I don't think anything is sticking out. Okay, everything is corrected. Everything seems to be right there. What we had talked about some time back, and that reflects as some part of our portfolio, which are companies that have put in a large part of expansions and capital on the ground, and are looking at expansion in the international marketplace. Okay, Pharma is our largest exposure out there. We got one aviation business which is expanding rapidly as far as the expansion process goes. We got a little bit of metals. About 10% metals, and IT is there. So that's essentially where our
Pharma, aviation, metals, and IT.
Yes.
That's also hugely global facing. Are you kind of worried? Would you be tinkering around at all with that? Because we don't know Pharma, US tariffs, eventually what happens. Metals, again, it's sort of globally linked.
So like I said, anything that's got to do with the tariffing of some of these companies or these industries doesn't diminish our competitiveness. See, we are at the bottom end of the entire value chain in terms of bringing cost-effective products to the marketplace. There is inflation that is there. We'll have to see how that inflation plays out for the customer, who's going to pick up some part of it all, and that's a readjustment phase. But and that also doesn't diminish the market opportunity out there. Look, pharmaceuticals is going to see a patent peak, which is almost 3x the size that you saw in 2015. So from an opportunity size, nothing diminishes the opportunity size.
A patent peak?
Yes.
Which is going to be 3x of what we saw in 2015.
So from the numbers that we have, it was about $111 billion up to 2015, and now incrementally it's going up to almost 3x of that number into 2035. A lot of that is what the Indian companies have invested in, and not just the Indian companies globally have invested in terms of genericizing that product line. So the opportunity size is not diminished, our competitors are not diminished, but there will be changes in business model to address that.
Okay. On the agri side, Kenneth, anything do you have exposure or you kind of?
No, we don't have a fixed view on that. There is some elements of those companies that are doing well. It's a very domestic driven economy. That part of the economy has also seen some part of growth numbers that are there, but it's left to individual business models. Category wise, I don't think it's any company is looking at a significant amount of expansion in their product in the macros out there.
All right, we briefly touched upon Dava. Let's talk about Daru as well. That's something that you have liked in the past. Personally, I'm on Lent, so I'm totally clean. But otherwise, you have spoken about this premiumization, and I'm also looking at the input costs for these alcohol companies have cooled off. You believe there's still a long runway there for these alcohol companies? And if you could name a couple of them that you'll have in your fund.
So we just have one holding in terms of Radico at this point in time, and that's been there for a long period of time in our various avatars that are there. So that continues to hold out there, and it's a very strong product line. And from whatever I get in the marketplace or whatever channel checks we've done, the market is still short supplied in the premium end category. It's not just one company; it's just all companies that are there. It's also a market that's getting significantly overcrowded. Indian entrepreneurs have significantly invested in what they call single malts. Okay, but when it gets crowded out, obviously there's some medium term to long term price restriction. So companies have to hold that. Okay, so I think that's where that's our view on it. Nothing to worry about really, except for valuations are extremely expensive out there.
Kushi or dam, whatever it is.
It's a good discussion to have. We have a midweek holiday coming up.
Yeah, he never leaves that.
No, I'm on a break.
Wait until Easter. Okay. All right, Kenneth. Thank you so much for joining in. Really valuable inputs.
Thank you very
really
much.
appreciate it. Thank you. But I think, Nigel, it's all about chemicals now and how this sector is going to cope with those tariffs.
Well, that's right. Let's shift focus to the chemicals sector. Then B&K, they believe that tariffs lower than China is positive for Indian chemical companies. DAM Capital, they expect tariffs should significantly improve competitiveness of Indian players with regard to the Chinese competitors. Well, to help us out with some perspective, we're joined by Rajan Venkatesh, the Managing Director and CEO at Lakshmi Organic Industries, as well as Sunil Chari, who is the co-founder as well as Managing Director at Rosari Biotech. Hi, gentlemen. Thanks a lot for joining in. Rajan, coming across to you first. You all have some exposure to the United States. If I'm not mistaken, it's around 20 to around 30% or thereabouts. So tell us, what is your take? Now we have tariffs that are imposed both on India as well as on China.
I hope you can hear me. I'm walking through the airports here. So just call out if you cannot. I think
we can hear you fairly well, sir.
My side.
Yeah.
I hope you can hear me.
Yes. Yes. Please go ahead.
Yeah. So I think a lot of your guests have been speaking about is certainly things are evolving as we speak. We all wish we can get more granular, but that's not yet the case. So that's point number one. The second lens is there will be repercussions on the inflationary pressures as a result, because certainly U.S. is not producing the entire range of chemicals or chemistries, and hence, if you're putting in tariffs, this will have certain implication on the finished good pricing for the U.S. consumer. The third lens is obviously coming closer to home for Lakshmi. We have about a 10% exposure of our business into the U.S. particularly. So that's where we are from that lens.
Oh, so Rajan, you mentioned that your exposure to the U.S. is just about 10%, is it?
Yes, at an enterprise level, yes.
Okay. So what do you see, as next steps for yourself? I mean, and that would be, I think, how a lot of industry players will be thinking. Right now, what we know is that the tariff is 26%. So unless it's negotiated down further, will you be able to pass all of this on to your end customers, the U.S. buyers? What happens? Will you have to take a bit of a margin hit? How do you see life changing for you come April 9th?
So I would say first is we are in deep in conversation with some of our key accounts that we are serving in North America and the U.S. particularly. So I think still, as I said, things are evolving. It's difficult to pin down. But you will need to understand also the product portfolio that we serve that market is our specialty products, which are in sense unique in their performance, but in the total cost of formulation a very small part. So that's how we view it, and we will see how things pan out. Let's also not, at this point of time, we need to understand what are the other measures other countries, for example, Taiwan has decided to support its industries that are impacted. We are seeing other countries also taking these measures. So we will need to see how all of that is evolving at this point of time.
Okay, all right. Let's get in Mr. Sunil Chari as well, the co-founder and managing director of the Rosari Biotech, into the discussion. Hi, Mr. Chari. Good morning. Good to see you in. Tell us, what is your take? India getting taxed, but maybe not as much as China. Does it throw up a big opportunity for India and Indian companies like yours?
Yeah, I think there is a silver lining to the dark clouds, and we at Rosari are seeing, what molecules to focus. Our competition for the non-ethoxylate range was basically with China, and China also was routing some products through Vietnam and Thailand. And now all the three countries have, tariffs higher than India. We see opportunity to increase our exports to US. We don't see any threat to what we were doing already in the US.
So currently, what is your exposure to the US, and what kind of an opportunity could you throw up?
So for us, our total sales, out of the total sales, we have about 2% sales to US, but we have a bigger sales to LATAM. And there is no, I don't think there is change in LATAM. There is a lot of specialty chemicals which we make also made in US, and they may increase the prices. So for us, I think things are better with the higher tariffs than it was previously.
Okay, sir, so, could you just tell us, would you be, or are you already considering, I know it's early days, but if this remains, and that number can vary, like I said, it's 26% today, a couple of percentage points up or down, but Mr. Chari, are you thinking of any kind of realignments to either, take advantage of the opportunities that are opened up from China? Because with China, the war is really escalating. Do you foresee any change in supply chains? And at a company level, are you already thinking of making some changes to align with that?
So we were talking to some of our accounts yesterday. So we set up calls yesterday, and everybody is more bullish on India than China. In the specialty chemical sector, we are there, and everybody expects that exports from India will increase. I saw some reports where they say we will have a $7 billion hit from export from India, but I don't think so. In the specialty chemicals, all my peers should have, and us, Rosari, should have better opportunities in the chemical industry.
Okay, all right. Mr. Chari, just to complete the point, how is demand on the whole? In Q3, there was some softness, right, in the international market. Has that bounced back right now?
No, we have had higher, very, very good sales. And of all the chemical industries in India, we have been particularly growing rather than degrowing. And even our profits have grown if you see the first 3 quarters. And I see for the coming year also, a double-digit growth happening in Rosari.
So the international market is doing well, but in the domestic market, is there still softness?
No, domestic market, the last quarter, I think we saw a better demand than in the previous 3 quarters. FMCG companies are, demands are increasing for the accounts we have.
So good times for you then, both domestic as well as international business, you're seeing good amount of demand. I think earlier you were guiding that in this year, you'll grow by 12 to 13%. Are you sticking to that?
Yes, definitely sticking to that.
And on this sort of a base, FY26, what does it hold? If demand's coming back, both on the domestic and international front, should spell better times?
Because the world is VUCA, it's still very uncertain, and I don't know what it is, but I would stick to the 10-12% guidance for this year also.
10, so for next year as well, right? You're saying even FY26.
The coming financial year.
Actually, we're already in it. I know. The current financial year. I know it's still kind of hazy in the head because 2nd of April became such a huge day, right? But FY26, 10 to 12% growth. Let me ask the same question to Rajan as well. Rajan, things are moving quick and fast, but all things put together in terms of growth and margins, what do you see ahead for the company?
So if you see the first 3 quarters of FY25, we've delivered profitable volume growth. We remain on target to deliver that for the full year of FY25 too. Certain of our capexes, especially the big one at the Dahej, is taking shape and is coming online in the second half of the FY26. So we are taking the steady steps. We have clear right to win in certain of our technologies, and that is keeping us in a good space in what continues to be, like what Mr. Chari said, a VUCA world, and we are navigating this very diligently.
All right, gentlemen, we'll leave it on that note. Thank you very much for joining in and giving us some perspective on how Indian chemical players and companies are gearing up to take on the tariff onslaught and maybe even some of the opportunities that are arising because of it. Well, with that, let's quickly move on. Bank of Maharashtra is in focus. The stock has been moving higher in trade after reporting a pretty strong business update for the 4th quarter. Deposits are up by about 10%. Advances have grown by 5% sequentially. We have with us Nidhu Saxena, MD and CEO of the bank, joining in. Ms. Saxena, thanks so much for joining in. So, how do you see the trends shaping up, given with your 4th quarter update? Are you hopeful of, this whole problem of deposit mobilization? Are you hopeful of this now finally resolving?
So if you see, before I comment upon the going forward situation, there are a lot of things that we did in the last year, and we have seen some positive outcomes. Concrete results have come in. What you mentioned for deposits, a couple of things that we did was around, new products that we created to reach to some segments which are hitherto not reached by the bank. New processes that once if the customer has to be onboarded, customer onboarding happens seamlessly, and once onboarded, the customer is able to transact seamlessly. So there were examples like video KYC we did available on Sundays and holidays. We looked at all the channels, digital channels of transactions. We reviewed the transactional limits. So once the customer is onboarded, the transaction on these channels was seamless, and customer convenience was looked at. We also set up a new business vertical which was focusing primarily on institutional business, institutional deposits. We also are a differentiated bank which was opening branches last year. I opened 200 odd branches, and for the next 5 years, So all these things actually resulted in the business numbers, the deposit that you asked. We have been able to meet our guidance, and I'm happy. Yet another quarter of good performance by the bank. Not only deposits, whatever guidances we had kept for total business advances, we have been able to meet those guidances.
No, absolutely. Because, I mean, if I look at your deposit growth year on year, it's a strong 13.5%. Your advances growth is almost touching 18%. This CASA ratio at 53.3%. Are you confident of maintaining it here? Do you think it can even get better? And then this, then once we get that out of the way, then the advances growth. I mean, is 18% something that can be sustained even in the coming quarters?
So, if you ask me, we have not finalized our guidance for the next financial year. But I don't see, yes, there are concerns and challenges in the industry, in the system, and I'm not out of that. But the way we have been addressing this successfully in the last 12 months, going forward, I see absolutely no challenge in getting more traction from whatever strategies we have put in for both deposits, within which low-cost deposits and advances. If you see my RAM corporate, it is a guidance was 60-40 plus minus 2%. I have closed the number at 62-38. Not that corporate is not important. Wherever new opportunities were there, profitable opportunities were there, bank has been present and we have participated in those. But somehow the way we have managed our business mix, we have looked at not only the top line growth, but the bottom line growth also. So the profitability has been equally important. As of now, there's nothing for me to share, but because the audit is going on, but I'm pretty confident that what we did last year, we'll be incrementally doing better, and whatever guidances we had kept for the various ratios and the absolute numbers, also we would be meeting.
All right, Mr. Saxena, good morning. Nigel on this side. Congratulations first on mobilizing deposits. So that's good on you. But I wanted to understand, what about the cost of funds? Could you give us an understanding? What is it now if you compare it to the previous quarter? And if it's come at a higher cost, then would it mean that your NIMs dip in quarter 4 in comparison to quarter 3?
Right. So, Nigel, my cost of funds December quarter was 4.75. And very consciously, we have actually shunned some bulk deposit which has been there with us on a high cost. We have discouraged that. It is the low-cost CASA. We have also looked at other alternate channels to raise resources. We did a handsome capital raise last financial year. We also went for refinance. So some 8,000 crores of refinance was availed at good rates. And that is what has actually funded my credit growth also. Both capital raise and refinance put together with deposits. But I have very consciously stayed away from high-cost bulk to maintain my profitability.
Okay, so NIMs will be maintained at what levels?
So, as I said, for the last 3 quarters, we are almost close to 4. 3.98 was my December quarter. Currently, the audit is going on. But the way we have built our business mix in this last 12 months, last quarter also, and with good recovery performance coming in the bank, I don't see any challenge, although system as a whole, with the kind of deposit rates increasing, there will be concerns around NIM contraction, but I'll have to only wait and see once the audit process gets concluded. And I am pretty confident that we are going to definitely outperform our guidance in NIM and other profitability ratios too.
Good to hear your optimism. Let's get a couple of more questions out of the way. The NCLT cases, how many of them do you expect them to get resolved in the coming fiscal? Point number one. And what's the outlook on credit costs?
Yeah. So I have 8,000 crores of material which is with the NCLT at various stages. There are around 200 odd accounts which are composing this NCLT cases. The way we have been, things have for the last 12 months, 15 months, the traction that has come, the delays that have been addressed, concerns around the resolution in the NCLT that have been addressed, we hope to see that by the next maybe FY 26-27, the entire processes, entire cases will see some resolution. To what extent the recovery comes to the bank is yet to be seen. But for me, there is no concern because this is a 100% provided book. As and when there is a recovery in or resolution coming in at whatever haircut, I am going to get some traction in my OP also. So that's regarding the NCLT cases. As regards your second question on, can you, Nigel, share again?
So, sir, just to...
So it was around... Yes.
Yeah.
Credit cost. I'm sorry, I recall that. Let me answer that as well. So if you look at my provision coverage, we are at a very high 98.3 was my PCR in December. And with this high coverage that we are having, the aging provisioning requirement is actually very minimal. And the way we have looked at underwriting quality, so my slippages also are controlled. So credit cost is going to be remaining well within the limits, within the guidance. I don't see much challenge for the bank in terms of any kind of increase in credit cost.
All right, we'll leave it there, sir. Thank you very much for joining us and running us through all of that in terms of updates at Bank of Maharashtra. 245 points higher is what the Nifty is trading with in terms of gain. So we have come off the highest point by, a fair bit actually. So let's just to record, the high was 22,577 and we are now about 170 points off the day's highest point on the Nifty. And the Nifty Bank similarly has also come off very sharply. And here the high was 50,793. Basically 5,800 was the high, and we have lost about 500 points from the high. And 50,300 is where the Nifty Bank is now trading at. Any fresh trades? That's the question. Mitesh is now joining us for that. Mitesh, good morning again. What do you have?
Morning, Prashant. So I think, as I was saying, look for trades in the stock side, and on the index, I'll still maintain my negative spreads because, see, the real problem of tariffs hasn't gone away. You might see markets, giving a decline and then a strong pullback. Plus, also is the fact that the index continues to trade below the near-term and short-term moving averages. So 22,600 was my first target. We got a higher around that. I think till this 22,600, 800 band is crossed, the index will not recover in health. So I think the overall setup is slightly negative. On the stock side, I have one buy and one sell. Petronet is a sell with a stop at about levels of 278 for targets of 260. And a buy on HUL. And in fact, we had a buy on Colgate also earlier in the day. I think it's the FMCG pack, which is more on the defensive side, looking better on chart. So HUL is a buy with a stop just below levels of 2254 or just below today's low, and a target of around 2310 can be looked at on the upside.
Okay. All right, Mitesh, got that. Thanks very much. So those are some of the trades at 10 that you can consider. We'll take a break now. On the other side, we'll have Manisha Gupta join in, and she'll talk about the latest from the commodity markets.
We learn from our beloved Prime Minister. Let me mention just two lessons here for all of us. One, Modi ji never lets a good idea go to waste. His Man Ki Baat inevitably becomes his Man Ka Sankalp. His sankalp is always Vajra Sankalp. His determination is as hard as a diamond. He does not rest with simply making a sankalp. He knows how to turn his sankalp into success. In the last 10 years, the world has seen how he especially chooses impossible-looking tasks and transforms them into reality. This, for all of us, is lesson number 1. Lesson number 2 is about his boundless energy. Narendra Bhai Modi's name stands for Anant Shakti, infinite energy. Since PDEU is an energy-focused university, all of us should learn to be as energetic as our Prime Minister. People often ask the question, where does Modi ji take rest? Or does he rest at all? I can tell you that
All right, welcome back. As promised, let's look at all the commodity cues that are coming in. Manisha, so there's a recovery pretty much across the board. Which commodity are you tracking?
Well, I'm looking at gold because there's a sharp sell-off that we saw into the commodity markets, but gold clearly had the most of it. In the overnight markets, the maximum decline clearly has come in for the gold prices, where we have seen 2% of a decline coming in, and we did see a 4-week close of 2955 coming in on the charts as well. Well, prices have hit an all-time high, as remember, of 3,167 in the month of March. So from there, the kind of decline that we saw was almost $200 of a decline, and $100 of that actually came into markets yesterday itself. It's not just about golds. Well, silver prices saw some 0.5% of a gain in the overnight markets, recovering from a 7-month lows, and that's exactly what you have seen for the industrial metals as well. So crude gained, base metals gained, silver gained. The only thing that saw a decline was the gold prices there. That is because the US dollar is off its 6-month lows there, and we've seen the dollar index gain versus various other currencies. That is what was weighing on. The second thing is that the investors now seem to be turning into other currencies as safe havens, which is US dollar. Obviously, the kind of yields that we have seen, the Japanese yen and the Swiss franc also have gained in the overnight markets there. Apart from that, when you look at the COMEX gold stocks, well, they have seen very strong gains there. There have been gold sales also to set off the losses that we've seen in other asset classes. And gold is the only one that actually made money if you look at the last 3 months. So that is something that is bound to happen and is seen most of the times as well. Coming to the US markets then, the COMEX gold stocks are at a record highs. We've seen them continue to gain, and it is up by $80 billion since the month of November. And you remember, there is no tariffs on gold and silver that has been exempted, and US had been buying a lot of gold ahead of that. So that markets also seem to be easing right now. And that clearly shows on in the LME markets there. Well, LBMA has seen gold inventories gain, even if by a small 0.1%. But that tells you that the inventories are not being taken out of Asia and other parts of the world into US. That scenario seems to have stopped at this point in time. A very supportive factor, though, is the China Central Bank buying in cents of gold, and we've seen that continue for a 5th straight month in the month of March. That report came in yesterday, and Chinese central banks are continuing to buy gold there. Now, where is the gold prices headed? While we have seen a correction of almost $200 from all-time highs, most of the banks and brokerages still believe that the gold has further highs still left it in. The kind of tariff concerns that we are seeing, the recession concern, a lot of data that's also coming into this week, including the FOMC meeting minutes that gets released tomorrow. There are banks still telling you to go ahead and be long on gold. Deutsche Bank's latest report came in yesterday, and 3139 is what they're talking about. 2,900 to 3,300, as you can see, coming in from HSBC, ANZ. The most bullish of all the banks is still Goldman Sachs, Bank of America, Citi. They're talking about $3,300 to $3,500 an ounce by the end of this year. And then, of course, 3,000 is a level that JP Morgan talked about yesterday as well. UBS also talks about 3,000. But many of these markets, of course, will watch out for what happens to dollar index, and a lot of data that is due from US in this week itself.
All right, Manisha, thank you very much for that. So that is commodities in focus. Let's talk about Titan, of course, which is also, in a way, a play on gold. Mangalam is here with the focus on this one. Mangalam, over to you.
It is indeed a play on gold. The question is that, with higher gold prices and now lower gold prices, what's the kind of sales that they are likely to do in this quarter, which has Akshaya Tritiya. But more on that later. The previous quarter, the company has given its fourth quarter update, where the standalone revenue for them grew at around 25%. It was led by 25% growth in the jewelry business itself, which in turn was led by 27% rise in gold jewelry and 65% rise in gold coins itself. Watches grew 22%, eye care grew 19%. Some of their emerging businesses like CaratLane, etc., and Taneira were underperformers. Macquarie has written this morning they have an outperform rating on the stock with a target of 4,000 rupees. They say that there was better than expected sales across jewelry and watches. That was their key takeaway. However, they did speak about the concerns around deterioration in studded jewelry and the impact that could have on their margins itself. There was a healthy jewelry sales growth and recovery in buyer value growth, but at the same time, we did see weakness in the lower level, sales, especially when it came to solitaires, etc. Just keep an eye out on their EBITDA expectations. It's close to 20% on a 25% revenue growth, which implies margin compression. So we'll keep an eye out on how the company speaks about what they look at in terms of margins and the sales for Akshaya Tritiya this quarter.
All right, Mangalam, thank you very much for that. Stock's up 4% for now. A big correction over the last couple of days here. BEL is the next one. Upasana is here to tell us why we're focused on Bharat Electronics. Upasana.
Well, the company continues to receive slew of orders, and even this time company remains in focus on the back of the order win. Now, BEL has received orders worth 2,200 crore. This order is mainly for electronic warfare suits for Mi-17 helicopters from Indian Air Force. Now, this order forms a part of 5,000 crore pipeline, which the company had indicated when negotiations have concluded, pending finalization is what the company has said. Now, this is the second order received from Indian Air Force in this month. Mind you, earlier company had received order worth 593 crore on 2nd of April is what the company had highlighted. Now, on the back of this, Phillip Capital says that the company has kicked off FY26 on a strong note, securing current order inflow at 2,800 crore within just the first week of April. Valuations also stand attractive at 27 times FY27 EPS, and the brokerage maintains a buy rating on the stock with the target price of 390 per share. So certainly, BEL remains in focus on the back of the order win.
Okay, all right. BEL still retaining a gain of about 3%. Upasa, thank you very much for that. The market overall, I mean, from a pop of almost 400 points at the open, there's a little bit of a cool-off. You have to acknowledge that, no taking away. About 250 points up on the Nifty. The Midcap index gain has also now cooled to about 1.3%. Let's see. The opening was, unexpected lines. It was a no-brainer. We were always going to open gap up. It's a question of building from here on. Let's see if buyers come in for a second round. As of now, in terms of the top movers on the Nifty, Shriram Finance is taking the top honors, 5% up on that stock. Titan on its Q4 update, 25% growth in Q4. That stock's also holding up about 4%. And then the others include BEL, Grasim, and Bajaj Finserv. Well, with that, let's take a very quick break. We'll come back on the other side with our special segment, It's the Economy. Lata today speaks with Chetanaya of Morgan Stanley on the impact of the US tariff threat on India and how the RBI might approach interest rates.
This question. The answer lies in what Pandit Deen Dayal Upadhyay ji has said, who is the founder and whose name this university bears, has said about rest or Vishranti. He has said, Kaam mein badlav hi Vishranti hai. Change of work is itself rest. And I think this is our Prime Minister's motto. This should be our motto, dear students, also. Therefore, when we think about these two lessons, how to turn ideas into action and how to work tirelessly, we cannot escape the conclusion that Narendra Modi ji is not only India's Pradhan Mantri, but for us and this university, he is our Gurudev, our respected teacher, and we will follow his learnings.
Welcome to It's the Economy. Post the shockingly high tariff announcements, many brokerages have lowered growth rates of the global economy as well as most individual countries as well. How much may India's growth be impacted, and how will that alter the Reserve Bank's approach to interest rates, to liquidity and to its stance? I have with me veteran economist, veteran India watcher actually, Chetan Ahya, the chief economist for Asia for Morgan Stanley. Chetan, good morning and thank you very much indeed for your time. Can you begin by telling us what's the Morgan Stanley view of Asian growth and global growth as well? Have you all marked anything down?
So, look, we have not made any adjustment as of now, but what we have been highlighting is that when you're thinking about regions' growth, you should expect downside of more than 1 percentage point. That is the number that we had seen in 2018-19 as damage to regions' growth. So to the extent to which the tariffs situation is far more worse than what we had seen in 2018-19, we are highlighting that the region's growth will slow by more than 1 percentage points in this cycle.
Okay. Now, how much should we be prepared for India? Your note clearly says that India is one of the least affected countries, but impact would still be there, isn't it? Any ballpark numbers?
Yeah, so India will see we are saying that India could see a 40 to 50 basis points downside in its GDP growth. So, yeah, I think India is not going to be unscathed. And the main exposure for India would be from the fact that India's exports are going to be affected across the world. It's not just about your exports to the US that gets affected, because remember that this is a global slowdown. This is going to cause a global capex slowdown. And then the aggregate trade effect is more important than the bilateral trade effect with the US.
Okay. Yeah, I agree with you. There is going to be a huge reset of how trade is done. Will there be a general migration of value or, output to the United States? I mean, even if it is not to the extent that the tariffs suggest, will the US see, much better growth next year, for instance?
Well, I think it's going to be complicated. It will take time. Certainly, as well, one of the approaches that the administration is trying to do is to have U.S. trade deficit reduced with its trade partner by way of trade partners buying more of U.S. goods. So let's say that if India wants to buy more oil and gas from the U.S., we sort of spoke to our team internally in the US, and the US will take some time to increase its production capacity for oil and gas. So, yeah, I mean, there will be some onshoring of manufacturing, and there will be also increase in the existing industries in which the US has the capability. But these things will take some time because it will not be possible to do it immediately. For oil and gas, our analysts told us that they will take about 18 to 24 months time to augment their production, to give more oil and gas to different trade partners in the region.
Oh, now, that's a new and very important factor that you're bringing in, because, if that is the case for oil and gas, then it is going to take much more time to ramp up other products if they insist that every country should buy more US goods. Let me concentrate first on the Reserve Bank. How will the Reserve Bank approach? I mean, if it's not 6.7%, what do you expect them to say will be the India growth forecast? And therefore, how will they approach interest rates?
I think it will also be difficult for Reserve Bank to give a point forecast. I think they may also operate in the way that we are operating right now, highlighting the downside risk. Maybe they do bring some downside into the numbers, but my guess would be that they will probably also approach it the same way as we guys are approaching it, that you highlight the risks and then see eventually what happens and then actually mark down their numbers. But I would reckon a 40 to 60 basis point downside, just as we are highlighting, is more likely from RBI as well.
Okay. And therefore, will it be a more than expected dovish policy? Can they go to 50 bips rate cut, or will it be rate cut plus a stance change?
Yeah, so we are saying that there will be a rate cut plus stance change. We are not building in 50, we are building in a 25 bips cut. That's the forecast that our India economist Upasana Chatra is highlighting.
Okay. What about liquidity? Are you expecting to hear more? If you look at the OIS rates in India, they are factoring in a 50 bips cut, not because the Reserve Bank will cut, but because they expect liquidity to be adequate and therefore the call rate going towards 6%. Are you therefore factoring in far softer, much more dovish policy in terms of liquidity?
I think that should happen, and that should have happened actually independently of this tariff risk weighing on growth outlook. Because what we have seen in India is that while we have done one policy rate cut, if you look at the banks' 3-month CD rates and just the effective deposit rates in the system, they have not been brought down.
Yes.
So in terms of transmission of that rate cut that RBI has done, it's not effectively there. And so they have to ensure that there is enough liquidity. If you have liquidity deficit and if you have a volatile interbank rate, it becomes very difficult for banks to plan their liabilities and then accordingly cut deposit rate. So yeah, we were expecting that before the tariff risks emerge, and then the tariff risk has even made it more sure that they will do that.
Okay. Now, can you tell us how Asia will reset? Are you expecting lower growth in China? How much would you expect will be the cut in Vietnam, for instance? Your report points out that their exposure to the US is more than 26% of their GDP. So, can you give us an idea of whether Asia sees a really steep cut and where will the cuts come?
So as I mentioned, right now we are operating with growth rates downside of more than 1%, and more than 1% is quite a lot because, when you're talking about region's average growth rate at around 4.5%, this is quite a meaningful cut that you would see if these tariffs are going to persist. I think the best way to look at it would be in terms of relative basis, just look at exports to GDP, because as I highlighted earlier, the biggest issue that you're going to face is overall exports slow down for the region. It doesn't matter how much you're exporting to the US, but to the extent to which this tariff uncertainty is going to weigh on global capex, therefore global trade, you want to be looking at countries or economies which are having higher exports to GDP. Those will be more hit compared to the ones which are having lower exports to GDP. So India is on the lower end of the spectrum. India's exports to goods exports to GDP is the lowest at 12%. And then at the high end, you have economies like Malaysia, Korea, Taiwan, other ones which are highly exposed. China is somewhere in between. Its exports to GDP is about 20%. So China will be less affected than other more export-oriented economies in the region.
Okay. I wish I'd put that table as well. We are running your exports as a percentage of exports to the US as a percentage of GDP. But yes, as you point out, your exports anywhere could be impacted because the world itself may deflate a bit. Let me come to inflation on that point. Are you expecting the RBI to lower its inflation forecast of 4.2% because, people will be pushing their goods elsewhere, what they can't sell to the US?
Yeah, I think they should because, this is going to be deflationary for all of Asia and all exporters for two reasons. Number one is you will see that weakness in domestic capacity utilization because of your exports getting affected. And secondly is that there is going to be so much excess capacity with the trade partners. So if you think of it like China, that will weigh on international prices, and therefore you're going to get this double whammy as far as inflation outlook is concerned. So, and already India's inflation is below 4%. So yeah, I think tariffs are deflationary, and that will be reflected in India's inflation outlook as well.
Okay, very quickly, a last question. There are some people in India who take relief from the fact that our tariffs are lower than that of Vietnam, Bangladesh, China, etc. People with whom we compete. And therefore, we should do better in terms of exports to the US. Would you counter that?
No, I think it's a fair point. But look, I think Lata, I think the most important point I remember from 2018, 19, and that was also the time when a lot of people were saying that China is being able to reroute it from Vietnam and other countries, Mexico. What in reality what happened is that China's exports slowed, and guess what? The other countries which did not have tariffs and did not have to reroute from Vietnam, their exports slowed even more than China. So I think it's going to be possible in the medium term that India will benefit, but in the near term, what you will see is everybody's exports will get affected because the aggregate trade effect is going to be overwhelming compared to individual countries' bilateral situation with the US.
Okay. Well, thank you very much, Chetan, for bringing that level of understanding to how we have to look at our own trade and our own growth. We have to wrap up for want of time, but let me take a rain check from you on discussing, how the global reset will impact both in the near term and in the medium term. That discussion for another day. For the moment, it's a wrap on Bazaar. Chartbusters coming up after a break.
आज जैन समाज का एक कार्यक्रम था बड़ौत में सीपीएल स्कूल में, जो पिछले 30 सालों से हर साल होता है। और यहाँ पे एक वुडन स्ट्रक्चर था जो कोलैप्स हो गया और अराउंड 40 लोग जो हैं वो घायल हुए हैं और उन सभी को 108 की एम्बुलेंस समय वहाँ पर मौके पर पहुँच गई थी। सबको हॉस्पिटल पहुँचा दिया गया है और 20 लोगों का प्रथम उपचार करके उनको घर भेज दिया गया है। बाकी 20 लोगों का उपचार अभी चल रहा है।
We must aim higher. Within a couple of years, India will emerge as the third largest economy in the world. No power on earth can stop India's growth trajectory. I can clearly foresee that India will become the most prosperous nation in the world before the end of this century. But India, with other large economies, also has a big responsibility. We must not allow economic growth endanger planet Earth and further worsen the climate crisis. Therefore, the transition from fossil fuels to clean and green energy has to be accelerated. I am supremely confident that green technologies and green energy
East Street opens with the green recovering some of yesterday's losses even as US President Donald Trump threatens even higher levies on China. Consumer durables, select financials gain, mid-caps relatively outperform.
Titan climbs on the back of a strong showing in Q4. The standalone revenue growth comes in at 25% on a year-on-year basis. The company says the domestic jewelry business grew owing to a significant increase in gold prices.
Oil marketing company stocks HPCL, BPCL, IOC, all of them trade higher after oil prices fall overnight. The government's also announced a 2 rupee per litre increase in special additional excise duty on petrol and diesel prices. LPG prices also increased by 50 rupees per cylinder.
Realty stocks, Godrej Properties as well as Shobha, they climb on the back of a good Q4 business update. Godrej Properties quarterly bookings crossed 10,000 crore rupees for the first time in Q4 FY25, while Shobha sees the highest number of new launches in Q4.
Sticking with the real estate space, Brigade Enterprises also in focus, up nearly 3% as the company has signed a joint development agreement for a premium residential project in Mysore with a gross value of 225 crores.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. Well, Mangalam, some green on the screen. We have come off the top, but I'll tell you what, put together yesterday's second half pullback as well as today, we've seen a good pullback from the recent lows. The hope is that now we try to defend the 21,700 odd mark, and the hope is President Trump
doesn't tweet anything in the evening.
I mean, doesn't tweet, doesn't say anything.
Put out anything on. Oh, just goes for golf. Actually, I guess that's what he should do.
Chill for a bit.
Celebrate his. We have a truncated week here. Might as well put a truncated week in the US as well. But be that as it may, two things really stand out from yesterday's recovery. If you look at point-to-point recovery, it seems like it's close to around 600 points from yesterday's low itself. One is that the market breadth today is a lot better than what it was all of yesterday. So we have 2,100 stocks which are advancing for just about 366 stocks which are lower. And this line, gap between the green and red lines, has been maintained since morning. So there hasn't been much wavering around out there. So that's a positive. The second factor is that despite, the sell-off that we've seen from highs, the recovery is holding on and the India VIX has come down. So the India VIX is down about 11%, has moved closer to 20 than, the 21, 22 that we were at yesterday. So that is another positive. So we'll just keep an eye out on how this pans out from here on. And the Nifty Bank, very close to the 50,300 mark, which is an important technical level to track. So let's see how all of that happens. But tomorrow's triggers are more important, right? One, because Thursday is a holiday. We have the expiry tomorrow. And then obviously the all-important RBI policy outcome. More than just the action, the commentary would be extremely crucial to track.
Well, that's right. Mangalam, today a couple of stocks as well are doing so well. And just one more point, yesterday the breadth of the market was dismal.
Yes.
It was only 200 stocks advancing, 2,000 stocks declining. But I'll tell you what, in yesterday's trading session, you had 300 stocks that gained more than 10% from the low point of the day. In the morning, there was some panic selling. And a lot of those stocks got picked up. Just to highlight a few stocks that have gained in the last half hour or so, Divi's Laboratory has now moved to the high point of the day. So good move is what we're seeing out there. Pull up the intraday chart of Coromandel as well. Big uptake is what you're seeing out there. And the stock is moving on very, very good volumes. So the market's being a little bit selective today. A couple of these names are doing quite well. Let's welcome Shilpa Rao from Prabhudas Lilladher for a technical check on the show. Hi, Shilpa. Good morning. More green than red today. What's it? A dead cat bounce? Or you think we are good for more?
Good morning, Nigel and Mangalam, and thank you for having me on the show. Talking about the setup, yes, we see some pullback happening here, but of course 22,600 will act as a resistance, and above that 22,800 a very strong resistance for now. So any pullback also towards 22,200 can be a buying opportunity. Keep a stop loss of 22,000, and first target should be around 22,600, 650, and if we sustain that, then 22,800. But it should be, only when the levels are coming. Otherwise, right now it's like a no trading zone. So immediate fresh levels to buy not recommended. So talking about Bank Nifty also trading at around 50,200 odd levels. So from here, the resistance is at 50,500. So immediate buying wouldn't be recommended. Any dip towards 50,000 mark can be done with a stop loss of 49,850. Stay long there for targets of 50,500.
All right, Shilpa, we'll come to you for stocks. Nigel, you spoke about a lot of stocks which recovered from lows yesterday. I'm looking at a stock that actually reversed from yesterday's high, and that's Delivery. Just look at Delivery, currently down 6%. The street read the acquisition positively, but maybe right now they're concerned about the company's ability to make it turn profitable. And at the same time, how do you navigate through the biggest risk of the acquisition of Ecom Express, having 50% of its revenue coming in just from Meesho, one client itself. So those are a couple of things we'll most definitely keep an eye out on. Yesterday's gain could also have been on account of short covering, because the market was so heavily weakened that maybe any recovery from the lows led to that short covering. The other stock that I'm looking at is Nykaa. Nykaa is, was under a wee bit of pressure in yesterday's trading session owing to the weakness that we saw in their fashion business. But beauty continues to remain strong for them. Early 30s growth in their beauty GMV and, mid-20s growth in their beauty net revenue itself. Yeah. That's done well. So that stock is up around 4%. And finally, I'm just looking at the entire jewelry space. Titan's up 5%. But look at the others. PC Jeweler up 10%. We have Thangamal Jewelry up 6%. Yeah. TBZ itself is up 5%. And you have a decent up move seen on Senco as well. Is this because gold prices have come off the highs and right now people are expecting buyer growth to increase as again just value growth on account of gold or not? Is the big question that we'll get an answer to.
Yeah, that's right, Mangalam. And with regard to that point that you're making on, delivery, I think only Equaris, I think that was one of the loan brokerages who had mentioned that the company just turned profitable and now they're gone with this acquisition. Exactly. Again, that will be on them. So kudos to them. A couple of brokerages pointing it out. On the whole, it looked positive, but for the time being, the street is taking note of some of those negatives. And I'll talk about gold. We have Akshay Tritiya that will be there on 30th of April as well. So look forward to that. But Shilpa is still with us. Shilpa, you want to leave us with a couple of picks?
Yes, Nigel, I have one buy and one sell. The sell would be in, of course, delivery. Delivery is showing some sort of weakness. It is heading towards 220. I believe that should be the levels again to go long. But from here, with a stop loss of 270, one can keep a short trade here for levels of 220. The other one would be a buy in Petronet. That is where, the other one would be a buy in Nykaa, sorry. Nykaa, it is looking very strong. The support is at 174 in futures. So that should be a stop loss and stay long for targets of 185 from here. Nykaa is showing a very strong long built up and I believe 185 levels shouldn't be very far from here.
All right, we take that point. Thank you so much, Shilpa, for that. With that, in a market like this, let's get you some ideas of profit coming in from our colleagues at Money Control Pro. Let's get in Varsha Bang, who joins in with a stock that she's been tracking. Varsha.
Today's ideas for profit is Saregama India Limited, India's oldest music label which holds 19% market share. The company has an extensive IP portfolio of over 160,000 songs, 70 films and 45 digital series. The company generates revenue across 4 key segments: music licensing and artist management, music-related video and digital content, and live events. Saregama reported strong growth in Q3 FY25, surpassing its revenue targets. Caravan business is transitioning from traditional model to e-commerce and modern retail, which will enhance margins. However, this shift may impact volumes. The company is strategically transitioning from free to paid subscription while investing rupees 1,000 crore in content acquisition over 3 years, targeting 25 to 30% of new music release. The company content acquisition strategy should drive strong momentum in licensing revenue and expand its market share in newly acquired content. With diverse monetization strategy and a growing digital presence, Saregama is well positioned for substantial revenue growth in the evolving entertainment landscape. Currently, the stock trades at 32.3 times FY26 earnings, which appears reasonably given the company's growth and investment prospects.
All right, we take that point. Thanks a lot for that. Just keep an eye on a couple of, oil users. So we have Pidilite, which has moved higher. Pidilite is among the users of, vinyl acetate monomer. And then you have a couple of these paint companies as well. They are seeing some pickup. Berger Paints, for instance, has moved to the high point of trade. A lot of stocks on our radar. We'll take a short break, come back, discuss all of them. Stay tuned to Chartbusters.
Can reverse the ecological degradation and indeed make our planet more beautiful, more livable for future generations. Our Prime Minister wants India to become the greenest nation in the world. For this purpose, India is also transforming itself into a deep tech nation with advanced manufacturing capabilities. This is the context in which PDEU should see its future role and responsibility. My dear PDEU family, therefore, Here are my 3 expectations from all of you in the PDEU family. My first expectation, PDEU should further improve the quality of research and make it application-driven. We should specially focus on newer areas like bioenergy, which have the potential to help our farmers and boost employment opportunities. My second expectation, we should simultaneously increase our internal strengths and also forge national and global collaborations so as to enhance our leading position in research and academics. My third expectation, the intersection of green energy, green materials, and artificial intelligence is going to shape the future of humanity. I would like PDEU to gain a leading position in this synergy. Talking of artificial intelligence, I have a piece of advice to our young students. You must be good at using AI as a tool of learning, but
Well, in an otherwise strong market, there's no respite for metals. They continue to tread lower. So we have Nalco, SAIL, Jindal Stainless, JSPL, all of them. In fact, the metals index comes up for you. That too itself is at the low point of trade. But speaking about commodities and speaking about oil, metals, all of that, sources tell us that oil companies are set to mop up nearly 9,000 crore rupees in FY26 on the back of LPG cylinder price increase. Sapna joins us to tell us more about what she's gathering out here. Sapna.
Yeah, absolutely right. Around 9,000 crores is the rough estimate as to how much they'll be able to kind of, pick up from this 50 rupees hike on LPG cylinders across the board, Ujjwala as well as non-Ujjwala consumers. Well, the point to be kept in mind over here is the fact that these monies which will be accruing to the OMCs, that will basically help plug the ongoing LPG losses. So that aspect needs to be kept in mind because FY26 also, we know the numbers lie. So basically, 250 rupees was the loss per LPG cylinder that they have been incurring so far. Hopefully, this 50 rupees hike should bring that loss down to around 200 rupees per cylinder. So there will still be some kind of an recovery, but at least that will get addressed to an extent. That's one. Second, also in terms of the 2 rupee hike on petrol diesel that has been effective, has already been done. That around 32,000 crores is what is likely to accrue to the exchequer. So the mechanism will be as such that the oil ministry is likely to seek a cabinet nod, basically to access that money in order to compensate the OMCs for losses that they've incurred in the previous financial year. And that number we already know, around 41,338 odd crores. So in total, you are looking at that number just for the last financial year. Now this year, we really don't have the under-recovery LPG number so far. But we do have, 2 sets of numbers. That is basically 32,000 odd crores is what they expect to get to compensate OMCs for LPG losses for the previous year and 9,000 odd crores this year. This is the math as of now. It depends on how crude price behaves. We have also been given to understand that this 2 rupee hike in the excise is being absorbed by OMC simply because the margins have improved because of the crude oil softening. So from $83 to around $75 odd is the average cost of the inventories, which is now likely to come down further substantially. And going forward, in case oil stabilizes around the same levels, of course, the indication is that there could be some headroom for a price cut as well.
Okay, all right. Thanks a lot for that, Sapna. Well, let's shift focus to another sector, realty. A lot of news and updates trickling in from a couple of real estate companies. Vinny joins us to fill us in with more on that. Well, Vinny, tell us what are you picking up? I believe you enjoyed the game yesterday. Unfortunately, Mumbai Indians didn't come out on top. But for the time being, tell us about these companies.
Absolutely. The game was amazing as well, a close match there. But we're seeing in terms of realty space, Godrej Properties, that's the first one I'm keeping an eye out on today. With the Q4 business update coming in, a good update coming in from the company, highest ever quarterly bookings that they've seen, 10,000 crores for the first time. Now, what is interesting is that the guidance which the company had given for FY25 was around 27,000 crores in terms of booking value. They have managed to beat that guidance and their booking value is now coming at around 29,444 crore rupees. This is the booking value, which is up 31% on a year-on-year basis. So yes, that's a good performance coming in from the company. 7th consecutive quarter that they are achieving more than 5,000 crores in terms of booking value as well. So interesting update there, and that is why the stock is in focus. Now, Soba Realty on the flip side, it's not that great a set of numbers in terms terms of the update that has come in from the company. Sales value, yes, they have seen a growth on a quarter-on-quarter basis of 32%, year-on-year basis growth of 22%. But what is a bit of a miss is the guidance which they had given. It's below the guidance in terms of they wanted their sales to be at around 6,644 crores, which was around FY24 value, which is still below that level. So yes, it's below what the company was expecting, and that is what one is watching out for in terms of a bit of a worry. Though obviously launches and everything has been in line, highest ever launches that the company has seen as well, and highest ever average realization. That is something that I think the street is liking. Now, other than that, Brigade Enterprises, this is not a Q4 update, but they have signed a joint development agreement for a Mysore project. The gross development for value for that is around 225 crores. So important to keep an eye out on this real estate stock as well.
All right, we take that point, Vinny. Thanks a lot for that. Indeed, a close game, Nigel. I was at the stadium as well.
Oh, you're together?
No, not together. The thing is that I've never seen Mumbai Indians lose in Wankhede every time I've been at the stadium. So maybe Vinny was the jinx that broke that streak. But be that as it may, we're not blaming you. Tell us a little about Piramal Pharma. There's a brokerage note out there.
Absolutely. So, Piramal Pharma, that's in focus because we have Goldman Sachs that has initiated coverage on this one. Buy rating, target price of 275 rupees per share. What Goldman Sachs is highlighting, they believe that Piramal is well placed within the coverage to actually see good growth in terms of good profit as well. They expect the PBT margins to jump from 3%, which was in FY24, to around 16% and more than that in FY28. And what will lead to this growth? CDMO business that is doing well. They're seeing a turnaround on that front, focusing more on the small molecule side of the business. So that is a thumbs up coming in from the company, as well as growth is something that will be good in this business from FY26 and onwards. Now, other than that, the CHG business, that is expected to see a capacity ramp up. So that will lead to growth in that business. And consumer side of the business, consumer healthcare side, that is also seeing a turnaround. So three key positives, three key segments, seeing a turnaround, seeing a growth from FY26 and onwards is a positive for Piramal Pharma. And Goldman Sachs has one more note that has come in as well, and that is on Pharma. So one more CDMO player. So overall, they're positive on the CDMO space, and they believe that this also will see a good growth from FY26 onwards. They're expecting a turnaround in the AG chemical macros as well, successful integration of the newer businesses that has come into the company, and potential approvals of newer drugs is something that will be driving the growth for Suven Pharma. Initiated coverage on this one as well. Buy rating, target price of 1,350 rupees per share.
Okay, all right, Vinny, thanks a lot for that. Well, for the time being, though, we'll slip it. No, I think, no, we can't let Vinny go. That's right. Vinny, you've got your hands full.
Absolutely. Now let's
what a busy day after seeing the IPL game yesterday, coming in the morning.
It was as busy as the match was yesterday, watching and seeing the wickets or seeing the sixes and fours going. So it is as busy as that today as well for me.
But next time you and Mangalam don't go, I'll go. Hopefully, I'll be the good luck charm.
All three of us can go. Let's do that.
Absolutely. But for the time being, tell us about one more stock. I believe you're tracking Interglobe Aviation. Tell us more.
So yes, Interglobe Aviation, now this is actually more of an expectation coming in for Q4. We had that analyst day meet also, which came in just a few weeks ago, where the company had management highlighted about good numbers in Q4. So obviously what Morgan Stanley is highlighting, they're maintaining the outperform rating. Target price has been raised to 6,085 rupees per share. And they're talking about that strong performance in Q4 driven by yields improving as well. They expect, multiples to re-rate. Why? Going forward from here, ramp up in international operations, tight industry capacity, tailwinds, that is something coming in from the business class ramp up that they've seen in 2024. Weakness in fuel prices in the recent time, crude prices, and fuel accounts are around 40% of their cost. So that is a positive on that front as well. And do not forget, Indigo currently is trading somewhere around 10.4 times in terms of the FY26 EV to EBITDA against the pre-COVID median, which was 8.5 times. So a bit more on that front, but COVID was a different scenario that we had to see. But good numbers coming in Q4, and that is what one is expecting this time. Morgan Stanley is overweight on that front.
All right, thanks a lot for that, Vinny. Let's go across to Abhishek now. A couple of brokerage notes coming through on banking names as well. Abhishek, before you speak about the brokerage notes, did you go for the match yesterday or no?
No, I didn't go for the match. So we have a couple of brokerages writing on financial sector. So Goldman Sachs has written, they have upgraded PNB Housing to buy. The target price has been set at 1,184 per share. They say that there is improving visibility of delivering loan as well as robust profitability for the entity. Axis Bank, they have upgraded it to buy. New target price is 1,228 per share. They say that valuation mean reversion as seen, is good for them, and profitability and growth are nearing bottom in H1 FY26. So the company is a beneficiary of liquidity infusion in the system by the regulator, which should act as support for the loan growth trajectory for the bank going ahead. SBI, they have upgraded it to neutral from sell. Target price is about 823 per share. They say that the risk reward is balanced as of now, with the stock having derated from 1.1 price to book value to right now about 0.9x 12-month forward price to book value. So this valuation as per them is fair for a 90 basis point ROA, that is return on asset franchise. Now we also have CLSA on Bajaj Finance outperformance target price of about 11,000 per share. They say that with asset quality headwinds receding, they expect Bajaj Finance to gain its class from FY26. So the investors' focus will shift from being on net interest margin asset quality towards the loan growth trajectory for the lender. So even if ROA declines from the current level of 4% to around 3.5%, they say that over the next 5 years and with AUM growth of 25%, the PAT CAGR will be at a healthy 22% to 23%. So this is one of the key reasons that they have written a note on it, and they say that no other large stock in their coverage and probable over the next few years will see such a trajectory on profitability. Back to you.
All right, Abhishek, thanks a lot for that. We probably get Abhishek to the games next time as well. So
all four of us.
All four of us. Nigel, Abhishek, Vinny, and we'll all go for the games. But as we do that, let's get you some good news. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or can just scan the QR code, which is there for you on the screen.
योर ओन क्रिटिकल थिंकिंग। चैट जीपीटी का जरूर से इस्तेमाल करो, लेकिन याद रखो आर्टिफिशियल बुद्धि से नहीं, खुद की बुद्धि से हम आगे बढ़ेंगे और आप आगे बढ़ सकते हैं।
Welcome back. You're watching us here on Chartbusters. Let's listen into Ruchir Sharma, chairman at Rockefeller International, discussing expectations of the Fed, how tariffs could impact global growth, and a lot more that's taking place right now in the world, which is causing so much uncertainty across global markets.
I think that he's changed his tone a bit, because in the couple of weeks ago after the Fed meeting, he was tempted to use the word transitory again, but I think that he sort of walked back on that. But the market doesn't believe him. The market thinks that he's going to capitulate soon enough, because that's been the Fed's track record for the last couple of decades. And at the first sign of economic trouble, they tend to capitulate. They did that last September, and even before that with SVB. But there's a long history of the Fed having capitulated, and the fact that the Fed has missed its inflation target now for 5 years in a row and will do so for another 2 years. So I'm really surprised in a way as to where the market is pricing in these rate cuts, but also sort of understand it, because that's been the Fed's track record going back the last few years, if not decades. Obviously, global growth is going to take a hit, but I think that at the end of what's going on here, and something we've spoken about as well, is that the rest of the world is laser focused now on trading without America. So what's happening there is that they're sort of expediting their trade deals of trading with each other, as I've sort of written in the past as well, that if you look at the 10 fastest growing trade routes in the world, only 2 now involve America, 5 involves China and other countries. So the world is moving on, but obviously in the short term, everybody gets hit. But this is a very different kind of market reaction and even downturn that, as you know, that this time, even after the carnage in the international markets over the last couple of days, the US market has really underperformed, and the dollar, in fact, has weakened through this all. We went into this with the US being the most overhyped, overowned, and overvalued market in history relative to the rest of the world. That never before had so much capital flown to the US. 80% of all flows into the stock market globally went into just the US market this decade. So there's a lot of unwind of that which has to happen, and a lot of that capital came in unhedged, expecting the dollar to appreciate. So that's why, you know, that was something that we discussed was the mother of all bubbles, and that bubble is now being pricked. But this credibility damage is going to last, and I suspect that over the next few years, the US stock market and US assets are going to underperform, no matter how this tariff drama is resolved.
Well, keep an eye out on the markets. We saw a bit of an intraday dip, but it appears, at least as of now, that dip has got bought into. Cipla and Dr. Reddy's, both of them should come up for you on the screen. Both of them have perked up in the last few minutes. So let's get up an intraday chart out there. You have SBI Life as well, that was trading in the red. That's moved into the green. So good going on that. And ITC, that's a larger weight on the index, has been a bit of an underperformer. That one as well has moved up. So, the markets are now holding with the gain of close to around 200 points. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is coming up next.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. And at 11 o'clock, markets are still going strong, up 200 points on the Nifty, 650 points on the Sensex. But we've come off a tad bit from the day's high. At session highs, the Nifty was up nearly 400 points. Now we're up about 200 points. But still, it's a pretty good rebound after the massive sell-off that we had yesterday. Midcaps are up 1.5%. A quick word on the picture across the Asian market. Hang Seng is leading the gains, rebounding after what was a fairly tough session for them yesterday. So Nikkei is up close to about 5.5% on expectations. It will get priority in trade talks with US. Nikkei is the one we're referring to. Nikkei is up close to about 5.5%. Hang Seng Shanghai up in the green, up nearly about 1%. Taiwan, though, continues to, come under stress. The Taiwanese markets, no rebound, no participating in the global rebound. That's still down close to about 4%. And names like TSMC, etc., are down nearly 4%. So after the historic fall that it had, the sentiment hasn't settled on all of Asia.
Thank you so much. And good morning, Rima, to you as well. Thanks so much for, number one, highlighting what's exactly happening as far as the Asian markets are concerned, given the fact that that is what has actually rubbed off in terms of a positive sentiment for the entire Indian markets. We opened in tandem with global markets, a bit of a bounce, cooled off the opening highs, but again, in the last 20 minutes or so, as you can see on the screen, the Nifty chart indicating a bit of a bump up. What's actually doing very well for the markets today? The financials pack. So Goldman Sachs today has upgraded quite a few stocks. So look at names like Axis Bank, SBI, PNB Housing, a double upgrade coming in there. So all of these stocks are the ones that are doing very well in the session. Remember, Axis as well as SBI have significant weightage as far as the Bank Nifty is concerned, and they are the ones that have taken the markets higher. OMCs, it's been a very volatile trading session for all of the three OMCs, HPCL, BPCL, ISCL, opened higher, cooled off significantly, and now once again seeing buying activity. LPG price hike, that is something that the street would cheer as far as OMCs are concerned. However, the corresponding excise duty cut has taken a bit of a sheen off yesterday's announcement. And lastly, watch out for both BSE as well as MCX. You've seen significant volatility as far as markets are concerned. And on the back of that, the rising premium turnover is something that the street likes. So both MCX, number one, almost 5% higher today, and BSE is the other stock. Both of them have bounced back quite significantly post the recent pretty brutal sell-off.
Okay, and one more delivery. Today it's seen a fall of close to about 6.5%. Yesterday it was fairly resilient after it made the acquisition of the rival company Ecom Express. But today, selling pressure visible on delivery. But let's get back to the big story, and that's oil marketing companies. Lots of news flow over the last 24 hours. An excise duty hike of 2 rupees per litre on petrol and diesel. An LPG cylinder hike of 50 rupees. What does all this mean for oil marketing companies? Sudarshan is now joining in to explain it. Sudarshan.
So yesterday, Oil Minister made 3 announcements. First, special additional excise duty will be increased by rupees 2 per litre. Second, LPG price is going to be increased by rupees 50 per cylinder, and LPG compensation to be made to oil marketing companies. Now, these announcements at the first go will look positive, will sound positive, but if you dig deep, it's not that positive. Why? Now, the first coming on excise duty hike. So, government has increased by rupees 2 per litre. Now, where will this excise duty go and where will it come from? First, oil marketing companies will borne this excise duty hike. So basically, ideally, whenever the excise duty is hiked, the prices, retail fuel prices go up. But in this case, Oil Ministry has announced that retail fuel price will remain the same as it is now. So OMCs will borne the excise duty hike, and now whatever money from excise duty that comes will be paid for LPG dues for FY25. So in FY25, total LPG under recovery was rupees 41,338 crore. Now from excise duty hike, total, as per calculation, around 30,000 to 32,000 crore might come, so that money can be used. But here there is a catch. Now, normally LPG compensation amount goes into special fund, but due to excise duty hike, this fund will go into exchequer amount. So basically, Oil Minister will have to go back to Finance Ministry requesting for that money to come as LPG compensation. Now, second is LPG price hike of rupees 50 per litre. Now, that is going to, so currently on one cylinder, oil marketing companies incur loss of around rupees 220, 250 per cylinder. That's a loss. Now, after an increase of rupees 50 per cylinder, there is a likelihood that that price loss will come down to around rupees 200, and this will help these companies to reduce their LPG under recovery for FY26. So, excise duty hike will be used for LPG under recovery compensation for FY25, and LPG price increase will be used to compensate for ongoing losses on LPG. Now, this was the announcement. The last question that comes, that will retail fuel price increase because of excise duty hike? The answer is big no, there will be no change. And here also, Oil Ministry announced that if crude price remains in the current range, basically $60 to $65, or even it increases to $68 per barrel, there will be a headroom for oil marketing companies to reduce fuel price. So this will also be uncertain on the oil marketing companies going forward. Now, what do brokerages feel? HSBC says that it maintains buy call on all the oil marketing companies, but it has cut target multiples due to increased risk perception. CLSA says marketing margin will remain higher than any of recent quarterly averages for Q4, because most of the oil marketing companies were making marketing margin of around rupees 12 to 17 because of sharp down move in the crude. And it also said that oil minister's comments raises the chances of a cut in retail price. So overall, these announcements were minor positive, but if you go in details, it's not that great, it's not that huge positive. Also, retail fuel price cut will be a focus area going forward for the oil marketing companies.
Thank you so much, Sudarshan, for joining us and telling us exactly what has transpired last evening and the implications for the OMCs as far as the entire excise duty cut and LPG cylinder price hike is concerned. But remember, yesterday Piyush Goyal cleared the air over BYD's plans to enter India, the Indian auto market, that is. Let's listen in to that, and also Sudarshan then joins in to explain what this means for M&M.
Well, we need to be convinced that they will work by the rules of the game, and several unfair practices which are gradually coming to light as more and more companies come to us with what's happening, the kind of dumping that's happening in steel, for example. I mean, as these practices come to light, we have to be cautious in whom we allow to invest in the country. We have to be cautious about our strategic interests, our security interests. So it's a mix of many issues before we are able to take that decision.
Okay, sorry, no BYD, yes for Tesla. That's the word coming in from Piyush Goyal. So, Darshan, what does all this mean for, say, a company like Mahindra & Mahindra, which is a dominant player in the EV marketplace in India?
So if you remember last month when there was a news report regarding that BYD is going to set up a manufacturing unit in Hyderabad, that day we had seen a sharp fall in M&M stock price. It had fallen almost 6%. Now this announcement of Commerce Minister Piyush Goyal that it's a complete no as of now for BYD, it would be taken positively, and the reason is because recently M&M had launched two electric-borne vehicles, and the price range was above rupees 19 lakh and it was up to rupees 30 lakh. So normally BYD vehicles also come in the same range or slightly higher. So it was being seen as that if BYD is allowed in the Indian market to manufacture. So normally see, as of now, whatever vehicles we import, built-in vehicles, India charges 100% tax. But if it would have been allowed to manufacture in India, the prices would have come down and it would have been a huge competition for M&M. But now this Piyush Goyal's comment should be taken positively, and it will be positive for M&M because now there won't be any major competition.
Thank you so much, Sudarshan, for joining us and explaining what exactly the non-entry of BYD means for M&M. Well, there's been a significant rebound as far as the markets are concerned. First up, look at the entire FMCG pack. Falling crude prices especially bodes quite well as far as the paint stocks are concerned. So look at names like Berger Paints, look at names like Asian Paints. Both of these stocks are near the day's highest point. Also look at some of the pharma companies. They've rebounded quite sharply. Look at names like Cipla, Dr. Reddy's, Sun Pharma. There's been a significant rebound coming in as far as some of these names are concerned. We highlighted, some of the larger banking names, but have a look at names like Bandhan Bank. That particular stock up almost 4% higher in today's trading session. But what we'll do is we'll slip into a short break. Up next, we'll discuss what's buzzing in the market on the other side.
Cash.
Welcome back to Trading Hour. Well, let's have a look at the mid-cap and small-cap end of the markets. The mid-cap index up 1.7% in the session. The small-cap index up close to 2%. So it's a significant rebound that we're seeing from the brutal sell-off that we saw yesterday. In fact, if you look at the advanced decline ratio, there's been a significant improvement over there as well. The advanced decline ratio, advances far outpacing declines, especially when we are looking at, look at it, over 2,100 stocks in the green, just around 400 stocks in the red. But we are now shifting focus to the commodity space. Manisha joins in, and today we're focusing on crude.
Thank you for that, Vivek. Well, yes, we've seen some possible technical recovery come in for the crude oil prices. Overnight, we've seen 1% of gains come in for the crude oil prices. This is after very sharp losses that we've seen in many recent sessions, down by nearly 15% in the previous week itself. So some technical opportunity buying is what we've seen in crude oil prices. Also, this is happening after US threatens additional 50% of retaliatory tariffs on China. So the market's clearly slightly jittery there. Apart from that, the street does believe that the break-even cost for the shale oil producers in US comes at around $60 a barrel. So every time you will see 60 break on the lower side, there's going to be some resistance at those lower levels there. So as of now, markets feel that there is some support or a bottom being created around these recent levels. But then apart from that, if you look at the kind of interest that crude has, we've been looking at record volumes in the Brent prices there. If you look at Brent trading globally, 75% of international crude oil trade happens in Brent in the Intercontinental Exchange, and we're looking at volumes really surging on Friday, on Monday, yesterday as well. The markets also are looking at the kind of cues that we've seen in sense of economic data. Chinese numbers have not been so great. US has FOMC meeting minutes that are going to be released tomorrow, and then you have manufacturing and retail data as well coming in this week itself, and markets would take further cues from that. In the meanwhile, a report from Citi says that they are cutting their price forecast for this year for Brent, and $60 is what they're talking about in the next 3 months itself. We are currently trading at around 65 on your screens there. There also is a report from JP Morgan which says that they're looking at a surplus of crude oil availability in this year. They're anticipating a number of 1.3 million barrels per day. This is in line with various other banks and brokerages as well. They believe that 1 to 1.7 million barrels per day of a surplus is what this year could be seen in crude oil prices, and that perhaps would continue to weigh on there.
Thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in next as the Nifty surges close to about 300 points. We'll also get in his top trading bets. Welcome back. Let's talk about Titan Industries because that is rebounding smartly after hitting 52-week lows yesterday. The company came out with their pre-quarterly Q4 update, and it looks like we've seen fairly broad-based growth, Mangalam, across the categories that they operate in, whether it's jewelry, watches, eyewear, etc. And a decent retail expansion footprint also continues.
Well, the Titan's fourth quarter update was fairly steady, and a large part of that can be attributed to the big rise that we've seen in gold prices itself. So their overall revenue growth on a standalone basis is around 25%. And remember, over 3 quarters that their revenue comes in from jewelry business, which itself has grown at around 25%. And in jewelry itself, gold grew at 27% for jewelry, and gold coins grew at around 65% year on year. Remember, these are low margin products for the company. So let's see how that pans out in terms of the overall margins for the company. The other verticals of the company, be it eyewear, watches, grew between 19 to 22%. The emerging businesses of the company, which is fragrances and ethnic wear and fashion accessories, in that ethnic wear, Taneira actually saw a sales decline of 4%, because of which emerging businesses grew just by about 7%. Carrot Lane, which in the past has been growing upwards of 30-40%, has now seen a growth slowdown to around 22% itself. What does the company attribute this growth slowdown to and the growth upmove to? The growth upmove is led by higher gold sales and the gold prices itself, but there has been low buyer turnout or single-digit buyer turnout, and that's because of the weakness that we're seeing in consumer sentiment at lower levels, and that's visible even in their studded business, which has actually grown in just low double digits as against the 20% plus growth that we've seen in gold verticals. So to that extent, while we're seeing good growth in their overall revenue, margins are something that the street will most definitely keep an eye out on, along with the sluggishness that we're seeing in emerging markets or emerging businesses for the company itself. Brokerage house Macquarie has an outperformed rating on the stock with a 4,000 rupee target price. They believe good growth in jewelry and eyewear along with watches is the key takeaway, but the key weakness is the low turnout that they've seen in terms of buyers, especially in the solitaire, high-end solitaire businesses, which will impact their studded ratio, and therefore margins are something they will definitely watch out for.
Thank you so much, Mangalam, for joining in and telling us about what exactly is driving Titan higher today. But Bharat Electronics is gaining in trade on the back of an order win. Upansna joins in to tell us more.
Well, the company continues to bag a slew of orders in this month as well. Now, company has received order worth 2,210 crores for electronic warfare suite for Mi-17 helicopters from Indian Air Force. Now, this order forms a part of 5,000 crore order pipeline that the company had indicated when negotiations concluded pending finalizations. Now, this is the second order received from Indian Air Force in this month by the company, and mind you, company had earlier received order worth 593 crore on 2nd of April. Now, on the back of this order win, Phillip Capital says that the company has kicked off FY26 on a strong note, securing orders over 2,800 crore in orders within just the first week of April. It believes that the valuations of the company, they stand attractive at 27 times FY27 EPS and maintains a buy rating on the stock with a target price of 390 per share. So on the back of this, BEL continues to remain in focus with the strong order win momentum.
Thank you very much for that. Let's now turn our attention to the realty sector. Lots of Q4 updates coming through, whether it's from Godrej Properties or Shobha Developers. Vinny is now here with a complete picture.
Hi, morning. So in terms of Godrej Properties as well as Shobha Developers, we have Q4 updates. So for Godrej Properties, good numbers coming in the business update. Quarterly bookings have crossed around the 10,000 crore mark. Pre-sales have seen a good growth, around a 55% CAGR growth over the last 3 years. Now, this quarter, strong bookings was led by strong demand in the key new projects which were launched during this time as well. So, good performance on the new projects. Overall, FY25 booking value grew by 31%, which is beating the guidance that the company itself has given. And the highest ever booking value that they've seen on an annual basis was reported by the company this time. Other than that, the NCR, MMR as well as the Bangalore region saw a good performance as well in FY25 for the company, and overall business development was at around 26,500 crores in FY25. Good performance coming in from Godrej Properties in terms of Q4 update. Now, Shobha Realty, overall when you're looking at it, it's a good Q4 update. But on FY25 basis, it's a miss coming in on the guidance front, and that is why a bit of that worry that comes in on the overall FY25 sales decline front. Sales value grew by 22% for Q4, and overall in terms of volume grew by around 16%. Bangalore, which comprises around 80% of the business, saw good growth, while on the other side we've seen Kerala business that saw a sharp fall in terms of the volumes as well, a decline of around 52% on a year-on-year basis. Overall sales volume for FY25 declined by 23%, missing the guidance that the company had spoken about, and that is why something that we're watching out for, though as of now Soba is still managing to hold on to gains of almost 2%.
Thank you so much, Winnie, for joining in and telling us about the realty space. But stay on, because we're also looking at the pharma space. And today, Goldman Sachs has come out with a very interesting report on the CDMO space with a bullish stance on two pharma stocks, both Suven Pharma as well as Piramal Pharma. Tell us and give us more details on that.
Absolutely. So, Suven as well as Piramal Pharma, they've initiated coverage on this one, Goldman Sachs, both these companies. Firstly, Suven Pharma, buy rating, target price of 1,350 rupees per share. Goldman Sachs is highlighting that they expect a strong rebound, structural growth starting from FY26 and onwards. They expect continued traction in the top 3 to 5 drugs for the company. Potential approvals for newer drugs will come in, so which will lead to better growth for the company going forward. And successful integration of these recent acquisitions by the company, Cohance as well as NJ Bio, is something that will help the growth and enhance the growth for the company going forward. They expect the combined entities EBITDA to be compounded around 20% of CAGR in the medium term as well. So good growth expected going forward. Now on Piramal Pharma also, positive on this one as well. Buy rating, target price of around 275 rupees. They believe that Piramal Pharma is well placed to deliver a very good growth in terms of profit that they're expecting. PBT margins for the company, they expected to jump from just around 3% in FY24 to more than 16% in FY25. And what will 28, I beg your pardon. What will lead to this growth? The turnaround in the CDMO business, good growth in the CDMO business from FY26 and onwards. The company has been working on smaller molecule sites as well. So that is something that will support the growth. In the CHG business, that they're expecting a capacity ramp up, which will lead to better growth in FY26 and onwards from here on. And as well as the consumer healthcare side of the business, they're expecting a turnaround there as well, and good growth on that front. So overall growth for Piramal Pharma on the back of 3 segments doing well for the company.
Thank you very much for that. Goldman, in fact, has also written on the banking pack where they've upgraded a PNB Housing, Axis Bank, State Bank of India. But not just that, we also have a CLSA note on Bajaj Finance. Abhishek is now joining in. He's compiled all the notes that we've got on the banking sector, and he joins us to give us the details. Abhishek.
Well, Rima, to begin with, Goldman Sachs has written on financial services sector. Now, they have written on PNB Housing, upgraded the stock to buy. New target prices about 1,184 per share. They say that the company's, visibility on profitability is improving, and along with the fact that loan growth is expected to remain strong. Axis Bank, they have upgraded to buy target price of 1,228 per share. They say that the valuation mean reversion is seen over here as profitability and growth are nearing bottom in H1 FY26. So the company or the bank is one of the big beneficiaries with respect to liquidity infusion into the system, which should support its loan growth trajectory going ahead. They have also upgraded SBI to buy from neutral. The new target price is about 823 per share. They say that the risk reward looks very balanced right now, and the stock has actually derated from 1.1x 12-month forward that it was some time ago to right now about 0.9x 12-month forward price to book value. So this valuation reversion that has been seen seems to be fair for a 90 basis point ROA franchise that SBI has. CLSA has written on Bajaj Finance. They have an outperformance rating with a target price of 11,000 per share. They say that with asset quality headwinds is receding for the lender, they expect Bajaj Finance to regain its class from FY26. So investors' focus should shift away from net interest margin or asset quality towards the loan growth trajectory for the lender. So even if ROA declines by 50 basis points, say from 4% to 3.5% over the next 5 years, and AUM grows at 25%, the PAT CAGR will still be a healthy 22 to 23%. So as per them, no other large stock in their coverage and probably overall in India offers such a healthy PAT growth over the next 3 to 5 years. Back to you.
Thank you so much, Abhishek, for joining us and giving us a roundup of what brokerages had to say as far as the BFSI space is concerned. Well, if you could pull up the intraday chart of Delivery, you'll see that that stock is now seen significant selling pressure at the day's lowest point, almost 8% low as far as Delivery is concerned. There you see, yesterday was a significant outperformer in the weak market, but today has given up all of those gains and in fact is now below where it was yesterday. But as promised, Mitesh Thakkar now joins in for a quick technical check on the market. Thank you so much for joining us, Mitesh. It's a very volatile last couple of days as far as the Nifty levels themselves are concerned. Where do you see markets headed from here on, and immediate resistance and support levels?
Yeah. So one, I think it will be choppy. You're right. I think this is a market which had a big gap down and then some short covering today. But my understanding is that till we actually managed to cross 22,600, 800 zone, which is where the gap happened, I think we'll see supply at higher levels, and we still haven't done any kind of base building, which means that on the lower side also the earlier lows could be revisited. With that, the overall index was slightly on the negative bias, so it's a sell on rally kind of thing. In fact, instead of selling in futures because of the volatility, what we've advised people is to get into some kind of bear spreads or put spreads, and that could possibly make things easier from a trading point of view. On the stock side, I have one sell and one buy. A sell on Tata Steel with a stop at 133.5 and targets of 120. While Pidilite is on the buying side, keep a stop just below levels of 28.75, look for 29.50 as the target area.
Got that. Thank you very much, Mitesh, for joining in. While IT is rebounding, one stock deserves mention, and that is Cyient. Cyient is up nearly 3%. Today, the company is holding a press conference at a hotel in Mumbai where they will talk about their new semiconductor subsidiary. Remember, earlier this month, or just about 2-3 weeks back, the company carved out its semiconductor business from the existing Cyient business and created a dedicated, wholly owned subsidiary because they believe this semiconductor business has a lot of potential and it requires its own focus and dedication. So the company will be holding a press conference today in Mumbai to talk about the potential. The revenues of the semiconductor business is about 225 crore as of 9 months of FY25. But what are the projections? What's the outlook looking like? The amount of investment that the company will be making in it. So Cyient should be a stock you should watch very closely. Get into a break. On the other side, market fundamentals lined up with Rohit Sikseria from Sundaram Mutual Fund. Stay tuned.
Welcome back to Trading Hour. Well, Rohit Sikseria from Sundaram Mutual Fund now joins in to discuss market fundamentals as well as his top sectoral picks. Thank you so much, Rohit, for joining us. First up, analyze for us, how exactly you've read all of the developments over the last 48 hours, the impact of the tariffs, and what is it that you like or dislike at at the current juncture?
Thanks. See, short term, this tariffs and the narrative of the tariffs will keep the markets volatile. And it's very difficult to say how the entire tariff situation plays out because it's all dependent on what one individual wants to do. So I guess for the next 2-3 months, we'll have to wait it out and see how the tariff and its impact plays out in the short term. However, if we look beyond the tariffs, the domestic macroeconomic environment is improving. the sharp correction in the crude prices is going to help the domestic economy. Even it's going to help the government revenues. Like yesterday we saw government increased excise duties, which would shore up the government revenues, whatever shortfall they may have from income taxes. RBI, on the other hand, is ensuring there is sufficient liquidity in the system. From liquidity deficit environment, we have moved to liquidity surplus. That will ensure that the rate cuts which RBI does gets passed on. So we are looking at an environment, monetary environment, which is more conducive. And with crude price correction, you will have margin tailwinds. In such an environment, I guess once the tariff headwinds, we are clear over that, markets should rebound in that kind of environment.
The problem is no one knows how this tariff, certainty, how prolonged it's going to be. In the meanwhile, markets are going up, down, anywhere, and narratives are changing by the day. But Rohit, be that as it may, because it's outside our control. Are you putting money to work at current levels in the Indian markets?
See, as a house, we are always fully invested. We don't take cash calls. So we remain fully invested. And the way we are trying to navigate this is by focusing more on domestic part of the economy rather than looking at the export-oriented names. So that's how we are navigating this short-term tariff-related volatility.
Understood. Rohit, we are now heading into Q4 earnings season. In fact, a couple of numbers will start trickling in today, tomorrow. IT starts off. So going into Q4, what are your expectations? Where do you think we will end FY25 at? And any initial estimates that you have for FY26?
See, Q4, our expectations are in line with consensus expectations. Mostly flattish kind of an earnings growth is what we are looking at for Q4. As I told that the improvement which we have seen recently, both from the crude and from the RBI side, will take time to flow through to the economy. So somewhere towards the later half of F26, I believe we'll start seeing improvement. So overall F26 should show a good double-digit kind of a earnings growth, would be my early guess right now.
What are the sectors that you like and what is it premised on?
See, as I told you, we are right now more focusing on domestic sectors. And one sector which I like the most right now is the banking and NBFC space. That's one sector where valuations have been very reasonable, and with RBI providing support not only from surplus liquidity, but from on the regulatory side, they are more supportive of growth now. So in such an environment, we believe the banking and NBFC space should do well. In the environment where RBI is cutting rates, your NBFCs tend to outperform as their interest margins expand. So that's where we are playing at. One concern this sector had about was retail asset quality, but that also we believe was too much was made out of it. It's well under control. So this remains the best sector according to me. Another sector which we look at is the consumer discretionary sector, the specific pockets of consumer discretionary sector like luggage, durables, restaurant, hotels. These are the pockets where we are looking to play.
Understood that. Rohit, you said, you have a very positive stance when it comes to the BFSI space. You also enumerated the reasons why you like that space. Now, within the BFSI pack, where does your preference lie? Is it the large banks, the PSU banks, private banks, or is it the NBFCs, or would you look at some of the MFIs that have been beaten down quite a bit?
See, right now, what I like most is the NBFCs and the MFI space. NBFCs, as I told, is a play on the interest rate cycle. As rate cuts flow through, their net interest margin should expand, and that should lead to a better earnings on the NBFC space. MFI space is very interesting. The valuations have corrected sharply because of the asset quality stretch which they endured for the last year. But the recent updates are quite encouraging. In most of the states, the asset quality has started improving. And in such an environment, I see a very good risk reward even in the MFI space.
Understood that. So BFSI, we have your views. Now, two sectors, that have been impacted the most, especially from the tariff tantrums. First is the IT pack, worries of recession, that is something that has led to significant selling. So IT, given the fact that FY26 Q4 expected to be quite muted, would you turn positive from here on? And what is your view on the pharma space? Do you like any names there? Would you be positive on that front?
Right now, I'm maintaining more of a neutralist stance, as the recession fears are more or less getting priced in. But now the growth, I don't see short-term growth surprises coming from that sector. So that's why I maintain more of a neutralist stance on the IT side. On the pharma side, it's a little more cloudy according to me. A big part of pharma earnings over the last couple of years came from one particular drug, Revlimid, and that's going to expire next year. So we need to see how that plays out is one part. And secondly, the entire tariff narrative, how it flows for the pharma, we don't know right now. So pharma, right now, I'm avoiding till the time the situation gets clearer.
Understood that. So IT, a neutral stance, pharma at this point of time is an avoid for you. Well, let's talk about, some of the domestic facing industries as well. Auto is one particular space, there's been significant volatility, worries about, impending entry of larger players from the US market, BYD entering, or maybe not entering, as is the clarification that has come today. So do you like autos at current levels? And within autos, where does your preference lie? Is it the passenger vehicles, the CVs, or the two-wheelers?
Yeah, I am positive on autos, and within autos, what I like most is the auto ancillary pack. It's the specific pockets of auto ancillary, because auto ancillary becomes quite wide. There are specific pockets of auto ancillary which are doing very well. They are gaining share, market share and wallet share from the clients, and they are expanding well. So that's one pack we like. And within the four-wheelers, two-wheelers, I believe four-wheelers gives us a better risk reward. One from the income tax cut this year, we are expecting some sort of a demand improvement, and some of it should flow in the auto pack, and more of it going into the next year when the pay commission revision comes in. That's when we believe the four-wheeler pack should start doing much better.
Okay, got that. Just wanted to get your thoughts in on the EMS companies, because there was this Apple news that how they're planning to send more phones to the US from India to offset the high cost of China tariffs. If this happens and it gets more broad-based, do you think it could be a big boost for EMS companies? The only issue is that while the opportunity is there, valuations have also been always, on the higher side for the last few years.
Yeah, see, that's again coming back to the tariffs or differential tariffs between India and China. Right now, it's very difficult to take a call on how it finally ends up. I don't think any company right now will be making changes to the supply chain based on the initial numbers which has come out. All the companies will be waiting for how it finally plays out, what's the final stable numbers, and based on that, they will be taking a call on how to reorient the supply chains. If the current numbers stay, then there may be some marginal benefit to Indian EMS companies. But as you rightly said, valuations are more or less pricing much of it. So right now, I am not that positive on the EMS names.
To that, thank you so much, Rohit, for joining us and giving us a view across a whole breadth of sectors, especially in this volatile time. But we'll move on. We'll take a quick break. We'll get you more on the markets on the other side.
Welcome back. Speculation on some sort of tariff pause circulated on social media caused stocks to whipsaw before the White House called it fake news. Prashant joins in more with the kind of a roller coaster session that Wall Street had, with more on this particular development. Prashant.
You know, what does it take to move trillions in global markets, right? As last night we saw, all it needs is just one headline, and that too unverified, and as markets found out later, a fake one. Now, this is a story of how sentiment whipped in minutes based on pure speculation and nothing else. Let me tell you how this played out. Even as equity indices were starting to recover from the lows, rumors broke out on Wall Street that Trump may announce a 90-day tariff pause for all countries except China. The headline was picked up and flashed across news networks, and Wall Street went vertical. The S&P 500 added over $3 trillion in market capitalization from the intraday lows. I mean, in terms of percentage gains, the Dow was up 7%. I've taken lows to the high. Remember, some part of it, of course, already happened. And market, as I said, was already recovering when these headlines hit. S&P went up 8.5%. The nasdaq rallied 10%, all in a matter of minutes. Well, but, you know, in a matter of minutes again, but minutes later, came the first crack. Reports said that the White House was unaware of any such move. The White House officially denied the story to CNBC, calling it fake news. And almost immediately, the market went south, giving up all the gains it had accumulated a few minutes prior. In all, trillions of dollars, you know, by some estimates, $5 to $6 trillion swung on the back of this headline, this fake headline, in less than 30 minutes, driven purely by hope, greed, herd behavior, and just general sort of anxiety. What are the lessons here? And I think the lessons are very true for our markets as well on a daily basis, but I think in markets like this. You know, this is a market where there is extreme emotion. Markets are in a fragile state. Number one, you can't take headlines at face value. Please investigate sources first. I think that is paramount. It has to come from credible news sources, not an unverified Twitter account without any backing. Also, it kind of helps to stay a bit cynical, especially in markets like this, unless proven otherwise, even if a short-term bounce cannot be ruled out. I mean, I think it just generally helps. Bring me proof. You have to have proof before you decide to act because there is real money at stake. And of course, as always, remember, short squeezes in bear markets, or I'd call it this bearish markets, can be vicious. I mean, they can be absolute rippers like what we saw yesterday. To wrap it up, I was wondering, right, and I think many are as well, markets were down sharply 4, they went up 4, so 8%, but they did not go down 4. We ended flat. Why is that? Why is that? And the reason perhaps is a little tongue-in-cheek, but, you know, maybe the thinking, at least among some market participants, is this: imagine if a fake headline can do this to markets, what could a hypothetical real headline of some sort of relief do? So maybe better to be a little light. The simpler explanation, of course, I think is also in the mix, that markets are much cleaner. We've had 2-day historic falls, and people just want to stay a little light. So I think that is what we are looking at this point in time.
Thank you so much, Prashant, for joining and giving us a sense of what exactly transpired in a very volatile trading session as far as the US markets were concerned yesterday. But despite the sharp criticism against tariffs, President Donald Trump has shown no signs of reversing course. However, when asked whether tariffs are permanent or have space for negotiations, this is what he had to say.
They can both be true. There can be permanent tariffs, and there can also be negotiations, because there are things that we need beyond tariffs. We need open borders. There are a lot of things like opening up countries that were totally closed. China is essentially a closed country. In fact, it is a closed country. And what they do is they charge tariffs so that if you sell cars or if you sell anything, nobody's going to buy it because the price is out of control. But that's true with a lot of other countries also. So we're going to get fair deals and good deals with every country. And if we don't, we're going to have nothing to do with them. They're not going to be allowed to participate in the United States.
China, for now, appears to be fighting back. So there is no one who is backing down, at least between US and China. But several countries have reacted to the executive orders imposed by Donald Trump. We have Dia joining in our special segment, Trump Watch.
In response to the steep tariffs imposed on car imports by US President Donald Trump, Canada has launched a complaint with the World Trade Organization, the global trade body said Monday. In the request, the Canadian government charged that the tariffs were inconsistent with US state obligations under international trade laws. Meanwhile, Israeli Prime Minister Benjamin Netanyahu met Donald Trump at the White House on Monday. The two are also set to discuss Gaza. Japan's Prime Minister Shigeru Ishiba said on Monday he had held a call with US President Donald Trump in which they agreed to more talks on the latest US tariffs. As the global trade landscape continues to evolve, India's Commerce Minister Piyush Goyal has weighed in on the ongoing tariff debate. Speaking on Monday, Goyal addressed the claims surrounding India's tariffs on US imports, responding directly to the Tariff King label given by President Donald Trump. Let's listen to what he said.
Our tariffs are a protection against these unfair trade practices, trying to remain abreast with new ways of beating the system. And a lot of our tariffs are to do with such protection against such economies. If you look at the United States, for example, while our overall tariff may be 17%, but a lot of it is products which we don't import it at all. Our applied tariff to the United States is probably 7 or 8%. It's not humongous. So really, it's a question of understanding India's tariff story.
That's all for today. Now back to you.
Thank you so much, Dia, for joining in and giving us a roundup of what exactly has been the response to the likely tariffs. Now, to discuss the impact of tariffs and also the way forward for markets globally, we spoke to a whole host of experts. Let's listen to a few excerpts.
11% of the U.S. economy is imports. 40% of those imports aren't finished goods. They're parts. That gets confusing, but I think you would know what I mean when I say that has a big impact on the supply chain, because it gets very, very confusing. And if this is sustained or permanent, then it would require pretty massive change in terms of the supply chain. So I think the impact is huge. 11% of our economy is like 3.3 trillion. That's the imports. It's profound, and it's self-imposed.
The main thing is that this has dramatically raised the risk of a Smoot-Hawley type outcome. So Smoot-Hawley was 1930. Other countries retaliated, global trade collapsed, and the Great Depression was on. So I think that's really what has people worried about this. It doesn't have to work out that way, but this unilateral move, abrupt, is setting up a situation where you could get a dramatic downturn in the economy. So Wall Street is marking up its recession probabilities, and I think that's appropriate. And I think this is probably executive overreach compared to what Congress. You can do things like this if you want, but you probably have to have Congress weigh in on that.
We went into this with the U.S. being the most overhyped, overowned, and overvalued market in history relative to the rest of the world. That never before had so much capital flown to the U.S. 80% of all flows into the stock market globally went into just the U.S. market this decade. So there's a lot of unwind of that which has to happen, and a lot of that capital came in unhedged, expecting the dollar to appreciate. So that's why, that was something that we discussed was the mother of all bubbles, and that bubble is now being pricked. But this credibility damage is going to last, and I suspect that over the next few years, the U.S. stock market and U.S. assets are going to underperform, no matter how this tariff drama is resolved. Obviously, global growth is going to take a hit, but I think that at the end of what's going on here, and something we've spoken about as well, is that the rest of the world is laser focused now on trading without America. So what's happening there is that they're sort of expediting their trade deals of trading with each other, as I've sort of written in the past as well, that if you look at the 10 fastest growing trade routes in the world, only 2 now involve America, 5 involves China and other countries. So the world is moving on, but obviously in the short term, everybody gets hit. But this is a very different kind of market reaction and even downturn that, as you know, that this time, even after the carnage in the international markets over the last couple of days, the US market has really underperformed, and the dollar, in fact, has weakened through this all.
And there are some estimates that the S&P 500 is still, after the correction, is still higher than the long-term averages. So even after the correction that we've seen, because of the whole of last year on the back of this US exceptionalism, we saw such a re-rating in the US indices. Get into a break. On the other side, we'll get you more in the market. Stay tuned.
Welcome back to Trading Hour. Well, tomorrow is a very important day. Remember, the RBI will announce its monetary policy decision tomorrow morning. Ritu joins in with the key expectations.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC-TV18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC-TV18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is, what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs. But for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
Thank you, Ritu, for that. Just a quick word in the markets as we wrap up on the show. Benchmark indices still up 1%, so 22,400 on the Nifty. So that rebound, it's been a largely steady session. Yes, we've come off a tad bit from the highs, but again, holding on strong. On the mid-cap end of trade, you've got some big winners. So one of them is 5-Star Business Finance. That's up nearly 9%. Vijaya Diagnostics, 8% on very, very large volumes. Capital Marketplace, we spoke about BSC, MCX. BSC appears to be gaining market share. For MCX, the options premium turnover numbers appear to be strong, but Angel One is also another mover there. Look at JM Financial. That's rallied close to about 4%. So if you have to pick a pack, a theme which is doing very well today, it's the capital marketplace in a very broad-based way. Well, that brings us to a wrap on Trading Hour from the entire team. Thank you for watching. Don't go anywhere. Halftime report is up next.
Stocks drift down after opening up with a big gap on hopes of trade negotiations tempering tariffs. Consumer durables, healthcare and realty have bounced up, but metals and utilities are the big drags. The indices are trying to recover from the lows.
Titan turns in a healthy growth in the gold jewelry segment in fourth quarter, riding on higher gold prices, but sales of studded ornaments lag. Other segments like watches, eye care and fragrances too grow well. The stock higher.
Bharat Electronics has bagged a hefty 2,200 crore rupee order for electronic warfare suits from the Indian Air Force, swelling its order wins in the early days of FY26 to nearly 3,000 crore rupees. The stock perks up.
Oil marketing companies gaining from a sharp drop in crude prices will pay an additional duty of 2 rupees per litre on petrol and diesel, even as they get to charge more for LPG. Funds from the fuel levy are expected to be used to pay for oil marketers' LPG losses.
US President Donald Trump threatens to levy an additional tariff of 50% on Chinese goods if the Asian giant does not roll back its 34% counter levy before the 9th of April. China proposes dialogue and warns it will fight to the end if the tariffs are levied.
Well, it's not just a tariff war, it is also a war for commentary, it's a war for supremacy, it's a war for headlines. That's exactly what's taking place in the global world right now. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. Yesterday was a big gash that we saw on our indices. Today is a mild recovery from those levels itself. Maybe the street is now coming to terms with what's taken place over the weekend after a big cut that we saw across the global markets in our own markets. The good part today, though, is portfolios might be feeling a little better than what we saw yesterday. And that's largely because the Midcap index is doing a lot better. 2,100 stocks in the green. From yesterday's low to now, there has been a recovery of nearly 600 to 650 points on the frontline index. That's the Nifty Bank leading charge as well ahead of important events like the RBI policy outcome tomorrow. Hi, Horma.
Hi, Mangalam. Some very important days lie up ahead, as you just mentioned. The RBI policy tomorrow, the day of the reciprocal tariffs also kicking in on the 10th, which is Thursday, which is a market holiday for us. But it is a very important day because also TCS will be reporting results that day, starting the earnings season for the Nifty 50 constituents. Of course, as Mangalam just mentioned, the broader market's doing very well for themselves. There are some enough and more stocks that are in the green, 2,100 of them to be precise, and 5-star Business Finance is leading the pack here, 8.5% higher on the Nifty 500. The top gainer there, Vijaya Diagnostics, is the other one, 8.25% higher there as well. And some of these consumer durable names, or the electronic component manufacturers, if I can call it that, the likes of Keynes Technologies, PG, Electroplast, all of them seeing gains of anywhere between 6 to 7% in today's trading session. Speaking of a Tata Group name, as you mentioned, TCS, but Titan is the one that's in focus today. That's doing well after it reported its fourth quarter business update. And Mangalam, it looks to be a good number.
Looks to be a good number, but there are a lot of internals out there which we need to watch out for. Why is it that the street is reacting so positively to these numbers? Because one, Titan's base is fairly high, and on top of that, a 25% growth is something that the street is reacting to favorably. Remember, the stock had actually hit a fresh 52-week low in yesterday's trading session. So from oversold levels as well, it is moving higher. If you look at the details, X of jewelry, the other businesses have done extremely well. Watches up 22% in revenue, eye care up 19%. But it is the jewelry business which was actually led by higher gold prices. The company itself said that, gold jewelry saw 27% revenue growth. In fact, gold coins saw a 65% jump as well. What did not do too well for them are a couple of things. One, buyer growth was in low double digits or high single digits. That's actually not doing well for them. Even the, diamonds or studded jewelry has grown in low double digits itself, which again is lower than what the company's gold business has been, implying that the margins this time may get compressed. The third thing is CaratLane, which grew at 22%, is a positive. But remember, in the past, CaratLane has been growing at a CAGR of over 35-40% as well. So that has actually seen a bit of slow growth. Emerging businesses, which include the likes of fragrances and ethnic wear, fragrances grew by 26%. Ethnic wear, which Titan's next big foray was in Tanera saris, has actually seen a decline of 4% in their revenues. So those are a couple of factors we need to keep in mind. We've had the brokerages right as well. Macquarie has a 4,000 rupee target price on the stock. They expect 20% standalone EBITDA growth for the company. Now, this is important because if the revenue growth is 25% and the EBITDA growth is 20%, it implies margin compression as well. So let's see where it goes from here on. But from lower levels, the stock has seen a bounce on the back of news that revenue growth has been healthy at 25%. And this quarter has some triggers in the form of, lower gold prices from the highs. And secondly, Akshaya Tritiya towards the end of this month too.
Indeed, and it's showing up in the stock as well. Of course, you can also attribute that to the move in the markets as well. So 4% higher on Titan after its business update. Moving on then, we're gathering from our sources that oil companies are set to mop up around 9,000 crore rupees in FY26 on the back of the LPG cylinder price increase. But to explain, all of that has gone down since last evening and there are plenty of developments there. Sudarshan is joining in to tell us just that. Sudarshan.
So stocks of oil marketing companies have been extremely volatile, opened with gains of 2 to 3%, then had turned flat. Now again, all these three stocks are higher in the range of 2 to 3%. Now, what led to these gains? So first, yesterday government made three announcements. First, it increased special additional excise duty on fuel, that is petrol and diesel, by rupees 2 per litre. Second, LPG price was increased by rupees 50 per cylinder. And third, also announced that it will make compensation for LPG dues. Now, the first question, why was excise duty increased? So excise duty was increased by rupees 2 per litre to compensate LPG dues for FY25. Now, total LPG under recoveries for FY25 as per Oil Minister was rupees 41,338 crore. Now, as per the calculation, total that government is going to mop up by the hike of excise duty of rupees 2 per litre comes in the range of 30 to 32,000 crore. Now, what sources suggest that government will soon move to cabinet seeking the approval for the compensation of 30 to 32,000 crore that can be paid to oil marketing companies for LPG compensation. Now comes to increase in LPG price, which was increased by rupees 50 per cylinder. So what was the reason of increase? Now that increase is going to be basically government will use that increase to make the payment for ongoing dues. So currently all the oil marketing companies make losses of around rupees 220 to rupees 250 per cylinder. That's the loss. Now after the increase, that loss should come down to rupees 200 per cylinder. So basically now the biggest question comes that now after the excise duty hike, will the fuel price at the pump that we buy, will the price increase? The answer is no. Why? Because all the oil marketing companies will bear the loss. So basically they have increased the excise duty that will be borne by oil marketing companies. They are taking money from oil marketing companies and again pay it back as LPG compensation. Now there is a catch here also. Normally LPG compensation that government used to announce used to go into special fund, but in this case it will go into exchequer money. Basically oil ministry will have to go back to finance ministry asking for that money. What do brokerages feel? HSBC believes that it basically increases the risk perception, but it maintains buy call on all the oil marketing companies. CLSA says oil minister's comments raises the chances of a cut in retail price. Why CLSA is saying this? If you remember, yesterday oil minister has said that if crude remains in the range of $60 to 65 per barrel, or even if it increases to $68 per barrel, there will be a headroom for oil marketing companies to cut the retail price. So going forward, the one thing that will be in focus is the cut in the retail price, because these oil marketing companies are making a healthy marketing margin if crude remains in the current range of $60 to around $70 per barrel. But currently all these oil marketing companies are carrying the inventory of 45 days, and if you calculate on 45-day inventory, the crude level is $75 per barrel.
Right, Sudarshan, thanks a lot for that. The next stock on our radar is M&M. After India has announced its plans to restrict market access to BYD, Commerce Minister Piyush Goyal yesterday cleared the air over BYD's plans to enter the Indian market. Let's listen in.
Well, we need to be convinced that they will work by the rules of the game, and several unfair practices which are gradually coming to light as more and more companies come to us with what's happening, the kind of dumping that's happening in steel, for example. I mean, as these practices come to light, we have to be cautious. in whom we allow to invest in the country. We have to be cautious about our strategic interests, our security interests. So it's a mix of many issues before we are able to take that decision.
All right, articulated comment coming in from the minister out there with regards to the potential entry of people or companies in this EV space. Sudarshan joins in to explain what exactly does this mean for M&M. Sudarshan, when the news had come by that day, the stock was underperforming. So should this mean by virtue of that relief?
That's so correct. So if you remember last month, there was a news report that BYD is going to set up a manufacturing facility in Hyderabad. And on the basis of that report, we had seen a sharp fall in M&M stock, and that day stock had slumped almost like 6%. Now, this comment from Commerce Minister coming that there is a complete no for BYD's entry in the Indian market. So basically, the reason BYD is not going to set up a manufacturing facility, why this is positive for M&M. So normally, currently, India charges almost 100% tax on built-in cars. So basically, if you build any car outside and want to sell in India, there would be 100% tax. But if you manufacture here and sell, first, tax rate comes down drastically, and second, the price range would come in the range of that M&M has launched its electric vehicles. So now with saying no to BYD, it's going to be positive for M&M because it has launched 2 major electric vehicles, which is in the range of almost that BYD sells its products.
Markets now, Sudarshan, thanks a lot for that, by the way. The markets have surged to the highest point of the day now, 370 points higher on the index, 22,532 is where the index stands, a sharp recovery from the lows of the day. But the market is volatile. Sudarshan is versatile, from OMCs to autos. Now we move to another auto company, and that's Ola Electric. That's under government scrutiny after a mismatch emerged between its reported February 2025 sales. And who else but Sudarshan to tell us more on that? Sudarshan.
So if you remember the February sales of Ola Electric, basically I would say the February retail numbers. Ola Electric had announced that it had sold around 25,000 vehicles or more than 25,000 vehicles, while Vahan website was showing that it had registered around 8,000 vehicles. Now there was a confusion on this number, and that's the reason basically it had got a letter from Road Ministry, also Heavy Industries Ministry, and even some of the RTOs of Maharashtra, Madhya Pradesh and everywhere else. Now CNBC-TV18 has access to the correspondence between Ola Electric and Road Ministry. So now what does it say? So February, Ola Electric tells Road Ministry that February sales statement of 25,000 vehicles were based on the confirmed orders that company had received for 25,207. And it also tells that it included around 12,000 bookings for S1 third generation scooter and roadster bikes, and deliveries for S1 third generation scooter began on March 16, while roadster bikes are yet to be commercially launched. It even adds that it manufactured 15,533 units in February, of which more than 3,700 were Ola third generation scooter. So basically, confusion has been going on the February sales of Ola Electric for the last few months, and we'll have to see what exactly comes out from this correspondence between Road Ministry and Ola Electric. But currently, in today's state, Ola Electric is currently down almost 1%.
Take that point, Sudarshan. Thanks a lot for that. With that, we'll take a short break. We give you a break as well. On the other side, we get you more on the stocks and markets. We are seeing some bit of a revival in the market. The Nifty up above the 22,500 mark, closing in on the higher end of today's trading range so far. And it's been led by, a smart recovery in the IT pack. So pull up the Nifty IT, which has moved to the high point of trade. And alongside that, we have, a Reliance as well. That is the biggest weight. That too has moved to the higher end of today's trading range. So the IT pack, which was underperforming for the last few trading sessions, has bounced back, and as has Reliance, which has moved to the highest end of today's trading range. And that meant that the Nifty has crossed past that 22,500 mark. Let's see where it goes from here. More after this short break.
Welcome back, and Bharat Electronics is the next stock on our radar. It missed its FY25 order inflow guidance. The stock fell after that, but now on the order win front, it's bouncing back with a vengeance, and another order win was received by the company yesterday. Upasana is here to tell us more on that. Upasana.
Certainly, Hormaz, as rightly pointed out by you. Now, BEL remains in focus today as well, as the order momentum of the company continues to remain strong. Now, company has bagged one more new order worth 2,210 crores from electronic warfare suits for Mi-17 helicopters from Indian Air Force. Now, this is the second order received from Indian Air Force in this month, and mind you, company had received order earlier worth 593 crore on 2nd of April. Now, this current order forms a part of 5,000 crore pipeline that the company had indicated last time, where negotiations have concluded, and now the pending order finalizations is going on. Now, on the back of this, Phillip Capital says that the company has kicked off FY26 on a strong note, securing orders over 2,800 crores till now in just first week of April. It believes that the valuation of the company currently also stands attractive at 27 times FY27 EPS, and it maintains a buy rating on the stock with a target price of 390 per share. Hence, BEL continues to remain in focus as it bags slew of orders even in FY26 as well.
All right, Upasana, thanks a lot for that. With that, we slip into a short break, get back onto the market technicals itself. Sachidanand, the taker of Trade Bulls, will join us with some trading strategies in a day which is seeing some rebound, and the rebound is accelerating as we speak. Let's get in a perspective on the F&O setup this afternoon. We have the Nifty, which is crossed past that 22,500 mark. It's recovery after a fall that we saw yesterday. Nifty holding up above those levels. In fact, from yesterday's low, now the recovery on the frontline index is almost 800 points. So that tells you the kind of recovery that we've seen. More so on the mid-cap end of things. The index is up around 2%. And the flat line, which the crisscross lines have neither crissed nor crossed, after a bit of a wobble sometime in the middle of the day, are now back at parallel tracks. We have 2,100 plus stocks which are in the green for sub 400 stocks which are in the red, and that's how the case has been throughout the day. The other thing that has really stood out is after the big spike that we saw in India's volatility index, along with the global volatility index as well, we've seen the India VIX come down by about 9%, telling you that there is some put writing which is taking place. That's a positive. The Nifty Bank is above the 100-day moving average, so that's a level that it's crossed. Now, upwards of 51,000 will be the 200-day moving average. So the question is, where does it go from here on itself? The Nifty has its important moving averages at around 23,000, but that's a fair way from here. Before that, we have some triggers for tomorrow. The overnight global cues, anything may come overnight, because that's what the last few days have told us. There is the RBI monetary policy outcome. We'll tell you what the street is expecting. Does the rate cut happen? Does the governor change its stance to accommodative or not is the big question. And the Nifty weekly options expiry plays out tomorrow because day after tomorrow is a holiday on account of Mahavir Jayanti. Where does the market go from here? Yesterday, remember, on the way down, the 22,500 put writers were caught unawares. So today, does that happen with the 22,500 call writers? For that to happen, the Nifty has to hold above 22,650 thereabouts for these guys to cover their positions. But as the market moved higher, put writers are fairly active. 22,400 put writers are active, telling you that maybe closer to 22,200 would be an important support that comes by. But were the market to break up and break above current levels and, see that short covering, people are positioned for that as well. 22,800 call buyers are fairly active, buying something for 41 rupees a pop. Typically, an option which is expiring tomorrow with that kind of a distance would not trade at 41 rupees. But remember, over the last few trading sessions, the VIX has moved higher, so the option premiums have also increased. A lot of short positions added on delivery after yesterday's up move, which was led by short covering and, the acquisition news. The street is coming to terms with the fact that, the business is loss-making. So how does the company turn that around? And some longs added on financials. We have PNB Housing Finance, which has seen some long positions being added, along with SBI cards as well. So we'll watch out for these.
PNB Housing after that upgrade from Goldman Sachs, and of course delivery slipping further away from its IPO price. The top loser on the Nifty 500 now, 487 rupee IPO price. The stock now at 250. Sachitanand Uttekar of Trade Bulls joins in for a quick chart check and of course with his trading ideas as well. Sachitanand, good afternoon. Thank you for joining in. There was a bit of a dip that got swiftly bought into, but does the texture of the market remain a buy on dips after the kind of fall we witnessed yesterday, or would you want to see further upside for a confirmation of that trend? Part one, and of course your stock recommendations for the afternoon as well.
Good afternoon, Armaz. Good afternoon, Mangalam. I think the confirmation was already set in yesterday's session. The way Nifty, confidently closed above that 22,000 mark. It still keeps that hope clear that there could be a double bottom in place. If you look at today's data, the way Nifty has commenced the day, we saw an initial dip. That dip is also bought in, and the writing at around 22,300 looks like a very stable base. We are expecting that gradually, we may see the Nifty scaling towards 22,800. And that's why we are maintaining a long bias here. If you look at the contribution from Nifty IT, I think that will be very significant. In fact, last week during this show, we highlighted the fact that there could be a sharp decline towards 32,500, where its 50-month exponential moving average support is placed. That particular level has been met, and I think if you look at the way Nifty IT is also recoping, I think a lot of contribution will be there from the IT stocks. So we are expecting that the market texture remains buy on decline, and we may see the Nifty scaling higher towards 22,800 comfortably in a day or so.
All right, 22,800 comfortably in a day or so. That's where we've seen some call buying as well. Sachi, individual stocks, the IT pack is bouncing back. We're seeing some strength in Pharma. Bharti Airtel has been resilient as ever, currently at the high point of trade. And Reliance has also picked up. Would any of these interest you from a chart standpoint, or your picks are totally different from these?
Mangalam, I think we have covered a lot of these ideas, but I think the fresh momentum is displayed by IT stocks, and I think HCL Tech has been on our radar. If you look at the overall structure, the structure was a strong low top, low bottom sequence. But if you look at yesterday's price performance, the stock respected its 200 weekly exponential moving average support at around 1,300 very well, and the recovery has eventually led to a bullish hammer formation, which is again a very strong sign of a bottom in place. If you look at the options data, 1,400 call writers were very dominant yesterday. I think they have been pushed back, and that's why we are expecting that there could be a very strong short squeeze in this particular counter. If you look at the data, it is supporting the fact that there could be a rally towards 1,470. Eventually, we are expecting the stock to rise towards 1,540 in a couple of weeks' time. So that's why we are recommending building long positions here when it comes to HCL Tech. The stop loss can be placed at around 1,370 on a closing basis. The first target would be around 1,470. Second target would be 1,540. The recommendation is given to our clients. This will be our disclosure. Even Bajaj Finance, I think most of the financial stocks are outperforming. And if you look at the performance of Bajaj Finance, On the 60-minute charts, there's a clear-cut breakout from a falling wedge formation. We are expecting that the stock may again, try to attempt its fresh 52-week high, and that's why the reward to risk opportunity is also better. So one can place aggressive long positions here, keeping a stop loss at 8,700 on a closing basis. We may see a swift move towards 90 to 40 within a week's time. So even Bajaj Finance would be one particular counter wherein the trend has been very clear.
All right, Sachitanand, thank you so much for sparing time joining us today with your views on the index and on specific stocks as well. By the way, the Nifty is now up 400 points. 22,570 is where the index stands at the highest point of the day, and part of that move could also be attributed to the Dow futures. A few minutes ago were up 550 points. They are now up 720 points. So good going for the Dow futures as well. Some spill off onto our own markets. We take a short break, but before we do that, let us also listen in to Robert Subramanian, the head of global macro research at Nomura, on this entire scenario playing out in the US. Take a short break. Back with the opening of the European markets.
Baseline is very near a recession now, and it's clearly a risk, a big risk to our baseline view. By the end of the year, you could have core PC inflation above 4%, so more than double the Fed's inflation target.
Welcome back. Let us now cut across to the Rising Bharat Summit, where Shireen Bhan is in conversation with industry leaders to decode what's driving India's next big growth wave.
Offered an olive branch, so to speak. Japan is already in conversation with the US, or at least that's what the US president seems to suggest at this point in time. We've had a call between Marco Rubio and our own Minister Jai Shankar saying that things are on track as far as the India bilateral trade agreement is concerned. The global markets are in a state of panic at this point in time, and we've seen wealth erosion across the US markets, across Asian and European markets, and our own markets as well. So in this very, very volatile mix, how does India position itself? What should our response be? And more importantly, from a domestic point of view, what should we prioritize and focus on? Well, I have three gentlemen who have their ear to the ground and their ear to the clients, who are telling them what is going on at this point in time. Rajiv Memani, let me start by asking you, a Trump era that we live in today, where every tweet changes the way that the markets move, changes the way that policies are being pursued at this point in time. How are you looking at it? When you talk to clients today, when you're talking to your partners sitting in the US and in other parts of the world, what is the view?
Yeah, no, I think very few people really fully are able to grasp the situation now. I think everyone's living on a pretty much day-to-day basis. But, if you just step back, I think what's clear to everyone is this position of high fiscal deficit, high trade deficit, high debt, and that debt being owned significantly by the country with which you have the largest trade deficit was not something that was sustainable, and I think President Trump called it out quite aggressively and has been calling it out. In fact, there was an article that was written by Warren Buffett in 2003, which actually captured this very well. So this has been going on for a while, but I think he's the person.
And he's literally the only one who's kept his shirt on, Warren Buffett, while the markets melt.
But no one really called it out the way President Trump has. So one thing is clear, I mean, if you look at all this, that he's very determined that manufacturing has to return to US. So I think if you have to pull out anything, I don't think anything is going to stop him from that. Whether he has to apply pressure on countries, on companies, create the incentive environment for that, I think that's very, very clear. He's also very focused on targeting countries with whom US has a massive trade surplus or trade deficit, and they have a trade surplus, and where he believes that there are issues of the rules are not equitable on both sides. So he's going, as a matter of priority, I think he's going after those countries. So if you peel this further, what this is creating, Shireen, is it's creating a lot of uncertainty.
Yeah.
People are unwilling to take investment calls, unwilling to take business decisions. Supply chains are likely to change in a significant way. So everyone is now, and because of that, if I talk to our clients, especially in the US, they're already calling out that the EPS will not be what they thought it will be, and they're finding it difficult to project forward. CapEx is probably going to be higher. So that's getting reflected in what the stock markets, especially in the US, are showing. So that's one, I would say, that's coming out very clearly. Second is almost all countries in the world will now look at trying to say, how can I do more? Value chains have to be redefined with countries with whom we have a level of mutual interest.
Right.
It cannot be absolutely one-sided. So the benefit that China got for a period of last 15, 20 years, I think that is difficult to sustain. And I think that means that a lot of supply chains and everything else will be changing. And if you pull this forward and you come back to say what it means for a country like India, and if you add that this uncertainty that AI will create, whether it's in 3 years, 5 years, 10 years from now, when I say uncertainty, much higher productivity, but in terms of jobs, then India has no choice but to look at manufacturing in a very significant way. And if you're looking at manufacturing, if you look at historically countries that have had outlandish growth sustainably, it's on the basis of exports, whether it's Germany, Korea, China, Japan earlier. That story may not work in that way. So that means your emphasis on domestic value added has to become much, much more stronger. How do you create more domestic value add? How do you build relationships of mutuality where you have mutual interest with those, I think, so that you can leverage on the export side of it? And how do you create a business environment which is conducive to all these three things? So whether it's in terms of cost curves, whether it's in terms of ease of doing business, whatever it is. So if you want, I can dive into details of all three.
I'll get you to dive into the details in just a second.
But that's what we're heading from.
That is what we're heading for. But Karan, I want to pick up on a couple of the things that Rajiv has laid on the table to set the context for this conversation. First up, the first order impact of the uncertainty created by the tariffs, this chilling effect that Rajiv spoke of, that investors are going into a state of panic at this point in time, and future investments at this point look uncertain, and so people are going to pause and wait to see how this dust settles. Is that what you're hearing from your clients as well?
I think, Shireen, I agree with Rajiv. There's so much of uncertainty that the clients are all looking at alternative scenarios and what might play out. We'll see multiple, this is a dynamic world, given what you talked about, what the first order reaction is, what different countries are going to respond to, what's going to happen with the macro environment with stagflation, and then the implications on what happens to interest rates, etc. So there's a lot of variables that need to be worked out. So scenarios is the right way to think about. And people will look at.
It's great news for consultants. Isn't that what you do? Paint out scenarios.
And I think there are opportunities here. I wouldn't say this is all a doom and gloom. I think the opportunity for India, given we're looking at differential tariffs, and if it does play out, And it's great that India has taken Section 4C rather than 4B, and we are negotiating with the US.
Yes.
And if we end up in a good place in those negotiations, this can be a big plus for us. If I also go back to what Prime Minister Modi and Trump talked about, which is the 500 billion export opportunity, I think therein lies potentially a massive opportunity for manufacturing. And Rajiv is exactly right. We need to push up manufacturing to 25% plus because we need that for jobs. And so I think there are sectors where I think India is very strong, very credible. And I think there is a get and a give. The get is in sectors that we're looking for where the US can send us technology. Whether it's defense, whether it's AI, whether you're talking about nuclear energy, I think could be a huge plus for the country. So I think, but having said that, I think there is a few key imperatives we have to make sure we are following through on. The lesson from China, the lesson from Vietnam is we absolutely need to make sure that we have the ease of business and we are attracting more FDI into the country.
Yeah.
Our FDI, net FDI is only $10 billion. And we need global champions to come in to help set up that ecosystem. We also need innovation, what Chatter talked about in the earlier panel.
Yeah.
We need to design in India as we think about Make in India. And it's an absolute must that the private sector must do more on that front. And I think we need global scale to be competitive. We all know about what in China, the big scale companies and the advantage they have.
Yeah.
So we have to be hyper competitive. So I think while there may be an opportunity for India here, and I really hope it does work out given how the negotiations will play out, I think there is an imperative for us to also take away for the longer term for us to position ourselves appropriately.
Before I get Rahul back into the conversation, let me just get Rajiv and you to comment on what we just heard you say there in terms of the supply chain diversification that is expected. Some of it is already happened post-COVID, but the expectation now, because of the differential that you talked about, Vietnam, China, etc., much higher tariffs in comparison to India. Rajiv, do you believe that that's going to have a beneficial impact on India in the short, near term?
Yeah, I think it should have, but I think it's too early to call out. So if you look at countries that are competing with India, if you look at Mexico, for example, I think the US, Mexico, Canada, the USMCA, has much more favorable clauses than what India has. And I think what President Trump has said is an opening gambit. It's not. This is not a closing. And by the time countries take a defining moment to say they want to change, it takes time. It takes time for companies in India to create capacity. So I would say we are very well positioned because India's ability to negotiate is much greater. If I look at trade deficit of Vietnam, US's trade deficit to Vietnam is $125 billion.
Yeah.
If I look at Mexico, it's $180 billion. If I look at China, it's $320 billion. With India, it's somewhere between 40 to 50 billion.
Yeah.
And there are lots of ways by which India can balance that.
Yeah,
Also,
higher oil imports, LNG imports, defense, all of that. Yeah.
And we have done an analysis to say even if the duty rates were to come down, we can't talk about agriculture here, but in most products, if the duty rates were to come down in India, which is his India is the tariff king.
Yes.
It is, I think, and if the markets open up and supply chains get redefined, it'll be a far more beneficial thing for India.
So you're saying industry is okay and on board with a tariff cut, a significant tariff reduction by India?
Most parts of the industry are very open. I won't say all, but I'm saying in aggregation, India will be beneficiary of that. Industry is also wary to say where surplus capacity gets created. India's biggest concern right now is, yes, there's a lot of talk about India-US, but the bigger concern is the surplus capacity this will create in China, Vietnam, and in some sectors in Europe as well. So I think to that extent, people want to watch out for that closely. But I would say broadly, Shireen, most of Indian industry is quite comfortable And I think if things go as logically one would, and it's very difficult to say this in the current regime,
yes,
I think India should be a net beneficiary. And companies are quite bullish.
Yeah, and today, this morning, we saw headlines saying that Apple is going to redirect more of its production to India on account of what we're seeing with tariffs on China. Do you believe that that's a one-off? Because we already have the capacity that's been created here, or to Rajiv's point, that people are going to wait to see how this plays out before taking calls on fresh investments and fresh capacity.
Shireen, Apple is already doing, the electronics sector has been a big plus, and the way the government has set up the electronics sector in the last few years, I think is a big story around India. So that will continue. Now, Apple is going to wait and watch and figure out, what's the amount of production they'll do in different geographies. But I think it's very smart what the government has done when it has not only has put in the PLIs, and now we're moving towards the latest announcement of going into components, going into more domestic value add, and then even going into design. You've got firms like L&T that are doing semiconductor design in India, and then you've got the fabs, etc., that the Tatas and the Murugappas are setting up. So I think electronics is a very good story in India, but it's still yet to play out to full potential. If you think about electronic value chain in 2030 will be about 6 trillion. It's about 4.3 trillion today. So it's a massive global value chain that we should be thinking of participating. And that's why us getting in front with the right incentives and being competitive with the scale players, you need the scale players like a Tata, the Murugappas to be playing to build that ecosystem in India.
Yeah. Rahul, let me come to you now in terms of the opportunities that you believe present India at this point in time, the sectors that you believe are poised for growth and have a strength and advantage at this stage.
So I think just to build on the previous points, and then I'll come to your point, I think we have to de-average the situation a bit. And if you see from our vantage point, we are the least dependent on US exports, especially as far as goods and merchandise is concerned.
Yeah, 2%.
2%, and it doesn't move the needle for us in terms of our domestic GDP growth and so on. So I think if we negotiate well, as has been said, right, it can open up a large window of opportunity, especially in sectors where the differential tariffs are there and where we have longer term advantage. So if I was there, I would go out and think of it as a positive opportunity creation, where whether it's electronics or it is textile or it is cables and wires, where we see the competing nations have relatively higher tariffs than us. On the other hand, I think we need to be also aware that the whole world trade will get rewritten, and which means that countries which will not provide or supply material to America will supply elsewhere. And for example, China, which has large capacity of many products, they will find their way into the country. So we have to be resilient. We have to watch that closely and ensure that our industry is protected against that.
So let me put a challenge your way now. If you had a client who asked you to draw up a scenario for India at this point in time, perhaps the Indian government reached out to BCG and asked you to draw up and do some scenario planning, what would be the 3 or 4 things that you would ask the government to prioritize?
I think it's difficult to pinpoint, but I would say first we have to, in the short term, there will be uncertainty. And there is uncertainty. Whenever uncertainty happens, people freeze decisions. Capital investments will go slow, and therefore in the near term, we will face, and not just we, everyone in the world will face some decision paralysis, some capex slowdown, and therefore it is good to incentivize the economic growth, because our economy is strong and resilient. If you look at our drivers of economy, it's more consumption-led. I think we are talking about manufacturing, but manufacturing has stayed at 15 to 16 to 17% of GDP for decades.
For the last, right? Several decades.
And in contrast, Korea, China is 25, 27%. Yes. If we want to grow from 5-6% to 8-9%, we need manufacturing to pick up. But our base growth comes from consumption. And that is there. Our demographic profile, our rising GDP per capita, spending power, all of that poises to all, whether it is financial services, healthcare, anything that our mass consumes will grow, irrespective of all the macro trends.
And I think
Quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries. And with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1,350 to as high as 1,950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010 the stock has
Welcome back. Let's get in a corporate conversation right now. We have an InfoEdge update coming in, fourth quarter update. Their billings are up 19%. We'll get in some more details with regards to their, all their verticals, be it the Naukri vertical, be it the real estate vertical, and all the other businesses that the company is doing, including that of matrimony. Currently, 19% higher billings, something that has the street excited. The stock up around 1% from lows itself, though has taken a bit of a drubbing itself. Speaking about, business tech itself, we have Affle, which is an ad tech platform which helps companies with mobile marketing and other stuff as well. They've held the Affle 3i Summit at BSE, which marks their third decade of business. It's fairly well attended by a lot of investors, HDFC Mutual Fund, you have GIC Singapore, Goldman Sachs, JP Morgan, all of them. So let's get chatting with the management about what the near future and what the long-term, medium and long-term aspirations of the company are. Anuj Khanna, Soham, who is the CMD and CEO, joins in. Anuj, always a pleasure speaking with you. The last 5 years, your revenue has grown by about 5.5 times. EBITDA has grown by about 4 times as well. You have a medium to long-term vision of growing your revenue by 10 times. If you could tell us if there was anything new that was discussed at this summit, and what are your near-term and long-term targets?
Thank you. Today at Affle 3i, we have invoked the power of our third eye intelligence, and we have also unveiled quite a few initiatives that we will be anchoring our growth on for the next decade. We are targeting 10x growth over this decade, which is basically a math of 25% compounded annual growth rate for our revenues. We expect margin expansion. We expect us to do really well at the back of these AI initiatives. Today we unveiled Optics AI, our creatives platform that can power about 1 billion unique hyper-local, hyper-contextual creatives. We also unveiled CTV AI that has the capacity to serve 1 million SMEs around the world, bring them on board with advertising, to try CTV advertising in a performance advertising format for bite-sized ad campaigns. We also unveiled 100 AI agents today for the first time, and that is AI agents that will enhance the authentic, augmented intelligence of Afflers working around the world. We see ourselves attaining 10x growth for the company in this decade ahead, with maybe at max 1,000 Afflers augmented by, and the productivity augmented by the AI intelligent agents working with it. So that's the plan that we unveiled today, and yes, you're right, it was very well attended, and we're pretty happy with the kind of response we've got.
Anuj, good afternoon. Thank you for joining in. So we've laid out these plans for the next decade, but there are some uncertainties that are springing up on the immediate term, and that of course is because of the fact that all of the uncertainties that you're seeing in the global markets. Now 26% of your top line for this year has come from developed markets. What is the reading that you're getting from your clients overseas, particularly in the US as well? What's the reading on the ground that you have right now?
See, two things I'd like to say, when you talk about turbulence, I believe you're talking about tariffs. And advertising is a strictly local business. It is not really anchored. I mean, at least our company, we are registered in the United States. We have an entity there. We have some customers there. It's a very small part of our business, and it's a very small part of the total advertising pie of the US market. So we have a very large addressable market there. We are just scratching the surface of what we can get there. And it is at the moment immune from tariffs at 2 levels. One, there is no import-export involved in doing advertising services. Secondly, tariffs don't cover digital software services at the moment or IP-related charging. And third, most of our IP is in Singapore or in Dubai entity, and when we work with our US entity, they are on the lowest grades of tariffs. So at the moment, we feel that we are navigating that quite well, and the message we are getting from the market at the moment, the pipeline looks robust and strong. So we'll watch it closely, but I think we are quite resilient and well prepared at the moment with our risk management frameworks.
All right, what about the very near term? You know, FY25, if you could give us a sense of where you've ended in terms of growth, because you did have that target growth overall around 25% with PAT margins of 17 to 18% in the medium term. If you could define that medium term and how this year has been for you, and what's the immediate target for the next year?
Yeah, so for the last financial year, which ended in March, I mean, you know, we'll wait for the earnings call to come up, but we believe that we have exceeded or met any market expectations so far. We are still waiting for the audit results, but, you know, we're pretty much on track. I think the performance has been good. I'm pretty happy with the way FY 2025 has ended for us, and we look forward to covering more details once the audit numbers are out and we can talk at the earnings call the next time. Our outlook for FY26 is also very, very strong. You know, at the moment, we are seeing broad-based growth coming across from all our verticals. A lot of tailwinds in our business. We are seeing a lot of efficiencies coming with AI utilization. Productivity of our workforce is up substantially with the 100 AI agents going live today. So on all these fronts, whether external or internal, at the moment, we remain bullish. Of course, we are concerned about, you know, the turbulence in the overall, markets, and we are not immune from that. But I think fundamentally our business is strong. Our financial fundamentals are strong. Margin position looks intact. Efficiencies of scaling up and scaling up efficiently seems very clear. So I believe we will grow, and we will grow well, and we will also expand our profits more than our revenues in this next coming financial year.
All right, take that point. It was a pleasure speaking with you. Obviously, we'll let you go with the promise that you join us post your fourth quarter numbers and then discuss those quantitative details in a lot more granularity, and we'll obviously press you a little more for FY26 numbers on that as well. Thank you for joining in. With that, we'll take a short break. On the other side, Manisha Gupta joins in with Anindya Banerjee of Kotak Securities on all things commodities.
Annual returns only thrice, and 2 of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2,080 rupees to as high as 3,750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains.
Welcome back, and joining us on the show now is Anindya Banerjee. He is Senior VP Head of Research Commodities, Currencies and Interest Rates at Kotak Securities. Anindya, hi. Difficult times clearly with the way the markets are very, very volatile. But I do want to start with the precious metals first. And we've seen silver prices gain in line with some bit of a risk on with base metal prices, while the gold prices have seen some correction on the lower side. How do you read this divergence within the two precious metals?
A very good afternoon, and thank you for having me, Manisha. Yes, actually, silver has gained compared to gold, and that is because of, one, the base metals, as you pointed out, and second, there is a short covering rally in the equity markets too, because silver is more risk on than gold. So it has that ability to outperform when things are looking better. So yes, since yesterday is morning low, we have seen an outperformance in silver, and it may continue for a while as long as the uptrend in the stock market continues. So we could see actually silver gaining. On charts too, it's looking a little more stronger than gold as well. So it can see levels of $31 over the near term.
And as we've seen in the last 12 hours, even as the gold prices have come off, we've seen that safe haven buying money go into dollar, in Japanese yen and Swiss franc. Is this like a short-term phenomena, or do you see the safe haven money now getting kind of split here?
So, in fact, if you see this whole cycle, initially the money was going towards gold and partly towards silver, because that was a flow which we termed as a de-dollarization flow, which was basically anticipating this fracture in the global trade, which we are now seeing. But as this fracture in the global trade happens, the de-globalization, it is actually quite positive for dollar. It is quite positive for the US treasuries and yen, because these are the traditional safe haven assets which attracts a lot of flows during times of turmoil. So right now we have seen margin calls selling in gold and silver as well. And that's the reason why gold has come down, in spite of the fact that gold should be benefiting from this. But and the dollar index is still relatively weaker, but gold has not been able to catch up it, because we think there's a lot of margin related selling which is happening in gold, especially in the global markets. And yes, so at this time, the dollar, yen, and the US treasuries tends to do well. Gold is also looking a little weaker on the chart, so it might just struggle over the near term.
Did you say from de-dollarization to de-globalization, Anindya?
Yes, because if you remember the last time I was on your show and we were talking about base metals, I said in all the bullish outlook, the biggest threat is the intensifying trade war between China and America, which we anticipate will become far more intense in the coming days, because Donald Trump's America First policy is another name for deglobalization, is another name for basically moving the manufacturing from into US. So it will lead to a situation where the trade war between America and China will intensify in the coming days, and we are already seeing the signs of it.
Yes.
So that can be a factor to watch out for.
Anindya, thank you so much for that. Manisha, thank you for taking us through with that conversation. We wrap up on this edition of Halftime Report with the news that the market surged to the day's high, 22,650 on the Nifty, making it 875 points from yesterday's low. IT Pack, Reliance, and a bunch of stocks doing well for the Frontline Index. Take a short break, come back, and Business Lunch takes all the market action ahead.
Of anywhere between 2,700 to 3,700 on the stock. Now, HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet, no analyst on the street has a sell rating on HDFC Bank, with price targets ranging up to as high as 25.50. Now, FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3,400 rupees on the stock. Staying with consumption, Titan is set for its first negative calendar year after 2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, as the 5th time in the last 7 years that the stock has had negative returns. Yet, 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024. With 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive
Market builds on gains to trade near the day's high. Sensex and the Nifty gain over 2% each. Midcap index is up 1,000 points. All sectoral indices are up between 1.5 to 3%. Titan turns in a healthy growth in gold jewelry in Q4, riding on higher gold prices, but sales of studded ornaments lag. Other segments like watches, eye care and fragrance too grow well during the quarter. The stock gains in trade. Bharat Electronic bags a hefty 2,210 crore order for electronic warfare suits from the Indian Air Force, swelling its order wins in the early days of FY26 to 2,803 crore rupees. The stock perks up. Oil marketing companies gaining from a sharp drop in crude prices, while will pay an additional 2 rupees per litre on petrol and diesel, even as they get the charge for more for LPG. Funds from the fuel levy for expected to be used to pay for oil marketers' LPG losers. US President Donald Trump threatens to levy an additional tariff of 50% on Chinese goods if Asian giant doesn't roll back the 34% counter levy before April 9th. China proposes dialogue and warns it will fight to the end if tariffs are levied. Hello, good afternoon. You're tuned into Business Lunch, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala, and thank you so much, as always, for tuning in this afternoon. But a quick look at the markets, right? Today is a happy day coming in. From yesterday's fall, we saw that recovery coming in yesterday's last few minutes of the trading session. And today, we've seen green coming in on the screens. Nifty trading at the day's highest point as of now, 22,638, around that mark. 2.15% gain is what the Nifty is holding on to. Similarly, for the Sensex as well, holding into gains of more than 2% at the day's highest point. Let's pull up the broader end of the market and what is that doing, because Nifty, mid-cap and small-cap are also managing to hold on to good gains of more than 2% in today's trading session. Just slightly off the day's highest point is what Nifty mid and small cap is trading at. Nifty Bank also, keep an eye out on that. We were seeing that a short while ago. That's managing to hold on to good gains as well. 1.6% gain for the Nifty Bank. All sectoral indices today, any of the sectors you pick up, is managing to hold on to very good gains and is holding on. The best sector performance today is IT. 3% gains coming in for Nifty IT. Other than that, we have pharma names that are doing well. So CDMO players pull that up. All the CDMO players are buzzing in trades. So Suven Pharma, Piramal Pharma, that's managing to hold on to gains. And other CDMO players like Lotus Labs also, you can see, holding on to gains. So yes, keeping an eye out on that. Real estate stocks on the back of Q4 updates, Godrej Property, Shobha Developers, Keystone Realtors, all of them have come out with their Q4 updates. So they are managing to hold on to gains. But yes, that's how the market setup is looking like. As of now, so far, so good coming in. All the sectors are holding on to gains of more than 1.5%. So not a bad afternoon. We'll wait on and see what is going to be happening, whether these levels are sustainable. But as of now, a good day. Now let's move on and start the show by talking about important updates that are coming. Especially markets are seeing an uptick after 2 sessions of a bloodbath on the global market front following Trump's tariff unveil. Now, despite the sharp criticism, Trump has shown no signs of reversing his course of action. However, when asked whether the tariffs are permanent or have a space for negotiation, this is what he had to say. So let's start the show with that and listen in.
They can both be true. There can be permanent tariffs, and there can also be negotiations, because there are things that we need beyond tariffs. We need open borders. There are a lot of things like opening up countries that were totally closed. China is essentially a closed country. In fact, it is a closed country. And what they do is they charge tariffs so that if you sell cars or if you sell anything, nobody's going to buy it because the price is out of control. But that's true with a lot of other countries also. So we're going to get fair deals and good deals with every country. And if we don't, we're going to have nothing to do with them. They're not going to be allowed to participate in the United States.
Now, the EU has proposed a 0-for-0 tariff deal with the United States, but has struck back with a 25% tariff on some of the imports. The bloc, which faces the tariffs between 20 to 25%, proposed its first retaliatory tariff of 25% on a range of these US imports. CNBC's Sylvia Amaro is joining in with us to give us more details on this front. Sylvia.
No doubt that we're monitoring what the EU is saying when it comes to trade. On the one hand, they are preparing the retaliation measures as a response of the first round of measures that the United States imposed on European steel and aluminium. But at the same time, they are now discussing what other tariffs, what other countermeasures they can put in place as a result of the latest round of tariffs from the United States, what Donald Trump, the President of the United States, called the retaliation measures of 20%. So I know there's a lot of talk about tariffs and a lot of discussions around countermeasures, but it's important to keep in mind that there are several negotiations and several discussions taking place at this stage. Let's see what the EU member states will vote on. There's a vote on Wednesday to exactly discuss some of these countermeasures. But in the meantime, we have to take stock of what is already happening on the European economy. We have seen a lot of pressure on European equities, and that has also been the case for European banking.
Absolutely. So that's the update coming in from EU. But Asian markets and Asian countries also have responded. Japanese market led to a rebound in Asia. This came in after Japan was actually urging Trump to rethink tariffs, while what China was saying that they will fight to the end after Trump threatens a 50% higher tariff. CNBC's JP Ong is bringing us more details on this front.
Asian markets tried to mount a comeback on Tuesday, with equities showing varying degrees of hope and defiance. The day's outsized gainer in the region was the Nikkei 225 on hopes that Japan would be able to strike a trade deal with the U.S. in the coming weeks. Though Japanese Prime Minister Shigeru Ishiba urged U.S. President Donald Trump to rethink tariffs planned for the world's fourth largest economy, reports indicate that the United States will prioritize trade discussions with Japan, with Treasury Secretary Scott Bessent expected to lead negotiations. The hope for a possible deal lifted the Tokyo benchmark out of bear market territory as the Nikkei 225 surged 6% higher. Surprisingly, greater Chinese markets managed to keep their nose above water, despite Beijing striking a defiant tone against the U.S.'s tariff actions. Following President Trump's promise of more tariffs in response to China's decision to retaliate with 34% tariffs on American goods, China's Commerce Ministry vowed not to respond to what they called blackmail from the United States and that they will fight to the end. And while the Hang Seng in Hong Kong tries to find its footing, Chinese equities look stable and reports that state funds have stepped in to support Chinese stocks. Elsewhere, a bit more mixed among Asian markets. Though there were modest gains for South Korea's Kospi and Australia's ASX 200, Taiwan's TAIEX extended losses, falling into bear market territory today. The same happened in Indonesia, with the Jakarta Composite plunging after markets returned from an extended holiday. For CNBC International, I'm JP Ong.
Okay, thank you so much for that. But while the full impact of US President Donald Trump's reciprocal tariffs are yet to be felt by the world, global experts have actually already begun to factor in this possible recession or a chance of a higher inflation that one would see. CNBC spoke to a host of experts to sense the mood of the market. Listen in.
The president has decided the best way to get inflation and interest rates down is to take a recession. And, recessions tend to have certain recurring patterns to it. And I think we're heading to a recession.
I would not be surprised to see elevated inflation over the next 5 months. I would not be surprised to see, and across every CEO I talk to, we're starting to talk about a more fearful economy going on right now. And a lot of it is that fear. But I do believe this is going to be more short term. Once we understand the policies, once we become more accustomed to it.
We have a lot of dry powder, and I talked about cash as a recommendation on Fed days for the past few Fed days, as much as 25 or 30% cash. I would not be deploying that cash yet. I think you're kind of in the middle innings of this thing, although certainly the market going down so much on Thursday and Friday, it's a little bit disconcerting that we don't have more of a bounce in the market.
Also, let's listen to Richard Sharma, chairman of Rockefeller International, who's explaining how the rest of the world is starting to move despite the short-term impact of Trump's tariff.
Obviously, global growth is going to take a hit, but I think that at the end of what's going on here, and something we've spoken about as well, is that the rest of the world is laser focused now on trading without America. So what's happening there is that they're sort of expediting their trade deals of trading with each other, as I've sort of written in the past as well, that if you look at the 10 fastest growing trade routes in the world, only 2 now involve America, 5 involves China and other countries. So the world is moving on, but obviously in the short term, everybody gets hit. But this is a very different kind of market reaction and even downturn that, as you know, that this time, even after the carnage in the international markets over the last couple of days, the US market has really underperformed, and the dollar, in fact, has weakened through this all. We went into this with the US being the most overhyped, overowned, and overvalued market in history relative to the rest of the world. That never before had so much capital flown to the US. 80% of all flows into the stock market globally went into just the US market this decade. So there's a lot of unwind of that which has to happen, and a lot of that capital came in unhedged, expecting the dollar to appreciate. So that's why, you know, that was something that we discussed was the mother of all bubbles, and that bubble is now being pricked. But this credibility damage is going to last, and I suspect that over the next few years, the US stock market and US assets are going to underperform, no matter how this tariff drama is resolved.
Now, UBS's chief economist Paul Donovan believes that tariff pressures could possibly put US into a recession. He adds that uncertainty around Trump's economic policies could help China portray itself as a reliable trade partner. Listen in.
With regards to recession risks, those have clearly risen. There's no question about that. You've got a massive tax increase, you've got massive disruption and uncertainty coming through. Obviously, that's gone up. However, we do have to remember just how strong the economic foundation was at the start of this year. What is happening now is very destructive, but it's very destructive from a strong starting point. And that means that I think if we continue with the current policies, if the taxes on US consumers stay at these levels, a recession will happen in the United States. Maybe not globally, but in the United States. I think is in a position to take advantage of this, as is the EU and the UK and so on, because what we have, and I think this is important, this is not the 1930s. The 1930s, the famous 1930 Smoot-Hawley Tariff Act, started a global trade war. We don't have a global trade war. We have the US cutting off its own arm. This is an entirely US-focused situation. So the rest of the world can carry on trading. But of course, we have a big difference between China and the United States when we're talking about trading partners. That the United States has been a consumer, has been raising its standard of living by consuming low-cost imported goods, whereas China is a producer. It runs a trade surplus. So for Europe, yes, China may be a more dependable trading partner, but it's a very different trading partner when it comes to the interactions because China is a producer, not a consumer.
Let's also listen to some more views coming in on Trump tariff orders and the impact on global economies.
The main thing is that this has dramatically raised the risk of a Smoot-Hawley type outcome. So Smoot-Hawley was 1930. Other countries retaliated, global trade collapsed, and the Great Depression was on. So I think that's really what has people worried about this. It doesn't have to work out that way, but this unilateral move, abrupt, is setting up a situation where you could get a dramatic downturn in the economy. So Wall Street is marking up its recession probabilities, and I think that's appropriate. And I think this is probably executive overreach compared to what Congress. You can do things like this if you want, but you probably have to have Congress weigh in on that.
The EU retaliates and China's retaliating, that's going to make a much weaker global economy. India, out of all the major economies around the world, is probably going to be least affected. And that means from a market perspective, ultimately could be a positive story. There's a few things going on here. I would say the first one is India is a very big economy and it's a more domestic orientated economy. So from that perspective, it's less affected by tariffs and trade wars than many other Asian economies.
Okay, on that note, we're going to take a very short break. When we return, we will continue our focus on the market and on stock-specific actions. So don't go anywhere.
Has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out. And now the industry is attempting price increases every month. They
Welcome back and thanks for staying tuned into Business Lunch on CNBC TV18. Now let's shift focus and talk about the rupee because that remains under pressure for the second day, running partly due to the lower fixing of the yuan and by the PBOC and partly because of the dollar demand from importers as well as foreign funds. Lata is here to give us more details on this front. Lata?
Well, we have seen a slightly steady fall in the currency over the last 2 days. On Monday, it fell from 85.23 per dollar to 85.83 per dollar, a sharp 60 paise fall. And then today we saw it go past 86 as well. So another 17 paise fall in the currency. Now, the fall is kind of a one-to-one correspondence with the fall that we are seeing in the yuan. There is something called a yuan fixing. There's also rupee fixing. That is the official rate, which is considered the average of the day for official purposes. The yuan fixing has always been around 7.19 by the PBOC. Now, today they fixed it at 7.2038, which is like pretty low. It's definitely lower than what it was before Trump was sworn in, or before even Trump won the election in November. Now, the official trading of the yuan dollar happens on the basis of the official fixing, and there we saw a fairly sharp fall in the yuan. It required 7.30 yuan to buy a dollar. Yesterday, today it is 7.33. So a clear depreciation, and usually all Asian currencies fall when the yuan falls. And today we saw the Korean won, Thai baht, ringgit, all of them fall. A little surprising because actually stock markets everywhere went up. So the fall is clearly responding to China. And China is probably responding to the fact that if you devalue the yuan, you are better able to face the tariffs. So that perhaps explains the depreciation in India.
Absolutely, ma'am. Thank you so much for that. But we do have Hardeep Singh Puri, who is talking at the Rising Bharat Summit. So let's go across and listen to what he had to say.
But I happen to be the minister, and therefore it always feels good to come here.
थोड़ा तो आप कॉलर अप कर सकते हैं, है ना?
नहीं, मैंने कॉलर नहीं.
अच्छा, लेकिन एक चीज़ है, the question I want to ask you, and I think everybody wants to ask you, सर तेल के दाम गिर रहे हैं, इंटरनेशनल क्रूड, बट आपने LPG के दाम बढ़ा दिए, तेल के दाम बढ़ा दिए. Markets are crashing, but oil prices, LPG prices are rising. Why, sir? Why?
Anand, I've known you for a long time, but I would have been surprised if you hadn't asked me the question. But a little surprised that after an hour-long press conference yesterday, you still asked me the question. But since you asked it, I owe it to you and your distinguished invitees
Let's
to
talk
explain.
LPG. We'll talk LPG first.
No,
Ji.
LPG, let's go with LPG first. We provide LPG first number of connections. It was 14 crores in 2014. Today is 33 crores. If one connection is for one household, so you multiply and each household has 4 people, we have covered the entire population of India and more. You have 100% saturation. We provide the world's cheapest cooking gas. For an Ujjwala beneficiary, it comes to 5 rupees a day. Okay? And for a non-beneficiary, it comes to 14 rupees a day. For every cylinder that is sold, we incur a loss of 500 rupees per Ujjwala beneficiary. 500 rupees. So there was a context in which it had to be done. We were in a particularly difficult environment. That is the environment in which we were providing 3 meals of dry ration in a day during the lockdown and pandemic. It's still continuing. But today, what happened as a result of the 503 rupees Ujjwala cylinder is that the companies which were supplying that, they have incurred a loss, and it's a cumulative loss of something like 41,000 crores. Now, I'm a student of subsidies. Money has to come from somewhere. It doesn't grow on trees, as a former Prime Minister said. So what we've done is something very basic. The price of a cylinder has been raised by 50 rupees only, okay? Which means the cost to a family of 4, which is using those figures, it's marginal, all right? But we have also raised the excise duty on petrol and diesel by 2 rupees. Now, there was a big halla yesterday when they saw the finance ministry notification. We clarified the dam at the petrol retail point will not go up. It will remain the same. What we'll do is we'll collect some resources which will help, because we are committed to those oil companies. When last time they incurred a loss of 28,000 crores on gas, we compensated them by 22,000 crores. So this is to do that. Now you come to the second part of your question. Oil prices are coming down. Wonderful news. You know something? We spend something like $150 billion a year on oil imports. If the oil price is down 20%, which means we save 30% overall, $30 billion. That is the value of our exports. So it's good news. But all things good, my friend, have to be sustained. If the oil price today is 61.89 yesterday, I don't know what it is as of this morning because I've been in functions like this. Today, we are carrying 45 days of reserves. The price in beginning January for oil was $83 a barrel. And if I take the average of the 45 days, it comes to something like $75 a barrel. Now, if the price goes even from 60 to 65 or more, yes, the oil marketing companies will have headroom to bring prices down. But it's a deregulated sector. I can't keep telling them, aja petrol or diesel pe bhi under recovery kar lo or gas pe bhi kar lo. But they are called very responsible corporate citizens. They're very good people. They helped us out on gas. We are compensating them. And petrol and diesel, let your red attire of the day signal that if the trend remains like this, yes, they will bring the prices down.
But that's the criticism. The criticism is कि चाहे वो 100 रुपया बैरल हो या 60 रुपया बैरल हो, कंज्यूमर 100 रुपया दे रहा है.
नहीं
95 रुपए 100 रुपए दे रहा है.
एक आप काम करिए, आपके पास बहुत रिसोर्सेज है, बहुत इन्फ्लुएंशियल चैनल है न्यूज़ 18. आप एक लिस्ट बनाइए कि सबसे ज़्यादा हल्ला पेट्रोल और डीजल प्राइसेस पे कौन करता है. और मैं रिजल्ट आपको अभी बताता हूँ. एक ऐसी आइडियोलॉजी के लोग हैं, एक पॉलिटिकल पार्टी है, मैं नाम नहीं लेता, उनकी 2-3 जगह शायद सरकार बची हुई है जहां पे वो नेशनल लेवल से 10-12 रुपए ज्यादा चार्ज करते हैं. और जब ये प्राइस की बात होती है, सबसे ज्यादा हल्ला वो मचाते हैं. भाई साहब, बीजेपी रूल स्टेट्स में और उन स्टेट्स में 10-12 रुपए का फर्क है. अगर आप देखिए डिफरेंस बिटवीन लखनऊ एंड नॉन बीजेपी स्टेट नियर बाय, 10 rupees difference. If you see between Assam and another non-BJP state closest to that, I didn't name West Bengal. I didn't name it, but प्रॉक्सिमिटी में देखो तो वही आती है। देखिए ये दिस इज हिपोक्रेसी ऑफ द हाईएस्ट ऑर्डर। और ऐसा है जिनको कुछ चीज की समझ नहीं, अरे आप बात कर रहे हो, अब मैंने कहा भैया जो स्टॉक हमने लिया है 45 दिन का उस पे वो दैट वाज नॉट बॉट एट 60। आई थिंक इट्स अ वेरी लेजिटिमेट पॉइंट टू मेक व्हेन द स्टॉक व्हिच यू आर होल्डिंग वाज बॉट एट 60। आपकी दुकान में माल भरा हुआ है जो आपने 80 रुपए पे खरीदा है और कहा आप 60 रुपए हो गए, उसको लॉस में बेच दो, कैसे होगा?
पर हरदीप जी जब 100 तक दाम बढ़े थे तब भी ये 45 डेज का बफर था। उस वक्त तो उन्होंने स्टॉक 80 में लिया था लेकिन प्राइस तो उस वक्त
नहीं।
और दूसरी बात, आप मुंबई का नाम नहीं ले रहे हैं।
किसका?
मुंबई, मध्य प्रदेश के भी नाम देखे तेल के दाम, तो वो भी वहां पर तो बीजेपी की सरकार है, वहां तो तेल के दाम कम नहीं।
देखिए बीजेपी स्टेट्स में भी कम हुए हैं, कुछ में ज्यादा, मध्य प्रदेश में भी ज्यादा था, कम हुआ है, बट हम थोड़ा ना स्टेट को बोलते हैं। अब देखिए मैं आपको दो बहुत सिंपल इंडिकेटर्स बताता हूं। जब भी प्राइसेस इंटरनेशनल बढ़ जाते हैं, यू हैव एन ऑप्शन ऑफ टू ऑर्गेनाइज योरसेल्फ।
यस,
हमने कंज्यूमर को नहीं आने दिया, उनको कष्ट नहीं होने दिया। माननीय प्रधानमंत्री जी ने ऑन 2 occasions, November 21, 2021 and May 2022, he reduced the excise duty on petrol and diesel by 16 rupees and 13 rupees. And then the BJP ruled state brought the VAT down. That's how it came down. So we took the hit in the central excise, number one. Number two, look, when the Congress government, और बहुत ही विद्वान वित्त मंत्री जी थे, जो आज उन्होंने ट्वीट भी किया, I admire the fact it's a mild tweet. He said, what I said yesterday should be critically analyzed, and I want to critically analyze what he did. जब दाम $128 पर बैरल पहुंच गया, तो कांग्रेस सरकार ने क्या किया? उन्होंने कहा कि देखो अभी तो हमें कंज्यूमर को सस्ता देना है, तो हम ऑयल बॉन्ड्स फ्लोट करते हैं। और ऑयल बॉन्ड्स उन्होंने फ्लोट किए 1,40,000 करोड़ के। और आज इतने वर्ष बाद में, कितने 12, 13, 14 वर्ष हो गए, उसके बाद में वी आर पेइंग बैक 3,10,000 crores. So this is also a very easy way that you take the debt and you get your grandchildren to pay it back. So I think
increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in part.
It's a roaring fight back from the bulls after yesterday's trading session. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Patakia. With me is Vamakshi Dhuria. Vamakshi, good afternoon. It's a very, very good day for the bulls.
Well, absolutely, Hormas. You know, yesterday the markets were not in such a great shape, but today the markets seem to be in the pink of their health, just like your shirt and my jacket. But, you know, there's a lot lined up today. So let's get started with some of the top headlines. Markets build on gains to trade near the day's high. Sensex Nifty gained over 2% each. Midcap index is up over 1,000 points. All sectoral indices are up between 1.5% to 3%.
Suven Pharma and Piramal Pharma are both higher in trade after Goldman Sachs has initiated coverage on them. The brokerage expects a strong rebound and structural growth for both of these companies and for Piramal Pharma to deliver a top quartile profit growth.
MCX is also in focus after it sees a significant surge in daily options premium in the last 3 days. Volatility in commodity prices leads to higher trading activity on MCX.
Oil marketing companies have rebounded from the day's low after a sharp drop, and that is after the excise duty hikes as well. Brokerages have also revised their estimates on these stocks.
Realty stocks Godrej Properties and Sobha climb on the back of good Q4 business updates. Godrej Properties quarterly bookings crossed 10,000 crore rupees for the first time, while Sobha sees highest number of new launches in the fourth quarter. Brigade Enterprises also trades higher after the company signs a joint development agreement for a premium residential development project in Mysore.
Well, we are almost on the verge of recovering everything that we lost in yesterday's trading session. We were down almost 600 points. We are up almost 500 in today's trade. Already 1,600 points higher on the Sensex. The broader market is doing equally well for themselves in today's trade. At the highest point of the day is the Nifty, 2.5% higher on the benchmark index. The Midcap index too trading with gains of a similar quantum, 1,150 points higher there. Another 2.5% gain on the small cap index as well. So it's uniformity seen across the benchmark indices and the broader markets in terms of quantum of the gains. And if you pull up the advance decline as well, firmly in favor of the advances, as has been the case for the last few trading sessions, barring the volatility that we saw on Friday and on yesterday's a very, very yawning gap and in favor of the advances. But which are those names that are contributing to these gains? Vivek is joining in to take us through just that. Vivek, good afternoon.
Well, good afternoon. Spoiled for choice today, especially if you're a bull, given the fact that you just showed the chart of the advance decline ratio, over 2,200 stocks on the NSE firmly in the green. But let's have a look at some of the gainers, especially from the broader end of the markets. You alluded to them a little earlier, the OMCs. Have a look at all of them. HPCL, you know, most levered as far as marketing margins are concerned, almost 5% higher. BPCL, IOCL topping off the list with strong gains as well. The entire capital market plays, you know, again, something that you alluded to, very high and very volatile trading sessions last few trading days have seen, and on the back of that, higher premium turnover is what BSE as well as MCX are enjoying. Angel One too has rebounded quite sharply from the recent close. Pharma stocks, well, it was a very bad week, last week, and also last couple of trading sessions extremely weak. But today, quite a few of the generic players are bouncing back in style. Biocon almost 6% higher today. Ipca Labs 4%, Divi's as well as Alchem rounding off that particular list of gainers. Well, a couple of stocks moving on the back of either news flow or brokerage upgrades coming in. Info Edge, very strong standalone billings data coming in for Naukri. That stock higher by 5%. Goldman Sachs today turning positive on the CDMO space. So Suven Pharma as well as Piramal doing very well in the session. And very few laggards in the session today, but a few names. Delivery almost giving up entirely the gains it saw in yesterday's trading session. Street, going ahead and analyzing the acquisition, not liking it so much today. Astral as well as Welspun Corp, some of the other laggards in the trade today.
Vivek, thank you so much for that list. Very few laggards indeed. But on that note, let's welcome in our technical guest, Shrikant Chauhan from Kotak Securities for a check on the market. Good afternoon, Shrikant. This is Vamakshi joining in. Shrikant, today to begin with, was a gap up opening. The market has continued to build on to the momentum. So what are the charts telling you? Is this sustainable going forward?
Good afternoon, Vamakshi and Horvas. Nifty is, yes, definitely is doing much better than the expectations. It is holding above the levels of 22,500, which clearly indicates that the fear is, we can say, fading out. But at the same time, close to 22,700, 800, the market is having good amount of resistance. But while looking at the daily pattern and the way that today market opened up with a gap and it is maintaining to that gap up opening, I am of the view that the markets are heading towards the levels of 22,800 in the near term. So in the short term, I'm going to say next 1 or 2 days of time, we could see the levels of 22,800. That's the view. So in case if we see the market is closing below the levels of 22,500, yes, then in that case, we can say that the markets can again come back to the levels of 22,200.
Shrikant, good afternoon. What are the specific stocks that you're recommending? Are you recommending a buy trade, or are you recommending using these bounces to exit some of the bad positions?
See, the way there was fall in last few days, the prudent strategy is to look for reducing weak long positions close to important resistance level, even at 22,700 and 800. But if there is a positional view or if there is a medium term view, then we should look for adding those stocks which are we can say defensives, or if we even consider the overall trend of the market, then we need to be on the risk off side. So while looking at the entire the overall performance of the indices, I'm of the view that we should be more on the defensives on the consumer stable side, and in that we like Tata Consumer, which is around some close to 1140, 1150 sort of levels. And there, if we see the trend, then it is forming reversal formation. I'm going to say it is forming some cup with handle sort of formation. It is around 1,050, 1,070 levels. It's not at 1150, but about 1100, we are expecting stock to move towards the levels of 1200 or maybe 1250. So at this level, it's a classic buy with a view of next at least 2 to 3 weeks. We also like Aadhar Housing Finance, and it is trading very close to its polarity levels. So it is finding resistance close to 465, 455 levels. But on the dismissal of 465, I'm expecting stock to move towards 490 or maybe 500. So Aadhar Housing Finance also looks good at current levels.
Well, thank you so much for that, Shrikant. Keeping an eye out on Tata Consumer as well as Aadhar Housing Finance. Let's slip into a very short break now. The management of Cyient now joins us to discuss their latest foray into semiconductor business. So don't go anywhere.
Electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in, more components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output. Right? We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn.
Well, 22,560, that's where the Nifty is at. The Midcap index, though, is looking like it's cooled off slightly from the day's highest point. As of now, 49 to 826 is where the Nifty Midcap index is at. A lot of these EMS companies actually buzzing in trade. Look at PG Electroplast. That stock is surging higher in trade. So is Keynes, up nearly 6%. Also, keep an eye out on Amber Enterprises. This stock is also trading higher. The IT index, as of now, is trading with gains of nearly 3%. So lots of IT names in focus, and one other such name is Cyient. The management is joining us. The company has created a dedicated subsidiary for its semiconductor business, which currently contributes nearly 4 to 4.5% to its overall revenues. To discuss the rationale and the way forward, we are now being joined by Krishna Bodhanpu, Executive Vice Chairman and Managing Director of the company. Well, good afternoon. This is Vamakshi. I just wanted to understand from you, what is exactly this ASIC turnkey business for the benefit of our viewers, and what is the kind of opportunity that you see out here, and what is the kind of total addressable market here?
Thank you very much, and good afternoon. The intent behind creating this semiconductor subsidiary is, as you can imagine, as more and more things have electronics and intelligence built into them. And when I say more and more things, it's anything from what you look at on a daily basis from a household appliance like coffee machines or air conditioning, HVAC systems, etc., to of course the more complicated things like automobiles, aerospace, and ultimately to data centers, computing equipment. The use of chips and silicon is increasing dramatically in most of the industries that we work in, and most of the equipment that we use on a daily basis. So as the use of chips is increasing, our intent is to create this capability, which will help our clients design these chips, which will help our clients manufacture these chips and ultimately deploy these chips. So the intent behind this semiconductor subsidiary is to enable our clients to more effectively design, manufacture, and get hold of these chips or these semiconductors. Like I said, the use of semiconductors is going up dramatically in all applications. All applications day to day or that we use, and that means that this industry, which is about a $600 billion industry, is expected to go to about a $2 trillion industry in the next 10 years or so. That's the opportunity space that we're addressing. We believe that a significant portion is what is called analog to digital on high nodes. These are the chips that we use in many of the day-to-day applications. And those are the chips that Cyient Semiconductor will target.
Mr. Bodhanpu, good afternoon. Thank you for joining in. Why is this that you have opted to create a separate entity? Is there an intention to bring in more partners as you go ahead? Because, of course, this is a very capital-intensive business, right? So, do you intend to bring in more partners ahead? Is there a plan to list this out in the near future as you have done with Cyient DLM? What is the ideal size you would be looking for if you embark on such a plan?
No, absolutely. And I think the intent behind carving it out as a separate entity is very similar to what happened with DLM. The economics of this business are very different to the economics of a technology services business that is Cyient. The capital intensity is different. The cyclicality is different. The investment cycles are different. So to make sure that we invest for this opportunity, again, it's a huge opportunity and it's a once-in-a-lifetime opportunity. And therefore, to enable us to invest to address this opportunity without sort of damaging the economics of Cyient Limited or what our shareholders expect, that's the reason why we created this separate subsidiary. It's also semiconductors is a very ecosystem-driven industry. We will have to have various partners for various parts of the ecosystem, which we will work with and bring in. I think it's a bit early to speculate on listing because right now it contributes to about 5% of Cyient's revenue, which means it's about a $35 to $40 million business. Of course, it has to be much larger before we consider anything like that. But one more thing I'll add is the Cyient board has committed to investing up to $100 million, and they've also authorized us to look at external capital. So we're, at least for the time being, we believe that we have the right access to capital and will grow this business for the opportunity it presents before we look at any external listing per se.
Well, that's a huge opportunity, right? But let's talk financials. In the first 9 months of this financial year, the semiconductor business revenue stood at 225 million rupees. Now, can you help us understand what is the kind of growth rate that you've seen so far historically in this business, and what is the kind of growth rate that you're envisaging going forward?
Historically, this business is a bit of a cyclical business, but taking that into account, it is a fairly good growth business. I think we would have grown about 10% year on year if you look at the last 5 years or so. But again, the intent going forward, like I said, is the addressable space is increasing dramatically, both because of the usage of semiconductor in various industries, but also geopolitics with the intent to diverse a little bit out of some of the current sources of semiconductors, India becoming a more and more important market. So therefore, the opportunity set, we believe, is significantly higher. And obviously, we're doing all this because we do see an opportunity to significantly accelerate from that 10% growth rate. That will require a different set of economics, capital, etc., which is the intent behind what we're doing here.
What has the revenue growth been for for Mr. Bodanapu historically for the first 9 months? And for the overall semiconductor business as well, it's around 4 to 4.5% of your revenue currently. Do you see that number going to double digits, say, in the next 3 to 5 years?
Yes, absolutely. That's the opportunity that we're seeing, and that's the reason why. Because to address that opportunity, though, we'll have to look at the economics a little bit differently, because these are customized chips, which means we will have to invest upfront. We will have to take in a little bit more of capex from an R&D perspective, and also from the materials, etc., that go into the R&D. So that's why we're spinning this off separately, because we see that proportion changing. But also it will require investments and it will require capital. And that's why we're doing this as a separate entity.
So you expect to accelerate from that 10% revenue growth. But I mean, what are the kind of margins that you enjoy in this business? Where are they at currently? And where do you see them heading going forward?
So the margins are not very different from the rest of the services business today because we run it more as a services business, not as a turnkey ASIC business. As margins accelerate, historically, semiconductor businesses also enjoy a better margin profile. So we also expect margin to get better along with the growth rate, just because of the nature of the semiconductor business. Now, of course, I do want to caution that it is because it's also a different business which requires a different investment profile. We have to do a lot of those things right. But the opportunity set to both accelerate growth and margins is much better. And that's one of the key reasons why we're going down this path.
All right, Mr. Bodanapu, thank you so much for sparing time and joining us today. Wish you good luck for the rest of this year as well. The management there of Cyient saying that they're committed to investing around $100 million and authorized, and they look at external capital as well. The stock, though, slightly off the highs of the day, 3.5% higher still. At 1160 is Cyient. Take a short break. More on the markets and specific stocks on the other side. Stay tuned.
13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over-leveraging of customers to credit cost to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, X of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023 and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen.
Welcome back. Now on to a CNBC TV18 exclusive. Then Yash is joining in with the latest that he's picking up on the Bajaj Group and the Allianz deal. Yash, tell us more.
Well, one of the largest deals as far as the insurance sector itself is concerned, with a total value of about nearly 24,000 crore rupees, where the Bajaj Group, particularly Bajaj Finserv, and other Bajaj Group companies intend to buy Allianz's 26% stake in the life and the general insurance JV. What we've been able to pick up from our sources is that the deal terms and the deal structure between the two companies, that is Bajaj Finserv, the other promoter companies, as well as Allianz, is likely to have been fixed as far as the deal structure going forward is concerned. What we've been given to understand is that a total of 26% stake belonging to Allianz is to be bought, and the first tranche of this transaction will involve the two listed companies, that is Bajaj Finserv and Bajaj Holdings and Investments, picking up a 6.1% stake from Allianz in both the life insurance as well as the general insurance JV. Of course, there is a lot of significance with this number, which is 6.1% stake, because as soon as that 6.1% stake is picked up by Bajaj Finserv and the other Bajaj Group company, that is Bajaj Holdings and Investments, the joint venture will get terminated and Allianz will be free out of that non-compete clause, which means Allianz can pursue its independent insurance ambitions in India, whether through a partnership or by itself. It can go ahead and do that as soon as that 6.1% stake is picked up. How much do which entities pick up as per the proposed structure? This has been made public. Bajaj Finserv picking up about 1.01% stake of Allianz's 26% stake. Jamnalal Sons to acquire about 5.04% stake, and Bajaj Holdings and Investments to acquire 19.95% stake. But importantly, the first tranche would be about 6.1%, and Bajaj Finserv as well as Bajaj Holdings to pick up that 6.1% stake jointly. As far as the regulatory approvals are concerned, also what we've been given to understand is that the company is expected to file, for regulatory approvals with IRDAI, SEBI as well as the Competition Commission of India by the second quarter of FY26.
Well, thank you so much for that, Yash. Bajaj Finserv as of now is trading with gains of around 2%. But moving on, let's put the spotlight now on MCX. That counter is buzzing in trade as daily options premium in the last 3 days have surged significantly. Keep in mind that a large portion of this surge is coming because of higher trading activity, given the kind of volatility that we're seeing in the commodity prices. From 24th of March to 2nd of April, the average daily premium was at 2,400 crores. The average daily option premium in the last 3 days itself, which is when the tariff tantrum started from the US, is at 6,850 crores, which is a massive uptick of almost 3 times the previous 8 sessions. The month of April for now is off to a very great start. The average daily option premium in the month itself so far stands at 5,150 crores. Keep in mind that MCX has disclosed data only up till September 2024. So therefore, when we look at the month of April, the kind of average daily option premium that we're seeing here, it is the highest in the last 8 months. In fact, when we compare it, the first 7 days of April to the entire month of March, it is an uptick of almost 60% on a month-on-month basis. And largely, this is being driven by crude, which the option premium out here saw an uptick of almost 111%. Look at the option premium on gold as well, up 79%, and natural gas on the other hand, interestingly, saw a decline of nearly 18%. So given the kind of moves that we've seen, the daily option premium surging on MCX, resultantly the stock is trading higher today. As of now, the stock is at 5,200 thereabouts, an uptick of almost 4%. Hormaz.
Indeed, and it's good going for MCX. It's around 11% in the last 1 month, despite the volatility that we have seen over the last few trading sessions. But the other one that's doing well today, though, is Info Edge, and that's after a strong fourth quarter business update. And Rima is here with more on that. Rima.
Indeed. So the company in a pre-quarter update has said that billings for the company, billings are basically a precursor to revenue recognition. Billings in the fourth quarter have gone up by 19%, and this is the best that we've seen in the last couple of quarters. Remember, Info Edge gets a majority of its revenue, 70% of its revenues from Naukri, which again is highly indexed to IT hiring. IT hiring went through a tough time, slowdown, and things had just started to recover. So we saw IT billings increase from single digits in Q3 of FY24. So that's about 6 quarters back, now back to levels of about 19%. So that's a positive. The only thing is that, this is backward-looking data for January to March. Now, come April, we know the macro uncertainty. IT companies, could face headwinds, in the form of whether they're going to grow or not, if there are going to be, tech budgets. So will they hire or not? So once again, hiring could come under pressure on account of uncertainty, which will negatively impact Info Edge's growth going forward. So Q4 update is good, but again, it's backward-looking. Back to you.
Indeed, Rima, thanks a lot for that. But good going for Info Edge in today's session as well. We call time on this edition of Midcap Radar. We leave you with the Nifty still at 22,500, a slight cool off from the highs of the day. It's been a little choppy in the last few minutes. We fell, the dip was bought into, we surged to the day's high, and now we are cooling off a little. Remember, tomorrow is going to be the weekly options expiry for the index, considering the fact that Thursday is a market holiday. And of course, that's also the day when the reciprocal tariffs kick in, and B, TCS reports its results. From Vamakshimi and the team that put this show together, thank you so much for watching. MF Corner on the other side.
Their stock price and valuations also declined due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a 1-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equitas Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, now underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly, as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, which along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized, hence incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
Hello, good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. Now, it is often assumed that profiting in a bull market is quite simple. Nevertheless, it becomes difficult to both make money and stay in the market when times are hard. To strengthen the emphasis on creating a robust portfolio, it is essential to possess a well-defined strategy along with the ability to think critically and make informed decisions. To know how to do that and how to go about this as well, and how to build wealth through mutual funds in such a tough market, we're joined by Nasser Salim, Managing Director at Flexi Capital, to talk to us about how we should go through this uncertain time. How should we start approaching our mutual fund portfolios? Nasser, good afternoon. Thank you so much for tuning in, as always, with us and joining us on the show. Tough times. Market is so tough to judge right now. Every day is a different story, right? One day you see the sharp cuts coming in, the next day it's up again. And due to this volatility, there are a lot of factors that we've seen, right? Whether you talk about inflation, geopolitical tension, economic uncertainty, and the main thing coming in terms of those Trump tariff issues and global trade war is a major concern. But as a mutual fund investor, how should I start approaching my mutual fund portfolio, building it if I'm starting it right now in such a challenging time?
Good afternoon, Vinny. Thank you very much for having me back on your show. Yes, no doubt, April 2025 has seen outsized market swings, which continue, which got attributed to plenty of figures, inflation, interest rates, geopolitical turmoil, Vinny, and the tariffs have obviously continued to play havoc, which is the biggest role in the current downturn. I think to answer your question, very, very simple. We keep going back and discussing this is BAU. Stay anchored. All MF investors today need to stay anchored to long-term goals and objectives and avoid knee-jerk reactions. Simply, Vinny, because, once you wake up in the morning, there's a statement by the president of the US, something goes wrong. You wake up, you should not move away from your long-term objectives and goals. That's number one. Number two, I think very, very important. Diversification is a very, very important. It's only it sounds like it's a word, but it's very, very important. And more so, I can tell you this with 20 years of experience. Diversification actually plays out a key role, the crucial mix between various assets that behave differently. So not all investments fall together. A prudent approach, Vinny, is good to consider in uncorrelated exposures, whether it's in precious metals or, for example, gold or silver. I mean, we've seen gold run up in the last few quarters, done really well. Maybe it's silver now, and fixed income alongside your equity portfolio. So diversification is number two, very, very important. The other quick one, without wasting too much time, is on equities as an animal. It runs on volatility as its feature. Rupee cost averaging to regular investments can further temper the impact of fluctuation. So I think stay invested despite noise. History has shown that rebounds eventually follow downturns. In short, keep calm, stay diversified, and stick to your plan.
Keep calm, stick to your plan. Diversification is the key. I want to ask you on diversification, because we often talk about diversification to manage the risk, right? You were talking about it right now as well. Could you elaborate how investors can effectively diversify? Because there are a lot of asset classes, right? You were saying about gold, silver, other commodities, equities is there. But there is much more than that, right? We have those debt funds that come in, international funds that come in as well. So how to go about that then?
See, very clearly, diversification effectively means having a basket of assets whose returns are not completely dependent on the same factor. I think that's the key. And thereby offering downside protection in times like this. I think in practice, usually spreading investments across equities, fixed income. Today, a lot of our discussions should be around fixed income, asset allocation. Very, very important. International funds, precious metals, and even real estate. I mean, why when we're looking at mutual funds, we don't talk about there are REITs available, there are mutual funds available investing in through real estate REITs, which give you participation. And each asset shines at different times. Equities drive growth, bonds provide stability, especially with high interest rates boosting yields. Now we're looking at the RBI MPC meet, which may come up. Precious metals, hedges against inflation. And international funds reduce home country risk, in my opinion. I think dividing the equity portion into a core and satellite, something which all MF investors should talk to their certified experts about, can provide further inter-asset diversification. The goal is to ensure that no single event causes major drawdowns in the portfolio.
Right.
That's the intent of diversification.
Absolutely. So it's not that one particular event will lead to a fall in your whole portfolio, and that's why diversification is key. And you mentioned how each of these other asset classes have their own benefit or what they provide as well. But, Nasir, just talking more specific now, what role does dynamic asset allocation play in navigating uncertain markets? And are balanced advantage funds a good choice for retail investors at such a time then?
Absolutely, Vinny. We've been clearly, saying this proactively at every platform that hybrids, especially for first-time investors who are starting their journey into equity as an asset class, should be exposed to hybrids. The world of hybrids is very interesting in today's times. There are many schemes that I was looking at this morning which have fallen. When the index fell by 4% yesterday, they've fallen by 0.2 or 0.25. And that's where the beauty of hybrids come in. So something like a dynamic asset allocation strategy lets your portfolio automatically adapt to market conditions by adjusting exposures based on prevailing market conditions. You mentioned about BAF. It's a very popular category, has grown since it's been launched. BAF exemplifies the shifting between equity and debt based on market valuations. BAF also reduces equity exposures when markets are high and buy more stocks after corrections, aiming to buy low and sell high, which is the fundamental approach to investing. I think some of these BAFs suit retail investors wanting equity-like growth returns with some downside protection. So effectively juggle between risk and reward. That's a very key factor that a BAF plays. I think also please do remember that BAF also carries equity risk as an asset class. They can't eliminate volatility or guarantee gains. However, they are used to for mid to long-term horizons as part of your portfolio. I think the other very quick one is dynamic asset allocation strategy, which is, in addition to BAF as a category, it takes emotions out of investing. Vinny, I think that is something which we need to kind of now play out and systematically navigate interest rate swings and global jitters by automatically rebalancing to safer assets when needed. So both hybrids, in the world of hybrids, BAF and dynamic asset allocation funds have moved really well.
Absolutely. Nasir, there are so many macroeconomic events that happen as well, right? Now, obviously, we do have RBI's decision that is tomorrow as well. We'll have the Feds coming up as soon as well. So all these interest rate hikes or cuts, whatever may take place, or even in terms of inflation data points that you keep getting every month, how do these impact different asset class? And is there a way that one could go about playing this as well, right? Because what if there's a rate cut that comes in? What should one keep in mind at such a point of time, and what should they be doing in such things?
So very interesting economic question which you posed, Vinny, and the answer is interest rates and inflation affect each asset class differently. They can never be the same. For example, when rates rise to combat inflation, bond prices fall, yields go up, but existing bond values go down. New investors, for example, can benefit from higher fixed income yields. Equities, on the other hand, may feel pressure too. High rates increases borrowing costs for corporates, for people who wish to borrow and leverage, and slow earnings growth, often hitting rate-sensitive sectors like realty or autos, for example. I think, on the other hand, gold, we've seen we've seen a sequential gain quarter on quarter, tends to shine and amid high inflation and geopolitical stress, which we've noticed. Investors saw gold outperform in 2024's volatile patch, as evident last year. Meanwhile, real estate and REITs can offer a hedge if rents keep pace with inflation, but rate hikes may soften property prices also. So look, there is never one particular formula, but being aware of RBI's signals, I think a potential rate cut, which you just said, is imminent, if possible, if inflation cools, could boost stocks and costs and bonds. Investors should adjust, not abandon. Example, favor shorter duration bonds in rising rate regimes. Look at quality scripts with pricing power during inflation and maintain some gold. Precious metals, for example, now it seems that data suggests that between gold and silver may be a little more prudent. As an option that can be looked at for shortlisting. So some of these as a holistic approach should be considered. given inflation and interest rates.
Absolutely. So keeping all this in mind, watch out for the signals that, Nasser mentioned as well. And, what we can do at such a time as well, if there are interest rates that come in or what happens in terms of inflation data points. Nasser, today when you look at it, the world is so interconnected, right, with each other. There's so much that's happening. How important is it to have that international fund or exposure to global equities in one's portfolio? Because you don't want that risk to come in only if there's a problem with the domestic front. Then at least you have some exposure on the international market. Or if there's something on the international market, you have something supporting you in the domestic market.
Well, in today's point of time, I would, the mandate is changing a bit. We're trying to get away from an interconnected world. But I great question again there. I think, international funds allow Indian investors broadly to own US, for example, US tech giants, European blue chips or Chinese innovators, spreading risk beyond the home market and economy. I think over the past year, data is available. Global equities have outperformed domestic during Indian markets downturn later in the year. International funds, for example, have averaged about 14% versus single digits for many Indian equity categories. I think the underscored value is when Indian markets tumble, global markets may rally and vice versa. I think that's the fundamental point. Including a healthy exposure up to 20% in international funds mitigates India-specific risks, like a policy change or a local slowdown that may happen in some other economy, and captures growth from leading global trends. Today we're talking about renewable energy, AI, EVs in the world. I think some of those, if it also hedges against rupee depreciation over the long term. I think the key is to choose established international funds, or ETFs for that matter, which are aligned with one's strategy, whether it's the S&P 500 index, for example, or a global multi-asset fund. It allows you to build a more resilient portfolio that's in tune with global opportunities and your individual risk-adjusted risk profile score. So I think that's something which is very important.
Okay, Nasser, thank you so much for that update there coming in on international funds. But we still have a lot more to discuss. We're going to sip into a short break and come back and discuss those other points with Nasser as well, so don't go anywhere.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports.
Welcome back to MF Corner on CNBC-TV18. Today we are discussing what you should be doing in a volatile market to keep a good mutual fund portfolio for a long term. What are the steps you should take? What is the risk you should avoid as of now as well? And we still have Nasser Salim and Managing Director at Flexi Capital who's still with us. Nasser, let's keep the discussion going on. And SIPs, that's popular way to invest in mutual fund. Everyone, we keep saying SIP is the right way to go ahead. You're talking about rupee cost averaging as well. how do they help in wealth creation? If you could explain our viewers why it's necessary to go through this process as well, and especially in this volatile market.
So three key things, Vinny, as far as SIPs are concerned. They are best friends of investors in choppy markets, all that I can say. They enforce discipline, investing a fixed sum of money monthly or quarterly into mutual funds, regardless of market levels. That's number one. I think clearly, the rupee cost averaging formula, which automatically buy more fund units when prices are low and fewer when prices are high, lowering the average cost is something which is a fundamental attribute to the SIP model. The other very, very important point is that you're less likely to panic, sell, or stop investing in a slump, which is when opportunities are greatest. In fact, continuing SIPs during crashes lets you accumulate units cheaply, which is currently what we are seeing, which reflecting during the recovery. When things recover, you all of a sudden see you accumulate a large number of units and start reflecting better in terms of return profiles. I think, moreover, compounding works better with early regular investments, Vinny, and each SIP installment can grow for years. Investors use SIPs for goals like children's education or retirement. They could also build wealth steadily without trying to time the market as such. I think the other very, very important is that it automatically removes any emotions that get attached. SIPs also just removes emotions from investing. I mean, you have no control over it. I may feel today I want to sell because there's negativity, there's a lot of red in my portfolio. But guess what? I mean, you can still do it, but in SIPs, it's discipline, it gets you in. So I think the key is to stay invested through cycles, and SIPs helps you achieve those.
Absolutely. The key is to stay invested, but Nasser, you're saying, like, it puts your emotions away as well. But sometimes, when you just started your SIP, maybe just this year, beginning of the year, and now you see that negative coming in even in SIP front, then it does worry anyone. Like, okay, am I going the right way or have I picked up the wrong fund? How does one judge that then?
So clearly, we're assuming this is a group which has done a proper study before you're investing, and you've chosen your shortlisted SIP funds, and you've used certified experts to solicit those funds that are being invested by you or by the investors. I think clearly, as long as your objective and your end need is to ensure that you're creating wealth and you have certain triggers, which are the reasons for shortlisting of those funds, which can be reviewed once in 6 months, perhaps, or maybe once in a year at best, to see if those short-term and long-term triggers were the reasons for choosing or shortlisting a fund. Is the reason why you should continue to hold. You should continue to hold. There is no reason for one to sell. And for newer investors, I think something which is very, very important is don't try to time the market. It's what determines is when you stay invested in the market. It's time spent in the market that will determine your returns through SIPs, not by timing the market. It's never worked, Vinny. And in our opinion, attribution analysis, when you're looking at shortlisting funds on SIPs that have been chosen by you or by your certified experts, review once in 6 months or once in a year to see if those attribution analyses remain still within the goal that you have chosen them, and therefore you remain invested. Else, you can look at some options where you need to consult and then change.
Okay. Now, sir, so many options that we have in mutual fund categories, equity, debt, hybrid. You can go on and on talking about the options that are there. So how should investors choose the right fund right now based on the financial goals? If I have a long-term goal and my risk appetite, what is it that one should be, how should one judge that?
So, these are time-based, objectives in investments that one gets to kind of choose from. Selecting a fund really depends on one's objective, risk appetite, goal. Equity funds suit long-term goals, for example, clearly nothing less than 5 years, bare minimum 60 months, and a higher risk tolerance. There is a riskometer by SEBI that is available on every KIM and SID. And I want your investors, viewers, to kind of ask their certified experts to show them what a riskometer is for their fund. They offer growth, but with a relatively higher degree of volatility. Within equity, we have large caps, which are relatively stable, while mid and small are much more volatile, but potentially more rewarding. Debt funds fit short-term goals or low risk profiles, think of liquid or short-term bonds for parking money safely. There's a category called arbitrage now, which is very, very popular. Then there are corporate bonds, gilt funds for steady income with moderate risk. We are also seeing now a very interesting set of funds where some large asset managers have launched something called arbitrage plus income. So it's a combination of debt plus arbitrage, and it also gives you a capital gain advantage over 2 years of holding period. Hybrid funds like balanced or aggressive hybrid, we just spoke about them. Blend equity and debt, giving a very mid-path approach. For example, an aggressive hybrid fund can invest up to 70% in equity as an asset class, 30% in bonds. Can be an ideal for a moderate risk investor seeking growth with some cushion. For a 1 year goal, an equity fund is too risky, so opt for debt. Our recommendation for 10 years plus, pure equity or equity-oriented hybrid might be apt. So also assessing one's comfort in volatility, their risk appetite is integral to portfolio construction.
Absolutely. Nasser, what is important right now also that sometimes when the market is going down, you do need some emergency fund as well. So what is your advice to an investor who's just starting off in terms of emergency funds, and why is this step so critical in financial planning as well?
It's a very, very important question, Vinny, and I'm so happy that you're raising this question. I think the importance of emergency fund in all our lives happened when we got hit by COVID in 2020. I think building an emergency fund is very, very important to one's discussion and portfolio construction. Before you even invest in any mutual funds, it is recommended to shortlist and set aside an emergency fund. This can be ideally for 6 to 9 months worth of living expenses, which would be parked in safe assets, liquid stroke arbitrage, which are available within 24 to 48 hours on call. It's the financial cushion for any job losses, medical exigencies, emergencies, unexpected home repairs. It prevents you from dipping into your investments at the wrong time, Vinny. If a sudden need arises and you've invested all your money in equity funds, you might be forced to redeem during a market crash, locking in losses. An emergency fund ensures your long-term investments are not touched and into uncertainties, so they can compound continuously, uninterruptedly. And it also grants peace of mind. I think the most important thing is if you have a set-aside budget or a bucket which is available for 6 to 9 months, it gives you peace of mind, knowing that you have a safety net. You can invest in volatile markets more confidently and avoid panic selling for cash needs.
Absolutely.
And typically emergency funds are kept in high interest savings or short-term, fixed deposits or liquid arbitrage assets. In this case, as far as mutual funds are concerned, that won't drop in value when you need them.
Okay. And Nasser, a quick one. What are some of these common mistakes an investor makes while building the mutual fund portfolio, and they should avoid, especially at such an uncertain time?
So again, a great question, right time, Vinny. I think in turbulent times, investors often become their own worst enemies, if I can say this on your show. A few frequent mistakes that one can avoid. Panic selling starts off with that. Watching your fund values daily, hourly, every minute, it can be disrupting and can induce panic selling and convert paper loss to real loss. So markets eventually recover. And if you exit, you might miss the rebound. So please do not look at panic selling. Trying to time the market perfectly, Vinny, waiting for the perfect entry or exit rarely works. In my last 22 years, I can tell you, I have not seen it work. It often leads to disruption, buying high and selling low. A better approach is sticking to a plan and following it consistently with an asset allocation model. Lack of diversification is another mistake that we all investors end up doing. Putting all money in one sector or fund, say all mid caps or all small caps, can backfire. Ensure a mix of funds across different market caps, asset classes. Also avoid over diversification. Ignoring risk profile. I think that's again something which is very, very important. Somebody may have come and told you that, listen, I'm invested in this particular fund. It could be suitable to that particular investor, but have you done your own risk profiling?
Yeah.
Chasing high returns, of small cap funds or past performances does not guarantee any returns. And it's subject to one's risk tolerance. Align investments to what you can stomach in terms of losses, nothing beyond that. And the last one is just people who don't stay calm. I mean, it may seem frequent tweaks to the portfolio are necessary, but high churn is known to hurt performance in the long run. Stay the course, viewers, review periodically, and adjust only if your goals or risk appetite changes in the process of investing in the journey. By sidestepping common errors, especially in uncertain times, you set your mutual fund portfolio up for long-term success. Those are some of the mistakes that I think one can avoid.
Absolutely. I think then it's the right time with that advice coming in and mistakes to avoid. So thank you so much, Nasir. We'll wind down this edition of MF Corner on CNBC TV18. Thank you so much, viewers, for tuning in as well. It's always a pleasure to get you all more details in terms of what to do in mutual fund. And up next, you have Closing Bell, so don't go anywhere.
Has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC TV18, Mumbai.
Hello, I'm Surabhi Upadhyay, and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC TV18.
Celebrating market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Overall, we're seeing green coming in across the screen for Asia Pacific, especially look at the Nikkei. That opened up first and that was up almost 5%.
China is essentially a closed country. In fact, it is a closed country.
Dollar index 103.43. Oil prices continue their slump.
Now all eyes on whether or not it can get past the 20-day MA. MCX is a stock that I'll track today.
India, out of all the major economies around the world, is probably going to be least affected.
22,481, 1.5% higher. The Nifty Bank is up on 1.3%.
FY25 is ending absolutely flattish on EPS terms.
Pharma is our largest exposure out there. We got one aviation business which is expanding rapidly.
This is a global slowdown. This is going to cause a global capex slowdown.
11 o'clock. Markets are still going strong, up 200 points on the Nifty, 650 points on the Sensex.
I would say we are very well positioned because India's ability to negotiate is much greater.
I've seen a slightly steady fall in the currency over the last 2 days.
Almost on the verge of recovering everything that we lost in yesterday's trading session.
$500 points on the Nifty. Well, that was a day so far, and as we start this edition, I think we are closer to the highs of the day, and is looking pretty good. Can we call it Turnaround Tuesday? Will that phrase hold till 3:30? That's the question, because we are still very sensitive to headlines as they will be coming for sure. Maybe not in the next 1 hour, but very, very sensitive in that sense. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant Budhi, my colleague Surabhi and Nigel. Guys, hi, afternoon.
Hi, afternoon, Prashant. Afternoon, Nigel. I'd want to believe what you're saying is right, Prashant, that the worst of the price capitulation, the absolute mayhem, is over. But that may not mean a straight run, a pole vault, a V-shaped recovery from here. But as long as we can at least stop the mad falling, I mean, it's been good from that standpoint today.
Provided we know all the negatives, which is not the case. We don't know what we're going to hear later today, right? So at least as of now, it's encouraging to see a bit of a bounce. And it's very encouraging to see the price action actually on the Indian markets, because all across the weekend, people kept telling you haven't seen 2008, you don't know what happens at that point of time. People are rooming the circuit limits. We had a couple of Asian markets yesterday that were halted for trade. Yeah. And we got away with a cut, right? With a cut of less than 2%. And we ended at the high point of the day. And today's price action as well is very, very encouraging. If someone told me that this is going to be the screen, it's pretty good. Maybe at high levels, we'll see some kind of supply. But a good bounce and a resilient market is what I'd like to call it.
Absolutely. So let's just quickly recap the levels here. We've essentially what we've done is we've retraced nicely to hourly averages. So, for example, and I don't know if you have the numbers which should come up on your screen. The high today is 22,697, unless we've made a new high. No, we've not. So the high today is 22,697, and 22. Basically, we've almost hit the 20 hourly average. The number that we put out in the morning, 22,711 was that number. So just 10 points short of it. At the day's high. So, now, of course, beyond this, we'll have to see. The next resistance is essentially the 50% retracement of the fall that we've seen for the Nifty, which is now 22,806. Again, very near-term levels. No point putting out sort of big numbers, but this is the next one for the Nifty. Bank Nifty high today is 5793. And here we've, again, almost hit the 61.8% retracement of the fall, which is 5848. Just 50 points short. There's nothing on the 51,000 nearly index. Small cap index, mid cap index, both are up 2% apiece. So, it's good going, and it's some recovery and repair which we are seeing. Although, as I've said, this is very sensitive. It remains vulnerable to what may come, and what we've heard overnight from Trump and officials once again seems to be clear that they're not looking for any easy wins, quick wins. They are in this, they're digging their heels in. So this is not going to get done easily. Even if countries offer to lower tariffs, what they're looking for is bigger than just tariffs. They're looking at the cumulative deficit, which includes tariffs and non-tariffs. And non-tariffs are more structural, more ingrained, and they're harder to undo in that sense. So we will be with this news flow for a while. And the only question is whether, negative news can only impact and keep hitting you with the same intensity at a certain point. Whether this is that, or this is just a little bit of clean positioning, allowing us to breathe a little bit. We'll find out over the next couple of days. Guys.
Yeah, well, for what it's worth, it's been a much-needed breath today across global markets, really. Most of the Asian screens have had a positive close. Japan managed to go home with all of those 6% gains today, so it's been looking good. Europe also is tracking gains between 1 to 2% as we speak. Now, for us here, financials, some PSUs, it's actually an across-the-board up move that we're seeing, but within that, financials are doing really well. On the large cap screen, obviously, the Bank Nifty is taking things higher, 1.5%, 1.4% higher. But like I'm saying, not just banks, NBFCs are having a very good run today. Look at Jio Finance on the large cap screen, 5% up, is actually making Jio Finance the best performing Nifty stock as we speak. But it's not alone. Immediate next one, Shriram. Shriram Finance is up about 4%. You move to the broader space in the market. Look at Chola Finance, 9.5% higher. 5-Star Business Finance. So it seems that NBFCs are very, very excited. Now, is there something more coming in the RBI policy tomorrow? The wide expectation is that there should be a 25 basis points rate cut for sure, and there should be an official change in the stance to back to accommodative perhaps, as the RBI addresses the liquidity concerns. Today also there was a 20,000 crore rupee OMO in the market. That's a 80,000 crore rupee liquidity bazooka in April that the RBI is discharging. Today was the second tranche, and there are 2 more to go. So all that is making financials, a very, very exciting spot in the market, so to speak, this afternoon. Beyond that, some other names that are seeing repair and recovery. PG Electroplast would be an example, 6-7% higher. You're saying, newer names or the more recent listings, for instance, Blue Jet Healthcare, also up and about. Acum Drug, 7.5% higher. So these are some of the other names. Beyond that, PSUs, like I said, PSUs are also seeing a fair amount of traction. Hoodco is up about 6%. As we're speaking, GAIL is up and about. BEL, obviously from the large cap space, doing really well after its order announcement. So it's a well-rounded up move, recovery, where I think right now 48 of the 50 stocks of the Nifty are participating. No, actually make that 50 on 50 now. If we pull up the heat map, it'll look very nice. Full 50 shade of green on the Nifty this afternoon.
Well, that's right. And talking about those 50 stocks, I think Reliance Industries has found its form.
Yeah.
And that's a large weight on the index. I think 1250 is a crucial resistance mark where its 20 DMA is there. I think the 100 DMA as well is there. And Reliance Industries finding its form is very, very important from a market perspective, purely because of the large weight it has on the index. But let's tell you how, the trade is setting up today. You have advanced decline ratio that should come up for you. Most encouraging, 10 stocks advancing, 1 stock that's declining. Yesterday as well, as we mentioned earlier today, there were more than 300 stocks that recovered more than 10% from the low point of the day. So the breadth of the market, actually, the price action is encouraging out there. The PCR made that point yesterday, made that point today as well. The PCR, when it moves to around 0.65, 0.7 odd, normally we see a bit of a bounce, and that's played to script, because as we speak, the PCR has moved to around 0.85. How is that? There's some put writing that's creeping back in there. And tomorrow is the expiry, remember, because we have Thursday, that's a holiday. So tomorrow is when that expiry will play out there. And the premiums have absolutely got smashed. The 22,500 put, aggressive writing is what we're seeing out there. 22,400 put as well. On both those two, the premiums are down between 70 to around 75%. So the bulls believe that maybe they can defend the lower levels just in the near term. These contracts expire today. And take a look at the 22,000 call. Those writers, they have packed their bags. They are in trouble, because today the ferocity of the kind of up move that we've seen, there's big unwinding out there, close to 28 lakh shares getting shed at that particular strike. Finally, what are the levels I'm looking at? I think this is more or less still a pullback, because we need to get around 22,950 to see a larger resumption of the uptrend. So that's the important mark, 20 and 50 DMA at around 22,950. And on the Nifty Bank, the 100 as well as the 200 DMA, that's very, very important in terms of a reference point. As of now, we're closer to around the 100 DMA. If we can get towards the 51,000 odd mark, that's what will give further confidence. So 22,950 on the Nifty Bank, around 51,000 or thereabouts. Till then, you'll be treating this as a bit of a pullback. That said, how do you trade the final hour? Mitesh Chakkal joins us on the show. Hi, Mitesh. A better day for the bulls, not out of the woods, but we'll do with some green, right? What are the levels you're looking at? And if someone had the guts to go ahead yesterday and take a long position, what would you advise? Enjoy the evening or stay tuned for President Trump and, hope that there's no negative news flow?
That's exactly what I would wish for, Nigel. Good afternoon. I think, the bounce back is good, and, while we did taper off during the day, you again come back, and that's a good thing. But my only worry is that, the first thing is that 22,850 was the low of Friday. So 22,800, 850 is the zone which I have been highlighting as the key level, though 22,600 had some pivot which has been captured to strike their action. So till we fill the gap, I think there will be some worry about the recovery process, but that's the level to watch on the upside. And till then, what we've suggested is to trade with some kind of put spreads on the Nifty. And the other thing is that you can look at trading individual stocks that amount. So I think that's the way we're approaching it. Right now, I think I have a buy on AB or Aditya Birla Capital, AB Capital. That's a stock which has recovered well. It's filled the gap. So buy here with the stock at about 180 for targets of 195 to begin with. If the markets are good, the stock can eventually even go higher from there. And the other one is a buy on HDFC Life with the stop at about 680 for targets of 710.
Okay. All right. Got that. Mitesh, actually, if you can just stay on, we want to discuss this move in OMCs with you in just a second. But first, we'll get the fundamental views around it very, very clear. Right now, oil marketing companies are seeing a nice surge, about 5% up on BPCL and HPCL. IOC is not too far behind. IOC is up about 2 to 2.5%. So much happened since last evening. There was an excise hike. There was a hike in the price of LPG cylinders by 50 rupees. And then there is a whole question of under-recoveries, because we know that in FY25, the previous financial year, these companies, oil marketers, they have suffered huge losses in the LPG sales that they have undertaken. So where does all of this stand? And can the companies hope for any sort of additional help or recovery from the government? Let's go across to Sudarshan for the latest on the math. Sud?
So yesterday we saw government, basically oil minister making two major announcements, and reason of both these announcements to pay the LPG compensation for FY25 and the ongoing losses that these companies are making on LPG. So first announcement that government made that it's going to increase the special additional excise duty on petrol and diesel by ₹2 per litre, and second that LPG is going to be increased by ₹50 per cylinder. Now coming to first excise duty hike, why it was hiked. So in FY25, total LPG under recovery was ₹41,338 crore. Now, this ₹2 hike will give OMCs or say government around ₹30,000 to 32,000 crore. Now, government is saying that this amount is going to be used to make the payment for FY25 under recovery. But there is one catch over here. Unlike previous LPG compensation, this time it's being done by excise duty hike. So the amount will go into exchequer account, not in the special fund. So oil ministry will have to go back to finance ministry making request for this payment. But ideally 30,000 to 32,000 crore will come. Also sources suggest that government will soon move to cabinet seeking the approval of this payment. The second announcement about the LPG price hike of rupees. Why was this done? This was done to make the payment for ongoing dues. So currently all these OMCs make losses of in the range of ₹220 to ₹250 per cylinder. Now this ₹50 hike will bring their losses down to ₹200 per cylinder, and oil minister has confirmed that this will help in reducing the losses. Now the question is, will the increase in excise duty hike impact our fuel price at the pump? The answer is no. It will be borne by oil marketing companies. What do brokerages feel? Brokerages feel that these are the positive announcements, but one concern will remain is the fuel price cut that these OMCs might take. Also, oil ministry did comment that if crude remains in the range of $60 to 65, or even if it moves higher to $68 per barrel, oil companies will have the headroom to cut fuel price. So we'll have to check going forward if there is a headroom and these OMCs take price cut or not.
Yeah, absolutely. As customers, we're definitely waiting by for that. But Sudarshan, before we let you go, I have to talk about this latest piece of news that's coming in from PTI. Let's pull up gas stocks, city gas distribution companies in a market that's wide green recovering. City gas distribution stocks like IGL, which have a huge presence in Delhi NCR, they are under pressure. And why is that? You just saw the flashes on the screen pointing out that it seems like there is a move to phase out CNG three-wheelers in Delhi NCR and perhaps go all electric. Sudarshan, have you seen this? What's the latest?
So earlier electric vehicle policy of Delhi government was about to expire on March 31st. So now this policy has been extended by another 15 days that Delhi government has announced. Also, as per PTI, we understand that Delhi government has released the draft of new EV policy that they are calling it EV policy 2.0, and under that policy they have announced certain recommendations, but please do understand that this is the draft. Before it gets released or notified, it has to go to government, cabinet and even the assembly. Once those approvals come, then only that will be implemented. One stock that will be impacted negatively because of these recommendations is IGL, because it's Delhi based, and total volumes, IGL 30% of total volumes come from these CNG, but majorly it comes from the cars. Now, what are those recommendations? I'll read out certain recommendations. First, government has recommended phasing out of CNG-driven auto rickshaws, and it says, the draft says, no CNG auto rickshaw registration will be allowed from August 15 of this year, that is 2025. And also, CNG auto permits will not be renewed from August 15. All the CNG auto permits will be substituted or reissued with only e-auto permits. Policy also recommends phasing out fossil fuel-driven vehicles carrying solid waste deployed in large numbers, and these vehicles are mainly of municipal corporation. For two-wheelers, it says Two-wheelers running on petrol, diesel and CNG will not be allowed from August 15 of next year, that is 2026. It says no diesel, petrol, CNG, three-wheeler registration in case of goods carriers from August of this year. Also, all garbage collection vehicles of this municipal corporation have to be transitioned to electric vehicles in a phased manner and have to achieve 100% electric fleet by December 31 of 2027. As far as the public transport buses are concerned, operated by Delhi Transport Corporation, it says they have to convert into e-buses in a phased manner, and private car owners will have to buy electric cars only if they already have two vehicles. So overall, recommendations are not looking good for as far as IGL is concerned, because automatically all these vehicles running on CNG in a phased manner will have to convert into electric.
Okay, all right, so Darshan got that. Thanks very much. So two important stories playing out. This one is a little more recent. The fact that Delhi could be moving towards a full EV fleet when it comes to three-wheelers. Well, let's discuss this with our next guest on the show, someone who actually hails from the national capital. Gurmeet Chadha is with us, managing partner and CIO at Complete Circle. Gurmeet, great to have you on. Let's start right there. I don't know if Delhi is fully ready, charged up for a full EV fleet or not, I mean for three-wheelers. But anyway, IGL is falling quite a bit. What would your take be on the stock?
No, so, we've held this will be for long that, city gas distribution and OMCs both, are subject to frequent pricing changes by state and central governments. And as a result, market is unable to, really discount the way it traditionally does in terms of what earnings you want to discount. So now this new EV policy puts a bit of a thrust on phasing out of CNG autos and old commercial vehicles. So I think it's a avoidable space to be in, not in our portfolios. And this is not the time to, really try and second guess in terms of what's going to happen, what's not going to happen. Just stay put in terms of where you have reasonable idea and some earning visibility as far as portfolio positioning is concerned.
We anyway have to second guess far bigger things as well, right? We have to second guess what the US president is thinking on a daily or hourly basis. So that as well. But there you go. So Gurmeet is saying no to OMCs, no to city gas distribution.
What about exchanges, Gurmeet? The two exchanges that are doing well today, one is MCX, because there's been so much of volatility in the commodity prices and the volumes have gone through the roof. If I'm not mistaken, yesterday and day before, the volumes were up, I think 50% higher than what we saw the average, say, of March. So massive volumes is what we saw in MCX, and that's where that stock is up. And BSE, it's a smaller player in the options market, but that's gradually gaining market share. And today is the expiry as well. Last week as well, I understand that their market share was in excess of 35%, just purely for this Tuesday. Y'all also, have NSE, I think so. So between the exchanges, what do you all like? NSE is the unlisted one, the safe one. Hopefully it lists at some point of time. But otherwise, these two, they are bucking the trend.
Absolutely, Nigel. But, it's just that the valuations are not comforting. It did fell below 4,000, especially BSE, from almost 6,000 odd levels. But still, even if you see depositories like CDSL or CAMPS, they also continue to trade at almost 35, 40 times. Good asset management companies like HDFC, Nippon, they are also at about 30 times plus. So while the structural story is there, despite the correction, valuations remain rich. So we are holding on to what we have. So we have CDSL, we have CAMPS, we have a couple of asset managers in the portfolio. We may look at a broking firm post earnings. I think that's when you'll get a better impact in terms of how much has been the impact on transaction revenues. And NSE now post the ISIN getting unfreezed is now freely available at even 100, 200 shares in terms of lots. So price is currently around 1,600, 1,550 to 1,600. If you take the pre-bonus rate, that's about 7,500 to 8,000. That's about 25, 30 times. That I think is still more reasonable amongst the lot. And obviously there are, conditions in terms of IPO coming this year. So I think capital market play is structural. But for now, I think you have got to be positioned where valuations are more reasonable, like banks, like a couple of good NBFCs, some gold-based NBFCs, where you can take advantage. And if you see the OIS rates now, 1 year and 5 year, they're actually indicating RBI may do a little more than 25 bips, either a CRR cut or a bigger reduction or more liquidity infusion. So I think that's a better pocket to be in, Nigel.
Okay, all right. By the way, this quarter number will show the pain, at least in some of these exchange businesses. Both NSE, of course, results are closely tracked, even though it's not listed yet. Of course, BSE as well. Gurmeet, coming back to you, let's talk about the currency markets as well. And a quick word on, of course, what's happening with the rupee. Under pressure, second day running. There is, of course, the the yuan fix by China as well, which is indicative of the fact that they're ready to push the yuan lower. Lata is here with some perspective. Lata, what are you picking up?
Well, there was a big fall on Monday. That's yesterday by about 60 pies from 85.23 to 85.83. And today morning, it seemed stable. You know, we thought we would get away with the 10 pies fall. But late after lunch, there has been a huge fall. And now we are about 40 pies lower. So together, it's almost 1 rupee more expensive that the dollar has become. The news is not the rupee fall. The news is the reason why it fell. And that is the lower Chinese fixing. The official rate every afternoon, all central banks fix, even there is an RBI fixing of the rupee. The yuan has been fixed at its lowest level since September 2023. It's not by a huge lot. It used to be 7.19 to the dollar. Today it is 7.203 to the dollar. It's not a big deal, but it clearly shows an indication. And once the PBOC indicates that it is prepared for a depreciation of the currency, the official, the market rate fell even further. 7.30 to the dollar yesterday, today 7.33 and change to the dollar. So clearly the Chinese yuan is signaling that it is falling. And obviously the interpretation is that if you're going to punish me with tariffs, I will cheapen with currency and get around it. That seems to be the message that's coming. Usually when the yuan falls, all Asian currencies fall. And you can see that in the won, in the ringgit, in the Taiwanese dollar, Filipino. You can see it across the board. And likewise, you can see it in the rupee as well. There are a lot of traders, treasuries, bank treasuries, which play all currencies. So there are these currency players who have marked most of the Asian currencies, including ours, lower. And there is the usual dollar demand from importers, maybe even from some foreign funds. We don't know whether it will be a net positive number today. So there is some demand from FPIs as well. And importantly, the Reserve Bank is not supporting any level. So they are not there on the other side. The point to take home is that hereafter, don't look at the rupee only by looking at the dollar index. Also look at the yuan.
Absolutely. Tomorrow, all ready for RBI, Lata? What's the question to the governor?
25 is for sure. Yeah. The question now is whether it will be 50.
50 or not.
I mean, it could be. If you're anyway going to give 100 basis points in this entire cycle, why not give one together, 50 bips? But if it is only 25, it will be taken as hawkish. It should be 25 plus a stance change or something like that.
But I think there is also now in the price. A stance change also perhaps is more and more people are saying.
What is in the price is the liquidity. There's so much money in the interbank system that normally the call rate, the rate at which banks borrow from one another, would be the repo rate. Today it is about 5 bips lower. Because there's so much liquidity.
So just on liquidity, stance change is one. I mean, if they change to accommodative, right?
Yes.
If they do from neutral to accommodative. On liquidity, since they've given this big bazooka, 80,000 crores in April already, would the market want to hear anything more on liquidity, or is there more than enough sloshing in the system?
There is more than enough sloshing. And I think the Reserve Bank has made it very clear that they have detached liquidity management from policy. Policy is the price of the money. Amount of money is on a daily basis, the liquidity that the Reserve Bank sets, and it's 80,000 crore this month. So, Ravi, from January to March, it is 7 lakh crores.
Whoa.
So, I mean, they've really pushed in. The point they are making is, what Nigel, you were hinting at, they're pushing it even below the repo. The rate at which money is exchanging hands is even below the signaling rate of the Reserve Bank. And they may, we are sure to ask that question in the press conference, and we will hopefully expect an answer on similar lines.
Thanks very much, Lata, for that. So that's basically the tomorrow's agenda, which is of course going to be all RBI and what happens in that sense. By the way, today the EMS companies are all higher. And you look at some of these names, right? PG Electroplast is up 7, Keynes is up 8%. And you've got a few others which are up 4-5%. I saw IIFL note which was talking about expectations for the fourth quarter. But this is, as Gautam Dugar earlier was saying, this is all, as numbers start to trickle in, it's all backward looking. It's always backward looking, but maybe Now, because of these tariffs, etc., it's a little more uncertain. So you want to hear, and I think most of the commentary and questions to management will all be about, what ahead and how are they seeing the implications, because if these tariffs stay, etc., direct and indirect as well. Gurmeet, always I kind of sort of try and ask you whether, is there anything you're particularly liking? I noticed delivery is down big time, 6.5%. Is the number one volume-led loser right now across the board. There was that acquisition of Ecom Express, Gurgaon-based company, dependent hugely on e-commerce. But I'm not sure if there's anything, delivery or any other names, Gurmeet, which interest you.
Prashant, on EMS, I think it's just that the margin for error for any misses is not there. I mean, obviously the story is good long term. We have Dixon in our portfolio. We exited some bit of PG Electroplast and Amber. I did some routine profit booking. And right now we are assuming that we are less tariff. If some countries like Vietnam, Taiwan figure out a zero tariff, deal, something may happen. Then all of this, So I think right now it's not the time to really second guess and think that, okay, we are less tariff, so we will gain and start buying 100p stock. You want to hold certain part of it, that's fine. On new age, I think Zomato, is something we probably added a little bit at around 200 levels. I think this quarter could be a bit rough in terms of the Blinkit being, because they've added more dark stores. And a lot of people say this is cash burn. To me, it is, it is actually capex. Adding dark stores is not cash burn in the long run. So I think that's one space we want to look at, both from a food delivery, both from a e-commerce as well as the district app, which is, the tourism economy, the ticketing economy, which is a much wider play.
Okay, so Zomato gets a thumbs up. Wondering if that's what you bought yesterday. What did you do yesterday? 10 seconds, you have to say goodbye, Gurmeet. Yesterday, what did you buy? There was a fire sale going on.
I just got L&T and Reliance, Surbhi. I'm just keeping it simple.
L&T and Reliance.
Now. Yeah, just keeping it simple for now. Buying things with no linkage with US.
Yeah. Okay, got it. So those are some ideas to work with. Zomato, L&T, Reliance, some of the recent positive bets for Complete Circle. Gurmeet, thanks very much. Always a pleasure having you on the show. Thank you for joining in. Need to take a quick break. On the other side, we get you a view from Kotak Mutual Fund. Shibani Sarkar-Kurian will join in with a perspective on the market.
Of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates.
Shibani Sarkar-Kurian is Head of Equity Research and Fund Manager at Kotak Mahindra AMC. Shibani, good to have you here. Prashant this side. So just your feedback, Shibani. I think that's all we can do after your, what's the feedback from your team? You have analysts, you have other fund managers. I'm sure you sort of put heads together to figure out how this is really going to play out. And what's the distilled view which is coming out from the Kotak house, Shibani?
Hi, Prashant, and good afternoon. So I think one clear view that is coming out is that uncertainty is possibly here to stay at this point in time. So it's very difficult to take a very clear-cut, idea or thought in terms of what pans out over the medium term or the near term, given the kind of situation that is ever evolving on a day-to-day basis. So in this sort of a context, there are a few key things to look at. One, when you look at markets and the way the global economy and growth is panning out, given the situation today and assuming that all things remain the way it is as of now, there is likely to be some impact on US GDP growth, and that has a second order impact on global demand. And India, to that extent, is not immune from an overall perspective. While there is a lot of thought that tariffs in India are lower than some of its other Asian counterparts, but again we'll have to wait and see how bilateral discussions move between countries and what you were earlier also discussing in terms of what countries do on the currency front. So I think the best way to approach the market as of now is to essentially look at stocks bottom up. Look at companies which are more domestically oriented, sectors which derive demand from the domestic economy, including discretionary mass consumption, some of the banks, power, cement as segments, or even healthcare, which is essentially hospitals and domestic formulations business. We've always had the view for a while that from a valuation perspective, it is better to be in large caps as compared to mid and small caps, and that thought continues to be the case. But overall, I think we are looking at companies more bottom-up in nature, trying to look at companies where there is some visibility of earnings and where valuations are reasonable.
Okay. Shivani, hi, great to have you on. So let's just talk about whether overall there's a shift in the house view in terms of preferred sectors. You've always had a bias for, of course, the capex side of the market, cement, of course, early investors in PSUs as well. But given the shifting nature of the market, is there a change? Is there a churn that you've undertaken at Kotak, and what would the top bets be now?
So obviously with markets evolving and the situation evolving, there is some amount of change that takes place in terms of thought process as well. While structurally we continue to like the entire capex manufacturing theme, we have also been cognizant of valuations in the past. And therefore that is one segment where we've, if you look at our disclosed portfolios, we would have reduced weight. Some of the sectors incrementally where we've, looked at positively, one has been the entire private sector banking pack, especially the large banks and some of the large public sector banks. Of course, the sector is not out of the doldrums as far as earnings, margins, lower loan growth is concerned. But our belief is that a lot of it is factored in terms of valuations. And therefore, that is one segment which we believe remains relatively insulated in this current environment. The second area has been discretionary consumption, especially mass discretionary consumption, areas like travel, tourism, retail, QSR, for instance, some parts of consumer durables, which essentially benefits because of the tax changes that have been announced in the budget and also because of interest rates coming down. So that's another segment that we've been positive on. Cement, we continue to remain positive on. We believe that volume growth has started to recover with some amount of government capex and spending coming back on track. And margins should hold up, given that there is lower cost pressures. And the overall thesis on cement of consolidation and market share shift continues to be the way forward. So these are some of the segments that we continue to like. And within the healthcare space, finally, I think hospitals has been a segment where we've believed that profitability improvement is continuing, though in pockets we are also cognizant of valuations, but overall within the healthcare space, hospitals is something that we continue to prefer.
Okay, hi Shivani, good afternoon and good to see you in. Well, one of the sectors of the day is actually the OMCs. In spite of that excise duty hike, which the government will be pocketing the 2 rupees, the gross marketing margins are still much higher than what we have seen in the last few years or what the street is working with for the next few years. And the kicker has come in because their LPG losses will come down as well. I see you all have HPCL, among the listed companies, IOC, BPCL and HPCL, it's part of your portfolio. You believe there's more to go from here, given that crude oil prices have come down drastically, valuations are fairly stable, and there is some room for the government, even if they hike duties, still there's room for them to make good money.
So So absolutely, Nigel. And if you look at what's happening globally, one of the possible impacts is that oil prices, given that there is global GDP growth slowdown in the offing, assuming things stay the way they are, oil prices are likely to remain fairly muted and possibly in a range. In that sort of an environment, clearly some of the energy names and the OMCs benefit. As you rightly pointed out, these are companies which are trading at extremely attractive valuations. From a marketing margin perspective, margins are such that they will possibly offset the weakness that you will see on the refining front, as well as some of the inventory losses that you will also possibly see during the quarter. You are right that even with the announced excise duty hikes, the marketing margins at this point in time, where oil prices are, they are enough to offset the impact as well as provide better profitability in the near term. So yes, we do believe that this is one segment, given the way the global growth outlook and demand scenario is playing out, as well as way supply demand is panning out where oil is concerned. This is a segment which looks attractive from a relative valuation perspective.
Okay, all right. Looking more inward then, what about the discretionary consumption names? You've got a couple of those in there as well. And I mean, there's unlikely to be much impact of what Mr. Trump is going to say, at least no direct impact. You'll continue to bet on that?
Yes, Nigel. I think overall our portfolio strategy, as we were discussing earlier, is to look at pockets within the market which are more domestic facing, which derive demand from domestic sources. And within that, the discretionary consumption pack clearly fits the bill. What we believe is that the impact that you're seeing, or the positive impact, I might say, of the tax cuts is starting to flow through now, especially where the middle income segment is concerned, and that should play out as far as some of the mass segments are concerned. Now, overall, within the discretionary pack also, we are looking at companies where valuations are reasonable, where there is some amount of certainty or at least visibility on earnings, and therefore segments such as, for example, travel, airlines, tourism, parts of retail, which is more mass in nature, parts of consumer durables, two-wheelers, for instance, which also derive benefit from the rural segment. These are names that we are looking at across the portfolios.
Okay, all right, got it. So to sum it up then, Shivani, what's the sense, what's the advice? It's anyone's guess as to when global markets stabilize, but over the next, say, quarter or two, are you expecting, I mean, is consolidation the best case scenario, or do you see the bull charge resuming anytime soon?
No, I think that at least we'll have to muddle through volatility and uncertainty in the near term till you start getting a sense in terms of how countries are, carrying out their discussions with the US and what's the final outcome. So near term, Surabhi, I think uncertainty stays. The best thing to do in this sort of an environment, even though while the medium term outlook on India seems to be fairly okay at the margin with, liquidity, as you were also discussing, improving GDP growth appearing to bottom out for India, as well as rural demand picking up. But I think in the near term, it is better to, one, stick with large caps over mid and small caps. Within the mid and small cap space, go extremely bottom up, be very stock selective, stay away from pockets of high valuation, look at companies where there is some degree of visibility on earnings and where valuations are reasonable. So I think that's how we are really approaching the market at this point in time. One thing is for sure that, we'll hear a lot more on tariffs. This is clearly not the end. So possibly over the next couple of weeks, months, there will be a lot of evolving parts and moving parts which will shape our markets going forward, as well as global markets.
Yeah.
All right, Shivani, we'll leave it there. A good conversation as always. Thanks very much for your time. Appreciate it. Well, the market has come off a little bit, 120, 130 points off the highs, basically from the 230 levels, and we're above 22,500 at this point in time. We'll take a quick commercial break here. As always, we get you what's happening in dealing rooms. D-Street Chatter with Nimesh comes up, and of course, some trading ideas with our technical experts as well. Stay tuned.
Go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming
Welcome back. Take a look at Z. You know, that stock is now up closer around 11% as we speak. Massive surge is what we have seen. I think at the start of an hour or so ago, it was up only around 5%, but now that's taken off. So big up move is what we're seeing out there. PVR Inox as well, that stock is now up close to 5%. The stock is less than half of what it was at its peak. So that's pulling back some of its losses that we've seen. PVR Inox now up close to 5%. But it's that time of the day when we tell you what's going on in D-Street chatter. Nimesh joins us to give us a pulse about what he's picked up. Nimesh, what is it? How are the flows?
Hi, Nigel. You know, a decent pullback, and you know, this is something which we spoke about, a possibility of a short covering rally yesterday as well, and that's exactly the way it's played out today. You know, in terms of flows, it's not a great participation from large institutions, but I guess it's largely a short covering rally. So extremely oversold sectors like IT, pharma, metals, all have seen a bit of a pullback in today's market. From a flow perspective, there is a bit of buying in technology stocks and select private bank names. So that's the overall feedback. But again, you know, I guess the big trigger to watch will be what happens to the reciprocal tariffs. The deadline is on 9, so if there is anything, a change of stance, that could be a big trigger for all markets, and that for India as well. So maybe a further short covering rally is not ruled out. But in that case, I guess on the higher side, 23,800, 900 will act as a very strong resistance. So net a good pullback rally on short covering, but there is no big participation from larger institutions today.
Nimesh, what's in the chatter box today? What are you picking up?
Just a word on what Nigel spoke, highlighted about Z Entertainment. I guess there is some buying interest back from larger HNI, so that's the buzz there. I don't know whether there is some deal in the works, but that's the chatter that I picked up. Having said that, a couple of names which are part of my list today. First is IDFC First Bank. Big volumes on the last few days in that stock as well. The stock has been consolidating, but I understand a couple of HNI investors are active buyers. At the same time, today there is delivery-based selling from larger FIs in IDFC First Bank. So that's the first stock. Second stock is HPCL. We spoke about the announcement which came yesterday, but for HPCL there is buying, as well as there is a Morgan Stanley tactical buy as well on HPCL. Morgan Stanley believes that from here on you could see an upside in the OMCs, and HPCL is most levered in that sense. So that's the reason why HPCL is buzzing in trade today. The third stock is a couple of names where there is delivery-based selling. Sun Pharma and Blue Star. Blue Star stands out because after a long time, I'm getting a sense of some bit of supply coming in from larger FIs in that name. So Sun Pharma and Blue Star on the sell side. And on the buying side, from a delivery-based buying point of view, Infosys and Wipro both stands out. I spoke about a brief buying in IT names, but these two specifically names are where there is a bit of institutional interest. So FIs have started buying selectively into technology names, and Infosys stands out in that.
Nimesh, anything you're hearing in delivery? The e-com company, I mean, there was their acquisition. I think the acquired company posted a loss. Is that it?
Yeah.
Yeah.
So Prashant, you know, broadly, I guess the sell-side analyst seems to be quite positive with this deal. I guess the only outlier from the sell-siders was an Equirus note. Nigel had put out as well on tweet. I mean, they seem to believe that it's negative in terms of acquisition. So that's the only negative that I heard of. But otherwise, I haven't heard anything negative, so to speak. I mean, broadly, most of the brokerages seems to be quite positive post the deal announcement.
Okay, all right, Ramesh, thanks a lot for that. Well, that's right. You know, the loan brokerage, I think that was negative on this deal was Equirus, and they have pointed out few points. One is they're saying that delivery just turned profitable. Now they're doing this acquisition, which will drive profitability yet again. Point number two, they're talking about their key client, which is Miso, both for delivery as well as Ecom Express. And, Miso has been scaling up their in-house platform itself, which is known as Valmo. So because of that, the need for them obviously goes down a little bit. The other point they're talking about is the intensified competition, and that's likely to weigh on all players out there. And finally, they say the merger could unlock longer-term synergies, but in the near term, it will be a bit of a drag. So though the initial reaction was, everyone's looking at the EV upon sales and the likes and saying got a very good deal because the acquired company itself, they got it at a fourth of what it was supposed to be at the IPO price.
Yeah.
But then they highlighted this, and to be fair, they highlighted this over the weekend itself. So initially the street has taken it positively. Today, I think the street is reacting to that.
And it's selling off on a day when the market is bouncing.
Yeah.
So there is some... And by the way, as I said, it is the number one volume-led loser on the NSE. So it's not going down in small volumes. It's large volumes as well. Well, Mitesh is with us now with what he wants you to do in terms of short-term trading ideas. Mitesh, what do you have?
So STBT on Siemens, I think that's one stock which is now slipped to the low of the day. Keep the stop above 2800 here, 2780 here, and look for a target of 2730. And on the buying side is Indus Tower, Prashant. I want to make a disclaimer that we have some call spreads over here. So we have a positive bias in our positions as well. But Indus Tower for me is a BTST with the stop at 368 for 367.5 for targets of 376.
Okay, all right. Just one more point, guys. Thanks a lot for that, Mitesh. Just want to point out one more stock, Vijaya Diagnostic. The stock is now up close to around 12%. The total volume traded, I'm just looking at it, is close to around 1 crore, which means that close to around 10% of the float has got traded now. Now it's up 15%. Interesting to see whether or not there's some large trend of ads, but the percentage, the total traded volume divided by the total number of stock that is there, it's more than 10%. So I guess that could be something to report by the end of today.
Also, their Q4 update, I think they're talking about almost 14 to 15% growth in the fourth quarter, and that's something that the market has clearly liked. I mean, they're loaded with the order book, of course, and revenue visibility, at least in the fourth quarter, seems to be 14%. Well, let's talk about financials now. A couple of brokerage notes have come through on bank stocks. Abhishek is here with the latest. Abhishek?
Well, Goldman Sachs has upgraded some of the financial entities that they cover. One of them being PNB Housing. They have upgraded it to buy target price of 1,184 per share. They say that they have upgraded on improving visibility of delivering healthy loan growth along with robust profitability by the entity. With respect to Axis Bank, they have upgraded it to buy target prices 1,228 per share. They say that valuation mean reversion is seen as profitability and growth are nearing bottom in H1 FY26. So the company will be a beneficiary of the liquidity, infusion that is seen in the system, which should support its loan growth trajectory. For SBI, they have upgraded it to buy neutral from sell, target price being 823 per share. They say that the risk reward is now balanced, given the fact that the stock has derated from 1.1 time price to book value on a 12-month forward to about 0.9 times price to book value on a 12-month forward. So this valuation seems fair for a 90 basis point ROA, that is return on asset, that it's generating. So CLSA has written on Bajaj Finance. They have an outperformance rating and a target price of 11,000 per share. They said that with asset quality headwind receding, they expect Bajaj Finance to regain its class from FY26. So investors' focus will shift away from net interest margin or asset quality towards a loan growth trajectory for the entity. So they say that even if ROA declines by about 50 basis points from the 4% level to 3.5% level over the next 5 years, and AUM grows at 25%, they still see a PAT CAGR of anywhere between 22 to 23% over the next few years for Bajaj Finance. So no other large stock in their coverage, and probability overall in India offers such a healthy PAT growth over the next 3 to 5 years is what they have to say about Bajaj Finance. Back to you.
All right, Abhishek, thanks very much for that. So that's banking and financial services stocks in focus there. 350 points in the Nifty. We take a quick commercial. Okay, I think we have Jay Bala with us now to take us through what he's making of things. He's, of course, with cashthechaos.com. Jay, good to have you with us here. Thank you for your time. We speak once every week. I think we'll have to increase the frequency because interaction to interaction, we see so much in terms of moves, big moves, that levels get taken out on both sides. What's the view now, Jay, from here on, near term?
Yeah, hi Prashant, good to be here. And see, I've said in the early part of May when the markets are bouncing from 21,900 and change, I said that there's a counter-trend bounce. The counter-trend bounce, I anticipated it to clock one more high about 23,860, but it failed to do that. But that's the thing with counter-trend bounces; it can end abruptly. But we had markers, if the markets got rejected from 22,412 and printed 22,676. I said, the counter-trend bounce has ended. But unfortunately, the markets capped down below the March low. So that wouldn't have provided opportunity for people to short. But right now, as the markets come back to that near about 22,600 odd levels, it's probably presenting another short-term shorting opportunities. But from a slightly higher time frame, if the markets were to hold on 21,608, it's an intraday print. It doesn't have to close or close below that level. If it can hold 21,608 or above, there is a bullish potential for the market for the medium term. But looking at how Reliance has broken down below March lows, Nifty metals index, Nifty auto index, Nifty IT index have broken down. I think that's a very low probability, but just to keep in mind. But I had presented three choices for three.
Jay, allow us to come in. To a lot of data points over here, so just allow us to come in. You said that the zone of around 22,600 odd, it could present a decent shorting opportunity. With what sort of a target?
Yeah, I think either 21,608 holds, and so we're getting a new low below yesterday's low of 21,752. So 21,608, if it holds, it's bullish. But if it doesn't hold, the March price objective that I mentioned, 17,800, that opens up. So the higher time frame objective of 17,800, I'm still not opening it up, but it's definitely a potential if 21,608 breaks even on an intraday basis. So right now I'm watching it very closely.
21,600, that's still a very decent 1,000-point short play if it works out, because you're saying short around 22,600, wait for it to see what it does around 21,000, 600. So that's almost a 1,000-point range. Any other individual, stock specific?
When does a short call get nullified? At what level?
Oh, good point.
Yeah, it's if 23,350 were to get taken out, that gets nullified. I think today's high is already probably it's done the corrective move. Probably it's starting to decline from today's high. Probably I don't think it's going to give another opportunity to get the markets to 22,600. Yeah, so that's the case here.
Okay, all right. If I have to guess, Jay, based on what Mr. Trump has to say, maybe by our next interaction, we'll either be at the upper end or the lower end of what you gave us, 23,350 or 21,650. Let's see how that goes. I want to hear more from you, Jay, but for the time being, we'll take that break, come back. We'll probe Jay a little bit more into what he's looking at in terms of levels on various indices. Don't go anywhere.
Story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. Well, a couple of stocks that have really spiked up. Z, we were highlighting this. That's gone to the high point of the day, up 13%. And Sun TV as well, another underperformer actually, though valuations are attractive. That stock as well has spiked now to the high point of the day. So keep an eye out on both those two. And Vijaya Diagnostics that we were talking about, it was up close to 11-12%. I think now it's up 15%. So big volumes out there. But Jay still with us. Jay, what about the tech index? It's pulled back, but you are seeing further downside even from here?
That's right, Nigel. The damage has been done in the medium-term charts, and there is as we have mentioned in November about the US techs possibility of clocking a long-term top. The IT index of India seems to be moving in tandem with the US tech, big techs. So, in the very short term, we could see a shallow bounce to something like 39,000, maybe even close to 40,000. I mentioned this last week, but the break of March low is very negative for the Nifty IT index. In a few months, I'm anticipating the Nifty IT index to clock something like 26,000, and not a short-term move, but it's possibly post 39,000 bounce. But in the medium term, if the US techs have indeed, which it looks like, have clocked a long-term top, the Nifty IT index is also likely to go low. On a lighter note, Nigel, you mentioned Trump last time. No, there's a way to solve issues. Apparently, if you say thank you to Trump, you can probably even stop the portfolio from bleeding.
But I'm more worried about this tech index you're talking about. After such a sharp fall, you're talking about another 20% downside. Jay, I'm waiting for you, to turn bullish. Anyway, Jay, but you got a couple of stock calls for us. Tell us more.
Yeah, it's on the Tata Group. Two stocks from the Tata Group, one on each side, on the bullish side and the bearish side. Tata Consumer, I'm watching it for bearish potential. It needs to do one more higher high above 1100 and then drop back below 1045. It has to do both these steps. Before that, it's not bearish. And if it were to exceed 1100 without a rejection from 1129 to 1130, then this is an invalid setup. So wait for the stock to clock higher high to 1129 and then get rejected. Then it turns bearish. The bullish call from the Tata Group is on Voltas, probably something to do with the summer. And the stock has moved from the February lows in a 5-step move. Usually 5-step move is a trending move. If the stock can manage to hold about 1182, there is a short-term bullish potential. It's not an investment call, a very short-term bullish potential. So it's a straight call, unlike Tata Consumer.
Very quickly, what about some commodities? Crude oil, we are celebrating it fall. You don't have to fall a lot more, actually. That would mean that we're going to get into a big recession globally. But from here, from 65, where does it go? And also, if you could give us the level on the dollar index.
Yeah, right now, crude has one more lower lows to come through. It threw a curveball last week, and I mentioned in March that it needs to clock one more lower low. But when it crossed 72, it just gave us a little bit of curveball, and it's come back to lower lows. I think one more lows is due for Brent around 55 mark, and after that, it's up for evaluation. When the dollar index is probably heading somewhere close to 100. If it were to break 100, I'll anticipate somewhere like 97 to 96. Again, given the extreme volatility in the commodities and the FX market, I'll have a wait and watch. And we'd anticipated, the dollar index to give up most of its gain to somewhere about 103, but it's far exceeded that level. So it's more of a wait and watch for the short to medium term. And one more commodity, copper. Copper has probably seen a buying climax. And copper is actually quite late. It gets a doctorate degree because of its ability to catch the bottom, not the top. It's been the case when 2008, 2000, and 2020.
All right. Jay, we'll chat more in markets forward. Coming back to you in a bit. Let me just quickly wrap out things. So we'll end about 380 points higher on the Nifty. So 22,550. So very decent bounce. But of course, we saw world markets also posting a decent session here in Asia, and I think in Europe as well. Even US futures, I think, are continuing a little bit of stability that we saw last night. So that is that. To be sure, I mean, there are no headlines out there except that fake one last night. There are no tariff headlines which suggest that there is a relief of any sort. This is just markets doing their thing. after what basically was 2 days of very large selling comparable to some big historical events. So that's what we are seeing. So this is a market which still remains hostage to headlines and news flow, etc., as and when it comes through. So those are indices, those are changes. I think the mid and the small cap indices also end about 2% higher, it's a decent looking session all told for markets. The big gainers on the Nifty are Jio Financial Services, Shriram Finance, Bharat Electronics, Cipla, Eicher, Grasim, and Titan, which really stood out. And of course, very few, actually one or two losers. That's it. So not bothering with that. And of course, gainers are Vijaya Bank, 5 Star, Keynes, and PG Electroplast. Something like a Chola Holdings was a big winner. OneSource, Sequent Scientific. On the downside, 2 names, Delivery, huge volumes, and there was IGL, of course, on the back of that Delhi news flow, which was down sharply, some 7.5% or so. I think it's a wrap on this edition of Closing Bell. Thank you for your time. Thanks for staying with us, but don't go anywhere. Markets forward. We'll pick up on all the action in just a bit.
Esteemed guests and friends, above all today, we express our deepest gratitude to our visionary Prime Minister, Shri Narendra Bhai Modi ji. Pandit Deen Dayal Energy University owes its very birth to his extraordinary vision. All of you are benefiting from what Narendra Bhai thought in the early 2000s. And when he called me and said in 2005 that we have to build one of the finest institutions in Gujarat, right? And that is what we have achieved from 2007 onwards. So we will always be grateful to our Prime Minister. Long before he became Prime Minister, he foresaw that India needed Atmanirbharta in energy. Over 20 years ago, he told me he wanted Gujarat to lead the nation in energy and energy products. He also told me that Gujarat should take the lead in cultivating world-class human resources needed to achieve India's clean energy ambition. That is how he helped establish this pioneering university. Friends, there are many things.
Dalal Street recovers after the recent sell-off due to tariff tensions. All indices end in the green. Midcap index and media stocks outperform. Good day for IT stocks as well.
China vows to fight till the end after US President Donald Trump threatens an additional 50% tariff if China does not withdraw its retaliatory tariff of 34% on the United States. China allows the yuan to weaken to September 2023 levels to boost its exports.
The RBI Monetary Policy Committee is expected to cut the repo rate by 25 basis points tomorrow. Street expects them to strike a dovish tone as tariffs could be treated as an additional headwind for financial markets. Well, a turnaround Tuesday for now, and I think we can call it that because markets look much better after last 2 days of absolute hammering that we saw here in India and around the world as well. You're with us here on Markets Forward. I'm Prashant Budbi, my colleague Surbhi. Surbhi, hi.
Hi, Prashant. Well, what a relief, day of relief, really, for global markets, for our markets as well. Yeah. Not all the gains, but I think the bulk of the gains were pretty much intact by the end of it.
Yeah, bulk of the gains were intact. And, so India did better, world did better. And of course, I mean, the rest of the world, and especially the rest of the Asian economies, and consequently those stock markets had fallen a lot more as compared to what India had lost in the last 2-3 days. And logically so, because those are open economies, much more exposed to global trade, world trade. We are not. And those markets recovered, appropriately. Japan, for example, ended about 6% higher, but it had fallen that much more. Here in India, of course, we saw about 1.7% kind of recovery. Nifty Bank, the mid and small cap indices, they were up about 2.5%. Market breadth was positive as well. I just want to reiterate and emphasize no relief from tariff headlines yet. So if you're looking at the price action and saying maybe, we've seen some relief in terms of actual news flow, nothing yet. There was that fake headline yesterday, but I don't think that has done anything except maybe, shake confidence a little bit. But that's in the US. Now, of course, markets remain in headline tracking mode. Tariffs remain top of mind. And of course, the RBI tomorrow, policy-wise, monetary policy-wise, will be important as well. Surbhi.
Absolutely. And we're watching for those headlines. Let's see what transpires overnight. But for now, there was green. And there was green universally across the board. So if you're looking at the constituents of the rally, it was, well spread out. Financials, Nifty Bank, look at the metals index, Nifty Metals Index, Nifty IT, PSU stocks. It was pretty much, well-rounded. And it was also quite good to see Midcaps recover. The Midcap index was up about 2%. The advance decline ratio was very strong. There were almost 6 stocks advancing for every one that was declining today. So a broad-based recovery. Looking very, very good. Well, we've got plenty to run you through over the next 20-odd minutes. We'll, of course, highlight all the big news points, all the key developments of the day. And, of course, we will have several stocks and sectors in focus as well. Movers and shakers coming up with Vivek in just a bit. Titan is in focus after its fourth quarter update. We'll also be putting the spotlight on stocks like IGL because of the new EV policy that Delhi is considering. It has some interesting takeaways. Then the Bajaj Group and Allianz deal is in the spotlight because of which some of those stocks were in focus as well. So more coming up on all of this in just a bit. But first, the day's movers and shakers, and it's over to Vivek for that.
Well, thank you so much for that. A session where, bulls heaved a sigh of relief. The advance decline ratio, like you mentioned, very much in favor of the advances. A lot of sectors were in focus that saw relief rallies. The entire oil and gas pack, all of the OMCs today saw significant relief coming in despite the excise duty cut. The LPG price hike actually saving the day. And along with that, GAIL as well as ONGC too rallied quite a bit. In fact, a lot of the PSU stocks today saw quite a bit of a bounce. The Pharma pack, stocks that have been beaten in the last 2 to 3 trading sessions significantly, all of them saw significant bounce. Names like Biocon, Ipca Labs, especially these generic names, saw the higher beta bounce today. The entire BFSI pack, you did see a couple of notes coming in, positive notes. Goldman Sachs upgraded a couple of stocks. Along with that, names like ICICI, names like Axis, SBI, PNB Housing, all of these names did very well in the session. Along with that, on the back of the significant volatility in equity markets, as well as commodity markets, you actually saw trading premiums go up across the board. And capital market plays like MCX, BSE, some of the other names like Angel World, CDSL, CAMS, all of these stocks too did quite well in the session. And the consumption basket, again, that had been a bit of a laggard, this entire basket too today did quite well. Warren Beverages, Radico, all of them doing very well. On the other hand, very few set of losers, but IGL clearly, the new draft EV policy as far as Delhi is concerned was taken quite negatively by the street. Delivery yesterday was a clear outperformer. Today gave up all of those gains. Now, the analysts on the street are actually going ahead and seeing whether that particular acquisition of Ecom Express makes sense or not. Back of that particular stock down over 7% today.
All right, Vivek, thanks very much for that. That's a wrap up what moved up and down. More up than down today. Jay Bala is with us, and so is Sudeep Bandopadhyay. Gentlemen, good afternoon. Good to have both of you here. Jay, for those who are joining us now, tell us what's the trade here. Let's start with the Nifty.
Yeah, Nifty, there is a very short-term shorting potential here. I think the low that the Nifty registered yesterday, it's an incomplete price structure, so possibly one more lower low is coming through. The stop loss for this setup is 23,350, and it could drop somewhere close to 21,600. And when it comes to the mainline banking index, HDFC Bank is going to be quite key. If it can hold 1661, it's about 5% away. That will be very short-term bullish. But if 1661 were to break, that opens up a big downside. So watch HDFC Bank as a support for the banking index. 1661, very important for the bulls.
Jay, this is you're saying you can sell here the Nifty.
That's
Target
right.
21,600 and stop is 23,350. You said, right?
That's right.
That's almost a 1:1 kind of risk reward.
That's the problem here. So because we are quite late stages of this trend, possibly. So that always happens. But if you had been live in the market, 22,600 was my watch level. So from 22,600, 22,650 to the stop loss 23,350 was about 700 rupees, and the downside was about 21,600. So it was slightly better risk reward. But this happens in the late stages of a move.
Okay. All right. Stay on, Jay. We'll have some more questions for you in just a bit. Let's look at Titan now. That's one of the key stocks in focus today. Now, the overall market was higher, but Titan shares really standing out. Big surge coming in today. This after the company reported what looked like a pretty good update for the fourth quarter. Let's go over the numbers with Manglam now. Manglam.
Well, Titan was among the top Nifty gainers today, and that was on account of their fourth quarter update, where they reported a 25% revenue growth in their overall business. But more importantly, the jewelry business, which is the mainstay of the company, saw a 25% revenue growth as well. But remember, a large part of that was on account of the rise that we've seen in gold prices. So that's reflected in their value growth, because gold jewelry saw 27% growth, and gold coins itself saw 65% growth year on year as well. What was a big positive was watches, eye care. Both these businesses grew by 19 to 22% for the company, whereas a couple of sore points that stood out, emerging businesses, which include their ethnic wear business, Taneira saw a decline of 4%, and CaratLane, which earlier was growing between 30 and 40% CAGR, has now slowed down to about 22%. The company actually attributes this to higher gold prices and sluggish consumer sentiment, as a result of which the buyer growth was just in high single digits. And even at the studded level, which is precious stones, etc., saw growth in just double digits, which tells you that the studded ratio was lower. So with all of this that's taken place in Titan, the revenue growth was positive. Everyone's keeping an eye out on how the margins for the company would be. Macquarie wrote a note today. They are positive on the stock. They expect a target price of 4,000. But they also expected 20% EBITDA growth, which implies margin compression as against the 25% revenue growth that the company has reported. But the street has taken note of the revenue growth. At the same time, the stock was at a lower level. In fact, it was at a 52-week low yesterday. So it saw some relief rally in today's trading session.
Okay. All right, Manglam, got that. Thank you for the update over there. Let's discuss this with our guest. Sudeep Bandyopadhyay is also with us now. Sudeep, Titan is a stock that you've liked for years, right? It's an old love for you. But now there are some fresh challenges, like Manglam's also been pointing out, lower studded share over many quarters, challenge from lab-grown diamonds, whatnot, slightly weaker discretionary demand perhaps as well. What's your sense on the stock now?
Well, I think it continues to remain an evergreen stock as far as I'm concerned. I think look at the gold price, the way it has been going up, and of course that reflects in the jewelry sales uptick which they had. Finally, you see the watches and the eyewear segment also has started doing well. Now, these are big segments. And now, the ethnic wear and all that are very small. Yes, there hasn't been commensurate growth there. CaratLane also, but these are very small compared to the watches and eye care segment. Now, these two segments, which are number 2 and number 3 post the jewelry, they are growing well. So I'm positive on Titan. I think the runway is good. Of course, there will be quarter-on-quarter fluctuations in performance, a little bit here and there. But by and large, the trajectory is good. And the other newer segments also will start doing well, is what we strongly believe. Not only Titan, we do like Kalyan as well. So both Titan and Kalyan looks good from our perspective at this point in time also.
No, absolutely. Point taken. Now, the other story which came towards the end of the show closing hours actually, was the Delhi government floating a draft of its electric vehicle policy 2.0, which recommends phasing out of CNG auto rickshaws along with petrol, diesel, two-wheelers by 2026. Stocks did see a dip after this came. Sudarshan is here with details. Sudarshan, over to you.
So Delhi government's earlier electric vehicle policy expired on March 31st, and government has decided to extend that policy for another 15 days. But what we understand from through PTI, that now the government has published the draft of new electric vehicle policy, and that it has called electric vehicle policy 2.0, and it has made certain recommendations, and basically it's recommending phasing out of petrol, diesel and CNG vehicles in a phased manner. So now first talking about CNG auto rickshaw, it has to be phased out by August 15 of 2025. Also, as per the draft of this new policy, CNG auto permits will not be renewed from August 15 of this year, and all the CNG auto permits will be substituted or reissued with only e-auto permits. Now coming to fossil-driven vehicles, and those vehicles basically carrying solid waste deployed in large numbers, those also have to be transitioned to electric vehicles in a phased manner. As far as two-wheelers are concerned, those vehicles running on petrol, diesel and CNG will not be allowed from August 15 of next year, that is 2026, and no diesel, petrol, CNG three-wheeler registration in case of goods carriers from August 15 of this year. And those garbage collection vehicles, basically those vehicles of municipal corporation, have to be transitioned to electric vehicles and have to achieve 100% electric vehicle fleet by December 31 of 2027. As far as public transport buses are concerned, those buses also have to be transitioned to electric vehicles. And remember why IGL is in focus, because 30% of its volumes are exposed to public transport, and this is IGL is the biggest CNG player in the Delhi or the NCR market like Noida, Ghaziabad. That was the reason you saw a sharp fall in the IGL stock price in the last hour of trade.
Absolutely. That puts it in perspective, Sudarshan. Thanks very much indeed. If everything's going to EV, what about IGL? Though, of course, IGL has been talking about setting up more charging infrastructure at the same, CNG pumps that it has in the NCR. But anyway, let's get some perspective on this. Sudeep, let me ask you. Obviously, IGL shareholders would be worried hearing the news flow today, given how important that market is for them. What would your advice be?
Oh, absolutely. I think I've been cautious on IGL for quite some time, and I think I continue to maintain my view. The transition of public transport into EV will definitely dent their business as far as the NCR market is concerned, and that's where they primarily operate. The charging station which they are setting up in that same CNG pumps, it will take quite some time, and I'm not sure how the tariff and all that will be calculated for the charging and things like that. So it's a very nebulous stage. So at this stage, I think it's better to be cautious on IGL. A lot of things are changing as far as this space is concerned, and the entire space, I think I'm a little careful.
Okay. All right, let's move on to the next important story. Sources are telling CNBC-TV18 that the deal structure in terms of the Bajaj Group and Allianz deal is likely to have been finalized soon. Yash is here with the details. Yash.
Well, one of the most anticipated deals in the insurance industry, quite big in terms of the size as well, nearly 24,000 crore rupees. What we've been given to understand is that the deal terms and the structure when it comes to the transaction between Bajaj Group as well as Allianz is likely to have been finalized. What we've been told further to that is that, both companies, that is Bajaj Finserv, the other promoter companies, as well as Allianz, they are expected to file for regulatory approvals by the second quarter of FY26. And as far as first tranche of the transaction is concerned, that will be to acquire about 6.1% stake of the total 26% stake held by Allianz in both Bajaj Allianz Life as well as Bajaj Allianz General Insurance. Of course, there is a lot of significance to that number of 6.1%. That is because once 6.1% stake is acquired by, the Bajaj Group companies, then the joint venture between the two companies gets terminated and it releases Allianz from the non-compete clause, which means Allianz would then be free to take its insurance ambitions in the country ahead on its own or through partnerships. What we've been given to understand is that 6.1% stake will be jointly acquired, the first tranche, by Bajaj Investment Holdings and Bajaj Finserv.
All right, Yash, thanks very much. Interesting story there. Jay, for viewers who are watching, we got, of course, the Nifty view and the broad market view that you have. Any specific trades here?
Yeah, I like Voltas as a bullish bet here, but you have to stay in the shallow end of the pool. It's not to be taken very aggressively. It's got a bullish rise from its February low, so and it's pulled back in a corrective fashion. So as long as the stock can hold 1182, it's short-term bullish, and possible negative setup shaping up for another Tata stock, Tata Consumer. It needs to do a small gyration within the short term. I want to see the stock do 1120 to 1130 and then get strongly repelled. If that happens, I'm anticipating the stock to turn bearish below 1045. So the setup becomes invalid if the stock crosses 1200.
Okay, one looking constructive, the other looking a little shaky. Voltas and Tata Consumer. Jay, thanks very much for joining us. Speak to you soon again. Sudeep, thank you very much for being here on the program as well. We'll take a quick break. We'll leave you with some commentary. This is Rob Subramanian, economist with Nomura. We spoke with him in the morning on tariff impact. Gautam Dugar of Motilal Oswal Financial Services as well was a view we got earlier. Listen and take that break. See you on the other side.
The EU retaliates and China's retaliating, that's going to make a much weaker global economy. India, out of all the major economies around the world, is probably going to be least affected. And that means from a market perspective, ultimately could be a positive story. There's a few things going on here. I would say the first one is India is a very big economy and it's a more domestic orientated economy. So from that perspective, it's less affected by tariffs and trade wars than many other Asian economies. Come down significantly. Inflation is around the RBI's target. I think there's a lot of room for the RBI to cut rates further. We're expecting a 25 basis point cut tomorrow and probably a shift from neutral to an accommodative stance. I would say the risk around our call is greater for a 50 basis point cut than no cut at all.
From our beloved Prime Minister. Let me mention just two lessons here for all of us. One, Modi ji never lets a good idea go to waste. His Man Ki Baat inevitably becomes his Man Ka Sankalp. His Sankalp is always Vajra Sankalp. His determination is as hard as a diamond. He does not rest with simply making a sankalp. He knows how to turn his sankalp into success. In the last 10 years, the world has seen how he especially chooses impossible-looking tasks and transforms them into reality. This, for all of us, is lesson number one. Lesson number two is about his boundless energy. Narendra Bhai Modi's name stands.
Welcome back. Well, now it's time for our special segment, D Street Chatter. Nimesh is here, as always, with all the buzz on what was a relief day for the markets. So, Nimesh, what all did you pick up and what were the interesting stocks on the radar?
I said, so a good relief day, thanks to short covering as well as some buying in select IT and some metals names as well. So that's overall flow perspective. But in terms of individual stocks, the first stock on my list was IDFC First Bank. While the stock has been consolidating, the volumes have picked up in the last couple of days. I understand a leading HNI investor is an active buyer. At the same time today, though, there was a selling as well at a leading FI. So that's the first name. The second stock was HPCL. All the OMCs were buzzing, but HPCL stands out in terms of very aggressive buying. Also, there was a Morgan Stanley tactical buy in the morning, and they believe HPCL is the most levered in terms of falling crude prices. The third couple of stocks where there was selling pressure, Sun Pharma and Blue Star. Blue Star stands out because after a long time, I'm seeing some sort of selling in that particular name. And on the flip side, some IT names got bought by FIS today, which is Infosys and Wipro. So expect high delivery volumes on both those technology stocks today.
All right, Nimesh, thanks very much. We'll keep an eye on these names as we come back tomorrow. Well, of course, what we'll also watch is the RBI Monetary Policy Committee announcement that is slated for tomorrow in the morning. Street is not only expecting a rate cut, but also a change in their stance. Ritu is here to take us through key expectations.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC-TV18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC-TV18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is, what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs. But for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
All right, Ritu, thanks very much for that. Well, that gets us to a close on this edition of Markets Forward. It's basically back to watching headlines from Trump and what comes out of the US for the rest of the evening. We'll see you bright and early tomorrow morning. But news and updates continue here. Thanks for staying with us.
In the global order. Let me very quickly give you a little bit about the backstory for each one of them. Lavanya Nalli, I'll start with you. Fifth generation entrepreneur of the Nalli Saris business. Lavanya has had quite an interesting journey. All the women here wearing saris are clapping for you, Lavanya, including myself. She's the first woman who decided to get into the family business and has had an interesting journey because she joined in 2005, then took a break to study. She worked at McKinsey and worked at Myntra as well before deciding to come back and steer the family business forward. Lavanya, it's great to have you here with us. Shashwat Goenka also decided to join the family business, as has now taken his group into new areas, including the FMCG business, sports, philanthropy, nutraceuticals, and plenty more. So Shashwat, it's great to have you join us. Jay Kotak also decided that he wanted to come back to India after he's finished his education in the US. He, of course, all three of them have a Harvard connection, by the way, and a McKinsey connection for Lavanya as well as Jay. Both worked at McKinsey, and Jay is now with Kotak Mahindra Bank leading the efforts on the digital banking side with 811. So Jay, thanks very much for joining us here on the show. Let me start by stirring a little bit of the nest. And Jay, I'm going to start with you. Uday Kotak recently said that heirs of family businesses are more interested in taking the easy way out, and they're running family offices as opposed to running family businesses. Do you agree?
So, thank you for having me, Shirin. Very surprising that you'd start with that question.
You were expecting that, weren't you?
I think this whole dichotomy of investor versus operator, where at least where my view on this is that where India is today, I agree with what a number of people have said. that the next gen should lean towards operating. If you look at the US 100 years ago, you look at the sons and daughters of the largest industrialists, they tended to be operators. It's only now, many, many generations later, that folks veer more into the investment side in the US. So that's my view.
That's your view. So you do believe that it is time for the next gen to roll their sleeves up, quite literally, and get into running operational businesses. Shashwat, Mr. Kotak made those comments, and Harsh Goenka, your uncle, sided with him in the debate and also joined the debate by saying that absolutely sweat equity is what they should be focused on, and that's clearly not the case. How do you look at this current debate?
I think I have a different point of view, right? And I think it's not either or, and I think you can do both, right? And I think it's important that you do both. I think today, the wealth creation opportunities that are available, it becomes important to look at your family office and to see how best you can invest what's in there to grow that, right? Whether it's to incubate startups, whether it's to create businesses that can give you inordinate value. And invest in those businesses. But I think it's equally important to also be active in operational roles or in operational businesses, operations businesses as well, because that is when you really get a pulse of what is going on, whether it's the consumer, whether it's the supply side, whether it's the entire value chain that you look at, whether from manufacturing to whichever way, right? So I think it's important to look at both. And I think when you look at next generations, and three of us are sitting here, fifth generation, seventh
generation for you, and second generation for Jay, yes.
Exactly. And I think all of us are running some business or the other, while we're also looking at the family office and investing further. So I think it's about doing both and
so they don't have to be mutually exclusive. You can do both. But Lavanya, this issue of ownership and management has been discussed ad nauseum over the years, and it perhaps has to be looked at in a more nuanced way, because when family-run businesses take inheritors to run the businesses, they're accused of not bringing in professional management, they're accused of not bringing in the right talent and focused much more on inheritors. But now the question is, if you actually do the opposite, then you're being accused of not doing enough. So how do you look at this, Lavanya?
I think excellent question. The way I look at it, I think a generation before, or even just 20 years, 10 years, 20 years ago, the next gen would enter the family business, not because they wanted to, because they didn't have a choice. So I felt that it was a little bit of pressure on both sides, right? It is a testimony to our country that we have this, the kind of opportunities that we do today, that children of family businesses, professionals, anyone who is probably graduating today has so much of choice in terms of they can follow their calling and they don't have to worry about financial sustenance. So that's one that I'd say it's good that people have a choice and they can choose to become an operator in the business or not. Having said that, to the point
Lavanya,
about...
can you just hold up your mic, please? Sorry.
To the point about... does it help to be an operator in your own business? Yes, I do think so. And I think there are families that have done this really well. The Murugappa group has done this beautifully. They have a leadership rotational program. Typically, these were things that you would see in large organizations like Unilever, the Tatas. If family businesses can adopt that kind of a mindset to say, when we want the next generation to come in, how do we sort of make them business ready? How do we sort of have a leadership rotational program, give them the ability to sort of work their way up through exposure to multiple different functions, maybe even motivate and encourage the next generation to get some kind of expertise outside and experience outside. I think there is a very strong path to successful leadership and succession here.
Yes, it's important that you talk about this path to successful leadership as well as succession. And very often, I'm not sure enough thought is put into it until there is an eventuality that a business family or a business needs to deal with. In your case, Lavanya, no woman who had joined the family business before you, you are a fifth generation entrepreneur. Your decision to actually work outside of the family business and then take the family business forward, what was that like for you? And as you look back at your journey today, what would you say you would like to do over to ensure that it was a more smoother transition to leadership?
So looking back, I'll answer the last question first. Looking back today, I think I wouldn't change a thing. Like it's shaped me and made me what I am today. There's a deep gratitude for the platform and everything that it's provided. But I've done 2 stints in the family business. One was in 2005 when I graduated and I just joined. And India was a very different world back then. Even malls coming up was a new thing. There were no VCs, there were no consumer brands, D2C, none of that existed. In fact, retail was considered a dirty word, right? There would be people who'd say, I don't want my son to work in a shop. He won't have manageable prospects. So jump cut to today in 2025 and see how much that universe has changed. When I joined, I think there was this air of, she's doing something till she gets married. So how much harm can she do? We'll fix it.
How much harm can she do? We'll fix it. Yes. That was what you had to deal with.
So but the benefit of that, and it's a matter of perspective, you can get away with mistakes because you're not being scrutinized, right? My brother, on the other hand, who's 5 years younger than I am, when he joined the business, same age, same level of inexperience, was scrutinized, right? Because there is a weight of expectation on them. So I think then, having gone to Harvard, having gone to McKinsey, having gone to Myntra, then I came back, and then I felt what he felt, right? So I think it's a matter of perspective. Having said that, I do believe that having a very thoughtful, intentional sort of leadership program, even for heirs in the business, whether it's external, professional, or heirs, is just a no regrets move, right? Because it's your company. You want to set it up for success. You want to set it up for longevity. Who would you invest in if not the next gen?
Absolutely. You have skin in the business, so to speak, quite literally. But it's interesting that you point out that the baggage of expectation was automatically on your brother and not on you. And you had to go through several hoops to be able to prove your mettle. But Shashwat, retail clearly is not a bad word for you. So let's talk about this new India and the new ways of looking at business. And let's start by talking to you. You've inherited this business. You're a 7th generation entrepreneur. But as you look at India today, why did you feel that these are the new areas you want to branch out to? Why did you feel FMCG was a play you wanted to bet on, or retail was a play that you wanted to bet on? And clearly it didn't impact your marriage prospects.
I think when you look at just the macroeconomic scenario of India and, the demography of India, 70% of India today is under the age of 34. And 10 years ago, when I started working, they were under the age of 24, right? And we were trying to size that market and see they are going to become the spenders of tomorrow, the earners of tomorrow. And therefore, there is a huge consumer tailwind in a way that India's demographic allowed it to have, right? And that was what we wanted to capitalize on when we looked at our consumer businesses. So whether it was retail or whether it was FMCG, right? From 2Yum to our personal care ventures, Naturally Within, to even our nutraceutical venture as well. And I think consumerism is only growing. And I think when you look at the Gen Zs who are coming into the consumption economy as they grow older, there is a lot of instant gratification that they want. The concept of accumulation or saving is not something that is inherent to them. Like we were talking before this, they've grown up in a world of abundance where they've always gotten whatever they wanted. They've not seen scarcity to the extent our forefathers may have seen, right? And so therefore, everything is an instant gratification that they want. They want it here, they want it now. And that just lends very well to how consumption works. And I think that's really what we wanted to capitalize on.
Well, speaking of instant gratification, we're also living in an era of 10-minute delivery. And that has changed the fulfillment aspiration for every sector at this point in time. How are you dealing with that?
Absolutely, it has. And to be fair, as, say, traditional grocery retailers in that sense, right, we did feel the brunt of it. But having said that, we have worked out our own model, and it's called Jiffy. And we do have our own quick commerce delivery option now. But what we've done is we've done it in a manner where with every order, we are actually making money. We're not losing money.
Okay, making money, not losing money. Jay, let me come to you now. As we talk about the new Indian consumer, we talk about digitization and digital transformation. That's what you're attempting to do at the bank with 811. Now, take me through what the aspiration is. How do you look at the consumer differently, for instance, from the way that your father looked at the banking business?
Sure. So there's been, I think, over the past 6 to 7 years, a profound set of things that have changed, that have stacked on top of each other. I saw a podcast with Jeff Bezos a few weeks ago where he said that Amazon would not have been possible without credit cards and without FedEx. And those two were key enablers that allowed much larger businesses to grow. In that context, India's had a few that have stacked on top of each other very, very quickly. One is UPI, which is something that 10 years ago you would never have believed.
Yeah.
That all Indians would be doing 15 and 20 and 25 rupee transactions on their phone. Two is widespread mobile telephony and availability of devices at very, very low prices. Three is Aadhaar. Aadhaar is something that solves a fundamental problem in the financial sector where know your customer is extremely important. And then you've had the mindset change from COVID and demonetization. All of these factors, stack ranked upon each other, have created an ecosystem that has made financial services in India much more ripe for disruption and made customers much more demanding of how their financial institution serves them.
You talked about disruption. The argument that one hears today is that Indian startups in the fintech space are far more disruptive than legacy incumbents like the banks. And banks cannot do what startups can do. How do you look at this? Do you believe that, a partnership, a symbiotic relationship is the way forward? And why do you believe, or do you believe that banks can be as disruptive as fintech startups?
Two parts to that question. The second part, yes, I believe banks can stand up to their own. Banks need to do a much, much better job than we have so far. But it is not easy. We talked about the quick commerce players. I would say the same of outstanding companies in the payment space, companies like PhonePe, companies like Google Pay, Zerodha, to name a few. All of these activities, payments and investments, 10 years ago, customers were doing with their banks. Now, banks have been disintermediated to a certain level and become warehouses for customers' money, whereas the actual engagement layer on top, the payment interface or the
Why did you lose that?
I think that if you look at the quality of customer interfaces and customer service that modern companies provide, and it starts with Amazon and Gmail that provide outstanding digital interfaces along with physical delivery. And now the new age guys do the same thing. And banks did not have the same kind of product offering in the late teens. And
so are you playing catch up now?
I think banks have caught up, but we're still behind.
Still behind.
Yes.
Lavanya, as we talk about this new wave of digitization, we talk about AI, we talk about the global opportunities that open up as well. I mean, each of you are catering to the Indian market, catering to the Indian consumer, so you're not so perturbed by what President Trump is doing. But as you look at the world today, as a young entrepreneur, as somebody who's running a business, what are the things that weigh on your mind? What are the things that you're looking at on your dashboard, to find signals in how you would like to operate, where you would like to grow, etc.?
So I'll tackle that question by talking a little bit about the disruption, right? Like where do we think that business could get disrupted? Now, when I came back to the family business 2016, the first thing that I started was the e-commerce business, and it's been 10 years now. So the mindset back in 2016 was very different. Also, if you're a successful incumbent, the mindset is, if anything, even more inflexible and rigid. So this is one thing that all of us as successful businesses have to watch out for.
So the curse of legacy in a way, right?
Yes, and it's also, I call it a sterility of success. You've done
sterility of success, that's a nice line, yeah.
Because you've done things a certain way for so long, you perfected it, right? And then here is this rinky-dink, ugly little e-commerce thing, because that's how nascent businesses start. It's not perfect, right? And then you're easy to poo-poo it. Oh, it's only for the discount brands. It's only for the kind of customers we don't want. Yes, but they will play catch-up. By the time you wake up as an incumbent, you've lost the plot, right? Because they built up the infrastructure, they built up the supply chain, they built up the digital marketing, they built up the talent pool. Now you're playing catch-up. So the only way to stave off disruption is you have to disrupt yourself. Easier said than done.
Yeah.
There is also a way to do that. Create a smaller pool and allow that little disruptive unit to breathe on its own. Because if you as an incumbent player come and sort of enforce the same metrics and the success metrics that you set for your established businesses and your cash cows, that disruptor is never going to be able to catch up. The larger org will always keep, forcing it to fail.
Right. And that's an important point. Sterility can often be, the opposite to trying and experimenting. Sterility of success, as you pointed out. But Shashwat, as you look at capital allocation for new businesses, for new ventures, I'm sure a lot of these questions have been asked of you. What's the point of it? Stick to the knitting, stick to the core, and so on and so forth. So what has been the pushback from your side to ensure that you address spaces and opportunities that you believe will be engines of growth for the future?
So I think for me, when I look at opportunities and how I sell it to the larger organization is using a lot of data, honestly, because in today's day and age, everything you're thinking about, somebody else in the world has already done it or is doing it. So there is a live example that's available. There is data that's available to kind of convince people on what is it that you're trying to say, right? And then, of course, there is an element of risk that comes with every such decision, but that's when you take the calculated risks, right? And I think today, ever more so than before, disruption is just imminent. And we're seeing it across every industry, every sector, right from, like you're seeing what's happening, disruption because of policy changes happening globally to technology, to AI, to everything, right? So you have to kind of be agile, you have to be abreast, and you have to also see how your business model evolves and how some of the traditional businesses may not be relevant 5 years, 10 years from today, and therefore what are the investment decisions that you need to take today to ensure that you as a business and as a business house is still relevant?
Are still relevant. Let me end by asking each one of you in 10 seconds each. They say the job of a leader is to find the future in the present. Jay Kotak, as you look at the present, what does the future look like? What do you aspire for yourself as well as for Kotak Mahindra Bank?
I would like for us to be a foremost player in digital banking in India.
Foremost player in digital banking in India?
The number one player, hopefully.
The number one player, by when?
As soon as possible.
As soon as possible. Shashwat.
I think when I look at our group, and it's very diversified, so it's difficult to give one statement like Jay did, but I think when I look at us 5 years, 10 years from today, how do I ensure that we are still as relevant and we are part of shaping what the Indian economy is going to be all about?
Shaping the Indian economy, that's the future bet, Lavanya.
I think for us, our core will always remain consumer, right? Like in service of the consumer, and it'll remain product. But how do we innovate on the product, and how do we create that kind of immersive experience for consumers and the future consumers? I think that's where the innovation and the excitement is.
Well, we look forward to hearing more from each one of you about your future endeavors, your future innovations, as well as the energy that you intend to put in to drive your businesses forward. Ladies and gentlemen, a big round of applause for the next gen of Indian business and what they're attempting to do to take their legacy forward. Appreciate your time, and we wish you the very best of luck. Thank you so much.
Fabulous to everybody. Congratulations. The best, to get the best of their panelists in limited time. The craft, she aces that. Shireen Bhan, Lavanya, Jay, and...
Anant Shakti, infinite energy. Since PDEU is an energy-focused university, all of us should learn to be as energetic as our Prime Minister. People often ask the question, where does Modi ji take rest? Or does he rest at all? I can tell you that I know the answer to this question. The answer lies in what Pandit Deen Dayal Upadhyay ji has said, who is the founder and whose name this university bears, has said about rest or Vishranti. He has said, Kaam mein badlav hi Vishranti hai. Change of work is itself rest. And I think this is our Prime Minister's motto. This should be our motto, dear students, also. Therefore, when we think about these two lessons, how to turn ideas into action and how to work tirelessly, we cannot escape the conclusion that Narendra Modi ji is not only India's Pradhan Mantri, but for us and this university, he is our Gurudev, our respected teacher, and we will follow his learnings.
आज जैन समाज का एक कार्यक्रम था बड़ौत में सीपीएल स्कूल में, जो पिछले 30 सालों से हर साल होता है। और यहाँ पे एक वुडन स्ट्रक्चर था जो कोलैप्स हो गया और अराउंड 40 लोग जो हैं वो घायल हुए हैं और उन सभी को 108 की एम्बुलेंस समय वहाँ पर मौके पर पहुँच गई थी। सबको हॉस्पिटल पहुँचा दिया गया है और 20 लोगों का प्रथम उपचार करके उनको घर भेज दिया गया है। बाकी 20 लोगों का उपचार अभी चल रहा है।
We must aim higher. Within a couple of years, India will emerge as the third largest economy in the world. No power on earth can stop India's growth trajectory. I can clearly foresee that India will become the most prosperous nation in the world before the end of this century. But India, with other large economies, also has a big responsibility. We must not allow economic growth endanger planet Earth and further worsen the climate crisis. Therefore, the transition from fossil fuels to clean and green energy has to be accelerated. I am supremely confident that green technologies and green enterprises can reverse the ecological degradation and indeed make our planet more beautiful, more livable for future generations. Our Prime Minister wants India to become the greenest nation in the world. For this purpose, India is also transforming itself into a deep tech nation with advanced manufacturing capabilities. This is the context in which PDEU should see its future role and responsibility. My dear PDEU family, therefore, here are my 3 expectations from all of you in the PDEU family. My first expectation, PDEU should further improve the quality of research and make it application-driven. We should specially focus on newer areas like bioenergy, which have the potential to help our farmers and boost employment opportunities. My second expectation, we should simultaneously increase our internal strengths and also forge national and global collaborations so as to enhance a leading position in research and academics. My third expectation, the intersection of green energy, green materials, and artificial intelligence is going to shape the future of humanity. I would like PDEU to gain a leading position in this synergy. Talking of artificial intelligence, I have a piece of advice to our young students. You must be good at using AI as a tool of learning, but do not give up your own critical thinking. चैट जीपीटी का ज़रूर से इस्तेमाल करो, लेकिन याद रखो आर्टिफिशियल बुद्धि से नहीं, खुद की बुद्धि से हम आगे बढ़ेंगे और आप आगे बढ़ सकते हैं.
Hello and welcome. You're watching Commodity Champions and I'm Manisha Gupta. Well, it's the US President Donald Trump's so-called Liberation Day tariffs against its trading partners have hammered the global equity markets, and the commodity markets were not spared either. The oil prices moved closer to their weakest levels since 2021 as the tariffs stoked fears of a global trade war, economic recession and also a negative impact on the demand. In the past week, the crude oil prices have declined by 15%. Natural gas prices are also down by double digits. The Goldman Sachs, Citi and Morgan Stanley have all revised their 2026 outlook for gold prices on the downward side. The gold prices also are down by more than 3% after hitting a record high of $3,167 per ounce. Last week, meanwhile, the silver and platinum prices also have seen a slump. Gold typically benefits from upheaval, but investors may now be selling gold to raise cash or cover margin calls in other asset classes, suffering steep losses. However, gold is still in the green for the year 2025. Among the industrial metals, copper is the worst hit. Its prices plunged more than in 5 years. Aluminum and zinc are trading at a 7- and 9-month lows as well. Prices of agriculture commodities, including coffee, cotton and rubber, also tumbled amidst fears that the demand for the raw materials could slump, especially coming in from the Chinese market. It really is about a lot of uncertainty into the international markets that we have seen, and the biggest decline when you look at the previous week has come in for the crude oil prices. To discuss what lies ahead for these commodities, joining me now on the show is Christopher Haynes, Head of Oil at Energy Aspects. Krit, hi, thank you so much for joining in. And we clearly have seen a lot of decline coming for the markets right now, with an expectation that you could be looking at further declines into prices, even from these levels. What is your sense? What are you going to be watching out now?
Well, hi, Manisha. Yeah, I think what we're looking at is really how all of this unfolds, because at the moment, I think even a lot of people in the US administration don't actually know what's going to happen. And I think, as you said just a second ago, the key issue is the uncertainty, and nobody really knows how much these tariffs are going to stick, how long they're going to stick for, what levels they're going to stick for, if they get changed at all. And I think that just creates a really bad environment in general for business, because there's no policy stability there for investment. So that's the struggle that we're dealing with right now. Until we get clarity on that, it's very difficult to see a better situation.
Kit, so what's your sense? How down or how deep are the crude oil prices going from here?
Well, we have seen a bit of a stabilization recently. I think that is because we have seen such a shock in the market. We lost $10 in the last 3 trading days or something like that. You've seen equal shocks in equity markets, in bond markets in the US as well. So I think you're starting to see that stress come through. So there's probably a limitation to where we can go. But at the end of the day, we don't think that the full impact of the tariffs as they stand right now are priced into the markets. I think there's still potential for that to be priced in if we don't see any movement from the Trump administration on these tariffs.
Okay, there are various reports, and yes, we have seen nearly 30 to 35% of a decline from 2025 highs in case of crude oil prices. From here, there are various reports suggesting that we could be headed to 60 and to 55 for the US crude prices. Do you see that kind of a decline coming in?
I mean, we're almost there already, right? I think we dropped below $60. I think it's a massive threat anyway to US production, which is going to be really struggling at the moment at that price in general, but also because they're suffering as well from higher costs. There's been tariffs on things like steel and other aspects of their business. So that's going to be a problem as well for, this drill baby drill mantra. I think it's going to be very challenging in such a price environment. It's not really particularly beneficial for US business at the moment.
Oh, well, yes. Kit, how are you also looking at the demand across? Because almost everybody, including Energy Aspects, is working with a surplus in 2025. One, what is the kind of surplus that you're looking at? And what does it really mean for the businesses, for the countries going forward?
So actually, our balances are showing a deficit for 2025. So if everything... If everything sorts itself out, then we still think this market is very, very tight. And right at the prompt, at the the fundamental front part of the market right now, things are still quite tight, and you can see that in in the structure of the market. So your first month versus second month trading. The problem is right now that because we have uncertainty, there's so much risk to demand further down the line. Our calculations suggest that if nothing changes and if tariffs stay in place as they are right now, as they've been announced, we could lose about 1 million barrels per day of demand. And that will put us in a surplus. And I think that's a pretty dangerous situation because 1 million barrels a day of demand loss is global recession territory. And it's pretty dangerous. So I think that's what the markets are trying to grapple with here. So you're seeing some of that price in. You're seeing some of that weakness in the last few days suggest, right, that markets are expecting some kind of an impact, but the full impact is just really not known right now because at the end of the day, I think there's a lot further to be clarified before we can get a decent number on this.
And Kit, how soon or how long do you think that could take?
I mean, that's a great question because I mean, how do we combat this when we're dealing with a president who's keeping a lot of his cards very close to his chest, and I think it's part of what we've seen in terms of his strategy, right? But at the end of the day, look, if we see more pain in markets, then I think you're going to have to see some kind of reaction. In a way, you've already seen some responses, I think, just to the weakness we've seen in markets recently. There's been certain, other members in the US that they're talking things down a little bit, trying to say, look, there's negotiations happening. We've heard, as many as 70 countries are now talking with the US to try and resolve this. So there's all these things going on. And yeah, I think it's just, it could take a while as well, right? Because we also have a lot of these negotiations are going to be bilateral, and that's going to put a lot of stress on the US side because they're going to be talking to 70, perhaps more different nations.
Oh, well, absolutely. How are you also looking at for the Indian markets right now? Because US has been pushing more oil, or the kind of conversations that we have. I mean, most people believe that India will have to buy more oil from US. Do you see those numbers increase? And how do you see the India's relation with various others changing here? Because we have seen those concerns coming from Venezuela, for Iran, and in some sense for some Saudi countries.
Yeah, so I think, look, from the US perspective, like India is very much going to be looking at price here. So if US crude is cheap enough, then they'll take it. I think that's the story. But what we have seen is recently OPEC has increased its unwind of the voluntary cuts, so that's certainly going to be beneficial for India. I think Indian refiners themselves are going to prefer that kind of medium style crude that the Middle East produces over the lighter crudes. And yeah, as you mentioned, like Venezuela is going to be a problem. They produce a very heavy crude, and that's quite difficult to replace at the moment. But again, you do have some volumes that are similar from Iraq, from Saudi Arabia. So if they are gradually unwinding, that is going to be beneficial for Indian refiners.
Kit, what do you see changing going forward from here? I mean, as you said, the environment for businesses is at best bad right now, and the crude price is clearly struggling from where they are. Some more declines is something that's not ruled out into the markets. How would you and what would you watch from here to get some clarity? Time period, unknown. What would US do? Unknown. What is it that you will watch for clarity?
So look, I think the real answers that we're looking for is, some of the big trade negotiations. So China's a big one, European Union as well. I think these are the big trading blocks. If we start to see, more bilateral conversations there, or even, last night we heard about Japan as well. That the talks are picking up there. So if we're getting more talk there, more movement towards agreements, then that I think starts to give global markets a bit more confidence in where we're going, a bit more kind of support to the demand outlook and actually, the world working together to try and create more prosperity. So those are the key things. But I would also say in the short term, demand looks pretty good. I think most places, we are in a bit of a seasonal lull, but we're just about to go into summer. Most places that sees an uptick in demand. So, US should start driving season, so more gasoline demand. And even in Europe, you start to see a pickup at the moment. So I think fundamentally, from a supply-demand perspective, we should be getting tighter going into the summer in that near term. It's just the backdrop of that uncertainty around the wider global picture is just really difficult to deal with at the moment. So I think once that's sorted out, it's going to give the market a lot more confidence to pick up from here.
That point is well taken, Kit, and thank you for making sense of that all, because yes, there are some near-term and macro fundamentals which really seem to be putting pressure, but yes, short-term demand hasn't really been impacted, and summer demand coming up is also going to be something that could be seeing some support. Thank you so much for joining in, and it really has been some sane words coming in there, bringing in sanity into all of that price decline that we have seen for the crude oil prices. Well, let's move on and let's get in Sandeep Bhan, CEO of SD-Kutri International, to talk about edible oil prices now, where we also have seen sharp declines coming in. Sandeep, the last 1 week has seen a decline of 4 to 5% for palm, for soybean. And soybean is more important because we have US now not selling it to China, or China not buying rather. And then you have Brazil and you have Argentina coming into the picture. Where does that leave India for palm and for soybean?
See, for India, the silver lining is that palm prices over soybean oil prices spread has narrowed down, which was a week, 2 weeks back, it was close to $75, and which has now narrowed down to $15. That makes India come back to the palm oil market. And last few days, we have seen India buying very aggressively for forward month. Main reason, palm has become again a cheap oil compared to other oils in leaving behind the aggressive premiums that we were holding on to last couple of months.
Sandeep, going forward, do you see India's demand pick up? Because the last couple of months didn't see much imports.
Oh, definitely, we see that demand is going to pick up. I mean, the last couple of months, we have seen India was buying very low palm oil. It was just hardly 300 to 400,000 tons in January, February, and March months, mainly because palm was maintaining a huge premium over soft oil. Now that oil, that premium has shrunk down to $15. So we should see India back into the palm oil, and in a big way. So we should see from 400,000 back to 500 to 600,000 tons if palm maintains its at par price with soybean oil.
Fair that. Sandeep, do hold on to that thought, because the U.S. Treasury Secretary Scott Bessent is speaking to CNBC US on the tariffs. Let's cut across to him.
Our trading partners was not to panic, don't escalate, and then we will see where President Trump is after a period of days or weeks. The response was overwhelming, so it was after a period of days, and he decided that it would be a good time to begin negotiating. The Japanese were very good actors. The president had a very good call yesterday with the Japanese Prime Minister that led to these negotiations. And look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
Mr. Secretary, we spoke yesterday with Peter Navarro, and he described his view on these things as it's not enough to get to zero tariffs. You have to take down all the non-tariff barriers that exist as well. His proposal, as he's written about today, is to get rid of the VAT, the value-added tax, on top of a lot of other things, that is what it would take for us to reach any sort of a settlement with Europe. Are you in the same frame of mind as Peter Navarro is when it comes to that?
Becky, I think everything's on the table. So they're tariffs. The academic literature shows that it's actually the non-tariff barriers, which are both harder to quantify and harder to, they're more insidious because they're hidden, they're obfuscated. So tariffs, non-tariff barriers, currency manipulation, and then subsidies to both labor and industry. So everything's on the table, Becky.
Meaning that it would take all of those things for us to reach any agreement that would make any sense? I mean, the value-added tax isn't directed at us. It's a tax that every manufacturer, including those that are based in Europe, pay as well. It's more the equivalent of a sales tax like we impose here.
Well, again, I think there's going to be a lot of back and forth. President Trump is going to be personally involved in the negotiations, and we will see what our trading partners offer. For instance, there is talk of a big energy deal in Alaska where the Japanese and perhaps the Koreans, perhaps the Taiwanese would take a lot of the offtake and provide financing for the deal. So, that could be an alternative for them to come forward with that, because not only would that provide a lot of American jobs, but it would narrow the trade deficit. So, Becky, everything's on the table.
Mr. Secretary, though, help us just understand this, and maybe it's a very nuanced answer because there's sort of a different component parts to this. So the president said yesterday with Netanyahu, quote, that these tariffs can be permanent tariffs and there can also be negotiations. We also had Peter Navarro, as Becky mentioned, and you just talked about, saying that the whole goal of this is to bring manufacturing back to the U.S., and then there's been the discussion of trying to raise revenue as a function of the tariffs. All of those different ideas, to some degree, oddly enough, are at odds with each other, meaning if you're successful at creating revenue from the tariffs, you're not bringing jobs back to America necessarily, though that could be an offshoot of what happens. I'm trying to understand from your perspective whether these really are negotiations, they're not negotiations, what success at the end of the day actually looks like.
Well, Andrew, that lot to unpack there, and let's just go through it piece by piece. That if we put up a tariff wall, the ultimate goal would be that if we're successful, tariffs would be a melting ice cube in a way, because you're taking in the revenues as the manufacturing facilities are built in the U.S., and there should be some level of symmetry between the taxes we begin taking in with the new industry from the payroll taxes as the tariffs decline.
Mm-hmm. Let me ask you a separate question, and maybe you can speak directly to the CEOs and business leaders who are watching this broadcast, along with perhaps policy leaders and others who are frankly running other countries. I've talked to a number of them who say, you know what, I'm going to sit back and just watch all of this play out. I'm not going to make any decisions about whether I'm going to bring manufacturing back to the U.S. or, frankly, how much I need to negotiate with this administration, this is now other countries, just yet, because depending on how the markets play out, depending on what you think is going to happen in Congress, depending on what you think is going to happen with the courts, all sorts of other things could happen first before I would need to make an actual decision as to either negotiating over the tariffs themselves, or if I'm a business, investing back in the U.S., because who knows what's going to happen, not just in 6 months from now, but in 2, 3, or 5 years from now, when maybe my plant would actually come on board or online.
Yes, so, Andrew, that I think that may be what some of the countries are saying in public, but I can tell you I've seen the call list at the White House, and it's substantial. We were having a discussion last night about which countries to prioritize, and I think you are going to see some very large countries with large trade deficits come forward very quickly. I think we can, if they come to the table with solid proposals, I think we can end up with some good deals. And, part of the calculus on that may be that some part of the tariffs stay on. And I actually think, as I said, that over the weekend, President Trump has maximum negotiating leverage right here, right now. And I think it would be a mistake for anyone to think otherwise. And as I said, many of our trading partners, they have queued up, and they have kept their cool. They have not escalated, and they will get priority in the queue. I think it was a big mistake, this Chinese escalation, because they're playing with a pair of traditionally. If you look at the history of the trade negotiations, we are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
All right, those are very interesting statements coming in from the Secretary Besson, where he says that we export 1/5 to China of what they export to us, and clearly China escalation is a big mistake. Also making a very strong point on the fact that there's a lot of back and forth, and that, yes, the US president is personally involved in various negotiations there, and everything as of now is on table. Sandeep, with that kind of statements coming in, and as we've been talking, that clarity or stability is pretty far from where we stand right now. What is your sense in the global markets, especially when it comes to agriculture as a space overall?
It's very too early to say about how this shift is set up, because a lot of negotiations will happen. A lot of countries are in fact in touch with US to negotiate these terms. So we have to keep a wait and watch and see how it will shape up in coming months.
Sandeep, especially when a country as strong as China is involved, which is a big powerhouse when it comes to commodities, whether it's agriculture and non-agriculture, do you think that is a major problem? Because a lot of other countries you perhaps wouldn't get so bothered about.
For palm oil specific, it's a good thing for palm oil, because if US stops soybean exports to China, then China will have to come into the palm oil.
Clearly that. Sandeep, thank you so much for joining in. So a lot of clarity is something that the markets are still waiting for. And as the Secretary also said, that everything is on the table right now, a lot of back and forth as well. And the goal, as he said, into US is to bring jobs and revenues back into US. So that is something that the US, of course, will be working for. But with that, it's time for a short break. But don't go anywhere. We'll discuss the impact of tariffs on India's gem and jewelry sector on the other side.
RBI MPC meets at a time when President Trump has sent many global markets crashing by announcing shockingly high tariffs on most countries. The world economy is staring at a sharp slowdown, and some Asian countries are even staring at a recession. Will this force the RBI MPC to be more dovish? Will it announce a 50 BPS cut or a smaller cut accompanied by a dovish stance? And how will that impact the economy and your finances? Watch the RBI monetary policy on CNBC-TV18, along with instant analysis from a host of policymakers, top bankers and economists. The RBI monetary policy at these times.
Well, the US President Donald Trump's decision to impose reciprocal tariffs of 26% on India is expected to significantly impact the gems and jewelry sector. Remember, the US accounted for $10 billion of India's annual gems and jewelry exports in FY24. Joining us now are Adil Kotwal, Chairman, Seeps Gem and Jewelry Manufacturers Association, and Sabyasachi Ray's EDI Gem and Jewelry Export Promotion Council. Gentlemen, hi, thank you so much for joining in. Well, another day and more uncertainty into the markets there. Mr. Ray, to you first. And I remember we spoke on the day one itself, and there was still some clarity that the street was awaiting. Now with 26% on and the negotiations going on, what is it that the sense you are getting on U.S. exports to the Indian exports to U.S. rather?
Aisha, I think I was watching you also taking in different segments. See, one of the things what is coming out from everywhere, every segment, every sector is uncertainty. And throughout the world, right now, what we are hearing from US also, so negotiations are going on. What we understand is that everybody is negotiating, whether EU or other countries, other than China. So that is where we are. So negotiations are on. Nobody has reciprocated what US has come into. We are also negotiating. In fact, what we understand is that our government, or rather our Prime Minister, went and had already discussed with Mr. Trump. And we are talking about $500 billion of exports in the near run. But right now, everything is on a standstill. I'll explain you what do you mean by a standstill. See, where are we? What is Jameson Jewelry? We are not some essential commodities what we talk about. And we are also very high value goods. So when you talk about percentage, like if let's say we talk about oil, it is $80, $60 or something like that. But at our end, we are talking about $1 million. So a percentage of 26% on $1 million will not work. Suddenly, let's say the date is 9th. Before 9th and after 9th. After 9th, suddenly your $1 million goods with 1 million, like 1.26 million. So it is not acceptable. So that way, we do not believe in the shorter run, there will be customers whom we can find to sell those goods. And in fact, the buyers who are also taking the goods from our sellers, like Adil Bhai is here, so they will also not accept the goods because they are also not sure that whether this 26% will remain or where it will go, how much down it will go, etc. Till those clarity comes in, the exports will be standstill for our sector. That is what we look into. And of course, after that, wherever we end up, let's say in jewelry, where we end up, in diamonds, what we end up, based on that, the demand, where it ends up. Because once the inflation kicks in, as we are not an essential commodity, they have to spend in other goods, and after that, how much it is in their pocket, and based on that, how much demand remains for our commodity. Based on that, only we'll understand. That is what right now I can, respond.
I understand that exports at a standstill currently isn't a nice place to be. And as my earlier guest was also telling me that it's a bad environment for businesses across the world. Mr. Kotwal, what has been your sense? Not a nice time to be and a lot of clarity awaited. But as we understand, as Mr. Ray also said, that there is conversation between the two governments, which can take 3 months or 6 months. And is the trade, is the industry, do you have that much time to wait by?
Good evening, Manisha. To respond to you, from SEEPs, starting today, starting tomorrow, I don't see any exports going to the USA. Everybody has told us that please put all orders on hold. They have told us manufacture it and keep it ready for us. We'll tell you because there are tremendous amount of uncertainties. When we export to the US previously on $1 million, we were paying $60,000 duty. Starting tomorrow on $1 million of exports, we'll have to pay $320,000 duty. Before the goods even enter United States, you have to pay the duty. So it's a cash flow mess. Retailers, they have to change their retails. A ring which was being sold in a retail store for $3,000 is now suddenly going to be sold for $4,000. Is it an attractive price at which the buyers will come and the customers will come and buy it? These are several questions. And so till the retail, we sell mostly to retailers from SEEPs. About a $3.5 billion exports, of which 64% account for United States. We employ 100,000 workers. Everything has come to a standstill. The retailers in the United States right now, I would say, have enough stock for the next 3 months.
Okay.
So they are not in any great rush to send us purchase orders and buy it and suddenly go out of sales. If this was during October, November, December, that would have been a different situation because they would want goods in their stores. But right now, it's a quiet time. Mother's Day goods have already reached them. So 3 to 4 months stock lying with them, they are not in any rush to send us purchase orders. What does that
Mr. Kotwal, what is the conversation with the government now? Because we do understand that whether it's about Commerce Ministry or Finance Ministry has been in touch, has been asking for representations, has been in touch with the value chain, the stakeholders, that is.
Yes. Oh, yes. The government has been in touch with us. We have been in touch with them. And I believe that in the next 3 months, some resolution should come about. this cannot continue like this. The India side is also very keen that we come up with a good resolution, a bilateral trade agreement. So whilst we'll have 3 months of difficult time, I believe things will settle down after 3 months. 3 months is a difficult, because the surprise element is the 26% on diamonds, which was never there. Now that has jacked up the prices tremendously at the end for the retail sector. I'm personally confident that we'll be able to settle this at a fair level where the jewelry can absorb that kind of duty. 32% jewelry in the United States cannot.
Just one word, Mr. Kotwal. So 26% doesn't work for you. Even if there is a negotiation, let's say in 3 months, the time that you're giving to yourself, what is a percentage that you are agreeable to work with?
I think around 10% we'll all be very comfortable.
Okay. Mr. Ray, US is one market and 10%, Mr. Kotwal says, is okay to work with. China is another monster right now. And how are you looking at various other markets? Because even if US doesn't work for, let's say, next 3, 4, 5 months, 3 months is what you are assuring yourself of right now. How are the other markets looking like?
Yes, again, Manisha, you are continuously with us, tracking the markets and how is it doing. You have seen we have a fairly good Hong Kong show in March. So we were, the diamond segment, which was also going through some very rough times, had a very good time in Hong Kong, and they were looking at orders from China, etc. So China is one of the markets which was not doing for us well. US was doing very well. So we were looking at revival of the Chinese market in March, but after that, when this tariff has come in, we do not know how much it will impact the Chinese economy. And based on that, again, the diamond market, how it will look like. So if you're looking at two big of our diamond markets, is US and China. That is where it looks like. Now let us go to the gold jewelry. The gold jewelry market, again, after CEPA has done very well in the Middle East. Again, if you look into the price of gold, it was a dampener into buying of the jewelry because the prices have shot up within the short run. And now, just now, again, I was hearing about the crude prices, etc. If that goes down, the Middle East money, the disposable income, what will happen about that? So if you're looking at this market, these are the three major markets where our sector operates. And all these three major markets, there is a lot of uncertainty right at this moment of time.
Oh, well, absolutely. And that's about US and China, two major markets. And what the tariff will do to other various countries is still something very, very uncertain. And how would it impact essential commodities and then luxury items like jewelry is something that all the markets really seem to be working on right now. Mr. Kotwal, Mr. Ray, thank you so much for joining in and throwing in some light on what really works and what doesn't. And of course, next 3 to 4 months is the kind of clarity that the street thinks we will get in some sense. But thank you so much. And that's all the time that we have on Commodity Champions. Thank you for watching.
Hello and welcome to Business 360. I'm Ritu Singh and here are the headlines that we're tracking this evening. Trade tensions rise as Beijing and Washington head towards fresh escalations. Chinese Commerce Ministry slams Trump's threat of imposing an additional 50% levy as blackmail, says it's a mistake on top of a mistake, and China will fight to the end. Stocks in Japan rebound 6%, leading a recovery across Asian markets. European markets also gain after the recent sell-off due to tariff tensions. Positive global cues lift Dalal Street. Sensex gains over 1,000 points. Nifty reclaims 22,500. Stocks add more than 7 lakh crore rupees in market cap today. The RBI Monetary Policy Committee is expected to cut the repo rate by 25 basis points tomorrow. The street expects RBI to strike a dovish tone as tariffs could be treated as an additional headwind for financial markets. The government's decision to hike LPG cylinder prices by 50 rupees is going to add 9,000 crores to oil marketing companies' kitty in FY26, compensate them to an extent for the 41,338 crore rupee losses they suffered on account of LPG subsidies in FY25. Sources say that OMCs will see cabinet nod for a further 32,000 crore rupees. India will limit market access to Chinese EV maker BYD. Commerce Minister Piyush Goyal says India will need to be cautious about strategic investments and needs confidence that BYD will play by the rules. This comes at a time when Elon Musk's Tesla is actively looking to enter India. Ola Electric includes yet-to-be-launched vehicles in its February sales numbers. Road Transport Ministry has already sent 3 letters to Ola over discrepancies. Ola claims the sales numbers are based on paid and confirmed orders, not preliminary bookings. For the first time in independent India, the Supreme Court prescribes a 1-month time limit for governors to act on bills passed by state legislatures, slams the Tamil Nadu governor for his reservations on 10 bills, calling it illegal and erroneous. The top court invokes its powers to declare the 10 pending bills are effectively approved. And the United States and Iran will hold talks in Oman this Saturday over a possible nuclear deal. President Trump makes the announcement after meeting Israel's Prime Minister Benjamin Netanyahu at the White House. And our big story this evening, trade tensions rise as Beijing and Washington head towards a fresh escalation. China has vowed to retaliate against the US. President Donald Trump's threat of escalating tariffs. Now, the country's Commerce Ministry has said that it will take countermeasures to safeguard its own rights and interests. The pushback from Beijing comes after Trump said he will impose an additional 50% duty on US imports from China. The US leaders said that duties will come into effect if Beijing does not withdraw the 34% tariff that it imposed on American products last week. Now, the Chinese Commerce Ministry has called Trump's threat blackmail and said that the move will be a mistake on top of a mistake. The European Union has signaled at offering a 0-for-0 tariff in turn with the United States. The trade ministers met in Brussels to discuss the bloc's response to US tariffs on steel and aluminium. Some ministers told reporters that they agreed to launching talks to avoid an all-out trade war, and this was their main priority. Here's a comprehensive report on the economy's response to Trump's tariffs.
Talking to China, we'll be talking.
US President Donald Trump has given China 1 day to end the 34% retaliatory tariffs it imposed on US products last week, or he'd slap an extra 50% duty on imports from China. It's an escalation in a trade war that has sent global markets into a downward spiral and stoked fears a recession is around the corner. Trump gave his ultimatum to China at the White House on Monday.
If that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on. So they've gone for years. They've become a rich country because of people, again, that were in the White House that allowed this to happen. Hundreds of billions of dollars a year they'd make on us on trade, and it shouldn't be that way.
Trump's long-promised round of global retaliatory tariffs were announced last week, with some rates as high as 50%. He has said they will help the US recapture an industrial base that has withered over decades of trade liberalization. On Monday, administration officials said dozens of countries had reached out to Washington in hopes of heading off the tariffs before they take effect Wednesday. However, Trump said he has no plans to suspend tariffs during negotiations.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
Beijing has responded with anger to Trump's latest threat. The Chinese Commerce Ministry said Tuesday China will never accept the blackmail nature of the United States and said U.S. threats were a mistake on top of a mistake. Trump said Monday his administration would open trade talks with Japan, one of Washington's closest allies in Asia. Meanwhile, the EU has proposed counter-tariffs of 25% on a list of U.S. goods over Trump's earlier steel and aluminium tariffs, according to a document seen by Reuters. EU Trade Chief Maroš Šefčovič said Monday they're ready to negotiate a zero-for-zero deal with the Trump administration.
While the EU remains open to and strongly prefers negotiations, we will not wait endlessly.
The 27-member EU bloc is struggling with tariffs already in place on autos and metals. It also faces a 20% tariff on other products on Wednesday. And Trump has threatened to slap tariffs on alcoholic drinks from the EU. Investors and political leaders are still trying to figure out if Trump's tariffs are permanent or a pressure tactic to win concessions from other countries. And many investors are now betting that the growing risk of recession could prompt the U.S. Federal Reserve to cut rates as early as next month. Fed Chair Jerome Powell has so far indicated he is in no rush.
Now, markets across Asia rebounded following their worst drop in decades, and that was triggered by USA's tariff policy. Japan's Nikkei closed 6% higher, recovering from the 1.5-year low hit in the previous session. Now, this on hopes of tariff relief after U.S. Treasury Secretary Scott Bessent said he will lead trade negotiations with Japanese Prime Minister Shigeru Ishiba. Now, both the Hang Seng and Shanghai indices closed with gains of 1.5% each. CNBC's JP Ong joins us to give an insight into the recovery that the Asian markets have seen.
Asian markets tried to mount a comeback on Tuesday, with equities showing varying degrees of hope and defiance. The day's outsized gainer in the region was the Nikkei 225 on hopes that Japan would be able to strike a trade deal with the U.S. in the coming weeks. Though Japanese Prime Minister Shigeru Ishiba urged U.S. President Donald Trump to rethink tariffs planned for the world's fourth largest economy, reports indicate that the United States will prioritize trade discussions with Japan, with Treasury Secretary Scott Bessent expected to lead negotiations. The hope for a possible deal lifted the Tokyo benchmark out of bear market territory as the Nikkei 225 surged 6% higher. Surprisingly, greater Chinese markets managed to keep their nose above water, despite Beijing striking a defiant tone against the U.S.'s tariff actions. Following President Trump's promise of more tariffs in response to China's decision to retaliate with 34% tariffs on American goods, China's Commerce Ministry vowed not to respond to what they called blackmail for the United States and that they will fight to the end. And while the Hang Seng in Hong Kong tries to find its footing, Chinese equities look stable and reports that state.
All right, on that note, I'm going to toss it right to Shireen Bhan, who's at the Rising Bharat, speaking with Borge Frende, the World Economic Forum former president. Take a look.
Facing unprecedented times. I would admit that in many ways, I'm glad I'm not a trade minister anymore. I could put it that way, because it is very challenging times. The largest economy in the world, the U.S., is almost 30% of the global GDP, with 5% of the global population. They have introduced now tariffs that are the highest ones in the U.S. In a century. And no different countries then deal with it bilaterally. And it is a time where a lot is at stake for the global economy. That's for sure.
Well, yes, a lot is at stake, Borge. But, when we were in Davos in January at the start of the year, President Trump did speak to the audience in Davos virtually. And while he had already held out the threat of tariffs, it seems to be the worst case scenario that's playing out. And if you look at the calculation, if you look at the tariff math, this isn't really reciprocal in the sense that we expected it to be. So what do you see as the impact and the implications on global trade? Is it too early to really make an assessment of how badly this is going to impact global growth?
So the discussion about reciprocity, that's a political discussion. The reality, if you look just at the numbers, the U.S. used to have tariffs around 3%, and now they will have tariffs with the latest proposal in the mid-20s. This is one of the highest, if not the highest, among all industrialized countries. So it is a major change. How this will influence the global economy depends also on what's happening in the coming weeks. We saw, for example, the stock market, the Nikkei index in Japan increased by 6% today because there are bilateral discussions between Japan as the third largest economy in the world and U.S. as the largest to find ways to break this impasse. So I think we know more about this in a few weeks, but of course we need all the growth that is possible because we are not back on what was trend growth for decades. We're still lower than the trend growth, and there are so many challenges, so many jobs, so many opportunities that have to be created, especially in emerging economies and frontier markets.
Yes, well, speaking of opportunities as well as the road ahead, I want to build a little bit more on the retaliatory action and now the possible retaliatory action on China with President Trump threatening another 50% tariff on China. China responding, saying that they will take countermeasures if the U.S. were to go forward with that. If President Trump goes through with the threat of additional 50% tariffs on China, which would take the total tariffs on China above 100%, Borge, what will that mean? How are you reading that?
This will all be speculation, so I don't want to go into that because we will know the answer to this in a few weeks, at least most likely. But it is significant when the two largest economies in the world also are not seeing eye to eye on how to then deal with trade and investment between each other. So as I mentioned, the U.S. economy is the largest. China is the second largest. Together, they're almost 45% of the global economy. So if we see a decoupling between these two economies, that is serious because there are also areas where they depend on trading with each other. It is though important to underline that China, that is a big exporter and a big manufacturer, has reduced also their reliance on the U.S. market during the last years. It used to be 20% of the Chinese export used to go to the U.S. Today, they're down to 12%. So even if the trade was going to stop, 88% of what China exports today could continue. And the U.S. is not that relying on China either in some areas, but in other areas it is. And the challenge will be, of course, for American companies that the input factors, what they price, what they pay for what they put into their production will increase. And that can also lead to increased inflation, something that they, of course, want to avoid because increased inflation will also, over time, lead to higher interest rates.
Yes, inflation expected to move higher and interest rates unlikely to be cut anytime soon. That's the expectation at this point in time. But Borge, let's talk about Europe. That's where you are currently. We've already heard from the EU Commissioner, Ursula von der Leyen, saying that the EU is willing to negotiate, sit across the table with President Trump and the US administration, and even look at a possibility of zero tariffs. Now, what do you believe the European response is likely to be? While they have talked about taking countermeasures if the US were not to come to the negotiating table, at this point in time, do you believe the EU is essentially waiting and watching how this plays out domestically for President Trump's administration?
I think that's a good summing up of the situation. We know from Mexico-Canada situation that the tariff did change over weeks, and there were different possible outcomes. For the EU, the US market is incredibly important, and instead of then going directly into a retaliation situation, I think the Commission wants to also have a dialogue with the U.S. Administration. It's true if you look at manufactured goods, there is a surplus on the EU side. But what the EU also then mentions is they want to bring in services and digital trade in this picture. And then they say it's a more balanced picture. And we also see that there are different signals now in the Trump administration. I saw that Elon Musk, that is still in the White House, he said that why don't we create like a customs union or zero tariffs between the EU and the US, if I interpreted it rightly. So there might be some movements there. Maybe that's also why the market in Europe today also has strengthened a little bit. And we see also that the market in the US before trading is also in green. So I think there is still some hopes that this can lead to some negotiated results that can be in all countries' favor, and also in this respect in EU and the US favor.
You talked about the relief that we are seeing across global markets. Yes, after the kind of severe beating they've taken over the last few trading sessions with, trillions of dollars being wiped out in global market cap, there is a little bit of relief on the screen at this point in time. But, I want to stick with what's happening in Europe, Borge. And when we last spoke, you did believe that perhaps this was going to be the time when Europe would do more to push difficult reforms, would do more to try and bolster economic growth. In light of the actions taken by the US, in light of this reinforcement of the EU and the grouping, do you believe that now is the time to do or die, really, so to speak? A bit dramatic, but is that the moment we're at as far as Europe is concerned?
I don't think one should write off Europe at all. Europe has shown in the past to be the comeback kid. Remember in 2012, people said that Greece was bust, the euro was gone as a currency. Today, Greece is one of the fastest growing economies in Europe. And look at Spain, that also had trouble with high unemployment, especially for youth, is now the fastest growing of the OECD countries, the developed economies. The euro is still the second strongest currency in the world. But of course, Europe also has its challenges. Inflation is on its way down. That's good. But they will need to implement the Draghi plan. There's 400 pages of proposals from a former head of the ECB, the European Central Bank, saying that one has to reduce red tape, has to make it easier to do business in Europe. And if Europe implements all this, and it's a war on talents globally, maybe Europe could be a place where also very talented people would like to live in the future. So I would not write off Europe. It's almost 20% of the global economy still. So it's incredibly important, and maybe Europe also can play a role here between the other big economies, not ending up between a rock and a hard place, but maybe say that we can work with India, we can work with China, we can also work with Latin America and the US. So there are some diplomatic opportunities here also for Europe that we should not underestimate. For example, Ursula von der Leyen, you mentioned, just recently went to Brazil and signed an agreement with Mercosur that has been on the table for decades. And Mercosur being Brazil, Argentina, and etc., together with the EU is, almost 30% of the global GDP.
Talking about diplomatic opportunities that you believe Europe should not miss. The India-EU FTA negotiations have been on for over a decade now, Borge. Do you believe that this could perhaps speed things up? Could we see both sides moving closer to getting that deal finally done?
Yes, I think so. I was struggling for many years with the so-called EFTA deal between EFTA and India. EFTA being Switzerland and Norway, Liechtenstein and Iceland, not the biggest, but together they're the 12th largest economy in the world. And I used to say the only international organization where my country, Norway, is a superpower. But anyway, we made a deal. EFTA did a deal with India, and we have seen that in the past when EFTA can do deals with big players, also EU follows. So I think this can be the push needed for an India and EU mega regional trade agreement that possibly can benefit both India and EU a lot.
Well, since we're here at the Rising India Summit, Borge, you were talking about the India-EU FTA and the possibility of that finally getting done. But how do you see India positioned today? We are, of course, in negotiations with the US for a bilateral trade agreement. We're in talks with the UK for an FTA. We're in talks with the EU for an FTA. How do you see India's role and position, and what do you believe the approach should be from here on? The speculation, the hypothesis is that India could be a net beneficiary of this move, anti-China move. But how do you see India's position at this point in time?
India is well positioned. The Indian economy is still growing much faster than most other economies. If India continues with reforms, I think easily can get 6% economic growth. If it increases the reforms, it can easily also get back to 8%. India has suddenly also become a manufacturing hub. I just looked up the numbers before this, and I saw that India is the second largest exporters of cell phones in the world. That was not the situation just 5 years ago. India has amazing talent. One of the youngest population in the world. The average age is 28% of the Indian population. More than 60% is in the age of working. A lot of other countries have not those kind of great numbers. And we know that also Prime Minister Modi has a good relationship with President Trump. So let's see if India now is able to work out also an agreement on the trade and investment side that works for India. Traditionally, though, India has been doing deals mainly based on the multilateral agreements through WTO. And for India, that has, I think, been a good starting point. But now the world has changed, and we see more mega regional deals, so-called plurilateral deals, coalition of willings. And we're seeing that India is also pivoting towards doing more mega regional deals. Of course, this is up to the Indian leadership to make this kind of assessment. But it's interesting to see that the approach is also changing in New Delhi.
You talked about bilateral deals that India is looking at, and you also talked about what we have seen happen on the electronic manufacturing side. In fact, reports today suggesting that Apple may redirect some of its phone supply chain to India and make more in India on account of the tariffs imposed on China. Now, given the fact that in the region, whether it's China or Vietnam, etc., the tariffs imposed by the US are higher, do you believe in the near term India is likely to benefit from the higher tariffs in the region?
That would only be speculations, but we'll also see how the tariffs develop in the coming weeks. But as I said, I think India has good relations both with the US as the largest economy in the world, and EU is the largest market in the world, the singular market. And there is also traditionally good relations there. So let's see how India maneuvers this. But there is a lot of things working now for India if the reforms do continue. It's a startup nation too. 160,000 startups, 120 unicorns. So a new unicorn like every 20 days. Of course, India is strong on services. Also relatively strong on digital trade. Those two things are growing much faster than manufacturing. But now also India is making huge progress on manufacturing. 300 now sites in India producing mobile phones. This shows that when first things move fast in India, it really moves fast.
You know, Borge, I think something that has fallen off the headlines for the last few weeks, ever since tariffs took over, is what's happening with Russia and Ukraine. Now, President Trump and President Zelensky and Vladimir Putin have been in discussion. We've seen fireworks in the White House and outside of the White House as well. What's the sense that you now get on what's happening as far as Ukraine is concerned? And what's the feeling in the business community with respect to a possible resolution now?
It's true that Ukraine has fallen a bit off the agenda because economics, tariffs, but also still the situation in the Middle East with Iran and the Gaza has had a lot of attention. And also the Houthis, of course, with freedom of maneuver, naval maneuver in the Red Sea. I think the latest on the battlefield ground in Ukraine is that the progress that the Russians had a few months ago has probably staled, and there is now also counterattacks from the Ukrainians. So there is still a situation where after 3 years of war, Russia has taken a little bit less than 20% of the territory of Ukraine. They still control 80% of their territory. Russia went into Ukraine in the hope of taking the whole country in a week. And now after 3 years, they have 20%. So hopefully there is also now a willingness from Mr. Putin and the Russians to take up on this invitation from President Trump to then get a ceasefire and later on a peace agreement. But it seems like now that ball is in the Russian camp, and it seems like President Trump is also getting a little bit impatient if you read his body language on this.
Yes, there has been some commentary coming in from President Trump that he is losing patience, but one will have to see how this plays itself out. In the context of what's happening in Ukraine, you know, the efforts to remilitarize in Europe, and there is now a lot of talk around what that could potentially mean. We've seen different countries coming out and expressing their aspiration to remilitarize, given the fact that there is now this trust deficit between the EU and the US. What could that mean for Europe, this effort to remilitarize?
It's true that Europe has, in the last decades, used far less than they used during the Cold War on the military. Some European countries even gone under 1% of GDP, but most of them are now getting closer to 2% of GDP. I think this will continue. Some countries might even go up to 3%. Poland, I think, is now close to 4%. At least that is their goal. And I think this is a reflection on the security situation. If you have a neighbor, and a big neighbor, that has just taken a piece of another country, not according to international law, quite the contrary, these countries want to have a strong military, and they know that the strong military is sometimes the best way of guaranteeing peace, because no one attacks another country if it's strong.
So, Borge, let me end by asking you, is it the end of globalization as we've come to acknowledge and get used to over the last many decades? Is it the end of the multilateral system that we've been used to, you know, whether it's the WTO, the WHO? You know, how are you reading the chain of events and what this means as far as reshaping the global order is concerned?
No, thank you. It can be looked at from different angles. Still, we should remember, though, that 70% of the global trade do happen under the rules of the World Trade Organization, the WTO. And trade is still growing, at least until the last week. We have so far this year had a growth in trade around 3%. The global growth has been around 3.2. So it's not even been shrinking. So we're trading more with each other now than at any other time in history. But with the new tariffs, it can represent also something new. And it's true that trade is not growing as fast as it used to do in decades. Trade used to be the engine behind growth. Now the growth is also coming also from other areas. I would say that we are not seeing a de-globalization, but I say that we are seeing a re-globalization or a different globalization than in the past. There is more nearshoring, producing closer to where the products are consumed, to put it that way. There's also some friendshoring going on, that some countries say, oh, we want to then buy from the countries that we perceive as our friends. So there is also this age of nationalism. So there are countries, especially the big ones, that said, oh, this we want to produce at home due to security reasons. What we have to hope, though, is that not this end in a total decoupling, because a decoupling and disintegration of global trade will lead to contraction of the global economy. And the least thing we need now is a recession, because there is no ammunition to fight a new recession, because the countries are more indebted now than since at any other time since 1945. So let's hope that we'll continue to trade. The trade might be looking different or some adjustments, but let's not lose the baby with the bathwater. That would be my last appeal.
Well, let's not lose the baby with the bathwater. Let's ensure that trade continues, and let's also ensure that the world doesn't head back into contraction. It's been a difficult time through COVID, and we don't want to go right back there. Borge Brende, it's been an absolute pleasure. Thank you very, very much for joining us here at the Rising Bharat Summit. Appreciate your time. We look forward to seeing you here in India, and we hope to be able to discuss how these events of the last few days are going to shape global growth and the global economy. Always a pleasure. Many thanks for joining us. Ladies and gentlemen, big round of applause for Borge Brende of the World Economic Forum. Well, ladies and gentlemen, we've been talking about rising Bharat, rising India. We've been talking about the opportunities that present us at this point in time, but we also have to look at the global context and what's happening in the world today. If I were to start by telling you or recapping for you what has happened overnight, it would sound like a Shankar Mahadevan song of being almost breathless in terms of the number of announcements that have come in from the US president, from governments around the world reacting to what President Trump has said. So let's talk about tariffs. Last night's big development is that the US and President Trump are threatening China with an additional 50% of tariffs. China retaliating, saying that they will impose countermeasures as well, but they hope that the US will come to the negotiating table. EU at this point in time has said that they're willing to negotiate with the US and have offered an olive branch, so to speak. Japan is already in conversation with the US, or at least that's what the US president seems to suggest at this point in time. We've had a call between Marco Rubio and our own Minister Jai Shankar saying that things are on track as far as the India bilateral trade agreement is concerned. The global markets are in a state of panic at this point in time, and we've seen wealth erosion across the US markets, across Asian and European markets, and our own markets as well. So in this very, very volatile mix, how does India position itself? What should our response be? And more importantly, from a domestic point of view, what should we prioritize and focus on? Well, I have three gentlemen who have their ear to the ground and their ear to the clients, who are telling them what is going on at this point in time. Rajiv Memani, let me start by asking you, a Trump era that we live in today, where every tweet changes the way that the markets move, changes the way that policies are being pursued at this point in time. How are you looking at it? When you talk to clients today, when you're talking to your partners sitting in the US and in other parts of the world, what is the view?
Yeah, no, I think very few people really fully are able to grasp the situation now. I think everyone's living on a pretty much day-to-day basis. But, if you just step back, I think what's clear to everyone is this position of high fiscal deficit, high trade deficit, high debt. And that debt being owned significantly by the country with which you have the largest trade deficit was not something that was sustainable, and I think President Trump called it out quite aggressively and has been calling it out. In fact, there was an article that was written by Warren Buffett in 2003 which actually captured this very well. So this has been going on for a while, but I think he's the person.
And he's literally the only one who's kept his shirt on, Warren Buffett, while the markets melt.
So but no one really called it out the way President Trump has. So one thing is clear, I mean, if you look at all this, that he's very determined that manufacturing has to return to US. So I think if you have to pull out anything, I don't think anything is going to stop him from that. Whether he has to apply pressure on countries, on companies, create the incentive environment for that, I think that's very, very clear. He's also very focused on targeting countries with whom US has a massive trade surplus or trade deficit, and they have a trade surplus, and where he believes that there are issues of the rules are not equitable on both sides. So he's going, as a matter of priority, I think he's going after those countries. So if you peel this further, what this is creating, Shireen, is it's creating a lot of uncertainty.
Yeah.
People are unwilling to take investment calls, unwilling to take business decisions. Supply chains are likely to change in a significant way. So everyone is now, and because of that, if I talk to our clients, especially in the US, they're already calling out that the EPS will not be what they thought it will be, and they're finding it difficult to project forward. CapEx is probably going to be higher. So that's getting reflected in what the stock markets, especially in the US, are showing. So that's one, I would say, that's coming out very clearly. Second is almost all countries in the world will now look at trying to say, how can I do more? Value chains have to be redefined with countries with whom we have a level of mutual interest.
Right.
It cannot be absolutely one-sided. So the benefit that China got for a period of last 15, 20 years, I think that is difficult to sustain. And I think that means that a lot of supply chains and everything else will be changing. And if you pull this forward and you come back to say what it means for a country like India, And if you add that this uncertainty that AI will create, whether it's in 3 years, 5 years, 10 years from now, when I say uncertainty, much higher productivity, but in terms of jobs, then India has no choice but to look at manufacturing in a very significant way. And if you're looking at manufacturing, if you look at historically countries that have had outlandish growth sustainably, it's on the basis of exports, whether it's Germany, Korea, China, Japan earlier. That story may not work in that way. So that means your emphasis on domestic value added has to become much, much more stronger. How do you create more domestic value add? How do you build relationships of mutuality where you have mutual interest with those, I think, so that you can leverage on the export side of it? And how do you create a business environment which is conducive to all these three things? So whether it's in terms of cost curves, whether it's in terms of ease of doing business, whatever it is. So if you want, I can dive into details of all three.
I'll get you to dive into the details in just a second.
But that's what we're heading from.
That is what we're heading for. But Karan, I want to pick up on a couple of the things that Rajiv has laid on the table to set the context for this conversation. First up, the first order impact of the uncertainty created by the tariffs, this chilling effect that Rajiv spoke of, that investors are going into a state of panic at this point in time, and future investments at this point look uncertain, and so people are going to pause and wait to see how this dust settles. Is that what you're hearing from your clients as well?
I think, Shireen, I agree with Rajiv. There's so much of uncertainty that the clients are all looking at alternative scenarios and what might play out. We'll see multiple, this is a dynamic world given what you talked about, what the first order reaction is, what different countries are going to respond to, what's going to happen with the macro environment with stagflation, and then the implications on what happens to interest rates, etc. So there's a lot of variables that need to be worked out. So scenarios is the right way to think about. And people will look at.
It's great news for consultants. Isn't that what you do? Paint out scenarios.
And I think there are opportunities here. I wouldn't say this is all a doom and gloom. I think the opportunity for India, given we're looking at differential tariffs, and if it does play out, and it's great that India has taken Section 4C rather than 4B, and we are negotiating with the US.
Yes.
And if we end up in a good place in those negotiations, this can be a big plus for us. If I also go back to what Prime Minister Modi and Trump talked about, which is the 500 billion export opportunity, I think therein lies potentially a massive opportunity for manufacturing. And Rajiv is exactly right. We need to push up manufacturing to 25% plus because we need that for jobs. And so I think there are sectors where I think India is very strong, very credible. And I think there is a get and a give. The get is in sectors that we're looking for where the US can send us technology. Whether it's defense, whether it's AI, whether you're looking at nuclear energy, I think could be a huge plus for the country. So I think, but having said that, I think there is a few key imperatives we have to make sure we are following through on. The lesson from China, the lesson from Vietnam is we absolutely need to make sure that we have the ease of business and we are attracting more FDI into the country.
Yeah.
Our FDI, net FDI is only $10 billion. And we need global champions to come in to help set up that ecosystem. We also need innovation, as Chara talked about in the earlier panel.
Yeah.
We need to design in India as we think about Make in India. And it's an absolute must that the private sector must do more on that front. And I think we need global scale to be competitive. We all know about what in China, the big scale companies and the advantage they have.
Yeah.
So we have to be hyper competitive. So I think while there may be an opportunity for India here, and I really hope it does work out given how the negotiations will play out, I think there is an imperative for us to also take away for the longer term for us to position ourselves appropriately.
You know, before I get Rahul back into the conversation, let me just get Rajiv and you to comment on what we just heard you say there in terms of the supply chain diversification that is expected. Some of it is already happened post-COVID, but the expectation now, because of the differential that you talked about, Vietnam, China, etc., much higher tariffs in comparison to India. Rajiv, do you believe that that's going to have a beneficial impact on India in the short, near term?
Yeah, I think it should have, but I think it's too early to call out. So if you look at countries that are competing with India, if you look at Mexico, for example, I think the US-Mexico, Canada, you know, the USMCA, has much more favorable clauses than what India has. And I think what President Trump has said is an opening gambit. It's not. This is not a closing. And by the time countries take a defining moment to say they want to change, it takes time. It takes time for companies in India to create capacity. So I would say we are very well positioned because India's ability to negotiate is much greater. If I look at trade deficit of Vietnam, US's trade deficit to Vietnam is $125 billion.
Yeah.
If I look at Mexico, it's $180 billion. If I look at China, it's $320 billion. With India, it's somewhere between 40 to 50 billion.
Yeah.
And there are lots of ways by which India can balance that.
Yeah,
Also,
higher oil imports, LNG imports, defense, all of that. Yeah.
And we have done an analysis to say even if the duty rates were to come down, we can't talk about agriculture here, but in most products, if the duty rates were to come down in India, which is his sort of this, India is the tariff king.
Yes.
You know, it is, I think, and if the markets open up and supply chains get redefined, you know, it'll be a far more beneficial thing for India.
So you're saying industry is okay and on board with a tariff cut, a significant tariff reduction by India?
Most parts of the industry are very open. I won't say all, but I'm saying in aggregation, India will be beneficiary of that. Industry is also wary to say where surplus capacity gets created. India's biggest concern right now is, yes, there's a lot of talk about India-US, but the bigger concern is the surplus capacity this will create in China, Vietnam, and in some sectors in Europe as well. So I think to that extent, people want to watch out for that closely. But I would say broadly, Shireen, most of Indian industry is quite comfortable. And I think if things go as logically one would, and it's very difficult to say this in the current regime, I think India should be a net beneficiary.
Rahul, let me come to you now in terms of the opportunities that you believe present India at this point in time, the sectors that you believe are poised for growth and have a strength and advantage at this stage.
So I think just to build on the previous points, and then I'll come to your point, I think we have to de-average the situation a bit. And if you see from our vantage point, we are the least dependent on US exports, especially as far as goods and merchandise is concerned.
Yeah, 2%.
2%, and it doesn't move the needle for us in terms of our domestic GDP growth and so on. So I think if we negotiate well, as has been said, right, it can open up a large window of opportunity, especially in sectors where the differential tariffs are there and where we have longer term advantage. So if I was there, I would go out and think of it as a positive opportunity creation, where whether it is electronics or it is textile or it is cables and wires, where we see the competing nations have relatively higher tariffs than us. On the other hand, I think we need to be also aware that the whole world trade will get rewritten, and which means that countries which will not provide or supply material to America will supply elsewhere. And for example, China, which has large capacity of many products, they will find their way into the country. So we have to be resilient. We have to watch that closely and ensure that our industry is protected against that.
So let me put a challenge your way now. If you had a client who asked you to draw up a scenario for India at this point in time, perhaps the Indian government reached out to BCG and asked you to draw up and do some scenario planning, what would be the 3 or 4 things that you would ask the government to prioritize?
I think it's difficult to pinpoint, but I would say first we have to, in the short term, there will be uncertainty. And there is uncertainty. Whenever uncertainty happens, people freeze decisions. Capital investments will go slow, and therefore in the near term, we will face, and not just we, everyone in the world will face some decision paralysis, some capex slowdown, and therefore it is good to incentivize the economic growth, because our economy is strong and resilient. If you look at our drivers of economy, it's more consumption-led. I think we are talking about manufacturing, but manufacturing has stayed at 15 to 16 to 17% of GDP for decades.
For the last,
right?
Several decades.
And in contrast, Korea, China is 25, 27%. Yes. If we want to grow from 5-6% to 8-9%, we need manufacturing to pick up. But our base growth comes from consumption. And that is there. Our demographic profile, our rising GDP per capita, spending power, all of that poises to all, whether it is financial services, healthcare, anything that our mass consumes will grow, irrespective of all the macro trends.
I think it's important to get that reality check that Rahul has put on the table, and Rajiv and Karan, I want you to address this. We've been talking about this manufacturing aspiration of 25% to GDP for over 15 years now, and we're still anywhere between that 13 to 17%. We're nowhere even close to the 20%. Why do you feel hopeful of the fact that we're finally going to see that breakout moment?
Shireen, I think there is the question you asked earlier. We should take a bold aspiration, and I agree. How do we think about getting the manufacturing up significantly? So the bold aspiration would be, can we get to $1 trillion of exports in, say, 2030? Keeping in mind that, this won't happen in the next year, given all the uncertainties. We are very well positioned when it comes to 5 or 6 sectors, which I have a hard time believing will move to the walled garden of Mexico. If you think about the pharma, we are massive headroom ahead when it comes going beyond generics. We have 50% of US generics. There is vaccines, there's specialty pharma, there's a whole host we can look at. The chemical complex is another big one. You need energy for chemical complex, where our renewable energy is a big plus. There is electronics that we just spoke about. There is the need for textiles. You won't see textiles moving to the US. So I think there's machining. So there's 5 or 6 sectors. I think that should be the focus. But here we need global scale players. We need even global players to come in and be competitive. And we need the right incentives for this to be to truly participate in the global value chain, which is massive for us.
Rajiv, go ahead.
I'll respond to both the questions that you raised. And I would say manufacturing, I completely agree with what Karan is saying. I think there are 3 things which are really important. For the first time, electricity cost in India has become competitive. The second thing is logistics costs are actually coming down pretty regularly. Third thing, if you see, manufacturing space has been occupied by China. And if that gets vacated to some extent, where country build barriers, a little bit of barriers to ensure that China, you have some insulation against China, because it's very difficult to compete with China given the way they're looking at things. So if you look at all those three things, and fourth, if you look at the success in some of these sectors where PLI and others have come about, then I think there is a good story. Obviously, there's a lot that has to be done in terms of ease of doing business, factors of production, labor, land, and others. But there is a toolkit now that's there where I think the signs are very ominous. Therefore, how India puts itself into the global value chains, how do we get some leaders the way we've got Apple, and then roll that out, I think that will be very important.
That will be very important. Yeah, Rahul, go ahead.
I'm going to build, I think manufacturing, there is a window of opportunity for us. We need to latch it. But for that to happen, three things need to fall in place. I think our cost of doing business, yes, power costs and logistics are also getting better.
But it needs to do better.
Our financial costs, our land, labor reforms, if they all have to fall in place, because that's only when comparative advantage comes. Secondly, we can't do only end assembly. We have to build the full ecosystem.
Full stack,
So therefore, SMEs play a big role, because, and the end users, whether it is app, and this is the Maruti movement for auto. They build the full ecosystem. We need to build the ecosystem for all these, whether it is electronics or semiconductor, and for that SME becomes. And third is innovation. We can't only be competing on cost. Therefore, investing in R&D, innovation has to be top of mind for all our industrial players.
Let's talk about the role that Indian conglomerates are going to play. And Karan, I want to get to you. When we talk about the $100 billion plus club, we talk about the $50 to $100 billion plus club. You were talking about scale and size. The role that Indian conglomerates need to play, how they should reshape their aspirations to cater to the new global order.
I think the conglomerates is a big story, and it is one of the biggest drivers for India in the next chapter. In fact, for the next couple of decades. The salience of conglomerates in this country will actually go up. Conglomerates are about 25–30% of revenues and profits and about 40% of capex. They have done exceptionally well in the last decade. The leading conglomerates have grown by 5 to 25 times in the last decade. They're very well backed. They're extremely ambitious. Their aspirations are really bold. And these are both promoters and also professional managers running these big, large conglomerates. And they're taking a very big, bold bet on the future. They are doubling down on what is their strength today. And they're reshuffling the portfolio to get into new areas, like we talked about with electronics, like we're talking about with defense, aerospace, like we've got talking about the opportunity in healthcare, opportunity in consumer.
But what will all of this mean now in terms of private sector capex picking up? Because that has been the grouse of the government, that look, we've done our bit. You need to start to do the heavy lifting now. So when you talk about reshaping aspirations and capex, when do we start to see this play itself out?
They are already investing. You may not see it in the capex, in the utilization numbers today, which is in the mid-70s, but the investments being planned is actually quite staggering. And this is where they're focusing on building new businesses. So I'm pretty hopeful with the conglomerates, we will start to see it. The question is that there's a big double down on India. I think we also need to start thinking about incenting and creating the right condition for global champions like we're seeing in China, so we can compete on the global stage.
Rahul,
if you go back 10 years in time, most of the industrial conglomerates were thinking of diversifying to either consumer sectors, technology sectors, services sectors. What has changed in the last decade because of PLI and all the policy stability is that mindset has shifted, and now manufacturing is back in the boardroom, on the drawing board. What we are seeing still is ability to vision at scale is only with very few groups. And that's what is the barrier. I think the opportunity is enormous. If we were to capture even a fraction of what China will vacate, there is enough play for us as a nation. But the question is, are we willing to really think big, put the right investments behind it and go for it?
Yeah, Rajiv.
Yeah, just to make your panel interesting, I have a slightly divergent view. I think conglomerates' competitive advantage is they have capital. And obviously the management skill that they have developed is very strong. So their ability to take those bets are very big. What we saw in services happen when you had the startups coming, we are now starting to see early signs of startups receiving funding in the manufacturing and in newer areas also. So if you look at newer areas in engineering, defense, electronics manufacturing,
drone
manufacturing,
space tech,
medical systems, space tech, I think you will see startup companies coming where it requires very deep conviction, deep competencies, and capital is there. See, what happened was in the early parts, India developed because DFIs provided that capital.
Yeah.
DFIs went away, then stock markets provided that capital. And then venture capital, private equity provided that capital only in the services and technology sector. So the space of, large scale, large capex manufacturing went to the conglomerates, and they've done a phenomenal job of actually building that out. But there is a lot of manufacturing which requires intellectual property, R&D, innovation, requires capital, not humongous amount of capital, but requires intellectual power and talent. And I think the startups will come in there in a very aggressive way. You'll also see AI coming in some of these areas in a very significant way.
Yeah.
Shireen, I think a future-back trend is really capital substituting labor in the long term. And I think, how do we play a key role, as Rajiv rightly said, with AI, with software, which is a huge strength of this country, and that is going to be a critical, driver of growth going forward. But I agree. I think the ecosystem for entrepreneurship, whether it's the young entrepreneurs, the government incentives, the capital, I mean, we're talking about $100 billion that has been deployed in the VC community in the last
and plenty of dry powder still.
And there's massive monetization. So I think there's a vibrant ecosystem for digital insurgents that will play a key role in the next chapter as well.
So very quickly, the last 1 minute, the big engines of growth that you foresee over the next 5 to 10 years for India.
I would say higher spending because of higher income levels and consumption. Second is AI. If you play the game well, it could be a game changer for us. Thirdly, climate and decarbonization. Again, the whole energy transition space is very much there. It's not gone. So that and manufacturing is the joker in the pack. If you get it right, it will be the biggest game changer.
It could be the biggest game changer. Karan, the engines of growth.
I think consumption is a big story in India. I think the second one has to be about manufacturing. Third one is energy transition. And I think we need services, which is around healthcare and education.
Rajiv?
They haven't left anything out, so they've not said one or two, they've said five. But I think India's story is India's per capita income of $3,000 going to $15,000 in a span of next 20 to 25 years. That's obviously going to spur consumption, premiumization, services around that. So that's one. I do think that if I have to pick up anything, energy transition and manufacturing, where India gets plugged into some global supply chains, those will be the two biggest differential pieces of growth.
Two biggest differential pieces. Before I let you go, gentlemen, I have to ask each one of you, your favorite consultant joke.
Sorry, my favorite?
Your favorite consultant joke.
My favorite consultant joke. I mean, they're on some MBB company, so I'll keep quiet. I have a long one, which I will not say.
The time is up, is that right? But gentlemen, it's been absolutely fabulous. Thank you very much for future casting with us in a very uncertain world of the opportunities that India must focus on and the advantages that India does enjoy at this point in time. It is going to be an interesting playbook. It is going to be an interesting world as we see the global order change and shift. Will it be advantage India? The jury is out on that, but we certainly look poised for the better. Ladies and gentlemen, a big round of applause. Thank you very, very much, gentlemen, for joining us here.
and welcome to Business 360. I'm Ritu Singh, and here are the headlines that we're tracking this evening. Trade tensions rise as Beijing and Washington head towards fresh escalations. Chinese Commerce Ministry slams Trump's threat of imposing an additional 50% levy as blackmail, says it's a mistake on top of a mistake, and China will fight to the end. Stocks in Japan rebound 6%, leading a recovery across Asian markets. European markets also gain after the recent sell-off due to tariff tensions. Positive global cues lift Dalal Street. The Sensex gains over 1,000 points. The Nifty reclaims 22,500. Stocks add more than 7 lakh crore rupees in market cap today. The RBI Monetary Policy Committee is expected to cut the repo rate by 25 basis points tomorrow. The street expects RBI to strike a dovish tone as tariffs could be treated as an additional headwind for financial markets. The government's decision to hike LPG cylinder prices by 50 rupees will add 9,000 crores to oil marketing company's kitty in FY26, compensate them to an extent for the 41,338 crore rupee losses that they suffered on account of LPG subsidies in FY25. Sources say OMCs will seek a cabinet nod for further 32,000 crores. India will limit market access to Chinese EV maker BYD. Commerce Minister Piyush Goyal says India will need to be cautious about strategic investments and needs confidence that BYD will play by the rules. This comes at a time when Elon Musk's Tesla is actively looking to enter India. Ola Electric includes yet-to-be-launched vehicles in its February sale numbers. Road Transport Ministry has already sent 3 letters to Ola over discrepancies. Ola claims the sales numbers are based on paid and confirmed orders and not preliminary bookings. SpiceJet shares are down 20% this year amid concerns over its revival. The airline curtails its summer schedule as fleet shrinks. SpiceJet says it will ramp up the flight schedule as more planes join the fleet. For the first time in independent India, the Supreme Court prescribes a 1-month time limit for governors to act on bills passed by state legislatures, slams the Tamil Nadu governor for his reservations on 10 bills, calling it illegal and erroneous. The top court invokes its powers to declare the 10 pending bills effectively approved. United States and Iran will hold talks in Oman this Saturday over a possible nuclear deal. President Trump makes the announcement in a meeting after meeting Israel's Prime Minister Benjamin Netanyahu at the White House. Well, debt-ridden SpiceJet stock has been under pressure in trade, falling over 20% to date. Now, the airline's fleet has shrunk, curtailing its summer schedule. SpiceJet has raised 3,000 crore rupees last year, and that sparked hopes of a revival. But where do things really stand now? Madiha Mujawar is here with more details on this. Madiha, SpiceJet continuing to struggle. What does the future hold?
Well, SpiceJet was trading above 60 rupees a share in October after the airline raised 3,000 crores via QIP. Since then, the stock is down over 30%. The revival seems to be taking time, with SpiceJet still struggling to ramp up its capacity. The airline cut down 57 flights in its summer schedule, as you were mentioning, as compared to what it had in the winter schedule. And the weekly schedule is down by 417 flights as against last summer. The airline's market share remained at 3.2% in February, obviously due to the constrained capacity. Now, SpiceJet has told CNBC-TV18 it has 24 planes in service, although when we checked live plane tracking site planespotter.com, it shows 22 operational planes. Now, in January, the airline had said it has 28 planes in service and it plans to unground 10 planes by mid-April. But instead of an increase, the fleet has in fact sharply decreased. SpiceJet says it has ungrounded 3 planes so far, and it had to return 5 planes that it had taken on wet lease at a high cost. The airline says that revival of other grounded planes is taking time due to global supply chain constraints. So shortage of aircraft explains why it had to curtail the summer schedule. Now, the question raised here, has the 3,000 crore QIP really helped SpiceJet? Well, it has largely helped the airline clear the long pending payments and dues, including statutory payments, settling creditor liabilities, employee dues and airport related payments. According to the airline, it has used nearly 2,400 crores of the 3,000 crore fundraise, of which 1,500 crores were used to settle dues. So now what next? Is the airline headed for a smooth journey or turbulence? Sharing its plans to revive the grounded fleet, SpiceJet said it has sent MAX engines to US MRO Standard Aero Inc. for maintenance and repair, after which it expects several MAX planes to join the fleet. It said it is working with other OEMs and MRO partners to facilitate the restoration of more planes. So let's see what happens next.
Well, interesting development there. We'll keep a close eye on it. Madiha, thanks very much for bringing us that story. Now, the other big story we're focusing on this evening, trade tensions rise as Beijing and Washington head towards fresh escalation. Now, China has vowed to retaliate against US President Donald Trump's threat of escalating tariffs. The country's Commerce Ministry has said it will take countermeasures to safeguard its own rights and interests. The pushback from Beijing came after Trump said he would impose an additional 50% duty on US imports from China. The US leader said that the duties will come into effect if Beijing does not withdraw the 34% tariff it imposed on American products last week. The Chinese Commerce Ministry has called Trump's threat blackmail and said that the move will be a mistake on top of a mistake. The European Union, meanwhile, has signaled at offering a 0-for-0 tariff deal with the United States. Trade ministers met in Brussels to discuss the bloc's response to US tariffs on steel and aluminium. Now, some of the ministers told reporters that they agreed to launching talks to avoid an all-out trade war and that this was their main priority. Here's a comprehensive report on the economy's response to Trump's tariffs.
US President Donald Trump has given China 1 day to end the 34% retaliatory tariffs it imposed on US products last week, or he'd slap an extra 50% duty on imports from China. It's an escalation in a trade war that has sent global markets into a downward spiral and stoked fears a recession is around the corner. Trump gave his ultimatum to China at the White House on Monday.
If that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on. So they've gone for years. They've become a rich country because of people, again, that were in the White House that allowed this to happen. Hundreds of billions of dollars a year they'd make on us on trade, and it shouldn't be that way.
We were having a discussion last night about which countries to prioritize, and I think you are going to see some very large countries with large trade deficits come forward very quickly. I think we can, if they come to the table with solid proposals, I think we can end up with some good deals.
Trump's long-promised round of global retaliatory tariffs were announced last week, with some rates as high as 50%. He has said they will help the US recapture an industrial base that has withered over decades of trade liberalization. On Monday, administration officials said dozens of countries had reached out to Washington in hopes of heading off the tariffs before they take effect Wednesday. However, Trump said he has no plans to suspend tariffs during negotiations.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
Beijing has responded with anger to Trump's latest threat. The Chinese Commerce Ministry said Tuesday China will never accept the blackmail nature of the United States and said US threats were a mistake on top of a mistake. Trump said Monday his administration would open trade talks with Japan, one of Washington's closest allies in Asia. Meanwhile, the EU has proposed counter-tariffs of 25% on a list of US goods over Trump's earlier steel and aluminium tariffs, according to a document seen by Reuters. EU Trade Chief Maroš Šefčovič said Monday they're ready to negotiate a 0-for-0 deal with the Trump administration.
While the EU remains open to and strongly prefers negotiations, we will not wait endlessly.
The 27-member EU bloc is struggling with tariffs already in place on autos and metals. It also faces a 20% tariff on other products on Wednesday. And Trump has threatened to slap tariffs on alcoholic drinks from the EU. Investors and political leaders are still trying to figure out if Trump's tariffs are permanent or a pressure tactic to win concessions from other countries. And many investors are now betting that the growing risk of recession could prompt the US Federal Reserve to cut rates as early as next month. Fed Chair Jerome Powell has so far indicated he is in no rush.
Well, the World Economic Forum President Borge Brende has said that the world does not have the ammunition to fight a new recession. Speaking at the Rising Bharat Summit, Brende told Shireen Bhan that his appeal to all of the nations is to continue trading since disintegration of trade will hurt global economies.
Disintegration of global trade will lead to contraction of the global economy. And the least thing we need now is a recession, because there is no ammunition to fight a new recession, because the countries are more indebted now than since at any other time since 1945. So let's hope that we'll continue to trade. The trade might be looking different or some adjustments, but let's not lose the baby with the bathwater. That would be my last appeal.
Well, in market action then, markets across Asia rebounded following their worst drop in decades, triggered by USA's tariff policy. Now, Japan's Nikkei closed 6% higher, recovering from the 1.5-year low hit in the previous session. This on hopes of tariff reliefs after the US Treasury Secretary Scott Bessent said he will lead trade negotiations with Japanese Prime Minister Shigeru Ishiba. Now, both the Hang Seng and Shanghai indices closed with gains of 1.5% each. And positive global cues also helped the Dalal Street clock all-round gains. The Nifty and the Sensex ended over 1.5% in the green, with the Nifty regaining the 22,500 mark. The Midcap index outperformed the blue chips, rising over 2%. IT and Pharma saw buying after continued selling over the last few days. All sectoral indices ended with gains. Prashant Nair is here with a wrap-up of the day's trade.
Well, overnight we saw much better markets, absolutely flat closes in the US. And today we got a recovery, a bounce of our own. And I think, once the data is out, we'll get to know how much of this was covering and what did flow numbers, etc. look like. But it was a good one. I mean, at the high point, the Nifty was almost 500 plus points in the green. But of course, we came off the highs of the day, and the change was up on your screen. The Nifty Bank as well, a decent bounce. By the way, the Nifty is got to almost its very short-term hourly moving average, and then kind of sold off from there. So, we'll have to wait and see if we've kind of completed a bounce, so there is more here. And something similar happened for the Nifty as well, with it getting to almost within 50 points of an important retracement. Mid-cap and small-cap indices, 2.5% each is what we saw on both these. Now, on the Nifty, there was pretty much everything which was higher. So I'll start with what was up the most. Geo Financial Services, top of the list. Shriram Finance was up in a strong way. BEL, Cipla, Eicher, Grasim and Titan were some of the other names. Just like on the way down, it was very difficult to point out XYZ reason. It was a broad-based sell-off. The bounce also something similar. So we're not really going down into specific reasons for why this or that stock were doing what they were doing. In the broader space, of course, what was the action like? Vijaya was the big gainer in terms of volumes as well. 5-star, again, NBFC name, Keynes, PG Electroplast from the EMS space, Chola Holdings, OneSource Pharma, Capacite Infrastructure. There was a name like Tangamail and Sequent Scientific were some of the other big volume-led gainers that we had. It's not a hugely market breadth was very positive, but not backed by a huge amount of volume-led gains. I have to point that out. On the downside, Siemens was a loser. Delivery lost quite a bit in volumes. IGL, of course, that news came through in terms of Delhi. Castrol, Welspun Corp and 361 were some of the others which came off on the back of sharp volumes. I mean, this remains a market where headlines are going to be closely watched with regards to tariffs and the negotiations, give and take, etc. So far, we've not heard anything from the Trump side which suggests they want to dilute or are looking for easy wins. But that's essentially front and center for markets. Back to you.
All right, Prashant, thanks very much for joining in with that. Now from equities, we'll move on to commodities, where oil prices remain steady with U.S. crude futures hovering around the $60 mark. Now, this comes after a massive sell-off in recent sessions that was triggered by the concerns that U.S. tariffs might depress demand. Now, meanwhile, gold prices rebounded from the near 4-week low that they had reached in the previous session. This is heightened concerns over the global trade war lifted investor appetite for safe haven assets. The crypto markets also rebounded marginally after joining the global market sell-off. The Bitcoin experienced heightened volatility, dropping below the $75,000 mark before recovering to $79,000. Now, this resulted in nearly $1 billion worth of liquidations, primarily from long positions. And moving on to the forex markets, where the Chinese yuan weakened against the US dollar, many currency traders believe China is allowing the yuan to depreciate to offset some of the impact of the tariffs on its exports. Now, the Indian rupee also weakened by over 40 paise against the dollar today. Bond prices continue to gain on safe haven bets as the yields continue to decline. Now, amid all of this tariff tantrum, the focus now shifts to the central bank's next move. Respondents to our CNBC-TV18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Most of the economists we polled expect the RBI to front-load the rate cuts in April and June as tariffs threaten to hurt economies globally. All of the respondents to our poll expect the MPC to deliver a 25 basis point rate cut in the policy. Now, with inflation cooling, growth slowing, dollar weakening, US yields dipping and crude prices falling, the RBI does have room to act. So the call on the rate cut is pretty much unanimous. The question is, what else? Now, that is where opinions differ. Half of the respondents expect a shift to an accommodative stance to signal a more dovish RBI, but 40% believe the MPC will stick with its neutral stance. The majority of respondents also see the terminal repo rate at 5.5%, and that implies a total of 75 basis points rate cuts additionally in this cycle. Now, no major liquidity surprises are expected. The RBI has already been addressing that through OMO purchases, currency swaps, and higher tenor VRR auctions, and is likely to continue doing so. Any more on this front is going to be seen as a positive. Economists expect anywhere between 30 to 60 basis point hit to our GDP because of the higher tariffs from the US. But for now, the majority expects RBI to leave the growth forecast for the fiscal unchanged at 6.7%, while a smaller section expects a slight downgrade. On inflation, which has been tracking below RBI's estimates, 60% believe it will be left unchanged for now, while 40% see it being revised lower to 4 to 4.1%. The tone of the policy is largely expected to be dovish. So, what are the big cues the markets are going to be watching out for from the RBI policy tomorrow? Lata Venkatesh rounds it up.
Well, the Monetary Policy Committee is expected to cut rates and some more. Only a rate cut will be seen as hawkish. It has to be accompanied by something because clearly the growth environment has gotten tougher. So there is an outside chance of a 50 bips cut. That's a minority expectation. But a growing majority is expecting a stance change from neutral to accommodative as well. So it will be a rate cut plus something. The dovish signal could also come from a rather sharp cut in the GDP. The GDP's forecast as of February stood at 6.7. There is a consensus that it will be marked lower, but whether it will be marked down to some 6.3 or something, or whether the Reserve Bank will only say that there is a downside risk of 25 to 30 bips because of the global slowdown remains to be seen. But that will be seen as a dovish signal. And even more dovish signal would be if they cut the inflation forecast. Now stands at 4.2, but given the fact that, Chinese goods in particular, but all goods really not finding enough markets in the US, may slosh around in other parts of the world, and that will lead to a serious disinflation in Asia is a widespread expectation. So a 4% on inflation will be seen as a very dovish signal by the market. But the most important thing will be liquidity. The RBI is not expected to do anything because liquidity is a continuous action by the Reserve Bank. It has been divorced from the monetary policy day itself. But in the press conference, there will be questions on how the RBI sees liquidity. If it gives any reassurance that it will keep the liquidity surplus, that will be taken very positively by the banks, because until now the rate cut has not been passed on. There will be expectations to know whether the Reserve Bank will allow the rate cuts and will see the neutral rate at 5.5, which is what the market is expecting, which means, 4 rate cuts in this cycle. All that will be expectations in the press conference. We will have to wait and see how much the governor is willing to reveal.
Oh yes, Lata, and we'll watch out for that tomorrow. Thanks very much for joining in with that. Now, oil marketing companies could see a 9,000 crore rupee mop-up in the current fiscal year on the back of 50 rupees hike in cylinder prices. Now, this may help plug a fraction of the over 41,000 crore rupee loss that the OMCs incurred in FY25 because of LPG subsidies. Now, sources have told CNBC-TV18 that the Oil Ministry will seek a cabinet approval for 32,000 crore rupees as compensation to oil marketing companies on the losses that they incurred in the previous financial year. Sapna Das has picked up more on this and joins in with the latest. Sapna, take us through what your sources are telling you.
Well, we're given to understand from sources around 9,000 odd crores will be could be mopped up by the OMCs via this 50 rupees price hike on LPG cylinders in FY26. To an extent, this 9,000 crores LPG losses in FY26, which will not be the case now. This 9,000 crores will help them to plug those losses to an extent. The second aspect is that, because the Finance Ministry is not in favor of any direct fiscal support to the oil marketing companies, hence the government has taken this decision to raise the excise duty by 2 rupees each on petrol and diesel. The funds that will be mopped up via that hike, and that's estimated to be around 32,000 crores during the financial year. To an extent, that money will be given to OMCs to help them compensate for the LPG losses of over 41,000 crores that they have already footed in the financial year gone by. Of course, the Petroleum Ministry down the line will seek the cabinets not to make this happen. Last but not the least, everyone is keen, all stakeholders are keen that crude should remain around this benevolent range of around 61 to 65 odd dollars, because that will help improve the margins of OMCs. That will help them bear this 2 rupees hike on excise duties, and down the line that could also give some headroom in terms of a possible price cut on petrol and diesel prices.
Sapna, thanks very much for bringing us that story, but we had to take a short break on that note. Up next, India will limit market access to Chinese EV maker BYD, says Commerce Minister Piyush Goyal. Says India needs to be cautious about strategic investments and needs confidence that BYD will play by the rules. That and more on the other side of this short break. Welcome back. Now, Commerce Minister Piyush Goyal has said that India will limit market access to Chinese EV maker BYD. He added that India will need to be cautious about strategic investments and also needs confidence that BYD is going to play by the rules. Now, this comes at a time when Elon Musk's Tesla is actively looking to enter India. Take a look.
Well, we need to be convinced that they will work by the rules of the game, and several unfair practices which are gradually coming to light as more and more companies come to us with what's happening, the kind of dumping that's happening in steel, for example. I mean, as these practices come to light, we have to be cautious in whom we allow to invest in the country. We have to be cautious about our strategic interests, our security interests. So it's a mix of many issues before we are able to take that decision.
In more news, Ola Electric has told the Ministry of Road Transport and Highways that its February sales numbers included yet-to-be-launched vehicles as well as bookings. Now, CNBC-TV18 has seen a copy of the correspondence between Ola Electric and the Road Ministry, which indicated that Ola Electric's February sales numbers included 12,000 bookings for the Ola S1 third-generation scooter and the yet-to-be-launched Roadster bikes. Remember, the government had sent 3 notices to Ola Electric over discrepancies in their sales numbers before. And staying with the auto space then, the Delhi government has floated a draft of its electric vehicle policy. The current policy will be extended by 15 days after it expired on the 31st of March. Now, the policy proposes replacing the CNG-powered auto rickshaws with electric alternatives. It also recommended that no diesel, petrol or CNG three-wheeler registrations will be allowed from the 15th of August. Two-wheelers that are running on petrol, diesel and CNG will also not be allowed from the same date. Households that intend to purchase a third car will also be required to opt for an electric vehicle. Now, the government also plans to transition garbage collection vehicles to 100% electric fleet by the end of 2027. In international news that we're tracking for you today, Israeli forces have continued to bombard Gaza, killing at least 19 Palestinians since its pre-dawn attacks. U.S. President Donald Trump and Israeli Prime Minister Benjamin Netanyahu met at the White House. The two leaders discussed countries that would be amenable to taking Palestinians forcibly displaced from Gaza. Now, the Gaza government's media office has also issued a statement urging global support for Palestinian journalists. Now, this comes after Israel's deadly strike on a media tent early yesterday morning. The United States and Iran will hold talks in Oman this Saturday over a possible nuclear deal. President Trump made the announcement after meeting Israel's Prime Minister at the White House earlier.
We're having direct talks with Iran, and they've started. It'll go on Saturday. We have a very big meeting, and we'll see what can happen. And I think everybody agrees that doing a deal would be preferable to doing the obvious. And the obvious is not something that I want to be involved with, or frankly, that Israel wants to be involved with if they can avoid it. So we're going to see if we can avoid it. But it's getting to be very dangerous territory.
Well, for the first time in independent India, the Supreme Court has prescribed a 1-month time limit for governors to act on bills that have been passed by state legislatures. The apex court has slammed the Tamil Nadu governor for his reservations on 10 bills, calling it illegal and erroneous. Ashmit Kumar decodes the significance of this court order.
Well, a landmark judgment coming in from the highest court of the country, the Supreme Court spelling out for the first time in independent India a timeline for governors to act on bills that have been passed by the state assemblies. Now, bear in mind that this decision comes on the back of a number of applications that had been moved by opposition-ruled states, states such as Kerala, Tamil Nadu, Punjab. They've all, in various points in time, raised concerns about the governors sitting on bills indefinitely, not passing them, and basically bringing about a logjam in the entire legislative process. Now, through various points in time, the Supreme Court has expressed its displeasure, has frowned upon this practice by governors, but this is the first time that a strongly worded order has been passed, which for the very first time imposes timelines. So what are the timelines? Well, for the governor to give an assent, the governor has been granted with a time window of just 1 month. For the governor to make a decision for either sending the bill back to the legislature or for referring it to the president, a 3-month window has been granted to the governor. And in case that the bill gets reiterated by the Legislative Assembly, well, in that case, the governor has no option. The Supreme Court ruled that there is no room for discretion. Governor has to grant the assent, and the assent must come within no more than 1 month period. Now, all of this, of course, on the back of Tamil Nadu government's application, which had cited 10 bills that the governor had been sitting on and that had been blocking the entire legislative process. The Supreme Court has now held that in case of these 10 bills of the Tamil Nadu Assembly, they will deem to have been approved by the governor, even though the governor failed to act. So strong words there. The Supreme Court reminding that the governor needs to act within constitutional norms and that the governor needs to respect the will of the people coming through the Legislative Assembly.
All right, Ashmit, thanks very much for bringing us up to speed on that. On that note, we're going to wrap up this edition of Business 360. Thanks very much for watching. But stay with CNBC TV 18. More news and updates will continue right here after this short break.
The RBI MPC meets at a time when President Trump has sent many global markets crashing by announcing shockingly high tariffs on most countries. The world economy is staring at a sharp slowdown, and some Asian countries are even staring at a recession. Will this force the RBI MPC to be more dovish? Will it announce a 50 BPS cut or a smaller cut accompanied by a dovish stance? And how will that impact the economy and your finances? Watch the RBI monetary policy on CNBC-TV18, along with instant analysis from a host of policymakers, top bankers, and economists. The RBI monetary policy at these times.
For the Nifty right this time around, but there are some stocks that have made records, not necessarily in a good connotation, and we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries, and with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now yet the street remains bullish, and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1350 to as high as 1950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now in fact, since 2010 the stock has delivered negative annual returns only thrice, and two of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2080 rupees to as high as 3750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2,700 to 3,700 on the stock. Now HDFC Bank, positive returns every year since 2013, but
that the government is potentially going to see a bigger than expected devaluation of the yuan to help offset some of the problems that could happen with a bigger tariff hit. But you guys were talking about it a little bit in conversations that I've been having with both Chinese suppliers as well as U.S. suppliers. The fact that the tariff rate now could go, as you guys are talking about, 104%, possibly 120% when you count all of it all together. They were telling me that this is prohibitive to business. One Chinese supplier said that they're already looking for other markets, that they wouldn't be able to really sell to the U.S. market. And then one U.S. company whose source is in China said that once Trump had made that announcement about the potential for another 50% tariff, he actually froze all of his shipments out of China. Part of it is because he said that he's just confused about exactly what type of price he should slap on any of his products. And then, so he's worried about the uncertainty, but he's also, just worried about what this could mean for his sales. He said that he would be in a position where he'd be losing on every single item that he sells. And even though he said he looked at the U.S. to potentially supply there, or set up a supply chain there, he said that it's just not realistic at this moment. So you're potentially looking at paralysis.
Eunice, the idea of retaliation against U.S.-based corporations that have a lot of business there. We've seen an investigation of DuPont, I believe something else on alumina. Do we get a sense there may be more to come?
I mean, that's the signaling at this point, but in terms of exactly who might be the target, it's really unclear at this stage. One other thing that I wanted to bring up when you guys are talking about Scott Bessent, from the Chinese perspective, they do not see themselves as the ones with the losing hand, because as much as China, as the U.S. China is the one who's selling to the U.S., so it looks as though China is much more vulnerable. On the other hand, it also means that the U.S. needs a lot of stuff that the Chinese actually sell. And that would include pharmaceuticals and other important things. So the leverage actually goes both ways, and the Chinese understand that.
Yeah. Eunice, thank you. Great reporting as always. Eunice Yoon in Beijing for us. We're on track for, of course, a very strong open here. Let's give you another look at futures. We begin trading less than 13 minutes from now, and we've got a lot more squawk on the street straight ahead.
4 years are returns in single digits, yet no analyst on the street has a sell rating on HDFC Bank, with price targets ranging up to as high as 25.50. Now, FMCG is a sector that has disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3,400 rupees on the stock. Staying with consumption, Titan is set for its first negative calendar year after 2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here, with IndusInd Bank positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and is the 5th time in the last 7 years that the stock has had negative returns. Yet 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, our news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India.
Started with trading less than 10 minutes from now, of course, after significant declines for many of the major averages. Yesterday, of course, not the case. Certainly the NASDAQ was up. We've also got this from the president on Truth Social, talking about the South Koreans. They're on a plane. Things are looking good in terms of a potential negotiation around trade. And by the way, he says other things as well. We're going to have more on that, what other subjects perhaps may be covered in a potential negotiation there. But it is negotiations and the prospect for them that have the futures up sharply this morning. We'll be right back.
Ban in NCR region and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports.
The industry, and importantly, the consumer, everybody's wrestling with the uncertainty that's out there. We need some clarity and uncertainty.
All right, that was the CEO of Levi Strauss, Michelle Goss. She was a guest of yours on Mad Money last night, and I think that what she said goes for so many other CEOs. We've heard from so many, not necessarily publicly, but certainly we've been talking to them on the phone.
And she's sourcing 20 countries. She's trying to figure out what to do where. But what matters is they have tremendous organic growth. Management reiterated their earnings per share guidance of $1.20, $1.25. Our friend Matt Boss has a terrific piece out saying it's the early innings, upgrades to overweight. Don't forget they have a 3.8% yield, and denim is doing incredibly well. And you come in, the stock's at 10 times earnings. This is the kind of thing that I like. Stock that has just been crushed, where the fundamentals are actually improving. And there are enough out there that you just have to find them. So I like Levi Strauss very much.
Okay.
And look, I think that their direct-to-consumer initiative is very strong. And I think that there are things, David, like I think Ralph Lauren
does
got
she know
recommended.
yet, though, how they're going to be impacted?
No, but at this point, I think what you would say is, does it really matter at 13? They will struggle through. It's now at 15 since they had such a good quarter. I think a lot of situations, David, are where you just say, you know what, it doesn't matter. They're down so low. And there are a lot of stocks that are down 50%. Look at Broadcom, David.
Yeah, which announced a $10 billion buyback.
And by the way, just so you know, that has to be done by year end. Hawk 10, the key line was, and we're going to buy it by year end. That stock was down 38%, and it hit every quarter. So, I mean, there you go. Like, what was that doing down 38%? Well, because it's data center. The word about data center is...
Right, it's through December 31st of the end of the year.
No,
so
Hawk is serious guy.
It's not necessarily an accelerated, but it's kind of fast.
Right, and so there's one you can buy because it's underneath.
Yep.
It will always be there. We'll get a big sell-off tomorrow, say, because of China.
AVGO.
Can we go back just for a second to what Eunice said?
Sure.
I think it's interesting.
Sure.
I think that what's at the crux right here is that U.S. companies with power are saying, you know what, we're not paying. You've got all those orders that you made for us, all that stuff. It's going to sit on a dock. The hell with you. The Chinese say you can't find anybody who else can make it.
I know. I mean, when it comes to Apple, for example, and this has been reported by others as well, but I've heard they were finding as many 747s as they could to get iPhones out of China and some out of India as quickly as possible, right? You can fit 200,000 iPhones on a 747, is my understanding.
Okay, so that's not...
They're trying, what I've heard is they were trying to get 2 quarters worth of inventory out of their manufacturing bases into the U.S.
That's incredible.
Because, there's you've got this pull forward in demand.
Right.
We all talk about it. Price of your iPhone's going to go up. It's hard to imagine it won't.
But
buy it now.
Right now, no. If you go to T-Mobile,
Right
you're going to get a great deal.
Right now, no. And so that was the hope. I don't know if they reached that goal or not. I haven't heard specifically from Apple about this.
I don't either.
I was hearing about it from other parties, and it's been reported on as well. But 200,000 iPhones on a 747. And they're trying to fill up, or we're trying to fill up as many to get them here today.
Wow.
Got to get them here today.
Now, in Amazon's case, I think they can say, hey, guys, why don't you just send the empty ships to U.S.? And they're saying, listen, we've got other countries that want our stuff, but do that. Do they have other countries? We take everything from China. That's over.
The Chinese,
will the Europeans buy their stuff?
Well, I mean, when it comes to EVs, they obviously produce overproduce. They've got to create more domestic consumption in China, of course. Right? We know that.
That's what they have to create.
Yes. And
exactly.
Their domestic consumption is far below our own.
Very interesting.
They may well do that, but to your point, are there just going to be a lot of things that sit there and don't get sold?
And I think that's what we're going to hear. I think we're going to hear the Amazons and the Walmarts saying, you know what? We'd rather be out of stock. We'll be out of stock on Amazon Basics. We don't care.
So everything's going to look like a Soviet Safeway? What are we talking about?
The gums.
Not going to find anything on the shelves?
The great department stores that had nothing?
Yeah, nothing. And you'll like it. You'll get nothing and you'll like it. That's
what
Brezhnev used to say, right?
They pretend to pay.
Yeah. All right, let's quickly get to the president's latest post on his Truth Social owned platform. Talking about South Korea, tremendous and unsustainable surplus, tariff, shipbuilding, large-scale purchase of U.S. LNG, their joint venture. These are all the things we provide them, military payments, billions of dollars, tax the former president, and then goes on to say, we're trying to get something done that's even, and I'm paraphrasing, even bigger than just tariffs, one-stop shopping.
Well, they like Korea.
Yeah.
Yeah, because like Hyundai, remember, who makes the engines here? And who just assembles here? Hyundai is deeply committed to making the intellectual property in the United States. Versus Volkswagen, versus BMW. And by the way, Ford is always on the griddle for them.
Say that again.
They always accuse Ford. They always accuse GM as being on the griddle.
Right.
Not doing enough. Will you look at that, David?
Look at that.
Let's find out who's in red and figure out what we can do against them.
That's like a...
Wow.
It's very pretty. All right, the opening bell, you heard it. Looked into the real-time exchange, of course. An awful lot of green there. The FDNY doing the honors here at the New York Stock Exchange, New York's bravest, at the NASDAQ educational nonprofit working in support of, as you might imagine, education. All right, our market is soaring right now. We've got the S&P beginning the day up 3.3%. The NASDAQ's on 3.7%.
So, yesterday, 24 hours ago, versus today, what's different?
What is really different?
Yeah, I mean, today, why are we up big? And yesterday, this time, it was fraught and looking down 4%.
Because we're getting the sense that there will be deals made, is the best I could tell you.
Yeah,
but nothing has really changed in terms of...
Nothing's really changed. Sentiment has changed.
Correct.
And I want to know, David, were there a lot of hedge funds that were poorly positioned? What are you hearing about? We're feeling better now with private credit?
No. I mean, listen, by the way...
Okay.
That move in the 10-year is weird.
It sure is.
I'm going to keep coming back to it. I'm sure Sarah's going to want to talk about it.
Remember everybody yesterday was talking about, maybe housing recovery?
Yeah.
People are just pointing about any straw they can grasp.
Yes.
Any straw.
I mean, many believe that a lot of this is designed to get yields down, to get that, and we were below 4% briefly, but this is perhaps capital flows. I don't know. You think the Chinese are starting to sell our whatever they, our treasuries?
It's not a card game. It's a game of chicken.
And they obviously devalue their own currency.
But I think the Chinese could lose this one. I think these factories are poorly capitalized. I think that China itself doesn't have the horses when it comes to...
Did you read Tom Friedman yesterday in the Times talking about how much money they've spent and how the factories there, I guess he's been there a number of times recently.
Teetering.
AI, how they're using AI. He was very positive, Jim.
Well, I'm not.
I know, but you haven't been there.
No, I have not been.
You haven't gotten eyes on
No,
one of their
I've not been
factories.
there. That's absolutely true.
Maybe we should go.
I'm always game. I'd like to do our show from there. I know they like me personally.
Be like Nixon going to China. Maybe we can make it all happen.
Yes.
I think we should go to Shanghai with the show. You
Remember
think
what
the
Nixon
Chinese
said
would
to
have
Joe
us
and
come?
Lai after they visited that museum of all the little things?
It won't cost much. Don't worry
Remember
about
they had the little creatures, little sculptures that they had, the
Yeah.
Chinese, and as soon as they left the museum, Nixon said to Joe and Lai, I think we should check everybody's pockets. And Joe and Lai was incredibly appalled. Nixon made a joke. David, okay, so what's going up the cruise ships?
I want to, by the way, I do want to get to, and we will,
How about the cruise
Medicare,
ships?
because you've seen
What do you
some
got?
of the providers of Medicare Advantage going up.
Oh,
but
yeah, I mean, United
let's talk
Health is the
about that
best.
now if we can, because UNH, CVS, which owns Aetna, Humana, take a look at all of them. They're amongst the biggest gainers this morning. Elevance, there you see it. We got a much larger payment from CMS than was expected. The
Thank
rate
heavens.
increase for Medicare Advantage, yes, is going to be 5.06% compared with 2.23%.
It's a huge win for seniors. Huge win for seniors because Medicare Advantage, that's at the end of the year, you try to figure out what, during open season, you try to figure out who's got the most stars, who's doing the best, and who has the best plan. This means that everybody might have a great plan.
They had been
Very
negative.
positive.
The rate had been negative the last 2 years.
You can't
the
just
Biden
rely on
administration
Medicare.
had put up in its final days a 2.3% increase. But my understanding is, and they had a call on this yesterday at 5:30, CMS did, they looked at the actual data. They came up with what they believe is fair reimbursement. And so far, there is a lot of concern about Medicare, but this would indicate that seniors are being protected.
Huge win.
And
Yeah, but you're right. Doesn't this make people feel better? 2 weeks ago, people were saying, "Oh my God, he's going to impact Medicare. He's going to do something. Third rail, but he's going to do something." Yeah, he did something. He made it even better.
Yes. So yes, and CMS, what they're articulating is that there's going to be parity in reimbursement based on cost. Now, they said on a call with analysts and the like, I mentioned they had one late yesterday. Medicare, they said higher costs to more people getting inpatient hospital care. We talked about that.
Yep.
And outpatient drugs that are administered in physicians' offices. Apparently, one official also talked about synthetic skin products within the higher spending. Not sure what that means.
Dynamite.
But they've met the cost increases where they are, as opposed to, frankly, saying to the Aetnas, the Humanas, the Elevances, the UNHs of the world that you're going to have to actually lose more money here.
But remember,
and so you can see the reaction.
There were companies that had mispriced it. Remember, CVS. Had
correct.
Now, David, just as you said, I haven't been to China. You haven't been on Medicare.
No, not yet.
But, now, Medicare is kind of like it covers some, but you need medical advantage. You need medical advantage. And all you're looking for is the one that covers the most.
Right.
And it's really interesting because there'll be like, oh my God, what a steal. Aetna mispriced. I mean, you try to find it like you're going to Costco versus Walmart.
Oh, so you're changing plans
constantly. You constantly change plans.
I didn't even
because
know
when you go to the doctor, David, but first of all, most of the big doctors in New York, it's a question about whether they'll even take Medicare at all. But if you got one that does, you're looking for the one that has the best of these.
I have so many things to look forward to.
Oh, no,
I can't wait to play my
great.
Medicare
David,
Advantage.
It's fabulous.
Oh, that must be
Medicare
so
Advantage,
much fun.
They have the cards, though. Don't forget, they have the cards.
They got the cards?
We should just do a show about cards.
Without a doubt.
China doesn't have the cards. Korea's got the cards.
China, Mahjong was created in China.
Ukraine, no cards.
No cards.
None whatsoever.
Apparently Chinese soldiers, although I don't know. I don't want to say that. Zelensky apparently said it, but I don't know if that's true. All right, where do you want to go?
How about the Mag 7? The Mag 7 of the cards?
Yeah, sure. Tesla's up 5%. Apple is even up, despite what appear to be significant
Apple's down
challenges
8.
there.
There's 3 underweights of Apple today, and they are all saying get out now.
Yeah.
They're doing the get out now thing.
Nvidia is also up
Amazon,
6%.
some people feel Amazon has the cards.
Perhaps. All of these stocks obviously down. Apple amongst the Mag 7, other than Tesla, is one of the biggest losers, down some 25% this year.
Can we
Tesla
talk about,
regaining a bit of ground, but still down 40%
we should talk about
for the year.
drug stocks.
The what stocks?
The drug stocks.
Yeah, all right, go ahead. Talk.
Because, we've got someone at HHS who is I'm not really a big fan of a lot of different things.
No.
Obviously, fluoride. Oh, my God. Is he Dr. Strangelove?
Yeah.
Fluoride. I felt like Sterling Hayden this morning.
Yes.
But there was recognition of Eli Lilly, and that was the other day. They pulled the Medicare. David Ricks was just named CEO of the year. That would have mattered at some point. Now people just yawn, but it's a terrific honor. And I think that Eli Lilly, who caught an upgrade today, is really fabulous. Bristol Myers did not catch an upgrade to fight their incredible drug, Cobenfy, for schizophrenia. But, David, the battleground will be, as usual, Zepbound, GLP-1s.
Yep.
And I thought that was a very positive recommendation today. Wow, J&J is another one people like that's just gone down so much. But a lot of people just are very fearful of Robert Kennedy Jr.
Yeah, well, and it's not just about the existing drugs on the market and the big providers of them. I have some real questions as to whether there's going to be a lack of capital flowing to companies that are developing drugs.
Thank you for mentioning
because
that.
I've had an opportunity to talk to a couple of people I know who invest in early stage biotech, for example. Right. The resignation or firing of Peter Marks, who was the top vaccine official at the FDA, that was last week, a little over a week ago.
That was devastating to people.
Was devastating to a number of people who felt like he really was on top of the situation there. And I've had people say, I will not invest in a company that is developing drugs any longer. I will only invest in those that have them on the market already.
Terrible.
There could be a lack of capital available for a very important industry in this country as a result of what's going on at the FDA.
Yeah, David, you're right. I mean, a lot of what we think makes America great, we're the #1 in developing drugs.
Not to mention all the scientists who've lost their jobs at the NIH and things of that nature.
I know, and I think that we don't talk about it. The revolution is happening in Washington right now, which is very kind of Luddite-like and maybe anti-science is rather remarkable.
Right, we've been very focused on tariffs, but there is a lot of other things going on.
I think there are a lot of people I know say, why don't we mention that enough? Why don't we talk about the fact that they've stopped funding at Hopkins, they stopped funding at Harvard, and you have to have each of these different institutions come to the table, and then they go to the banks, right, David? They go to the banks. They're just rolling one institution after another.
And
there are people who feel that maybe these institutions, this is a Timothy Snyder view, great blogger, maybe the institutions are weaker than we thought. In his book on tyranny, he said all the institutions are weaker. They will all roll over to a dictator.
They have.
Roll over.
They have not fought back. There has been, and we've talked about this, even CEOs speaking out publicly against the tariffs in a significant way.
Right.
We've seen some here and there a bit, but nothing, not a full-throated condemnation, the way that, frankly, I know I'm hearing it. I assume you are as well when we're having private conversations.
Oh, private, these are people who are appalled, Democrat, Republican.
And for good reason.
Well,
if you're the CEO of a public company and you've got a duty to your shareholders, you're not going to do something that conceivably is going to damage your business. And this administration has shown it's not afraid to take action if they don't think you're a friend. So
I keep hearing McCarthyism, but we're not going to do a thing about it.
Yeah.
Because they don't think it is their job. It was their job under Joe Biden.
We've seen it with the law firms, of course. I've mentioned this many times.
How quickly
as they continue. By the way, there's more still settlements coming there.
We know that law firms turn out to be businesses. That's what we didn't know. We thought they were more than businesses.
Certainly the New York firms that are very much transactional
Colleges are
in nature.
business.
Yep.
How about business is business? When do the banks roll over?
You think they're going to come after the banks in some way?
Why not?
What would be the pound of flesh that they seek?
Did the banks help? Were they banking these right-wing organizations that backed Trump? Or did they say no to them? I think if they said no, then you're going to be, those banks are in trouble.
It's another question. Now,
over.
I do wonder when, I know Elon Musk, for example, there's been some reporting on this, is very much opposed to the tariff policy. Concern for Tesla's production here in the U.S., for example, is what I hear.
He has to be careful because a lot of the parts for a Tesla are imported.
I know, 35%, I believe, is the number. I want to make sure, but that's what I have continued to hear. I think.
Is he just a car salesman? Some people say he's just a car salesman.
Come on, man. I mean, he's a lot of things, but he's not just a car salesman.
Well, that's what some people are saying.
What, Musk?
Well, there are people who are saying that Musk should be a little more...
You're going with that? People are saying?
I'm trying to do my job without... I have to talk to people.
Just say it.
I have to talk to people.
What are you trying to say?
No, I'm just saying that we think that it's all made in America. We think a Ford is all made in America.
Yes.
We think a GM's all made in America. But there's a lot of intellectual property in these cars that are not made here.
Without a doubt. In fact, even the chip stuff, again, you think the chips get sent, they get put into components that come from other places.
Yes.
Back to our earlier conversation
Yes.
about the cost of servers going up, even if
Yes.
the cost of chips is not, because of tariffs, that's going to be the same.
Yes, and I think that we're going to see surcharge. Micron put a surcharge on this morning.
They did.
And yet their stock's up. So maybe people say, oh, Micron's passing it on. Maybe we can pass it on. Micron's stock didn't get hurt.
You know, Jim, you
Sanjay
followed obviously Micron closely.
Very closely.
Isn't memory kind of where we see it first in terms of the memory guys and the bottlenecks and the pullback?
You can go to Korea. You don't have to stick with
I'm
Micron.
just saying overall, if you, in terms of signs of a slowdown in overall demand,
you got to go there.
Memory guys.
Memory is the first to go.
First to go, right?
Yeah, because it's the shortest contracts.
Right.
And
by the way,
PCs
memory's in everything. It's in the data center too.
It's in the auto company. Well, they have high bandwidth memory, 20%. Sanjay Mehrotra. Sanjay is, I think, the most forward-looking about what can happen, because he's in a tug of war against Korea.
Yep.
And what happens if the Koreans continue to get... The White House likes Korea.
Well, apparently.
They're
hopeful.
They're making a deal.
Well, I wouldn't go that far.
Well, I think they will.
They're on a plane, is what the president said. I'm looking here. Well, they're on a plane.
All right, they're on a plane.
They haven't necessarily made a deal yet. Their top team.
Top team?
Top team.
The top team
is on a plane.
Okay, top
and
team.
Things are looking good.
Well, there you go.
That's what the president said.
The pressure on China will be unbelievable. David, Meta.
What about it?
27 points it's up. Now, but then you look at it, you say, oh, wait a second. Meta was at 740, now it's 540.
Yes.
Let's keep buying Meta.
Right.
And that's what's going on in people's heads. Down too much.
All right, Meta. I mean, advertising goes down. If we have a recession, so that was the.
But okay, so I would say at 500.
Right.
That has the advertising going down. This is priced in.
Cost of building their data centers goes up.
Priced because that cost comes down. That's the wrap.
Cost comes down. What cost comes down?
The data center cost.
We've just talked about how it's going up. What do you mean it's going down?
No, the components
go up.
No, the components, they may have to eat it. Everyone may have
Who's
to eat
eating what? What are you talking about?
Okay.
Eating it.
All right.
There's no eating here. They're going to spend $60 billion on CapEx. They're going to go to $66 billion, $70 billion?
No, they're going to say we don't need as many.
Is that going to slow down our development of AI in this country?
I think that there's a belief that it will. But
is that good or bad?
It's bad.
Okay, just ask.
No, it's great that we're like a second-tier country. But you like that?
Well, I don't know. You know I have mixed feelings about the development of AI, so maybe slowing it down wouldn't be the worst thing.
What we need is robots that make sandals.
We need robots.
Yeah, well, boy,
we're going to have a lot of robots.
By the way, I think the administration is deeply focused on the idea that robots will save us.
I know, but I thought the whole idea was to create jobs for people, not robots.
It's people and robots. That's what they're saying. People and robots.
Living in harmony together.
Yes, people and robots. Absolutely.
People and robots.
Yes, people and robots.
All right.
Hey, I'm just saying what they're saying.
All those robots working allow more people to go on trips. Let's get back to what you wanted to make the point right when we opened, which is the travel names, I guess.
Yeah, well, I just thought that it's once again, thank heavens, we've got the cruise lines back up again. I was worried about them. The banks, David, the banks. I thought they were supposed to be hurt. No, the banks aren't helping at all. We love the banks.
Banks are soaring this morning. Again, we seem to toggle back between recession fears to overtaking the market and slowdown fears.
Your takeaway, David, is that the market
we do have the 10-year up and the banks are up.
Did you hear Semblish yesterday from JP Morgan?
I didn't.
He said this is historically what happens. You go down as much as we have, and you should be a buyer because it tends 85% of the time you make money. And that is what's happening. 30,000 people in the speech yesterday. It was such a great call.
Jim, back to
Semblich's call was brilliant.
Right, but to the debate that I was outlining with the beginning of the show, that's still in force. We still don't know what deals will get done over what timeline and what this uncertainty will do in terms of decisions that are not being made or held off and demand that therefore gets depressed. We don't know the answer.
No, but Monday at 9:40, the answer was everything's going to fail. No deals. And now we're in a better... It's not paying loss, but we're certainly in a better place.
Right.
You're I detect you being a little bit happier, a little more exuberant.
Well, I'm
I
a little
expect
happier
a bounce in your
a
step,
little
man.
happier when we see the S&P up 3+%.
Oh, you like that?
Well, I'm not that far away from retirement myself there,
Well,
old
then
man.
you start looking at that.
You may never retire,
You start
but
looking at that Humana plan. It's going to be better this year.
I cannot wait to just sit back and review my Medicare Advantage plans every day.
Watch Centene making a turn for people who are like your kids.
Centene.
See, I don't know. Oh, your kids don't have.
No.
They're not in there yet.
No, my kids, they're still on my insurance.
Centene,
thankfully, for quite some
Centene's
time.
got good for Medicaid, but not obviously for people in their late 60s. They don't.
I'm not ever going to. I'm going to stay here as long as
Look
you
at
are.
Walmart.
You'll never retire.
I'm never going to retire.
Yeah.
Look at Walmart.
Look at Walmart.
Walmart is at the fulcrum of this. That's the key to this market.
All right, there it is.
Because the Chinese may blink and say, you know what? Walmart's too big. They go to President Xi and say, listen, we got to make a deal.
It's only up 1.8%, though.
Well, no, I'm saying they could be that. That could be the one, David.
All right, we mentioned the bond market a few times. Of course, the 10-year yield, it is notable this morning. We'll give you a quick bond report right now as well. And you can see, we fell below 4% on the 10-year yield a couple sessions ago, not even. And there we are now, up again, up across the board. Who's selling?
Who's selling?
Who's selling? We'll be right back.
Of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in, more components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output, right? We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over leveraging of customers to credit costs to asset quality pain, etc. So the biggest
well above the broader markets move right now. JP Morgan up some 5+%, cutting its losses for the year at only 6%. There you can see Goldman, Morgan Stanley, and Bank of America, which got hit, and always does when yields go down.
Stock's cheap, jeez, 36.
Wait, down, yeah, right.
like gold. I know, but trust owns it. It's been hurting me. Let's hope David pulls a rabbit out of a hat, okay? And not you. David's home.
Why does he need a rabbit?
Well, you just said there's no IPOs, no M&A.
Well, not right now, but they got a lot of other things going on there.
They have private equity in there.
Private equity, they got private credit, and we've got stop trading coming up next week, Jim.
Seen for Spanna Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, ex of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023, and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spanna Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equita Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, the underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spanna Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized, hence...
For retail investors, there are these stocks that have good yield and good fundamentals, and I think that J&J is one of those, and Goldman recommends it today, and I just urge people to take a look and say, you know what, that stock is down, not down all the way at the bottom, but it's very low, and maybe I should be a buyer.
What about the talc litigation, which we talked about last week?
I think the talc litigation, that was a very bad blow for them, that they were paying, say, 10. But I will tell you this, that if you just amortize how much they have to pay, even if it's 12, 15, or if you talk about them fighting, they haven't lost any suits since the Missouri.
We're talking about the fact that a group settlement got thrown out.
Right, but they have not lost suits since they lost to Missouri. Missouri was very bad, but Missouri is the worst jurisdiction in the world. I do think that they're going to come out okay on that.
You do?
Yeah, I absolutely do.
Because you were worried about it for quite some time. And by the way, rightly so. The stock didn't do much at all.
Yeah, and it's been the big drag.
Yeah.
But I am confident that they can fight each one. It'll cost money. But the plaintiffs should have. There's just only one plaintiff that's really holding out. So I like it.
All right. What do you got on the big show tonight?
Okay, David, I've got Rubrik, I've got CrowdStrike, and I've got Viking. And I've got to tell you, Viking and Torhagen. David, I'm going on a river cruise.
Are you?
Yeah, I want to. Carl Quintanilla, our partner, is on the board of Sag Harbor. Of the foundation that supports Sag Harbor Theater.
Yeah.
And there was an auction. And I looked at Carl, and people weren't buying it. I stuck my paddle up. It sold.
So you want a cruise?
I know I'm going.
Where are you headed?
Sag Harbor Cinema.
Where are you headed in the cruise? Do you know?
Bruges.
Bruges. In Bruges.
Yeah, well, it goes down. Like, I don't know. It was like, hey.
That was a good movie, by the way. Nobody wanted to be in Bruges, by the way.
Sold. I mean, like, I turned to my wife and said, look, where are we going here? She's just somewhere better than New York City. I said, okay.
Bruges.
Bruges.
All right. We got a lot of screen. We got a lot of green. We got a lot of screen for you.
Yeah, got a lot of screen. Look at those same red ones. What a bunch of losers.
I think that's beautiful. I don't
David,
know
I'm going to go.
I want to hang that up in my house.
I'm going to go see if I can get out of my
Yeah.
Medicare Advantage, go to another company.
That sounds great, Jim. Keep it right here.
Capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steelmakers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty, along with the onset of a seasonally good quarter, could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
Good Tuesday morning. I'm Sarah Eisen with David Faber and Mike Santoli today, live at Post 9, as always, from the New York Stock Exchange. Carl's on assignment. Stocks are rallying. The S&P is coming back. 3.6% rally we've got on our hands. Every sector is higher. And if you look at the groups leading, financials at the top of the pack, 4.5% gains. Industrials are up there. So a lot of these cyclical groups that got just battered, we're nowhere near to making up the losses that we've seen, but we are seeing a nice rally here that is broad-based. The small caps up 3%. Look at the NASDAQ. It's up 4% because tech was among the hardest hit in this sell-off over tariffs. Take a look at treasuries right now. Remember, the story has mostly been buying bonds with lower yields. That reversed yesterday and continues to reverse today. The 10-year yield higher at 4.25 around, let's call it. The 2-year yield above 3.8%. David.
Well, we've got some important testimony, at least possibly on Capitol Hill this hour. President Trump's chief trade negotiator, Jamieson Greer, is appearing before the Senate Finance Committee. This, of course, after the administration's decision to impose tariffs on pretty much every country in the world, and the Penguins, too. Don't forget them. We're going to bring you the headlines, of course, as they happen, and that'll be this hour. Sarah?
Yeah, the negotiations, though, I think, is what the market is cheering today. Yep. We're 30 minutes here into the trading session. Here are some movers we're watching in today's big rebound. Some green shoots for shares of American automakers, except for Stellantis. All of these stocks nearly 30% or more off their highs at this point of the year. Coming back strong. Look at Tesla, up 5%. Also seeing gains for some beaten down consumer names, especially in the cruise lines. Names like Carnival Cruise, up more than almost 7% right now. Apple shares coming off their worst three-day stretch since 2001 as big tech tries to catch a bid this morning. Nvidia leads the charge. That's good for the market. It's been a big market leader until it wasn't. And then unrelated to tariffs, Medicare insurers, some of the biggest gainers of the morning on news that the Trump administration will substantially increase payment rates next year. More on what that means for the group in just a moment. But guys, we are in the negotiation stage and the market is feeling better about that. I mean, let's just start with what we got in the last hour from President Trump himself on Truth Social. He was talking about just talking with South Korea, but this is the key quote because we've seen China, U.S. ramp up in terms of just this fight on tariffs. Here's what he said. China wants to make a deal badly, but they don't know how to get it started. We are waiting for their call. It will happen. I consider that an olive branch, honestly, after what's been going on. A little bit. I mean, at least like he's inviting them to make a call to make a deal. That's progress, I think, considering what we had before. Overnight, the news was all just heated rhetoric from China to Chinese Commerce Ministry after the threat of more tariffs on China. The U.S. threat to escalate tariffs on China is a grave mistake on top of an existing one, which will once again expose the U.S.'s blackmail nature. China will never accept this. If the U.S. insists on its own way, China will fight to the end. And Secretary Bessent this morning on Squawk Box said that China's making a mistake about how it's going about it. Listen.
I think it was a big mistake, this Chinese escalation, because they're playing with a pair of twos. Traditionally, if you look at the history of the trade negotiations, we are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Bessent is out more, and the market likes it. And Navarro and Lutnick, when they talk, not as friendly with the markets. We just got a tweet from Elon Musk, who's had this back and forth with Navarro.
Bessent talks more about the potential for deals. In the 9 o'clock hour, Sarah, I laid out sort of two versions because I'm hearing them from those who run fairly large funds. One is the one that the market seems to be responding to, that we're going to get deals, that is starting with Japan. Maybe it will be followed up by South Korea, and you will start to see this pace of so-called deal making that will result in lower tariffs for those countries, perhaps the 10% across the board, obviously, for everybody, but that is ultimately real progress and will settle down the uncertainty that is, I would say, quite heightened right now in corporate America. The other is that that's simply going to take too long, that you're going to have a trade war with China, and that the impact of that, even if it's felt more strongly in China, is not going to be insignificant here in the United States. And we're going to have a recession as a result of the pullback in demand and of people and or decision makers sitting on their hands for some period of time.
It is obviously a race against time on some level for that reason. Although I think the most bullish version of this, for example, with the president's post about South Korea, is if these countries can just sort of deliver something that can be used to declare some kind of victory. We don't know how substantive. We don't know if it's good. Nobody really thinks we can create the conditions under which we eliminate trade deficits all across the world with every country.
But you don't think
but
that
if
they
you can
think
move
that?
things in that direction.
You don't think they think that?
I think they have to say that's what you're doing.
I mean, I agree. Nobody believes it's
massive
possible.
unintended consequences that would result from that. But anyway,
I mean, look, I do think part of the story here, though, and there was that political piece about how Treasury Secretary Bessent flew to Florida to talk to Trump and tell him to negotiate. Scott Bessent knows the markets, and investors and CEOs calm down when he is front and center, and when they see stories like this and him on the air on CNBC talking about negotiations. When he tweeted yesterday about Japan, that when he put that on X, on Japan, that he is in charge of the negotiations, that was a change in sentiment. And, also this Musk-Navarro back and forth, Musk now being a little more vocal this morning on X. Navarro is truly a moron. What he says here is demonstrably false. Responding to some comments.
I've been reporting the last couple of days. Navarro said that Tesla is just an assembler of cars, not a manufacturer of cars, which is, of course, not true.
It's ridiculous. It's a ridiculous statement. And, I mean, Musk is right to call it out. I've been reporting the last couple of days. Obviously, unfortunately, I haven't spoken directly to Elon Musk, but what I have heard from those who do is that he is increasingly concerned about what tariffs will mean, even though, as he points out, he is making an awful lot of automobiles here in the United States. It's still, a fairly large percentage of the components for those come from other countries, and they will face tariffs, and that will hit margins, and that's a great concern to him, is my understanding. He's made that clear to the president, is my belief, and I think he's telling anybody else who will listen, and clearly at least becoming a little more forceful as well publicly.
Yeah, I think Eamon Javers has some more color from the White House on this brewing rivalry. Eamon.
Yeah, Sarah, that's right. This is a behind-the-scenes rivalry that's now exploding into public view between Elon Musk and Peter Navarro, two very different wings of the Trump administration internally. I do now have a reaction to all this from Caroline Leavitt, the White House press secretary. I just spoke to her a couple of moments ago. Her reaction to the statement from Elon Musk calling Peter Navarro truly a moron and dumber than a sack of bricks is, whatever. We are the most transparent administration in history, expressing our disagreements in public. So clearly, the attitude from the president and from the White House more broadly is, sort of a boys will be boys attitude here that you get from that particular statement from Caroline Leavitt, that these two people disagree. They're disagreeing in public, and the president is getting a range of views in terms of all the inputs as he considers where to go with this trade war, guys.
Yeah, I mean, look, to David's point, like Navarro took a shot at Musk on the air in response to a shot, I think, that was taken at him. One of them is a CEO that operates a business that does a lot of business in China and around the world, and the other is a hawk on trade. So I think it represents, how a lot of CEOs are feeling what Musk is channeling.
And the question is, from Trump's perspective, is which of these two people does Donald Trump trust more? Is going to be a longer-term player in the Trump orbit, has been a longer-term player in the Trump orbit. And I would just point out to you that Peter Navarro literally went to jail last year to politically protect Donald Trump. Elon Musk hasn't done that. Elon Musk has been here for a couple of months. He's been very close to the president over those couple of months. But the Navarro relationship with Trump is longer standing and more deeply loyal than the Elon Musk relationship with Trump is, even though the Elon Musk relationship has been so dramatically public over the past couple of months, and we've seen all these pictures of Elon and the president together. That is a relatively new relationship. So if you're Donald Trump, who do you listen to more intently there? Is it Musk or is it Navarro? Of course, Trump has enormous respect for Musk, his history of building companies, and his wealth as well.
And his wealth and the money that has obviously been contributed to both support his campaign and other Republicans around the country as well.
Yes.
Eamon, everybody I have spoken to, again, close to Musk indicates that when you see the two together, you really, not many get to fly on the helicopter to Air Force One, but Musk does. I don't know if you've heard the same, but they, because you're always looking for that. I've been asking, well, aren't they going to at some point end up fighting with each other? And the answer has been uniformly no, not if you see them together. So I'd be very curious as well. Eamon's point is a good one in terms of if there is somebody to side with, which way do you go here?
But it all is happening, of course, Eamon, at the same time, as we've been saying, where it seems as if the Navarro hardline camp is maybe in a little bit of retreat or sideline for the moment. And, yesterday he had an op-ed says no negotiations, and by the end of the day, all we're talking about is negotiations.
Yeah, exactly. And the White House saying, well, at the time Navarro wrote that statement, that was the operating principle here at the White House, and maybe that's shifted a little bit. Clearly, over the past, I would say, 12, not quite 24 hours, the Navarro wing has been a little bit in retreat here at the White House. Navarro on CNBC yesterday morning saying, this is not a negotiation, laying out a vision of tariffs as more of a permanent economic state of affairs. Then you had Bessent, the Treasury Secretary, putting out this statement that he was negotiating with the Chinese at the president's direction, indicating that it very much is a negotiation. And the president sort of waffling on all this in the Oval Office. office saying, you know what, it can be both. It can be both a negotiation and a permanent state of affairs. And so I think this goes back to, this discussion last week in the market of, whether or not April 2nd would be a clearing event for the markets and we would now get certainty. Clearly this is going to be an ongoing process. There are going to be negotiations. There are going to be levers pulled by this White House. Things are going to fluctuate up and down, and that will, my guess is, just my analysis and nothing more than that, is that will last throughout the president's term, because the president likes tariffs. He likes the unilateral control. He likes the ability of the tariffs to force countries and companies to come to the Oval Office and offer him deals. You heard Scott Bessent talking about, we'll see what these other countries have to offer. The president sees that as him being in the driver's seat economically and then being able to carve out a deal in each case that's best for American workers. And they're very much focused here on workers, not on markets.
Well, they are being transparent, even when they're fighting, to Levitt's point. That's happening. More palace intrigue, I guess. Thank you, Eamon Javers.
You bet.
Guys, I know that the market is in a good mood now because of the negotiations happening, but there's no negotiations happening with China at this point, even with the president's post on Truth Social this morning. And I do want to talk about something that is sort of the... when I see rhetoric like China will fight to the end.
I wanted you to talk about this. I said to Jim, Sarah's going to tell me what's going on
so
here.
Here's what I want to show you.
Why are yields up, Sarah?
China will fight to the end. Here's what we don't want the end to be. So here are the foreign holders of our debt. This is who finances our deficits. This is who owns our treasuries. Japan is the #1 foreign holder, more than $1 trillion. China has almost $700 billion worth of U.S. treasuries. Now, that's come down a lot. Fine. That, we do not want that weaponized. Now, foreigners hold overall about 1/3 of U.S. government bonds, right? So there's a lot held domestically.
Well, the Fed has a lot, right?
Fed has a lot, banks have a lot. So the nuclear option is that China chooses to weaponize treasuries, and then we get into questions about the U.S. dollar. There's not indication, and that would hurt them as well.
Of course.
However, fight to the end. I just want to be aware of this risk.
They've never owned a smaller percentage of our debt than right now.
I said they've been shrinking it.
It's like 2 to 3%.
Right.
I mean, it was a time when it was actually.
By the way, isn't it possible that a lot of other places are selling as well? Aren't capital flows?
Canada's
yesterday capital flows were not coming here; they were going away.
That's very true, and I also think that there's some just general liquidation of certain strategies going on. You don't have to get into it, but basically there's an unwind of some trades where you be long the treasuries and short something else, short the futures.
So you don't think it's necessarily a reflection of diminishing credibility or concern?
Everything is in
rising concern?
Everything's in the pile.
I think it's not a 0% probability anymore when you have a war against and so far it's just been a trade war, right? We're talking about goods and deficits, trade deficits.
Declared war on 60 countries.
We do not want a capital war, is what I'm saying, and that is not a 0% risk. I just want to show one other chart which shows what is at stake here, and that is foreign direct investment into the United States. It has risen both in trillions of dollars and also in share of GDP. The U.S. has been a great story for foreign direct investment, and this was what President Trump has been seeing. I mean, the soft banks of the world, the Middle Eastern countries, that all wanting to pour money into it. If we have a global recession where he's picked a fight with all countries that are friend and foe, and the U.S. is no longer considered the exceptional place for assets and capital, then that is just something else that's at risk. Again, none of this happening, not fear-mongering, but I'm just saying that there are other things to consider when it comes to U.S. dependence and reliance and benefit from foreign money.
Absolutely. Disengagement has its cost, for sure. All right, a big rebound for stocks today, despite big declines this month. Our next guest is maintaining his 12-month target for the S&P 500 on 65.85. It's a pretty good run from here if we get it. Sam Stovall, Chief Investment Strategist, CFRA Research, joins us now. Sam, it's great to have you on. I'd love for you to help contextualize this, just in terms of the tactical moment we are in. There's some signs yesterday, overnight Sunday into yesterday, we might have gotten a really big selling crescendo, massive volumes, massive number of new lows. And then today, we have a very, very broad snapback rally. These happen in these highly torqued markets. But where does that bring us in your view?
Hey, Michael, good to talk to you again. Well, I think we really did see, as you said, that crescendo of selling that took place last week and in the beginning of trading activity yesterday, especially the range, the high and the low yesterday does basically indicate that we're probably close to at least a near-term bottom. I think we probably have to go up to about the 5,400 level on the S&P, which would represent the September retest of 2024. So now that becomes resistance. But I think overall, right now, investors are anticipating that negotiations are taking place behind the scenes and that there will be some sort of concessions from our trading partners.
The range of possibilities when we get one of these very, very steep declines, 15+%, we got intraday below the 20% line, whatever we're going to call it, there's the possibility, and the hopeful one, is that this is sort of a 1998 or a 2011 where the broader trend is fine, we don't have a recession right ahead of us, and it's much more about kind of a financial market dislocation or a shock, and we can move on from there. And then you have, recession related, and a lot of the markets are trying to maneuver in a direction that says maybe we have to raise our odds of recession. How do those things play out? What would you be looking for to have us know which one we're in for?
Well, I think you're right that the odds of recession have risen. Ours is now at 40%. We contract Action Economics for our economic projections. And speaking with Mike England this morning, basically are looking at the fact that the NBER, the final arbiter of recessions, would probably not say that it started in the first quarter of 2025 because there was an awful lot of purchases that took place in Q1 to try to get ahead of the Liberation Day in early April. So Q1 GDP probably will not end up being negative, and that we probably might see some softness in Q2. But the NBER would probably look at the old Arthur Okun adage of 2 successive quarters of GDP decline equal a recession. So they probably wouldn't be indicating such until the second or third quarter of this year. So the possibility of recession is out there. But when people started asking me, gee, how far would we have to fall to get to the median trailing 12-month gap PE ahead of recession since World War II, that indicated to me that they were looking for worst-case scenarios, which I thought was a sign of extreme lack of confidence.
No, there's no doubt about it that the mood has changed and therefore positioning and sentiment. But, just for our own sake, where would we have to fall to? What is that median PE that we would typically see at that moment?
Well, it would be about 16.5, which would be a 45% decline from the February 19th high, which certainly would put us into the range of the 1973 to 75 bear market, 2000 to 2002 bear market. So those would be what I call mega meltdowns, which typically take 4 to 5 years to get back to break even.
Right. Yeah. All right. So we know what we don't prefer to see, but appreciate you laying out the spectrum for us, Sam. Thank you.
My pleasure.
The shots from Elon Musk towards Peter Navarro continue. You can see the latest on your screen there.
He got a nickname.
He, Mr. Musk can get rather childlike occasionally and is certainly no stranger to launching any barrage of insults that he cares to. And there's the latest, calling him Peter Retardo.
Instead of Navarro.
Correct.
Yes. Okay, as we head to break, here's our roadmap for the rest of the hour. Crude oil prices hovering at fresh lows, but holding above $60 a barrel. Can the losses continue?
Plus, health insurers rallying big. We'll tell you what's behind that move.
And President Trump's chief trade negotiator, Jamieson Greer, he's in the hot seat. He's before the Senate Finance Committee this morning. He's fielding questions, of course, about the big tariff plan. We're going to bring you the headlines as they happen. A lot more ahead for you on Squawk on the Street. Don't go anywhere.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Upadhyay, and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards?
The key. Humana, as you see, up some 12+%. Bertha Coombs, of course, tracks all of this for us and can tell us exactly what is behind these moves this morning. Bertha.
Well, David, it was basically a surprise move. Medicare Advantage insurers getting a bigger than expected rate increase for 2026. The Centers for Medicare and Medicaid setting the new rate increase at just over 5%. It's more than double that the initial 2.25% rate increase that had been proposed by the Biden administration. Now, Humana, as you mentioned, seeing its best percentage gain in 5 years, among the biggest gainers today. The Medicare insurer has faced some of the biggest cost pressures over the last couple of years as the Biden administration had set lower rate increases, and we saw patients rack up higher than expected medical costs. Now, CMS boosted the rates after taking a look at full data for 2024, calculating a 9% increase in medical costs in Medicare, while the agency says it will still look to crack down on billing overpayments and other things like that. After 3 years of regulatory and rate pressures, this is a big tailwind for Medicare Advantage players, which will amount to about a $25 billion increase in payments, more so than anticipated in 2026. Now, analysts at Stephens raising price targets on the entire group as a result. United Health leading the Dow today, seeing its biggest move since November of 2020. Cantor analyst Sarah James notes that, the final notice was actually more positive than expected, given the incoming CMS administrator, Dr. Mehmet Oz's unexpected criticism of the program at his confirmation hearing. Oz was confirmed just last week as CMS administrator, and he has been a long-time overall supporter of the Medicare Advantage plan. So this was one of those things that people weren't sure whether they'd get this big a boost.
Yeah, Bertha, on the call, I believe that they had, at least with some people in the investment community and others late yesterday, they talked about, or the administrator talked about, parity and balance. Does that make sense to you based on what you know in terms of the increased costs for these insurers?
A little bit. They have been facing higher costs. So the likes of Humana was seeing 90% of their premiums, over 90% of their premiums going out. And normally it's in a range of about 85%. And, as we look out, David, later this year, those hip replacements, knee replacements and things like that, medical devices, they are likely to cost more because of tariffs. So that could well pose a bit of a headwind in terms of costs as we look out further into the year. So I think they were taking that into consideration.
Bertha, thank you. Bertha Coombs back at, of course, our headquarters. Oil prices, if you haven't followed them this morning, they're rebounding a bit. This after, of course, what has been a significant decline so far this month, coming off one of the lowest levels we've seen since August of 2021. Joining us now to discuss where, all sorts of things go from here is RBC Capital Markets, Halima Croft. Halima, great to see you, of course. Always good to have you here. What do you think of this move? Does it make sense?
I mean, I think the oil market is taking a bit of a breather. I mean, it's been hit by two stories. Obviously, the big one is a concern about recession and, what's going to happen in the all-important demand center of China. But also, OPEC announced last week, surprisingly, they would bring on more production in May. So people were saying, wow, we have a recession potentially looming and more OPEC supply. It was a toxic cocktail. But I think for now, people are waiting to see, is there a potential off-ramp to this trade dispute? And OPEC will be meeting on May 5 to assess what's happening in terms of compliance in the organization.
Yeah. Now, the president has long called for crude prices to be actually even lower than here.
$50 has been his price target.
And we have not really heard much full-throated opposition to that from people who actually work the shale in our Saudi Arabia, so to speak, in the Permian.
Which is so interesting because take a step back 5 years ago when we had the Russia-Saudi price war. And these same shale executives, it was basically hotline diplomacy to the White House saying, look, $30, $40 is going to kill American energy dominance. You need to get the Russians and Saudis back together. And President Trump, the ardent OPEC critic.
Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest-running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Hello and welcome to India Business Hour. I'm Arundhati Ramanan and here are the top headlines that we're tracking for you this evening. Battered global markets bounce back, but investors remain nervous amid tariff tensions. Wall Street opened sharply higher. European markets also recover. Japanese stocks rise 6%, leading a rally across Asia. Positive global cues lift Dalal Street. Sensex gains over 1,000 points. Nifty reclaims 22,500. Stocks add more than 7 lakh crore rupees in market capitalization today. US President Donald Trump says China wants to make a deal badly and he is waiting for a call. This after Beijing accused the US of blackmail after Trump threatened an additional 50% tariff on China. Trump also says he had a great call with South Korean president. The RBI Monetary Policy Committee is expected to cut the repo rate by 25 basis points tomorrow. Street expects RBI to strike a dovish tone as tariffs could be treated as an additional headwind for financial markets. Tariff wars have interrupted the global supply chain and changing the current model for cross-border trade, says Tata Sons chairman N. Chandrasekaran. He does not expect tariffs to get reversed to zero, but also adds big changes to supply chains cannot happen overnight. India will limit market access to Chinese EV maker BYD. Commerce Minister Piyush Goyal says India will need to be cautious about strategic investments and needs confidence that BYD will play by the rules. This comes at a time when Elon Musk's Tesla is actively looking to enter India. Ola Electric includes yet-to-be-launched vehicles in its February sales numbers. Road Transport Ministry has already sent 3 letters to Ola over discrepancies. Ola claims that sales numbers are based on paid and confirmed orders, not preliminary bookings. SpiceJet shares down 20% this year amid concerns over its revival. Airline curtails its summer schedule as fleet shrinks. SpiceJet says it will ramp up the flight schedule as more planes join the fleet. For the first time, an independent India Supreme Court prescribes a 1-month time limit for governors to act on bills passed by state legislatures, slams the Tamil Nadu governor for his reservations on 10 bills, calling it illegal and erroneous. Top court invokes its power to declare the 10 pending bills are actively approved. Ukraine claims to have captured 2 Chinese soldiers fighting for Russia. President Zelensky says more Chinese soldiers have been deployed in regions occupied by Russia and calls for the U.S. to intervene. United States and Iran will hold talks in Oman this Saturday over a possible nuclear deal. President Trump makes the announcement after meeting Israel's Prime Minister Benjamin Netanyahu at the White House. Those were the headlines that we're tracking for you this evening. But in market action, bears took a breather at the stock markets after a manic Monday. But this specter of Trump and tariff loomed large on global equities. First to United States, where the benchmark Dow Jones rallied in opening trade, surging close to 1,300 points. The renewed optimism could be attributed to signals that the White House could strike deals with some large economies soon. And here's what added to Wall Street's optimism. U.S. President Donald Trump has claimed that China wants to make a deal. In a post on Truth Social, Trump said that China doesn't know how to get the talk started, but insisted that negotiations will happen. Trump's post on Truth Social came hours after China vowed to retaliate against Trump's threat that he would impose an additional 50% duty if Beijing does not withdraw the 34% tariffs it imposed on American products last week. China's Commerce Ministry said that it will take countermeasures to safeguard its own rights and interests. Meanwhile, South Korea has begun negotiations with the United States. South Korea's acting president spoke with U.S. President Donald Trump over the phone. Trump said that the conversation focused on Korea's trade surplus with the U.S. and payment for military protection provided by the USA. The European Union may also be ready for negotiations with the USA. The bloc has signaled at offering a 0-for-0 tariff deal with the United States. Here's a comprehensive report on economy's response to Trump's tariffs.
Talking to China, we'll be talking.
U.S. President Donald Trump has given China 1 day to end the 34% retaliatory tariffs it imposed on U.S. products last week, or he'd slap an extra 50% duty on imports from China. It's an escalation in a trade war that has sent global markets into a downward spiral and stoked fears a recession is around the corner. Trump gave his ultimatum to China at the White House on Monday.
If that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on. So they've gone for years. They've become a rich country because of people, again, that were in the White House that allowed this to happen. Hundreds of billions of dollars a year they'd make on us on trade, and it shouldn't be that way.
We were having a discussion last night about which countries to prioritize. And I think you are going to see some very large countries with large trade deficits come forward very quickly. I think we can, if they come to the table with solid proposals, I think we can end up with some good deals.
Trump's long-promised round of global retaliatory tariffs were announced last week, with some rates as high as 50%. He has said they will help the U.S. recapture an industrial base that has withered over decades of trade liberalization. On Monday, administration officials said dozens of countries had reached out to Washington in hopes of heading off the tariffs before they take effect Wednesday. However, Trump said he has no plans to suspend tariffs during negotiations.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
Beijing has responded with anger to Trump's latest threat. The Chinese Commerce Ministry said Tuesday China will never accept the blackmail nature of the United States and said U.S. threats were a mistake on top of a mistake. Trump said Monday his administration would open trade talks with Japan, one of Washington's closest allies in Asia. Meanwhile, the EU has proposed counter tariffs of 25% on a list of U.S. goods over Trump's earlier steel and aluminium tariffs, according to a document seen by Reuters. EU Trade Chief Maroš Šefčovič said Monday they're ready to negotiate a zero-for-zero deal with the Trump administration.
While the EU remains open to and strongly prefers negotiations, we will not wait endlessly.
The 27-member EU bloc is struggling with tariffs already in place on autos and metals. It also faces a 20% tariff on other products on Wednesday. And Trump has threatened to slap tariffs on alcoholic drinks from the EU. Investors and political leaders are still trying to figure out if Trump's tariffs are permanent or a pressure tactic to win concessions from other countries. And many investors are now betting that the growing risk of recession could prompt the U.S. Federal Reserve to cut rates as early as next month. Fed Chair Jerome Powell has so far indicated he is in no rush.
Meanwhile, equity markets across Europe and Asia gained in trade today. European markets recovered after a 4-day losing spree. The pan-continental stock 600 ended the day with gains of 4%. The British FTSE, the German DAX and the French CAC all closing the day with gains of over 3%. Markets across Asia rebounded as well following their worst drop in decades, triggered by USA's tariff policy. Japan's Nikkei closed 6% higher, recovering from the 1.5-year low hit in the previous session. Back home, positive global cues lifted Dalal Street. The Sensex gained over 1,000 points, while the Nifty reclaimed the 22,500 mark. Stocks added more than 7 lakh crore rupees in market capitalization today, recouping 50% of what they lost yesterday. Prashant Nair joins us now with more on the Dalal Street recovery. Prashant?
Well, overnight we saw much better markets, absolutely flat closes in the US. And today we got a recovery, a bounce of our own. And I think, once the data is out, we'll get to know how much of this was covering and what did flow numbers, etc. look like. But it was a good one. I mean, at the high point, the Nifty was almost 500 plus points in the green. But of course, we came off the highs of the day and the change was up on your screen. The Nifty Bank as well, a decent bounce. By the way, the Nifty is got to almost its very short-term hourly moving average and then kind of sold off from there. So, we'll have to wait and see if we've kind of completed a bounce, so there is more here. And something similar happened for the Nifty as well, with it getting to almost within 50 points of an important retracement. Mid-cap and small-cap indices, 2.5% each is what we saw on both these. Now, on the Nifty, there was pretty much everything which was higher. So I'll start with what was up the most. Geo Financial Services, top of the list. Shriram Finance was up in a strong way. BEL, Cipla, Eicher, Grasim and Titan were some of the other names. Just like on the way down, it was very difficult to point out XYZ reason. It was a broad-based sell-off. The bounce also something similar. So we're not really going down into specific reasons for why this or that stock were doing what they were doing. In the broader space, of course, what was the action like? Vijaya was the big gainer in terms of volumes as well. 5-star, again, NBFC name, Keynes, PG Electroplast from the EMS space, Chola Holdings, OneSource Pharma, Capacite Infrastructure. There was a name like Tangamail and Sequent Scientific were some of the other big volume-led gainers that we had. It's not a hugely market breadth was very positive, but not backed by a huge amount of volume-led gains. I have to point that out. On the downside, Siemens was a loser. Delivery lost quite a bit in volumes. IGL, of course, that news came through in terms of Delhi. Castrol, Welspun Corp and 361 were some of the others which came off on the back of sharp volumes. I mean, this remains a market where headlines are going to be closely watched with regards to tariffs and the negotiations, give and take, etc. So far, we've not heard anything from the Trump side which suggests they want to dilute or are looking for easy wins. But that's essentially front and center for markets. Back to you.
Right, Prashant. Many thanks for those details. Now, the World Economic Forum President Borge Brende has said that the world does not have the ammunition to fight a new recession. Speaking at the Rising Bharat Summit, Brende told Shireen Bhan that his appeal to all the nations is to continue trading since disintegration of trade will hurt the global economy. Take a look.
Disintegration of global trade will lead to contraction of the global economy. And the least thing we need now is a recession, because there is no ammunition to fight a new recession, because the countries are more indebted now than since at any other time since 1945. So let's hope that we'll continue to trade. The trade might be looking different or some adjustments, but let's not lose the baby with the bathwater. That would be my last appeal.
Tata Sons chairman N. Chandrasekaran has said that tariff wars have interrupted the global supply chain and changed the current model for cross-border trade. He added that he does not expect tariffs to get reversed to zero. However, he added that big changes to supply chains cannot happen overnight.
If whole world had operated with tariffs between countries all the time, then the whole supply chain would not have got globally integrated. So what is the problem? The problem is the global supply chain has got integrated. So very aptly, globalization, basically you produced where it is cheap or where it is efficient, and you sold where there is a demand. So that's a byproduct of the model that the world got used to for so long. Now if you change the model, the underlying supply chain infrastructure has to change. That can't change overnight, because there is talent issue, there is raw material issue, there is sourcing issue, there's so many things. So that is going to be the fundamental problem. So I think it will play out. It's not going to get overnight solved. So it's not going back. I personally believe it's not going to go back to zero, because once something is announced, some part of it will stay. So where it settles, whether it settles uniformly across countries or it all gets solved bilaterally only, time will tell.
On to all the action from the commodity markets. Oil prices remain steady, with U.S. crude futures hovering around the $60 mark. This comes after a massive sell-off in recent sessions, triggered by concerns that U.S. tariffs might depress demand. Meanwhile, gold prices rebounded from the near 4-week low it reached in the previous session. This is heightened concerns over the global trade war lifted investor appetite for safe haven assets. The crypto markets also rebounded marginally after joining the global market sell-off. Bitcoin experienced heightened volatility, dropping below the $75,000 mark before recovering to $79,000. This resulted in nearly $1 billion worth of liquidations, primarily from long positions. And in the forex markets, the Chinese yuan weakened against the US dollar. Many currency traders believe China is allowing the yuan to depreciate to offset some of the impact of the tariffs on its exports. The Indian rupee also weakened by over 40 paise against the dollar today, plummeting to a 3-week low. Bond prices continue to gain on safe haven bets as yields continue to decline. Lata Venkatesh is here with a wrap on the currency markets. Lata?
Yes, the rupee fell by about 60 paise yesterday, that's on Monday, from 83.23 to 83.83, and today it's fallen by a further nearly 50 paise to about 86.27 at close. The importance is not that the rupee fell, but the important point is that the yuan fell and the rupee is falling in step. The PBOC, the People's Bank of China, has actually fixed the yuan at the lowest point since September 2023. It's actually only a small fall from 7.19 to about 7.20 per dollar. But that's a signal to the market that the PBOC is willing to allow the yuan depreciation, probably to overcome the disadvantage of higher tariffs that's being imposed on China. So in the trading market, the yuan fell even more sharply from 7.3 to the dollar to 7.33 to the dollar. All Asian currencies, almost all, fell in sync. The Korean won, the Thai baht, the Malaysian ringgit, all of them fell. the rupee fell the sharpest by almost 0.5%. A little surprising because the stock markets ended positively. Dealers said that there was pressure of dollar buying from importers and probably some foreign funds also. But the notable reason why the rupee depreciated was because the RBI did not stand in the way, and probably the RBI did not stand in the way because it wanted to let the rupee fall in sync with the yuan.
All right, Lata, thank you so much for those details. Now, the RBI Monetary Policy Committee is expected to cut the repo rate by 25 basis points tomorrow. The street expects RBI to strike a dovish tone as tariffs could be treated as an additional headwind for the financial markets. Ritu Singh is standing by with more details. Ritu, take us through the key expectations.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC-TV18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC-TV18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs. But for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
All right, Ritu, many thanks for those details. And in international news, Israeli forces have continued to bombard Gaza, killing at least 19 Palestinians since its pre-dawn attacks. U.S. President Donald Trump and Israeli Prime Minister Benjamin Netanyahu met at the White House. The two leaders discussed countries that would be amenable to taking Palestinians forcibly displaced from Gaza. Gaza's government media office has issued a statement urging global support for Palestinian journalists. This comes after Israel's deadly strike on a media tent early yesterday morning. Let's go across to the Rising Bharat Summit, where Prime Minister Modi is speaking.
Take their places. This document would not have been possible without their hard efforts. So we have luminaries like the director of IIT Madras, Professor Kamakuti, also part of, there are organizations like TD who are doing some phenomenal work, those who have brought up the Kalki bioculture. They've all worked together to solve for Bharat with respect to air pollution, waste management, with respect to cleaning up our rivers, education for all, and also decongesting our streets, traffic. May I request a huge round of applause? They all have done some phenomenal work. We've put together this document using technology tools. The reports are all QR coded. We've tried to bring it to life, the Samadhan document that solves for Bharat. Thank you. धन्यवाद प्रधानमंत्री जी. आपने जो 2 पल इनको दिए हैं, it's going to be a huge motivation. Thank you so much to all our participants. I'm going to request you to kindly make your way off the stage. Big round of applause for them and for their work. And I'm going to request Shri Rahul Joshi to deliver the welcome note.
Honorable Prime Minister Shri Narendra Modi ji, distinguished guests, ladies and gentlemen. I had the privilege of on the sidelines listening to the Prime Minister talk to the students. He's very appreciative of the effort but wants to know more. So he's given them a further task of telling them the process that they followed, the experiences that they have had, and that they should come back with more details to him shortly. And the students have promised to do that. Thank you, sir. Sir, as I stand here to welcome you today, I recall my many interactions with you over the past 2 decades, both as Gujarat CM and as Prime Minister. Some of us in media have had the privilege of seeing the different shades of the man who saw tomorrow. Modi, the reformer. Modi, the iconoclast. Modi, the modernizer. Modi, the culture czar. Modi, the messiah of the poor. Modi for Beti Bachao, Beti Padhao. And not the least, Modi, the unshakable, irrepressible youth icon. I recall the frenzy of the 2014 elections and the Modi wave that swept this country. In my election travels to the cities and villages of Uttar Pradesh, a state where BJP held no great sway back in 2014, I could only hear chants of Modi, Modi, Modi. Young kids zipped across towns in motorcycles shouting, Har Har Modi, Ghar Ghar Modi. Prime Minister, leading this wave and riding the storm were the youth of India who saw in Narendra Modi, the transformational leader, their role model. They saw in your eyes determination that gave them hope. They heard in your voice steely resolve of a brighter future and the war cry, na khaunga, na khane dunga. Sir, you have often quoted Swami Vivekananda and his belief in the power of youth. Very recently you said, स्वामी जी कहा करते थे कि उन्हें युवा पीढ़ी पर विश्वास था, नई पीढ़ी पर विश्वास था। जैसे विवेकानंद जी को आप पर विश्वास था, मुझे विवेकानंद जी पर विश्वास है। उन्होंने जो कुछ भी सोचा और कहा है, भारत के युवाओं पर मेरा अंधविश्वास है। He does not have faith in the youth, he has blind faith in them. Which is why the theme of this year's Rising Bharat is Youthful Aspirations. After all, Prime Minister, you have stoked the fire in the startup world to deliver the maximum number of unicorns in India, next only to the US and China. You've ignited the aspirations of the engineers and the technologists to write a new chapter for India in the production of semiconductors and in the development of AI. You've shown the way to a younger crop of politicians who are now cabinet ministers and chief ministers in their 40s and 50s. Where most CEOs are grappling with issues every quarter and can at best draw up a 3-year plan, you've dared to look decades into the future to draw up a vision for Viksit Bharat 2047. If you have dreamt the impossible dream, you've also kept an eye on the ground realities. Swachh Bharat was a mission. Atmanirbharta, the need of the hour. Pariksha Pe Charcha, a way to bring mental health of children into mainstream conversations. Prime Minister, later this year, you will celebrate your 75th birthday with 140 crore Indians. This year is truly special in many ways. Not only are you leading the country for a third consecutive term, you're a global leader who's given the Global South a strong voice in a topsy-turvy world. You're perhaps the only leader who can pick up the phone and talk to both Putin and Zelensky. You can soften Xi Jinping on the one side and drive a hard bargain with the tariffing Don on the other. And sir, as I say this, I look to yet another milestone that will go down in the annals of history of this great nation. Next year, when we meet at Rising Bharat yet again, you will be completing a historic 25 years in governance without a break in service, and I dare say, without a holiday either. I often wonder what the 90-hour weekday fuss is all about. Somewhere between you turning 75 and your completing 25 years in office is the 100th anniversary of your alma mater, the Vat Vriksha, as you have called it, the Rashtriya Swayamsevak Sangh, or the RSS. This is where you cut your teeth, starting at the tender age of 8. Prime Minister, between 2025 and 2026, your many paths are crossing in some inexplicable, divinely ordained way. As you celebrate your 75th birthday, you can look back with a sense of great satisfaction at your years with the RSS, which eventually paved the way for your years in governance. Modi ji, हर बार अंत में मैं किसी कवि या शायर का सहारा लेते हुए आपको संबोधन के लिए आमंत्रित करता हूं, पर इस बार आपके 75 वर्षगांठ के कुछ महीने पहले मेरे दिल में आपके शब्द कुछ इस तरह गूंज रहे हैं। सितंबर 2016 में जब आपने मुझे अपना सबसे पहला इंटरव्यू दिया था, तो मैंने आपसे पूछा था कि इतिहास मोदी को कैसे याद करे। आपका जवाब मैं एक बार फिर सबके समक्ष रखना चाहता हूं।
भारत के इतिहास में नरेंद्र मोदी खुद को कहां पाते हैं?
जो इंसान वर्तमान में जीने का शौकीन हो, वो इतिहास की चिंता क्यों करे? और जीवन में कभी भी ऐसी गलती नहीं करनी चाहिए कि अपने लिए कुछ करें। देखिए, हमारे देश का दुर्भाग्य रहा है कि सरकारों ने भी अपनी छवि बनाने की भरपूर कोशिश की, राजनीतिक दलों ने भी अपनी छवि बनाने की भरपूर कोशिश की, शासन पर बैठे हुए लोगों ने भी अपनी छवि बनाने की भरपूर कोशिश की। काश अच्छा होता, अपनी छवि के बजाय हमने देश की छवि बनाने के लिए अपने आप को खपा दिया होता। 125 करोड़ देशवासी, ये इतिहास की अमर कथा है। उन 125 करोड़ देशवासियों में एक मोदी होगा, उससे ज़्यादा कुछ नहीं हो। ऐसी ही मोदी की पहचान हो, वो 125 करोड़ में खो गया हो, 125 करोड़ में लिप्त हो गया हो, इतिहास के किसी पन्ने पर नज़र ना आता हो। अगर ऐसी ज़िंदगी जी करके जाऊं, अपने आप को पूरी तरह खपा दूं, आहूत कर दूं, तो उससे बड़ा जीवन का आनंद क्या होगा? यही खुशी होगी।
Ladies and gentlemen, I give you the Prime Minister of India, Narendra Modi.
नमस्कार। आपने मुझे इस समिट के माध्यम से देश और दुनिया के सम्मानित अतिथियों से, आपके दर्शकों से जुड़ने का अवसर दिया है। मैं नेटवर्क 18 का आभार व्यक्त करता हूं। मुझे खुशी है कि आपने इस वर्ष की समिट को भारत के युवाओं की एस्पिरेशन से जोड़ा है।